Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. BISC Education.
In this class, we're going to be talking about cost and managerial accounting. So let's dive right in, and let's start with cost accounting. And as you probably know, the whole point of cost accounting, the objective of cost accounting, is to tell management what it costs to produce one single unit. We want an accounting system that accounts for the basic elements of production: direct material, direct labor, and factory overhead. We want to account for those basic elements of production in such a way that we're able to tell management what it costs to produce one single unit. And you know why management has to have that information. It's all about billing and control. If management doesn't know what it costs to produce a unit, they don't know what to bill for their work. They don't know how to value their inventories on the balance sheet. Remember, the inventories, work in process, finished goods, they have to be valued for the balance sheet. So the real issue in this discussion is billing and control. So let's get right into it. If you're a manufacturing company and you're trying to determine what it costs to produce one single unit, there are basically two ways to go. This is how cost accounting breaks down. If a factory is involved in special orders, if a factory does any sort of special orders, they're basically forced to use some sort of job order system. They're going to use some sort of job order approach. But if they're involved in any sort of mass production, any kind of mass production, it has to be some sort of process approach. So that's how it breaks down. Now we're going to begin our discussion with mass production and process costing. Now, follow me closely. If you get any kind of problem in the exam on process costing, remember there are three primary steps. There are three primary steps to breaking down any process problem. The steps are account for all units, calculate EFU, and unit costs. Those are the three steps. Account for all units, calculate EFU, and calculate unit cost. If you can do those three steps, you can break down any process problem they can throw at you. Now, before we start the steps, I have to warn you about one little wrinkle, and it's this. One thing that complicates process costing is that in process costing, we have to make a cost flow assumption. We have to. And there's only two. It's either going to be first in, first out, or weighted average. There's no third possibility. We're going to begin with weighted average. And I will say, that's what you're more likely to see in the exam. They ask weighted average more than they ask FIFO. We will talk about FIFO later, but make sure you get weighted average down because that's what you're more likely to see. Now, to get us into weighted average and to get us into these three steps, we're going to go right to a problem. I'd like you to go to your viewer's guide, and I want you to go to the problem, Joy Manufacturing. In your viewer's guide, you should have a big problem, takes up a whole page, Joy Manufacturing Company. Now, you'll notice at the top of Joy Manufacturing Company, we're given some information. We're told that Joy Manufacturing had 25,000 units in the beginning work in process January 1. Work in process represents partially completed goods, goods that they didn't have time to finish. There were 25,000 units in the beginning work in process, 35,000 units in the ending work in process. During the year, they started 80,000 new units into production, and during the year, they finished and transferred 65,000 units. Let's do step number one. The first of the three steps is to account for all units. What I'm suggesting is you've got to be able to take information like we have on the top and break it down and account for all units. And in your mind, I want you to think of accounting for all units as basically a two-column reconciliation. Let's start with the first column. In the first column, we're going to say that in the beginning work in process, there were 25,000 units. So they started the year with 25,000 partially completed units in beginning work in process. Then what happened? Then they started 80,000 new units into production. If you add that up, that gives you 105,000 units to account for. Now stop and think what that's telling you. Now you know how many units they were working on in the factory. We now know they were actually working on 105,000 units. Now once you have that, you basically sit back and ask yourself a question. Physically, logically, what can happen to units? Well, if I gave you time to think about it, I think you'd agree. There's only 3 physical things that can happen to units. You can either finish them, you can still be working on them, or you can ruin them. There's no fourth possibility. There's only 3 physical things that could happen to any unit you're working on. You can either finish it, you can still be working on it, or you can spoil it. And if that makes sense to you, what that does is set up your reconciliation column. Let's set it up. We're going to put down finished, how many units they finished, how many units are in the ending work in process, and how many units were lost, how many were spoiled. Now let's fill it in. And remember, we're trying to reconcile back to that 105,000 units. We know they were working on 105,000 units. So let's fill it in. Of that 105,000 units, how many were finished? Well, we're told they finished and transferred 65,000 units. So we're done with those. How many units are in the ending work in process? Well, notice there's 35,000 units in the ending work in process. Those are units we're still working on at the end of the period. We're not done with those. And I'm sure you notice that only adds up to 100,000 units. So we plug it in. They must have lost. They must have spoiled 5,000 units. And normally, what the exam will do is leave the spoilage blank. That's why it's good to have this first step. It's good to be able to account for all units because so often they will leave the spoilage blank, and if you know my 2-column reconciliation, you can plug the spoilage. But let me say this. They could leave any piece of information blank. True? They could leave the number of units in the beginning work in process blank. They could leave the number of units in the ending work in process blank. And if you know my 2-column reconciliation, you should be able to find it. That's what I'm telling you. The exam loves missing information. As I say, it's usually spoilage. But with my 2-column reconciliation, if any piece of information is missing, you should be able to find it. So try to remember that. If you're in the exam and you've got a process problem and something's missing, account for all units. You'll find it. Now let's go to step 2. The second step is to calculate EFU. EFU stands for equivalent finished units. Now let me say what we're going to do. In the second step, we're going to take their production and convert it into finished whole units. Now before I get into how we do the calculation, let me take a moment and make sure you understand the concept of whole unit equivalence. Works like this. If I were to tell you that there were 1 million units in this room, and then I tell you each one of them is 75% complete, that's equivalent to what? That's equivalent to having 750,000 units in this room that are finished. That's the thinking in this step that we're about to do. If there's 100,000 units in this room and each one is 87% complete, well, that's equivalent to having 87,000 units in this room that are finished. That's the thinking we have to go through. Now, what I'm going to show you next is the format for calculating EFU, equivalent finished units, under weighted average. Remember, we're starting with weighted average. We're assuming a weighted average cost flow. Now, one thing before I start, remember this. Normally, in a process problem, you're going to have to do a separate EFU calculation for raw material and a separate EFU calculation for labor and overhead. Why? Because the problem with mass production is that you could have units that are 36% complete in terms of material, but 28% complete in terms of labor and overhead. So you'd have no choice but to do a separate EFU for raw material and a separate EFU for labor and overhead. That's what you'd normally expect in the exam. As I say, you could have units that are 92% complete in terms of material, but 84% complete in terms of labor and overhead, so you'd have no choice. You'd have to do a separate EFU calculation for raw material and a separate EFU calculation for labor and overhead. That's what you would normally expect to have to do. One more thing about terminology before I show you the calculation. Remember, in the exam, labor and overhead are referred to together as your conversion costs. That's a term the exam uses all the time. Labor and overhead are referred to together as your conversion costs. Maybe I should ask you, what are your prime costs? Prime costs are direct material and direct labor. That's a prime cost. But conversion costs would be direct labor and factory overhead. So you know what I'm saying. I'm saying that normally in process costing, we're going to have to do a separate EFU calculation for raw material and a separate EFU calculation for conversion costs, labor and overhead. Let's do the EFU for material. Here's the format. If you're going to do the EFU for raw material under weighted average, the format is take the number of units that were finished. You want to take what they finished. How many units did they finish and transfer? And add to that what they did to the ending work in process. And you can stop right there. That's the format. It's the number of units that you finished. Take what they finished. And you're going to add to that what they did, what they accomplished to the ending work in process. So if we have the format down, now let's fill it in. In this problem, how many units were finished? Well, they finished and transferred 65,000 units. They finished and transferred 65,000 units. So we put that in. Now we're going to add to that what they did, what they accomplished to the ending work in process. Now look at the problem. How many units are in the ending work in process? Well, they tell us that there are 35,000 units in the ending work in process. Now if you look at the problem, look at the degree of completion. How complete is the ending work in process in terms of raw material? 50%. So that's 17,500 whole unit equivalents. If you add that up, the answer is 82,500 whole units. That's the EFU. That's how many equivalent whole units of raw material were produced this period under weighted average. Let's do labor and overhead, or conversion costs. We're going to follow the same format. For conversion costs, we're going to take the number of units that were finished, again, 65,000, and then we're going to add to that what they did, what they accomplished in the ending work in process. And again, there were 35,000 units in the ending work in process. If you look at the completion table, it says we got them 30% complete in terms of labor and overhead before we ran out of time. So that's another 10,500 whole unit equivalents. So we're going to add that up. The EFU for conversion costs would be 75,500 whole unit equivalents. The purpose of the step is to take the production and convert it into whole units, equivalent whole units. Now let's go to step 3. The third step is to calculate unit costs. And here, your best approach is to memorize a format. Let me show you the format. Under weighted average, to calculate unit costs, along the top line, you're going to take costs. Take the costs from the beginning work in process plus the current costs. Add it up, that'll give you a total. Then you're going to divide by EFU, divide by equivalent finished units, and that'll equal unit cost. So that's what you want along the top line. You're going to take costs from the beginning work in process, you're going to add the current production costs, and that'll give you a total, and then divide by EFU, equivalent finished units, and that'll give you unit cost. Now let's get the unit cost for material. Let's put material in. I'm sure you noticed the cost information. There was $95,000 of raw material in the beginning work in process. The current raw material costs were $400,000. So if you add that up, that's $495,000 of raw material in total. Now we're going to divide that by the number of equivalent whole units of material we produced this period. That was 82,500 units. And the unit cost for material comes out to $6. That's how you get the unit cost. That's how you'd get the unit cost for raw material. It's taking the material costs from the beginning work in process, that 95,000, plus the current raw material, 400,000, giving you a total. I think a total column is a good idea. It gets it organized. 495,000. That's the total material for this company for this period. We're going to divide by the number of whole units of material produced, 82,500, and the unit cost for raw material comes out to $6. Same thing with conversion costs. We're going to take the conversion costs in the beginning work in process, that 78,750, plus the current conversion costs, 110,000. That adds up to a total conversion cost of 188,750. Now it's a matter of dividing by the number of equivalent whole units of labor and overhead produced. Our EFU was 75,500 whole units, and the unit cost for conversion cost comes out to $2.50. If you add it up, your total unit cost comes out to $8.50. And while that is on the screen, if you look at that schedule, the unit cost schedule, it shows you why it's mass production. Remember, we use process costing when it's mass production, and you can sort of see mass production in that schedule. Do you see what we do in mass production? We keep track of all the costs for a department, divide by the number of equivalent whole units produced, and that tells you what each one costs because they're all the same. Every widget cost $8.50. Every gallon of solvent costs $8.50. You can sort of see the mass production in that third step. Now, I want to go back to our second step. Now, you know our second step is to calculate EFU, equivalent finished units. And you know now that normally we do a separate EFU calculation for raw material and a separate EFU calculation for conversion costs. And I want to go back to the EFU calculation that we make for raw material. Why? Because I want to warn you that sometimes in the exam, they can make different assumptions about when they add the material. For example, they could say, all the materials added at the beginning of the process. And you have to know what that means to your EFU calculation. Or they could say, all the materials added at the end of the process. And you have to know what that does to your EFU calculation. So let me use the same problem, Joy Manufacturing, and let's go back to the calculation we did before, just to refresh your memory. Here's what I did in this problem. In this problem, because of the way they presented it, I said, all right, EFU for material. I'm going to take the number of units they finished, 65,000, and add what they did to the ending work in process. Remember, there were 35,000 units in the ending work in process. Table said they got them 50% complete in terms of material before they ran out of time, so that was 17,500 whole unit equivalents. We added it up and we said, hey, the EFU for raw material comes out to 82,500 units. Now, I did it that way because they gave me the percent of completion. Now, I want to do the same problem. But what if they said this? Instead of giving me that 50%, telling me the material was 50% complete, what if they just said in the problem, all the materials added at the beginning? Now, what would you do? Well, you follow the same format. If they say all the materials added at the beginning, well, if you're in weighted average, it's the same format. You take the number of units that you finished and add what they did to the ending work in process. So let's fill it in. We know they finished and transferred 65,000 units. But now I look at it this way. If all the materials added at the beginning, that would mean those 35,000 units in the ending work in process must be 100% complete in terms of material, because I put it on immediately. The first thing I did in the process was add all the material. So those 35,000 units in the ending work in process must be 100% complete in terms of material. Add it up, the EFU for material would now be 100,000. It's not that it's difficult, but it's something you have to watch out for in the exam. Now let's do this. Same problem. What if they said all the materials added at the end? Let's work it out. Well, it's weighted average, so I follow the same format. I'm going to take the number of units they finished, and I'm going to add what they did to the ending work in process. Let's fill it in. I know that there were 65,000 units that they finished and transferred. But now how do I look at the bottom piece? Well, there were 35,000 units in the ending work in process. If we add all the material at the very end of the process, I have to assume there's 0% complete in terms of material. I have to assume there's no material till they're finished. Do you see the way you look at that? Those 35,000 units in the ending work in process must have no material because I put all the material on at the very end. That's my very last step. So if I'm still working on the units, there's 0 material in the ending work in process. So that means the EFU for material, if that's the assumption, just would be the 65,000 units. As I say, it's not that it's difficult, but always watch out for that in the exam when they start making different assumptions about when they add the material. Now, I want to make a couple points about spoilage. Notice when we accounted for all units, there were 5,000 lost units in this problem, in joy manufacturing. Let me say a couple of words about spoilage. Theoretically, there are 2 types of spoilage. There is normal spoilage, and there is abnormal spoilage. Let's talk about normal spoilage. Normal spoilage is inevitable. You know, a certain amount of spoilage is the natural result of trying to produce anything in this world, and there's nothing management can do about it. A certain amount of spoilage is inevitable. So what you normally do with this sort of spoilage, normal spoilage, generally speaking, you ignore it. Generally, you ignore it. Just ignore normal spoilage, generally speaking, and that has the effect of spreading the cost of the normal spoilage among the remaining surviving good units. And that makes a lot of sense when you just remember this. Normal spoilage is a product cost. Remember that for the exam. Normal spoilage is a product cost. Why? Because it ends up being part of the unit cost of all the good units, all the remaining surviving units. That's generally what you do with normal spoilage. Generally, you ignore it, and that has the effect of spreading the cost of the normal spoilage among the remaining good units. Think of normal spoilage as a product cost. Another point, if the exam is silent, you assume spoilage is normal. Notice in joy manufacturing, they never said anything about the spoilage. We had 5,000 lost units. Nothing was said about it. I assume it's normal spoilage. Generally, I ignore it. So notice when I did all my EFU calculations, I didn't worry about that spoilage. I know you might have been wondering about that. But when I did those EFU calculations, I ignored the spoilage because if they're silent, I assume it's normal spoilage, and generally, normal spoilage is ignored. You don't put it in the EFU calculation, generally speaking. Now, let me also mention rework costs. Once in a while, with spoilage, with normal spoilage, they will mention rework costs. In other words, you have some normal spoilage, and you incur costs to rework the units, and then they're okay. I'll just give you one quick point on it. If you see rework costs, just assume that rework costs would be charged to factory overhead. There's more than one way to handle it, but that's always safe. If you see rework costs, just assume they're charged to factory overhead, and then when you allocate some overhead to all the good units, notice it becomes a product cost. It becomes part of the unit cost of all the remaining surviving good units. Now let's talk about abnormal spoilage. Abnormal spoilage is a little different. Abnormal spoilage is management's fault. You know, it's spoilage that is management's fault. Somebody messed up. It's spoilage that should not have happened. 2 big things to remember about abnormal spoilage. Number 1, abnormal spoilage belongs in your EFU calculation. In other words, if there was abnormal spoilage in this problem, now the format for EFU would have 3 lines. It would be what I finished, plus what I did to the ending work in process, plus the abnormal spoilage. Abnormal spoilage is added to your equivalent finished units, by the way, for material, labor, and overhead. You know, for material and for conversion costs. So as I say, you see abnormal spoilage, now my format for weighted average would have 3 lines. What I finished, plus what I did to the ending work in process, plus the abnormal spoilage. So abnormal spoilage is always put in the EFU calculation for material and conversion costs. And then one more thing. What we finally do with abnormal spoilage is add up all the production costs related to the abnormal spoilage and show it as a loss on the income statement. It's a loss for the period. That's why the exam will say abnormal spoilage is a period cost. So that's the fundamental thing that you want to remember about spoilage. Normal spoilage is a product cost. Why? Because normal spoilage ends up being part of the unit cost of all the remaining surviving good units. Abnormal spoilage is a period cost. Why? Because it gets reported as a loss for the period. That is the essential difference. I'd like you to try some questions. And remember now, when you do questions, don't just wait for me to solve them. You've got to use this like you're in class. So when I ask you to do questions, the best thing to do is turn your tape off, do the questions, and then come back and go over them with me. But don't just wait for me to solve everything. The way you learn is by doing them yourself, and especially, even though it's frustrating, getting them wrong. I mean, get them wrong now so you won't get them wrong in the test. That's the theory of this thing. I've always said you learn more by getting questions wrong than maybe any other thing. So that people who try to avoid pain like that, we all want to avoid pain. But if you want to avoid that pain, you're not doing yourself any good. You know the phrase, no pain, no gain, and it's true in the CPA exam. I'd like you to turn your tape off and do 1, 2, and 3. Do the first 3 questions, and then we'll go over them. Let's do number 1 together. I'm sure you noticed in number 1 at the bottom they say that the cost flow assumption is weighted average. Of course, in the exam you'd circle that. You're always looking for that. In process costing, you have to make a cost flow assumption. It's either FIFO or weighted average, so you circle that. And notice they want the EFU, the equivalent finished units, for what? For labor and overhead, for conversion costs. So let me ask you something. If they want the EFU for conversion costs, how important is it that material's added at the beginning of the process? Notice that's in there. Doesn't matter at all. I'd only worry about at what point they add the material if I was doing the EFU for raw material. But if I'm doing the EFU for labor and overhead, it doesn't matter when we add the material. So that's just there to get you to read extra words. It's meaningless. Let's do the calculation. And of course, the key to this whole thing is get the format right down. In weighted average, we're going to take the number of units that they finished, and we're going to add what they accomplished, what they did, to the ending work in process. In this question, they finished and transferred 10,000 units. Now we're going to add to that what they accomplished in the ending work in process. Notice there are 4,000 units in the ending work in process. They say they got them 75% complete in terms of conversion cost. That's 3,000 whole unit equivalents. We add it up. The EFU for conversion cost is 13,000. And the answer is A. Let's do number 2. In number 2, again, the cost flow assumption is weighted average. You circle that. And notice what they want. They want cost per equivalent unit. They want my third step. If you're with me down to this point, I think you can see really what the key to process costing is in the CPA exam. You sort of have to sit there, if you get questions on process costing, and ask yourself 2 things. What's the cost flow assumption, weighted average, and what step do they want? You know, which of Bob's 3 steps are they asking me to do? Here they're asking for step 3, unit cost. Now you might remember the format. With the unit cost, I take costs from the beginning work in process, add the current period cost, gives me a total, divide by EFU equals unit cost. And if you know the format, you notice something. I have to do step 2 in order to solve step 3. Isn't that true? In order to get unit cost, step 3, I have to divide by EFU. So anytime they ask me for step 3, unit cost, I'm forced to do step 2 because in step 3 I divide by equivalent finished units. And very often in the exam they make you work backwards like that. So let's get the equivalent finished units. Now they're asking for the cost per unit for material, so let's get the EFU for material. We're going to take in weighted average the number of units they finished, and we're going to add to that what they did to the ending work in process. Well, in this question, they finished and transferred 42,500 units. We're going to add to that what they accomplished in the ending work in process. There are 12,500 units in the ending work in process. They must be 100% complete in terms of material. Why? Because we add all the material at the beginning of the process. Notice that's in there. So those 12,500 units must be 100% complete in terms of material. That's 12,500 whole unit equivalents added up. The EFU for raw material is 55,000 whole units. Now, Having done step 2, we can do step 3. Remember the format. We're going to take costs from the beginning work in process plus the current costs, gives me a total, divide by the EFU, gives me the unit cost. Let's get the unit cost for raw material. We're going to take the raw material cost from the beginning work in process, 5,500, add the current raw material, 18,000. That gives you a total of $23,500 of total material. Divide by the number of whole units of material they produced, 55,000. The unit cost for material, which is what they wanted, is 43 cents. And that gives you answer D. So don't be surprised if they make you do that. If they ask for step 3, you're forced to do step 2, because in step 3, you divide by EFU. That's why I say if you know the 3 steps, you're on your way. Now let's do question number 3. In question number 3, again, the cost flow assumption is weighted average. Now what do they want? They ask at the bottom how much conversion cost was transferred to the second department. In this question, we have 2 departments, and forming is the first of 2 stages. And they want to know what forming would send to the second department in terms of conversion costs. You got a lot to do here. First, let's get the equivalent finished units for labor and overhead, for conversion costs. So we're going to take the number of units they finished, add what they did to the ending work in process. We start with our format. Now in this question, they finished and transferred 7,000 units. We put that in. Now we're going to add to that what they did to the ending work in process. And I'm sure you noticed there's 2,500 units in the ending work in process. They got them 80% complete in terms of conversion costs, so that's 2,000 whole unit equivalents. And I know this is going to drive you crazy, but I have to put the abnormal spoilage in. Excuse me, I have to put the normal spoilage in. Earlier I said, you might remember, that generally speaking, normal spoilage is ignored. Remember that? I did say, generally speaking, we ignore normal spoilage. We don't put it in the EFU calculation, and that has the effect of spreading the normal spoilage among the remaining good units. It's a product cost. Why do I have to put the normal spoilage into this calculation? Because they went out of their way to say the spoilage is normal. Well, what's different in this question is a couple of things. In this question, forming is the first of 2 departments, and if you look in the first paragraph, they said, and you might want to underline this, this is what makes it different. They said cost of spoiled units are assigned to units completed and transferred to the second department in the period the spoilage is identified. That sentence tells me it's completely different. What they're going to do is keep track of spoilage in the first department, forming, send it to the second department, and more than likely, the second department's going to rework the units and salvage them somehow. That's why we're not just ignoring it. So that's what's different about this question. Forming is the first of 2 departments, and they said that the spoilage is going to be kept track of, sent to the second department, and as I say, what's going on here is the second department probably reworks the units and makes them so that they're salvageable. So in this case, even though the spoilage is normal, we're going to put those 500 units in. So the EFU, the equivalent finished units of conversion cost, is not 9,000, it's 9,500. The normal spoilage has to be in there. Now let's get the unit cost for labor and overhead, for conversion cost. We use our format. Step 3, we're going to take costs from the beginning work in process plus the current period costs, gives you a total, divide by EFU equals unit cost. Let's fill it in. We're going to take the conversion cost from the beginning work in process, 10,000, plus the current conversion cost, 75,500. That gives you a total of 85,500 of total conversion cost. Divide by the number of whole units produced, 9,500. The unit cost for labor and overhead for conversion costs is $9. Now I can solve it. What were the conversion costs sent to the second department? Well, how many finished units were sent to the second department? 7,000, right? And wasn't there $9 of labor and overhead on every one of those? So that's $63,000 of conversion costs sent to the second department. But I'm not done. We also transferred 500 spoiled units to the second department. Maybe they keep track of it. There's $9 of conversion cost on each one of those. That's another $4,500 of conversion cost. So you add it up, the total conversion costs we are sending to the second department, $67,500. So the answer is C. Now, so far, we've only been talking about weighted average. But once in a while, the exam does hit FIFO. Remember, in process costing, could be weighted average, could be FIFO. As I said earlier, they do ask weighted average more, that's true, but you don't want to ignore FIFO because it does come up. So let's go back to Joy Manufacturing, and now we're going to solve Joy Manufacturing under first in, first out. We're going to take the same problem, Joy Manufacturing in your viewer's guide, but change the cost flow assumption. Now we'll make it first in, first out. I don't care whether it's FIFO or weighted average, you're going to follow the same three steps. Account for all units, EFU, unit cost. Account for all units, EFU, unit cost. Let's account for all units. Well, I'm not going to make us do it again. Accounting for all units is done exactly the same way. I don't care whether it's FIFO or weighted average. Accounting for all units is always done exactly the same way. We're going to come up with 5,000 lost units. So that schedule would be no different at all. We won't even go through it again. And by the way, all the notes I gave you on spoilage would still be true. You know, normal spoilage is generally ignored. If the exam is silent, you assume it's normal. Abnormal spoilage is a period cost. All those notes I gave you on spoilage would still apply as well. Now let's go to step 2. This is where FIFO is different. The format for calculating EFU, equivalent finished units, is different under FIFO. Let me give it to you. Under FIFO, we're going to take the number of units they finished. We're going to add to that what they did, what they accomplished in the ending work in process. So notice you start the same way. Down to there, it's just like weighted average. But in FIFO, you have to do one more thing. In FIFO, you then have to subtract what was already done to the beginning work in process before you started. So it's a little different. So that's the format for FIFO. You take what they finished, add what they did to the ending work in process, just like weighted average, but then in FIFO, you've got to subtract what was already done to the beginning work in process before you started. Let's do Joy Manufacturing, and let's do the EFU for raw material. How would I do it under FIFO? I'll put it on the screen. Under FIFO, we're going to take the number of units they finished. Remember, that's 65,000. We're going to add to that what they did, what they accomplished in the ending work in process. Remember, there was 35,000 units in the ending work in process. Table says we got them 50% complete before we ran out of time. So remember, that was 17,500 whole unit equivalents. Now notice down to there, it's just like weighted average. But as I said, in FIFO, we do one more thing. We now have to subtract what was already done to the opening work in process before we began. There was 25,000 units in the beginning work in process January 1st. Table says we got those units 10% complete. They were already 10% complete before we started the year. That's 2,500 whole unit equivalents. We back that out. The EFU for FIFO for raw material is 80,000 whole units. Let's do labor and overhead or conversion costs. We'll follow the same format. Under FIFO, again, we take the number of units that were finished, 65,000. We're going to add to that what they did, what they accomplished in the ending work in process. There were 35,000 units in the ending work in process. Table said we got them 30% complete in terms of conversion cost, so that was 10,500 whole unit equivalents. And again, down to there, it's just like weighted average. But now in FIFO, we subtract what was already done to the opening work in process before we began. There were 25,000 units in the beginning work in process. January 1. They said they were already 20% complete in terms of conversion cost before we started. Back out 5,000 whole unit equivalents, and the EFU for labor and overhead for conversion costs under FIFO is 70,500 whole units. Now let's do step 3. It's a little different. In step 3, unit cost, notice in FIFO, we take current costs only. Don't pick up the costs in the beginning work in process. We're going to take current costs only. Divide by EFU equals unit cost. So let's work it out. We're going to take the current raw material cost. Again, don't pick up the costs in the beginning work in process. No, in FIFO, pick up just the current raw material costs, 400,000. Divide by the number of whole units of material produced, 80,000. The unit cost for raw material, $5 under FIFO. For conversion costs, we just pick up the 110,000 of labor and overhead incurred in the current period. Divide by the number of whole units produced, 70,500, the EFU for conversion cost. The unit cost for conversion cost, $1.56. Total unit cost, if you add it up, $6.56. I would like you to try a question on FIFO. I'd like you to turn your tape off, try number 4, and then come back. In number 4, the cost flow assumption is first in, first out, and we have to do the EFU for conversion cost. So my point is, in the test, first thing you do is put the format down. It's what we finished plus what we did to the ending work in process minus what was already done to the beginning work in process. So we start to fill it in. In this question, notice they finished and transferred 160,000 units. That's how many they finished. Now we're going to add to that what they accomplished, what they did in the ending work in process. There are 20,000 units in the ending work in process. They say they got them 40% complete in terms of conversion costs before they ran out of time. That's 8,000 whole unit equivalents. And as I said before, down to there, it's just like weighted average. But in FIFO, you've got to do one more thing. You've got to subtract what was already done to the beginning work in process before they started the period. Notice there were 10,000 units in the beginning work in process. They said they were already 60% complete in terms of conversion costs before they started. Back out 6,000 whole unit equivalents, and the answer is 162,000 whole units. The answer is B. Now, before we leave process costing, I want to deal with one more issue that does come up in a process costing system, and that is the issue of joint products and byproducts. I'm sure you've heard the terms before, and you know what they are. Joint products are 2 or more main products, 2 or more products that produce significant total revenue that are produced together in the same department. Those are joint products. 2 or more, could be 3, could be 5. 2 or more products that produce significant total revenue, material total revenue, and are processed together in the same department. They're processed jointly. A byproduct is a product of insignificant value, immaterial value, that is produced incidental to the production of a main product. So that's a byproduct. A byproduct is a product of immaterial, insignificant total revenue that is produced incidental to the production of a main product. Now, what the exam tests most often on this area is making sure that you know how to allocate joint costs. Remember, these are 2 or more main products processed together in the same department. So that department, those costs, called joint costs, have to somehow be allocated to the main products. And that's what they test you on. How do we allocate these joint processing costs to the main products, to the joint products? And what you have to know for the exam is the relative sales value method of allocating joint costs. Let's go right to a problem. We'll do this one together. I'd like you to go to question number 5. Question number 5 says, Alley Company produces main products K and J. The process also yields a byproduct B. And they say the net realizable value of the byproduct is subtracted from joint processing costs, K and J. The following information pertains to the production in July, and notice the joint cost in totaled $54,000. Might want to circle that. So our joint costs are $54,000. At the bottom it says, if Alley uses the net realizable value method of allocating joint costs, what were the joint costs allocated to product K? Now notice, you might want to underline the method. They said the net realizable value method. Now the exam kind of plays around with this wording. What they call the net realizable value method, they also sometimes call the relative sales value method, and sometimes they call it the relative sales value at split-off method. That's three ways of saying the same thing. The exam has just not been consistent. They'll call this the net realizable value method, they'll call it the relative sales value at split-off method, and sometimes they just call it the relative sales value method. Now to solve this, first we have to deal with the byproduct. They said that the net realizable value, the byproduct, is going to be subtracted from the joint costs. So let's work out the net realizable value, the byproduct. If you notice in the problem, the revenue we expect to yield from the byproduct is $9,000. We expect to yield $9,000 of revenue from product B, the byproduct. But to get that extra revenue, we incur some additional costs of $5,000. So what I expect to net out of that byproduct is $4,000. So what I have on the screen right now, that's how you get the net realizable value of a byproduct. It's the revenue you expect to yield from the byproduct minus any additional costs that you can trace to the byproduct. There could be additional processing costs for the byproduct, additional marketing costs, additional promotion costs, but that's what you do. To get the net realizable value of the byproduct, it's the revenue you expect to yield from the byproduct minus any additional costs that you can trace to that byproduct. Again, additional processing costs, additional production costs, and they gave me that at $5,000. So the net realizable value of the byproduct is $4,000. Now getting back to the question, what did they say that they do with that net realizable value? They use it to lower the joint costs. So I'm going to take the joint costs, $54,000. I'm going to back out the net realizable value of the byproduct, the $4,000 that we just calculated. That brings my joint cost down to $50,000. And let me just make a point that that's what they do most often in the exam. Most often in the exam, they will take the net realizable value of the byproduct and back it out of the joint costs. That's not the only way to handle byproducts, though. Some companies would treat that $4,000, the net realizable value of the byproduct, as other income. Some companies would treat that $4,000 as a reduction of cost of goods sold. Remember, a byproduct by definition is immaterial. So you're given a lot of latitude on how you handle byproducts because by definition they're insignificant, they're immaterial. But as I say, more often than not, the exam will use this method, and by the way, there's a name for this. This method we're using is called the net realizable value method of accounting for byproducts. If you see that phrase, the net realizable value method of accounting for byproducts, you're supposed to do what I've done here. Back out the net realizable value from the byproduct, back it out of joint costs. So now our joint costs are $50,000. Now let's apply the relative sales value method to our main products. Let's start with product K. Product K can be sold for $40,000. Notice there are no additional costs. There are no additional processing costs. By the way, if there were, you'd back them out. In this method, if they said that there were $1,000 of additional processing costs for K, you'd back out $1,000. Here, there are none, so I'll back out 0. So what they call the sales value at split-off for product K is $40,000. Now let's do J. J can be sold for $60,000. And again, there are no additional processing costs to finish J. And again, if there were, you would back them out. In this approach, you're supposed to subtract additional processing costs to get sales value at split-off. Well, the sales value at split-off for J would just be the $60,000. Now you add it up. My total sales value at split-off is $100,000. That's the total sales value that we produced this period. By the way, it doesn't matter how many units you sold. Sometimes the exam will throw that in. They actually sold this many units of K. They actually sold this many units of J. It doesn't matter. You're after the theoretical sales value of all the good units produced. So don't let them throw you off. They start telling you how many units were actually sold. You couldn't care less. What you want in this method is the theoretical sales value of all the good units produced. So the theoretical sales value, doesn't matter what I sold, the theoretical sales value of my main products, J and K, is 100,000. Now I strike a ratio. I say, since K makes up 40,000 over 100,000, 40% of the sales value it's split off, in this approach, K would get 40% of the joint costs, which remember are down to 50,000. 20,000 of joint costs would be allocated to product K. So the answer is C. Notice we are literally using relative sales values to allocate those joint processing costs. Now, we've covered process costing. Now let's get into job order costing. Remember, when a factory is involved in special orders, they're basically forced to use some sort of job order approach. And I think you see why. If every order is a special order, it's custom made, the only logical way to work out what that unit costs is to keep track of the material, the labor, and the overhead I put into that unit or that job. In other words, in a job order system, when we start a custom-made job, when we start a special order, we start a job order cost sheet or a job order cost card. And on that sheet, we simply keep track of the material, the labor, and the overhead we put into that unit or that job. Now, if you're with me on the basic approach, I'll say this. There's one big thing to remember about job order costing, and it's this. In job order costing, direct material and direct labor are charged to each job based on actual. Direct material and direct labor will be charged to each job based on actual, based on the actual amounts they incurred on the job. But overhead is different. Overhead gets applied to a job based on a predetermined rate. So overhead's handled a different way. Overhead gets applied to a job based on a predetermined rate. Let me illustrate. Let's say in a job order system, we're working on a custom-made job. We're working on a special order. And the actual material costs for that order, $48. That's how much raw material I put into that job. Here's my entry. I would debit work in process, $48, and I would credit material inventory, $48. Furthermore, let's say we've actually spent $99 of labor. We've actually spent $99 of labor on this job. That's the actual labor that we spent on this job. What's my entry? I would debit work in process, $99, and I'd credit wages payable, $99. Notice, direct material, direct labor, charged to work in process based on actual, based on the actual amounts you incurred on the job. Now follow what I do with on overhead. Overhead gets applied to jobs based on a predetermined rate. Let's say my predetermined rate for overhead in this problem is $8 per labor hour. And let's say they spent 9 hours on this job. I would take $9 times 9 hours of labor times my predetermined rate, which is $8 an hour. I'm going to apply $72 of overhead to this job. My entry, I'm going to debit work in process for $8, my predetermined rate, times the 9 hours I spent on the job, $72. And notice I credit overhead applied. See, in a factory like this, there's going to be an overhead applied account. Overhead applied has a credit balance. And what do we use it for? It keeps track of all the overhead we've estimated for jobs. That's why we have overhead applied. It's going to keep track of all the overhead we've estimated for jobs. Now, I'm not done. You know, ultimately, all we care about is actual costs. So I have to have a way to keep track of actual overhead. So let me give you an actual overhead cost. Let's say this factory goes out and buys $100 worth of supplies. Okay, this factory actually goes out and purchases $100 worth of supplies. Now, you know, supplies would be indirect material. It would be a factory overhead item. So what's my entry? I would debit stores control 100, and I would credit cash 100. Now, why stores control? Well, the reason stores control is used is because it's supplies. Presumably, they'd have some sort of inventory of supplies. That's why I'm debiting stores control. Because it's supplies, I'm assuming they'd have some sort of inventory of supplies. All right, now one more point. Now let's assume they actually send $25 worth of supplies to production. Okay, now they're actually sending $25 worth of supplies to work in process. What do? Debit Work in process? No. No. You're not listening carefully enough. No, you would never charge work in process with actual overhead costs. No, direct material, direct labor, charged to work in process based on actual amounts. Overhead gets applied based on a predetermined rate. So notice that with overhead, work in process is always charged for the estimate, for the predetermined rate. No, if I actually send $25 worth of supplies to production, I'm going to debit overhead control $25, and I'll credit stores control $25. See, in a factory like this, they have an overhead control account. Overhead control has a debit balance, and that's where we keep track of the actual overhead costs. My point is, you cannot go into that exam and not know the difference between overhead control versus overhead applied. Overhead control always has a debit balance. It's where we keep track of actual overhead costs. Overhead applied has a credit balance. It's where we keep track of all the overhead we've estimated for jobs with our predetermined rate. And of course, the difference in those two numbers, they're never going to come out the same. No matter how carefully you set up the system, at the end of the period, there's going to be a difference between overhead control, what you've actually spent on overhead items, overhead applied, all the overhead you've estimated, and that difference, that's your overhead variance, which we're going to talk about later in this class, just to give you something to look forward to. We'll be getting into overhead variances, but let's try a couple of these. I'd like you to stop your tape and try 6, 7, and 8, and then come back. Okay, let's do this set together. 6 says, in a job order system using predetermined factory overhead rates, indirect materials like supplies usually are recorded initially as an increase in, I'd circle the word initially. Where would something like indirect materials, like supplies, be recorded initially? Remember, initially, things like supplies go to stores control. The answer is D. And then as you use them, they go to overhead control. Remember, initially, they go to stores control. That's why the answer is D. Key word there is initially. And then as you use the supplies, it would go to overhead control. So be careful. Number 7, in a job order system, the use of direct, I'd circle the word direct. Now we're talking direct material, not indirect, not supplies. This is direct material. Previously purchased gets recorded where? Well, the answer is A. Remember, direct material, direct labor get charged to work in process based on actual. That just goes directly to work in process based on the actual amount you spent on the job. When they talk direct material, it goes right to work in process based on actual. That's why the answer is A. 8. In a traditional job order system, the issue of indirect, I'd circle the word issue and I'd circle the word indirect. You're issuing indirect material to production. Remember, as you actually issue something like supplies, when you issue indirect material to production, you debit overhead control and you credit stores control. Remember, initially it goes to stores control, but as you issue the supplies to production, that's when you debit overhead control, and the answer is C. Because in this question, you're actually issuing the indirect material to production. That's going to go to overhead control. Answer C. Now, notice they said in that question that we're talking about a traditional job order system. I want to say a couple of words about a just-in-time costing system. In a just-in-time cost accounting system, as much as we can, we try to eliminate something like storage. We try not to carry inventories of supplies. As much as possible, we try to eliminate something like storage. Why? Because storage does not add value to our product. Customers are not willing to pay for storage. Storage is what they call a non-value adding activity. So with a just-in-time system, we don't keep inventories of supplies. We order things like supplies just in time to use them. We don't have inventories. We don't have storage. We're going to order something like supplies just in time to use it. That's a just-in-time system. So the entries I gave you, these job order entries, would be a little different if this were a just-in-time system, we wouldn't have storage control. Now, don't get me wrong, we could still charge work in process for a predetermined rate for overhead. Overhead would be applied to jobs based on a predetermined rate. We'd estimate overhead for jobs, so you'd still debit work in process for the predetermined rate. You'd credit overhead applied. But then, when you go out and order supplies just in time to use them, you would debit overhead control and you would credit cash. When you order something just in time to use it, you would debit overhead control, so overhead control keeps track of the actual overhead costs, and you'd credit cash. Notice there's no storage control. You sort of take out that first entry where we went to storage control first. In a just-in-time system, you wouldn't have storage control. You'd order something like supplies just in time to use them, and you would debit overhead control and credit cash. Let me say a couple of words about activity-based costing, ABC costing. Now, in an activity-based costing system, what you're trying to do is come to grips with the fact that it's activities that consume costs. And here again, in an ABC, in an activity-based costing system, we want to try to eliminate, if we can, any non-value-adding activities. Activities that customers aren't willing to pay for. Activities that don't add value to our product. And as I say, the fact is that activities consume costs. So what we try to identify in an ABC costing system is appropriate cost drivers. What are the activities that really drive costs? So you try to identify appropriate cost drivers and trace them to your product. Something like, purchasing materials. What's the cost driver? Purchasing transactions. Purchasing transactions generate purchasing costs. What is the cost? What would be the cost driver for the repair cost? The cost driver is machine hours. That's the cost driver for the cost of repairs. Now, something to keep in mind. In an ABC system, direct materials are handled exactly the same way. Direct labor, handled exactly the same way. All that's different is trying to identify those activities that drive costs and eliminate as much as you can non-value-adding activities. Let's just do one question on this. We'll do question number 9 together. Number 9 says, in an activity-based costing system, cost reduction is accomplished by identifying and eliminating, first column is all cost drivers. No, you can't eliminate all cost drivers. You're going to have some. No, you're trying to eliminate non-value adding activities. The answer is C. The answer is no, yes. You're trying to eliminate activities that customers aren't willing to pay for. Activities that don't add value to the product. Now, another thing that comes up in cost accounting is sometimes in the exam, they will ask you to work out cost of goods sold for a manufacturing company. And I want to make sure you know how to do this. So we'll do a question together. Let's go to question number 10. Question 10 says, Baker, a manufacturer, had inventories at the beginning and end of its current year as follows. And they give us the opening balances and the closing balances for the 3 inventories: raw material, work in process, finished goods. It says during the year, the following costs and expenses were incurred. They give us a long list. And at the bottom, it says, what is Baker's cost of goods sold for the year? Now, what I'm going to show you on this is a little shortcut. If you've studied this before, you know that this is a very long schedule. It's got, if you do out the whole schedule, you get 3 sections: cost of materials used, cost of goods manufactured, cost of goods sold. And if you're not careful, a question like this can take 10 minutes. But what really shortens it is if you know a little shortcut. Here's the fast way to get the answer. If you're in the exam, you just want to get the answer. It's a multiple choice. No one's ever going to see your work. No one's going to see how you got the answer anyway. It's graded by a machine. So here's the fast way to get the answer. Start by adding up the beginning inventories. So we're just going to add them up. Add up 22,000 plus 40,000 plus 25,000. Notice all the beginning inventories, all 3, add up to 87,000. Now add in what happened in the current period. Current raw material purchases, $300,000. Current direct labor, $120,000. Now, overhead, they made you think about a little bit. Let's go through this list. Let's identify the factory overhead items. How about indirect labor in the factory? Yeah, put a check mark there. That's $60,000. Indirect labor in the factory, that's a factory overhead item. How about taxes and depreciation on the factory building? Yeah, just put a check mark by that 20. That depreciation on the factory, that's a factory overhead item. How about taxes and depreciation on the sales room and office? No, that's a selling expense. It belongs below gross profit. Put a no there. Same thing with salesman salaries. Same thing with office salaries. These are not factory overhead items. How about the utilities? Right, just the 60% that apply to the factory. Pick up the $30,000. So let me summarize. My total factory overhead, $60,000 of indirect labor in the factory, like supervisors, $20,000 of depreciation in the factory, and $30,000 of utilities. Total factory overhead, if you work it out, is $110,000. Now, if you add up all the numbers, that adds up to $617,000. Notice all I've done to this point is add. Now what do? I bet you guess. You subtract the total of all your ending inventories. So we're going to add up 30 plus 48 plus 18, subtract 96,000, the total of all your ending inventories, and you get 521,000. The answer is B, about as fast as a human being can do it. That's just a fast way to get that answer. Now, I got to warn you on this, same problem. Sometimes, instead of asking you for cost of goods sold, they'll ask you for cost of goods manufactured. Well, you can use the same shortcut. Be careful. Are they asking for cost of goods sold, which we just went over, or are they asking for cost of goods manufactured? You've got to be careful. If they want cost of goods manufactured, the same shortcut will work, but now you just deal with the first two inventories. Knock out finished goods. So let's do it. I'll add up beginning inventory of raw material and work in process. 22 plus 40, that adds up to 62,000. Then again, I add in the current costs. Current raw material purchases, 300,000. Current direct labor, 120. Current overhead, I'd have to still work out. Remember, it came out to 110,000. Add all that up, it adds up to 592,000. Now back out the total of the ending inventory just for raw material, work in process. Add up 30 plus 48, which is 78,000. And that would give you cost of goods manufactured, 514,000. So the same shortcut will work, just use the first two inventories. Don't put in the finished goods. Now, the next thing I want to get into in cost accounting is a standard cost accounting system. In a standard cost accounting system, what we're basically going to do is set up a budget where we put a standard amount of material, a standard amount of labor, and a standard amount of overhead into every unit we produce. That's why it's called standard costing. In other words, now all elements of production will be charged to a job based on a predetermined rate. I'm going to have a predetermined rate for raw material, or a standard amount of material we apply to every unit we produce. I'm going to have a predetermined rate for labor, or a standard amount of labor I apply to every unit I produce. And of course, a predetermined rate for factory overhead, or a standard amount of overhead I apply to every unit I produce. That's why they call it standard costing. Now, one thing to keep in mind as you go, if you see standard costing, in this area, standard means budget. You might want to even write that down somewhere. Standard equals budget. Anytime they talk about standard, they mean budget. So if I say you have a standard for material, you have a budget for material. So really use the words interchangeably. But they call it standard costing. Now you know why we're setting up these standards, why we're setting up these budgets. Because ultimately, we're going to compare budget to actual. We're going to compare standard to actual. And we're going to come up with these variances. The whole reason we do this is as a yardstick to measure performance by. The whole point is to judge management performance. And again, the way we judge management performance is with these variances. And that's what I want to go over next. We're going to go over the variances that you have to know for the exam, and we're going to go right to a problem. In your viewer's guide, you should take out the major problem, Armando Corporation. It takes up a full page. It's a full problem. Let's take a look at it. It says Armando Corporation manufactures a product with the following standard costs. Notice here are your standards. What standard mean? Budget. Here's your budget. Direct material, they put 20 standard yards into every unit they produce. $1.35 is the standard price per yard, so they're applying $27 of material to every unit they produce. Labor, they put 4 standard hours into every unit they produce. $9 is the standard rate per hour. They're applying $36 of labor every unit they produce. Notice their budget for overhead. They apply overhead at 5/6 of direct labor. Don't let that bother you. If you take 5/6 of 36, that's where they get the 30. That's all they're saying. Notice they put $36 of labor on every unit they produce. And if you apply overhead at 5/6 of labor, you take 5/6 of 36, you get that 30 they gave you. So they're putting $30 of overhead on every unit they produce. If you add it up, their total standard, their total budget for every unit is $27 of material, $36 of labor, $30 of overhead. The budget for every unit is $93. Then it says the standards are based on normal monthly production involving 2,400 direct labor hours or 600 units of production. Armando actually produced 500 units. Notice they produced under budget. The fixed factory overhead budget is $6,000. The variable overhead rate is $5 per direct labor hour, and then they give us the actual information. And at the bottom it says, prepare the following schedules for the month of July and indicate whether each variance is favorable or unfavorable. And you'll notice they're asking for 6 variances. And I'll tell you, these are the big 6. These are the 6 they ask for all the time. If they're going to get into variances, they'll probably ask it for these 6. Material price, material usage, labor rate, labor efficiency, and they want controllable and volume overhead variances. Now, I'll tell you that with variances, there are basically 2 ways to go. You can memorize formats, or you can take some shortcuts. And I know you're not going to like this, but I think you really have to know both. I think the best thing for the exam is to know the formats cold, and there aren't that many, so it's not as bad as you think. But I think the best thing, the safest thing for the exam is to know the formats cold, and then I'll go over the shortcuts too, because sometimes the shortcuts come in handy. What I'm trying to tell you in so many words is that different approaches help with different type of questions. Sometimes the formats, you really need them. The formats never let you down. But then sometimes the shortcut comes in handy. Let's start with the format. We're going to start the first one, the material price variance. And before I start it, just one little wrinkle. When I do the material price variance, notice they said based on purchases. And that tells me I'm going to base that price variance on all 18,000 yards they purchased, not the 9,500 yards they actually used. So that's what that's telling you. They want it based on purchases. So that tells you you've got to base the price variance on all 18,000 yards they purchased, not the 9,500 yards they actually used. And by the way, that's almost always the case. Usually, the exam wants you to calculate a price variance on all the gallons, all the yards, all the units purchased, not what was used. Now, I'm going to start with the format. What I'm going to give you now is the format for the material price variance. I'll put it on the screen. For the material price variance, it's A times A compared with A times S. And let me say what the letters mean. We're going to take the actual yards purchased times the actual price. Notice A times A. It's actual yards purchased times actual price. We're going to compare that with the actual yards purchased times the standard price. So it's A times A compared with A times S. And as you noticed on the screen, what's going to help is we can use the same format later when we do the labor rate variance. This one format's going to get you 2. It's going to get you the material price. It's also going to get you the labor rate variance. We'll do that later. Let's get the material price variance. Let's fill it in. We're going to take the actual yards they purchased, 18,000, times the actual price per yard, $1.35. If you multiply that out, that's $24,840 of material. We're going to take the 18,000 yards that we actually purchased times the actual price per yard, $1.38, that comes out to $24,840 in material. Now we're going to compare that with the 18,000 yards we actually purchased times the standard price we should have paid per yard, the budget, $1.35. That comes out to $24,300. What we have here is a $540 material price variance. Now, one thing I want to say, you never put a variance down without thinking right away, hey, is it favorable or unfavorable? This one is unfavorable, and this one's pretty obvious. Why is it unfavorable? Because you're over budget. You spent too much. But I'll give you a shortcut so that I hope you're never wrong on this. Just remember this. I'm hoping this will settle once and for all whether something's favorable or unfavorable, because some get tricky. This one's obvious. But just so you'll know, in every variance we do in this class, all of them, if the top number is higher than the bottom number, it's automatically unfavorable. That way it's quick, and hopefully you'll never get it wrong. In every one we do in this class, if the top number is higher than the bottom number, it's automatically unfavorable. If you ever see a bottom number higher than the top number, it's automatically favorable. That way it's quick, you never get it wrong. Another point, unfavorable variances are always debits. Favorable variances are always credits. Sometimes they get into that. So what are we now going to know for the rest of our natural lives? When you do a variance, if the top number is higher than the bottom number, what do you know? Automatically a debit. It's automatically unfavorable every time. If you ever see a bottom number higher than a top number, automatically a credit. Automatically favorable every single time. Now, what I've gone over so far is the format. What's the shortcut? What's the quick way to get this? I'm sure you see it. The other way to get the $540 is to focus on the 3 cents, right? That's the other way. Look, our budget said we were supposed to spend $1.35 a yard. We actually spent $1.38. Turns out we spent 3 cents more than budget. We were 3 cents over budget on every yard we purchased. So if you multiply that 3 cents times 18,000 yards, that'll give you $540 also. Sometimes that'll come in handy. Now let's do the second variance, the material usage variance. Let me give you the format. For the material usage variance, we're going to take the actual yards they used, not purchased, careful, that first A, actual yards used times standard price, compared with what? What's the first S? The standard yards they should have used. Think of should, it's an S. The standard yards they should have used times standard price. And that'll get it for you. And as you can see on the screen, what's going to help is that we're going to be able to use the same format later for labor efficiency as well. And we'll do that later. But let's get the material usage variance. We're going to take the actual yards they used, 9,500, times the standard price, $1.35. If you multiply that out, that comes out to $12,825. Now, we're going to compare that what? With the standard yards they should have used. Now, listen carefully. They're probably not going to give you this number. You have to know how to get this number. How do I get the standard yards they should have used? Well, look at the problem. How many units did they actually produce? If I were you, I'd circle it. Always a critical piece of information in a variance question. I'll say this to you right now. There are many variances you cannot do if you don't have that information. How many units did they actually produce? You're always looking for that in a variance question. In this case, 500. All right, they actually produced 500 units. Notice I don't use the 600. More students get caught on that. Don't use the 600, the standard units they normally make. I'm going to say something to you, and I hope it makes you feel better. This is going to make you feel better. That 600 units that they normally produce, that's not used in any variance. Does that help? Because a lot of students keep looking back at it. What do I do with that 600? What do I do with that 600? Nothing. It's not used in any variance. But in a variance question, it's always critical to know how many units were actually produced. So let's work it out. They made 500 units. That's how many they actually produced. Now look at your budget at the top of the problem. How many standard yards should be put into every unit? 20. So they should have used 500 times 20, 10,000 yards. That's the standard yards they should have used, 10,000. times the standard price of $1.35, that comes out to $13,500. What you have here is a material usage variance of $675, and it's automatically favorable, isn't it? It's automatically a credit. It's automatically favorable because the bottom number is higher than the top number. The minute you see the bottom number higher than the top number, you know it's automatically a credit. It's automatically favorable. Now, that's the format. What would be another way to get that one? What's the shortcut? Focus on the yards, right? Look at the yards. Our standards say, our budget says we should have used 10,000 yards. Well, we made 500 units. We only used 9,500 yards. Somewhere we saved 500 yards. That's the shortcut. If you take 500 yards saved times the standard price of $1.35, that would also give you $675. That's the other way to do it. Now, another variance they could ask, what's the total material variance? Make sure you know how to get this one. Well, I have a $540 unfavorable material price variance. That's a debit. I have a $675 favorable usage variance. That's a credit. My total material variance is $135 credit. Sometimes they ask for that one, and I hate you to miss that because it's an easy one. I've got a $540 unfavorable price. That's a debit. I've got a $675 favorable usage. That's a credit. My total material variance is $135 credit favorable. Just combine the two you have. Now let's do 3 and 4. We'll start with number 3, labor rate variance. Remember, the same format we use for material price, we now can use for labor rate variance. We're going to take A times A compared with A times S. You know, eventually you're going to memorize these formats. Now, if I'm going to use this for labor, what's it stand for? I bet you know. We're going to take the actual hours worked times actual price and compare that with actual hours worked times standard price. Let's fill it in. We're going to take the actual hours they worked, 2,100, times the actual rate per hour, $9.15. They actually spent $19,215 on labor. Now we're going to compare that with the actual hours they worked, 2,100, times the standard, the budget. What's the standard rate per hour? 9. That comes out to $18,900. What you have here is a $315 unfavorable. The top number is higher than the bottom number. It's a $315 unfavorable labor rate variance. Automatically unfavorable, automatically a debit because the top number is higher than the bottom number. We've got that one. And I'll bet you're getting better and better at this. What's the shortcut? Focus on the 15 cents, right? Hey, our budget says we should have paid $9 an hour. We paid $9.15. Turns out we spent 15 cents over budget for every hour we worked. And if you take 15 cents times 2,100 hours, that would also give you $3.15. And sometimes that comes in handy. Let's do the labor efficiency variance or the labor usage variance. Remember, the same format we use for material usage, we can use for labor usage or labor efficiency. A times S compared with S times S. But I know you're with me. If I'm going to use it for labor, what do the letters stand for? I'm going to take actual hours worked times standard price, right? That's the A times S. Actual hours worked times standard price compared with what? What's the first S? The standard hours they should have worked. I like the word should because it's an S. The standard hours they should have worked times standard price. Let's fill it in. We take the actual hours they worked, 2,100, times the actual price per hour. Times the standard price per hour, $9. And of course, we'll take now that $18,900 and compare it with the standard hours they should have worked times the standard price. Now, how do you get the standard price they should have worked? Remember, this is a number they're probably not going to give you. You have to know how to get it. Remember, go to the actual units they produced. We don't care the units they normally produce. We always judge management on what they actually did. We don't judge management on what they should have done. That's a very different issue. We judge management. These variances are all about telling management, did they do a good job or a bad job on those 500 units they actually produced. It isn't about what they normally produce. So let's take the 500 units they actually did produce. And if you look at the budget, how many standard hours should they put into every unit they produce? 4. So they should have worked 2,000 hours. That's the standard hours they should have worked for what they produced. 4 hours times 500 units, 2,000 hours. You multiply that 2,000 times the standard rate 9, that's 18,000. We have a $900 unfavorable, a debit, an unfavorable labor efficiency variance. Hey, top number's higher than the bottom number, automatically a debit, automatically unfavorable. How about the shortcut? We've done the format. What's the other way to get that one? I bet you see it. Focus on the hours, right? Didn't they waste 100 hours? Look, your budget says if you make 500 units, it ought to take 2,000 hours. Well, we made 500 units, but for some reason it took 2,100 hours. So somewhere along the line, we wasted 100 hours. And if you take 100 hours wasted times the standard rate 9, that'll also give you 900. What if they wanted the total labor variance? They ask for that sometimes. I hate you to miss it. Just combine the two you have. You've done the hard work. You've got a $315 unfavorable rate, that's a debit, a $900 unfavorable efficiency, that's a debit, total labor variance, 1,215 debit. Now let's get into the overhead variances. And if you go back to the problem, notice requirements 5 and 6. They want the controllable overhead variance and they want the volume overhead variance. You might want to just, for your own purposes, bracket 5 and 6 together, kind of write in there, two-way analysis. What they're asking for here is the two-way analysis of analyzing overhead. And I'll say this, I'd say maybe 50% of the time in the exam, they want the two-way analysis, and 50% of the time, they want the three-way analysis of analyzing overhead. Now, you know me, I'm going to cover both because you really have to be ready for both. So we're going to start by solving this problem, Armando, under the two-way analysis. Now, before we start, one more piece of advice. With overhead, don't take shortcuts. I think more often than not, they get you into trouble. With overhead, you should use a format. The format is the way to go. As I say, shortcuts, sometimes you'll sit in the exam and go, oh, if I take this plus this, I've got the volume variance. Almost always, they're trying to lead you down the path. I think you're always safer with a format. Let me show you my format for the two-way analysis. At the top, we put the actual overhead cost. Now, that's given. If you look in the actual cost information, they actually spent $16,650 on actual overhead items. That's what they actually spent on variable overhead items like supplies, fixed overhead items like depreciation. That's what they actually spent on overhead items. Now, at the bottom, we'll leave a space, and at the bottom, we put in the overhead applied to work in process. Now, we're going to do this together. You're going to have to be able to get this number. Again, more than likely, they're probably not going to give this to you. So how do you get the bottom number, which is overhead applied to work in process? Well, go back to the problem. Look at your budget at the top of the page. What's their predetermined rate for overhead? Aren't they applying $30 of overhead to every unit they produce? Look at that budget. We know that in the budget, they're applying $30 of overhead to every unit they produce. Now I ask you, how many units did they actually produce? 500. If you take 500 times 30, they must have applied $15,000 of overhead to work in process. Now, if you take the difference between what they spent, $16,650, and what they applied, $15,000, that $1,650 difference, that's called the total overhead variance. They didn't ask for that here, but they do very often. That $1,650 difference between what they spent and what they applied, that's called the total overhead variance. And you have to know how to get that one. By the way, that total overhead variance, it's unfavorable. Why? Because the top number is higher than the bottom number. That shortcut will always work for you because $16,650 is higher than $15,000. That $1,650 is automatically a debit. It's automatically unfavorable. And I'll tell you this, that's where that shortcut really helps out. A lot of people in the exam, with overhead, they get the numbers right, but they just aren't sure whether it's favorable or unfavorable. But This little shortcut just solves it for you. Hey, 16,650 is higher than 15,000. That 1,650, which again they call the total overhead variance, it's got to be a debit. It's got to be unfavorable. And again, they didn't ask for that here, but they do ask for that often. All right, now, to get the two-way analysis, let's go back to the format. I put what they spent at the top, what they applied at the bottom, and now in the middle, I want an overhead budget based on standard hours. If I do that in the middle, between what they spent and what they applied, if I put in an overhead budget based on standard hours, that'll give me what I need. So what I have to work on now is that middle line, the overhead budget based on standard hours. Now, first of all, what do I mean by standard hours? Make sure you know how to get this. How many units did they produce? Bob, I'm so sick of that question. Well, in a variance question, you've got to know it. Doesn't matter how many units they normally produce. It's how many units they actually produced, 500. Now, if you look at your budget, how many standard hours should they put into every unit? 4. So the standard hours they should have worked for what they accomplished, 2,000. I'm now going to do a budget for overhead based on those 2,000 standard hours. Now, if you look at the problem, what's their fixed budget? Notice the fixed budget is $6,000. Would that be any different depending on what hours you work? No. Remember, that's the nature of fixed costs. Fixed costs are fixed. They're set in amount. Fixed cost, that represents things like depreciation, property taxes. These costs do not rise and fall with activity. So presumably, if they worked 1 hour, their fixed budget would be $6,000. If they worked 4,000 hours, their fixed budget would be $6,000, because that's the nature of fixed costs. They're fixed. They're set in amount. Again, that's $6,000 of depreciation, property taxes, insurance. That's the nature of fixed costs. They're set in amount. What you always have to be careful about is the variable budget. If you go back to the problem, notice their variable budget, the variable overhead rate is $5 per direct labor hour. See, that's telling you every time they work a direct labor hour, what happens? Every time they work a direct labor hour, of course, they incur more labor. That's obvious. But over and above labor, they incur another $5 of variable overhead items. Things like supplies, oil for the machines. So follow what I do. I'm going to take that $5, the variable rate for overhead, $5 times the standard hours they should have worked, 2,000. The variable overhead budget is 10,000. A budget based on standard hours is 16,000. And while I've got that on the screen, you can see how overhead always breaks down. You got to get used to this about overhead. Overhead always has two components. There's always a fixed budget, which represents things like depreciation, property taxes, and there's always a variable budget, which represents things like supplies, oil for the machines. And as I say, it's that variable budget you've got to be careful about. They said every time they work an hour, they incur another $5 of purely variable overhead. So I take the $5 times the 2,000 hours they should have worked. The variable budget should have been 10,000. The fixed budget should have stayed 6,000. A budget based on standard hours comes out to 16,000. Now let's go back to our two-way analysis and let's put it in. I take that 16,000 that I just calculated. Let's go back to our format. Remember, I have the actual overhead cost at the top, 16,650. At the bottom, I have what they applied, 15,000. We went over how you get that number. $30 a unit times 500 units. And we know the total overhead variance is 1,650, unfavorable. We've got that. Now that budget based on standard hours, I put in the middle. That 16,000 that I just calculated, that goes in the middle. Now I've got it. The difference between what they spent, 16,650, and the budget based on standard hours, 16,000, that's called the overhead controllable variance. And of course, it's unfavorable. Why? Because the 16,650 is higher than the 16,000. If the top number is higher than the bottom number, it's automatically a debit. It's automatically unfavorable. Now let's go back to the schedule. The difference between the budget based on standard hours, 16,000, and what they applied, 15,000. That $1,000 difference, that's called overhead volume variance or overhead capacity variance. The exam uses both terms, overhead volume variance or overhead capacity variance. And of course, that's unfavorable because the 16,000 is higher than the 15,000. Never let you down. It's a debit. It's unfavorable. So that answers requirement 5 and 6. The answer to 5, requirement 5, 650, unfavorable. The answer to 6, 1,000, unfavorable. Let me make a couple points about the volume variance. A volume variance or a capacity variance represents purely fixed costs. A volume variance always represents purely fixed costs. You get a volume variance because you either produced over normal and you over applied your fixed overhead, or like in this problem, you produced under normal. Normally they produce 600 units. Here they produce 500. You produce under normal, so you under apply your fixed overhead. That's why you get a volume variance. You either produce over normal, so you over apply your fixed factory overhead, or you produce under normal and you under apply your fixed factory overhead. In other words, volume variances are caused by volume of production, and volume of production is not necessarily under the control of management, because volume of production can be affected by outside factors. A downturn in the economy, a change in the interest rates, increased competition. Volume variances are caused by volume of production, and volume of production is not necessarily within the control of management, because volume of production can be affected by a recession, increased competition, a change in interest rates. Now, the controllable variance is made up of fixed and variable costs. It's fixed and variable. The controllable variance is made up of a spending problem and an efficiency problem. And theoretically, spending and efficiency are under the control of management. So that's what the controllable variance is all about. It's got a fixed cost component and a variable cost component, and even though it's made up of fixed and variable costs, it is caused by spending and efficiency. And spending and efficiency are theoretically within the control of management. So you see what the two-way analysis does. The two-way analysis says, look, your total problem with overhead, 1,650, we try to break it up into what management can control, 650, and what's outside the control of management, the 1,000. That's what the two-way analysis is all about. What is controllable by management and what's not management's fault. Now let's take the same problem and solve it under the three-way analysis. As I said, about half the time in the exam, they want the two-way analysis, and about half the time in the exam, they want the three-way analysis. Now let's solve the same problem under the three-way analysis. Now, you know what's nice? What's nice is if they want the three-way analysis, you use the same format I gave you, but you add one more thing. You're going to take the same exact format, but now you have to add an overhead budget based on actual hours, based on the actual hours they work. Go back to the problem. How many actual hours did they work? 2,100. They didn't work 2,000 standard hours. Remember they wasted 100 hours? Remember that? They wasted 100 hours. They didn't work 2,000 standard hours. They actually worked 2,100 hours. Now we're going to do a flexible budget for factory overhead based on the 2,100 hours they actually worked. I'll put it on the screen. Remember, a budget for overhead always has two parts. There's a fixed budget, which represents things like depreciation, and there's a variable budget, which represents things like supplies. What would the fixed budget be? That's right, 6,000. That's not going to change. Fixed is fixed. It's set in amount. This budget does not rise and fall with hours. If they worked 1 hour, presumably their fixed budget would be 6,000. If they worked 10,000 hours, presumably their fixed budget would be about $6,000. What you always have to be careful about is the variable budget. They said every time they work an hour, they incur another $5 of variable overhead. So we're going to take the $5 variable rate times the 2,100 hours they actually worked. The variable budget should be 10,500. The fixed budget, 6,000. A budget based on actual hours comes out to 16,500. Now we can do the three-way analysis. Let's start again. At the top of the page, we put the actual overhead costs, what they actually spent, 16,650. Then we leave a space. At the bottom, we put in what they applied. The overhead applied to work in process, $15,000. And here again, the difference between what they spent and what they applied, that $1,650, that's called the total overhead variance. And you know it's unfavorable. And as I say, I like to give you that because they ask for that one a lot. Now what do I put in next? I still put in the budget based on standard hours. The same $16,000 I did before. I still need that. I've got to put in that $16,000, that budget based on standard hours. And then I add the budget based on actual hours as well. But I've got to put in that budget based on standard hours, that $16,000. Notice the volume variance stays the same. I put it that same $16,000 I worked on before. The budget based on the standard hours they should have worked. I still need that. I put that $16,000 in. So notice, when I go from the two-way analysis to the three-way analysis, the volume variance stays the same. It's still $1,000 unfavorable. See what the three-way analysis does. The three-way takes the controllable and divides it up into two, into its spending problem and its efficiency problem. And the way you do that, let's go back to the schedule. Now we put in the budget based on actual hours. That's $16,500. Now I have what I need. The difference between what they spent, $16,650, and a budget based on actual hours, $16,500, that $150 difference, that's called the overhead spending variance. And of course, it's unfavorable because $16,650 is higher than $16,500. It never misses. Top number is higher than the next number down. It's a debit. It's unfavorable. Finally, the difference between the budget based on actual hours, $16,500, and the budget based on standard hours, $16,000, that $500 difference, that's called overhead efficiency variance. And of course, that's unfavorable because $16,500 is higher than $16,000. Never let you down. So you see what they mean by the three-way analysis. When they want the three-way analysis, they want overhead spending, overhead efficiency, overhead volume. What's the two-way analysis? Controllable and volume. What's the three-way analysis? Spending, efficiency, volume. So anytime the exam mentions the three-way analysis, that's what they're looking for. They're looking for overhead spending, overhead efficiency, overhead volume. That's the three-way analysis. Overhead spending, overhead efficiency, overhead volume, variance. Now there is a four-way analysis. Now, if they want the four-way analysis, which the exam has asked for, use the same basic format. At the top of the page, put their actual overhead costs, $16,650. They have to give that to you. Leave a good amount of space at the bottom. Put in the overhead applied to work in process. We know that's $15,000. And as always, the difference between what they spent, $16,650, and what they applied, $15,000, that $1,650, that's called the total overhead variance or the net overhead variance. Unfavorable. We got that. Then you put in a budget based on standard hours. That's $16,000. So the volume variance stays the same. Difference between the budget based on standard hours, $16,000, and what was applied, $15,000. Overhead volume variance, $1,000, unfavorable. That hasn't changed. Then I put in a budget based on actual hours, $16,500. We've got that. Notice the efficiency variance stays the same. That's the difference between the budget based on actual hours, $16,500, and a budget based on standard hours, $16,000. So notice when you go from the three-way analysis to the four-way analysis, volume variance stays the same, efficiency variance stays the same. What's different in the four-way analysis is that in the four-way analysis, they take the spending variance and divide it into two. You have to come up with a fixed spending variance and a variable spending variance. And the only way to do the four-way analysis is they have to break down that $16,650. What they actually spent on overhead costs, that $16,650. They have to tell you how much they spent on fixed items, how much they spent on variable. That was not given in the Armando problem. But let me just make it up. Let's say the $16,650 broke out this way. Let's say they spent $6,200 on fixed items, $10,450 on variable items. And again, the exam would have to give you that. So let's say that's how the $16,650 broke down. They spent $6,200 on fixed items, $10,450 on variable items. Well, now you can do it. They spent $6,200 on fixed items, depreciation and so forth, on the factory. What was their fixed budget at any level? $6,000. Don't forget their fixed budget was $6,000 at any level. So they have a $200 unfavorable. Top number is higher than the bottom number. They spent too much. They have a $200 unfavorable fixed spending variance. Now, how about the variable spending variance? Well, they actually spent $10,450 on variable items. What should they have spent? Well, they worked 2,100 hours. Every time they work an hour, they're supposed to incur $5 of variable factory overhead. Take $5 times 2,100 hours. They should have spent $10,500. They spent $10,450. They have a $50 favorable variable spending variance. So there's your four-way analysis. You have a $200 unfavorable fixed spending variance, a $50 favorable variable spending variance, $500 unfavorable efficiency variance, $1,000 unfavorable volume variance, and notice all the variances combined get back to the net, the $1,650 unfavorable. You can actually give 5 overhead variances: fixed spending, variable spending, efficiency, volume, and net. You got 5 overhead variances. Let's try some questions on this. I'd like you to stop your tape, try 11 to 14. Do 11, 12, 13, and 14. Come back, and we'll go through them. Okay, let's do number 11 together. I wanted you to do one like number 11 because I know these bother people in the exam. If you go to the bottom, it says, what was the actual price per unit? And maybe you have to actually be in the test to know what I mean, but people go to the exam, and if they've studied, they're all ready for variances. And you get there, they don't want the variance. They gave you that. No, they want something else. They want the actual purchase price per unit. I think of these as missing information questions. What's missing is we don't know the actual purchase price per unit. So I want to give you an approach to these, which I will tell you right now is absolutely foolproof. If you get one of these, a missing information question that's a variance, the key to the whole thing is to right away put down the format of the variance they give you. So I'm saying right away in your exam booklet, you would put it right away. You've memorized it. By the time the exam comes, you'll have these formats memorized. I know you don't yet, but you will. You'll get them down. So let's use them. You've got these formats. Use them. Now, what variance was given here? The variance they gave you was the material price variance. Remember, that's A times A compared with A times S. And like I say, by the time the exam comes, you'll have it memorized. So in your exam book, you'd write that down. A times A compared with A times S. Now what do? Fill it in as far as you can. Do we know the actual number of units they purchased? Yes, 1,600. Put that down. I know that. Do I know the actual price per unit? No, that's what's missing. But I do know at the bottom, I know the actual units they purchased, 1,600. And I know the standard price, right? The standard price is the $3.60. And of course, you've got a calculator in the exam. It's no big deal. You multiply 1,600 times 360. That comes out to 5,760. But I say the key to the whole thing is we know the variance. Didn't they say the variance was $240 favorable? Didn't they say that? So I ask you, if the variance is $240 favorable, what does the top number have to be? Does the top number have to be higher or lower than 5,760? It has to be lower, right? Because if it's favorable, the bottom number is $240 higher than the top number. So the top number has to be, just put it in, 5,520. And now you just sit there in the exam with your little calculator and you divide 5,520 by 1,600, and the answer is C, $3.45. It is absolutely foolproof. Let's do another one. Same idea. Number 12. They're asking for the actual hours that were worked. They gave us the labor efficiency variance. They don't want the variance. They want to know the actual hours that were worked. That's what's missing. So I say, oh, you're in the exam. They give you this. Put down the format of the variance that's given. Remember, what's the format for labor efficiency? It's just the same as material usage. It's A times S compared with S times S. Just get that down right in your exam booklet. A times S compared with S times S. Now let's fill it in as far as we can. Do we know the standard price, the budgeted price per hour? We do, $6. We can put that in under both S's, can't we? We know the budgeted price per hour is $6. And they did give me the standard hours they should have worked. That helps a little bit, that 1,500. Didn't they give me the standard hours they should have worked for what they did? 1,500. So you multiply 1,500 times 6, it comes out to 9,000. And I still say the key to the whole thing is they told us the variance. It's $600 unfavorable. Well, if the variance, labor efficiency, is $600 unfavorable, what does the top number have to be? It's got to be 9,600. The top number must be $600 higher than the bottom number. So the top number must be 9,600. Now you just sit there with your little calculator, you divide 9,600 by 6. The actual hours they worked must have been 1,600, and the answer is D. Now in 13 and 14, I'm sure you noticed that Beth uses the two-way analysis of analyzing overhead. So if you were in this exam, the first thing you do is put down the format for the two-way analysis. And again, I know you haven't memorized it yet, but you will have. So you'd put that down. Remember, at the top of the page, you put the actual overhead costs. Then you leave some space. At the bottom, you put in the overhead applied to work in process. And remember, in the two-way analysis, what you want in the middle is an overhead budget based on standard hours. That's what goes in the middle. Now look at those three lines. Think, they gave us enough information in the set to figure out which of those three lines. That's right, the budget. Didn't they give you all the budget information? So right away, let's work on the budget based on standard hours. Didn't they say the fixed budget was $50,000 at any level? And then they said the variable overhead budget for the standard hours allowed was $72,000. So you've got it. The budget based on standard hours is $122,000. Really, all you had to do to solve this set was get the budget done, $122,000. Now let's put in the rest of what we know. Don't we know that the controllable variance it's given is $1,000 unfavorable? Well, that was given to us. If controllable is $1,000 unfavorable, then they must have actually spent $123,000 because the top number must be $1,000 higher than the next number down. So the answer to 13 is D. We've got that. And if the volume variance is $500 unfavorable, if the volume variance is $500 favorable, that's given in the question, that means the bottom number must be $500 higher than the next number up. They must have applied $122,500. So the answer to 14 is C. I hope you've noticed something. I hope you've noticed how powerful it is with variances if you know two things. If you know formats plus what? Top number higher than bottom number unfavorable, bottom number higher than top number favorable. It is amazing how many variance questions you can do if you just know those two things. Got the formats down, and you also know top number higher than bottom number is unfavorable, bottom number higher than top number is favorable. It'll really help you in that exam. Now, we've been talking about fixed and variable costs, and I know you know what they are. A variable cost, of course, when we have a cost that's purely variable, the amount of cost incurred is directly related to the number of units we produce or the number of hours we work, right? That's the definition of a variable cost. When a cost is purely variable, the amount of cost we incur is directly related to the number of units we produced or the number of hours we work. So, of course, direct material, direct labor, those are purely variable costs. Now, a fixed cost is a cost that is set in amount. We're going to incur the same amount of cost. It doesn't matter how many hours we work or how many units we produce within a relevant range. You know, within a reasonable range of activity, some costs stay fixed. Doesn't matter how many hours we work within that range. Doesn't matter how many units we produce within that range. Some costs stay fixed. They're set in amount. Well, I brought this up because sometimes in the exam, they'll give you a mixed cost, a cost that's considered partly variable, and partly fixed. And what you have to know for the exam is the high-low method of breaking down a mixed cost. Let's do a set together. I'd like you to go to 15 and 16. They say 15 and 16 are based on the following information. Maintenance expenses of a company are to be analyzed for purposes of constructing a flexible budget. Examination of past records disclose the following cost and volume measures. Now you'll notice when this company works 32,000 hours, they spend $39,200 on maintenance. But when they work 15,000 hours, they only spend $24,000 on maintenance. Then they say, using the high-low method of analysis, what's the estimated variable cost per machine hour? Here's how you solve it. By the way, always start with the variable part. We're going to do the fixed part second. But in the high-low method, always start with the variable part. I'm going to take this information right out of the schedule they gave me. They said that when they work 24,000 hours, they spend $39,200 on maintenance. But when they work 15,000 machine hours, they spend $32,000 on maintenance. Now listen carefully. The secret to the high-low method is to take the change in cost and divide by the change in production. That's the key to the whole thing. You take the change in cost and you divide by the change in production. So to summarize, when machine hours went up 9,000, maintenance went up $7,200. You take the change in cost and you divide by the change in activity. And the fact is, when machine hours went up 9,000, maintenance went up 7,200. So 80 cents every hour must be purely variable. See what you're doing with that formula. When you take the change in cost and divide by the change in activity, you are isolating the variable part of the cost. It's got to be 80 cents an hour. So we've answered number 15. The answer to 15 is C. We've got the first part. All right, now 16 says, using the high-low technique, what is the estimated annual, I'd circle that word, what's the annual fixed cost for maintenance? All right, now how do we get that? Well, my point is, once you have the variable part, you can plug the fixed. Now, how do you get the fixed? To get the fixed, you have to focus on one of the levels of activity they gave you in the problem. It doesn't matter which one you use, you get the same answer. I'll start with 24,000 hours, and I'll put it on the screen. What do we now know happens at 24,000 hours? Well, we now know at 24,000 hours, 80 cents every hour is purely variable maintenance. So if you multiply that out, at that level, they spend $19,200 on purely variable maintenance. Well, what's fixed? It's got to be 20,000. Why? Why is fixed 20,000? Because that gets you back to the 39,200 they spent on maintenance at that level. So you can plug the fixed. Now, just to show you, it comes out either way. What if I had used 15,000 hours? You wouldn't do this because it's going to come out either way. But just to show you, it doesn't matter which one you use. At 15,000 hours, we now know 80 cents every hour is purely variable maintenance. So you multiply that out. At that level, we're spending 12,000 on variable maintenance. Well, 20,000's got to be fixed. Plug it right in. That gets you back to the 32,000 they spent on maintenance at that level. Now be careful. What's the 20,000? Monthly fixed maintenance. It's easy to lose sight of the fact, in the heat of the exam, you can lose sight of the fact that everything in this question is a monthly number. These are all monthly numbers. So that 20,000 is monthly fixed. If you want annual, you multiply by 12, it's 240,000. And the answer is B. Answer is B. And I'll just warn you, they do that a lot. That's something you have to watch out for in the exam. They give you monthly numbers, and then they ask for an annual figure. And all it means is you got to multiply by 12, and that's not difficult, but you got to notice it. So it's 240,000, answer B. I'd like you to try one of these. I'd like you to stop your tape, try number 17, and then we'll go over it. Let's do number 17. At the bottom they're saying, what does it really cost Matt to handle 75,000 kilos? So let's work it out. I'm sure you noticed when Matt handles 60,000 kilos, Matt spends $132,000 on handling costs. But when Matt handles 80,000 kilos, Matt spends $160,000 on handling costs. Remember, the secret to the high-low method is to take the change in cost and divide by the change in activity. So let's do that. What you had to notice is that when the kilos went up 20,000, handling costs went up 28,000. When kilos went from 60,000 to 80,000, when kilos went up 20,000, handling costs went up $28,000. The only thing that explains that, if you divide it out, is that $1.40 every kilo must be purely variable handling costs. Now, what's your next step? Do you know? Get the fixed. Now, how do you get the fixed part? Remember, the way you get the fixed part, and again, always do the variable first. Once you have the variable part of a cost, then you can plug the fixed. The way you get the fixed is zero in on any level of activity they gave you. Doesn't matter which one you use, you get the same answer. I'll use 80,000 kilos. What do we now know happens at 80,000 kilos? At 80,000 kilos, we now know that $1.40 every kilo is purely variable handling. So you multiply that out. At that level, Matt spends $112,000 on variable handling. What's fixed? We plug it in. Has to be $48,000 because that gets you back to the $160,000 they spent on handling costs at that level. Now we can solve it. What does it really cost Matt to handle 75,000 kilos? And by the way, we don't even want to think about what business Matt is in. And you got to wonder whether drug dealers really do this kind of sophisticated analysis. What does it cost Matt to really handle 75,000 kilos? Well, we now know that $1.40 every kilo is purely handling costs. So you multiply 75,000 times $1.40. At that level, Matt spends $105,000 on variable handling. What's fixed? That's right, $48,000. Fixed is fixed. It's set in amount. It's not going to fluctuate with how many kilos Matt handles. That gives you $153,000. And the answer is B. What we're going to do next is move on to managerial accounting. But let me just say one last thing about cost accounting, and that is that I want you to be aware that all through our discussion on cost accounting, what we've been talking about is what they call absorption costing. Absorption costing is what you're taught in any cost accounting course. And let me define that. Under absorption costing, the units that you produce absorb all manufacturing costs, both the variable and also the fixed. That's what we mean by absorption costing, that the units we produce absorb all manufacturing costs, both the variable and also the fixed. In other words, in absorption costing, both the variable and the fixed manufacturing costs are considered part of unit cost. Both the variable and the fixed manufacturing costs are considered inventoriable. They find their way to inventory. And as I say, all through cost accounting, what you're dealing with is absorption costing. Absorption costing is generally accepted accounting principles. But when you get into managerial accounting introduces another method of costing units. It's called direct costing or variable costing. Let me define it. Under direct costing, only the variable manufacturing costs are considered part of unit cost. Only the variable manufacturing costs are considered inventoriable. They find their way to inventory. That's what we mean by direct costing. Under direct costing, only the variable manufacturing costs are considered part of unit cost. Only the variable manufacturing costs find their way to inventory. Now, the fixed manufacturing costs in direct costing. What are fixed manufacturing costs? Depreciation in the factory, insurance on the factory. In direct costing, the fixed manufacturing costs will be treated as a period expenditure, not a product cost. The fixed manufacturing costs will be treated as an expense of the period, not a product cost. That's the essential difference. Now, to make sure you understand the difference between the two approaches, we're going to do a comparison. If you look in your viewer's guide, there is a direct costing comparison sheet, and I want to take a look at it. Notice on that page we have some information, and we've set up a column for absorption, we've set up a column for direct. Together, let's work out the inventoriable unit cost under absorption costing, and then we'll take the same information and work out the inventoriable unit cost under direct costing. But let's do absorption costing first. First information, direct material. They put 5 pounds of direct material into every unit they produce at $2 a pound. I think you know that $10 would be part of unit cost under absorption costing. Same thing with labor. They put 4 hours of direct labor into every unit they produce at $2.50 an hour. You know that $10 will be part of unit cost under absorption. Now, how about overhead? Remember we said that overhead is always split into two parts. There's a fixed part of overhead, which represents things like depreciation, property taxes, but there's always a variable part of overhead, which represents things like supplies, oil for the machines. Overhead is always made up of those two components. There's a fixed part of overhead, which represents things like depreciation, and there's a variable part of overhead that represents things like supplies in the factory. And the exam will break it out for you. And notice that the fixed factory overhead is applied at, the variable factory overhead, the next item, is applied at 50 cents per direct labor hour. And if you take that 50 cents times the 4 hours they spend on the unit, you know that $2 is part of unit cost under absorption. The fixed factory overhead is applied at $1 per direct labor hour. If you take that $1 times the 4 hours they spend on a unit, that comes out to $4. And yes, that belongs as part of unit cost under absorption because in absorption costing, the units you produce absorb all manufacturing costs, both the variable and also the fixed. So we put that in there. How about variable selling? We put that in there? No, put a no there. It's not a manufacturing cost. It's not an inventoriable item. That's a no. And of course, same thing with fixed selling. No, it's not a manufacturing cost. It's not an inventoriable item. So if you add it up, the unit cost under absorption is $10 of material, $10 of labor, $2 of purely variable overhead, $4 of fixed overhead. That's it. It's $26. And as I say, if you think about it, that's consistent with everything you do in cost accounting. Now, by comparison, let's work out the unit cost under direct costing or variable costing. The direct material, you know that's a purely variable cost. You put that $10 in there. The direct labor, it's a purely variable cost. This is variable costing. Put that $10 in there. The $2 of overhead that represents purely variable costs, of course, you put that in there. And now we're back to variable selling. And people sit in the exam and think, well, it's variable costing. Now I've got variable selling. I'm working on variable costing. Now I've got variable selling. Put it in? No, don't fall for that. That's an easy place to make a mistake. No, it's not a manufacturing cost. It's not an inventoriable item. That's a no for variable selling. And of course, the fixed part of overhead, also no. The fixed part of overhead, no. When you really look at it, this is the difference in the methods. The only difference between direct and absorption costing is how the methods treat this one item, fixed factory overhead. Fixed factory overhead is part of unit cost under absorption. It's not under direct. So try not to complicate it in your own mind. When you boil it down, the only difference in the two methods is how they treat that one item, fixed factory overhead. It's part of unit cost under absorption. It's not under direct. And like I say, don't make a mistake on that variable selling. It's not a manufacturing cost. It's not an inventoriable item. That's got to be no also. And of course, the fixed selling, no. It's not a manufacturing item. It's not an inventoriable item. So if you add it up, the unit cost under direct costing is $22. $10 of material, $10 of labor, $2 of purely variable overhead, and that's it, 22. Let's do a quick question together. Number 18. 18 says, using the variable costing method, which of the following costs are assigned to inventory? First column, variable selling. No. That's a no under that column. They know what I know, and that is the people are going to sit in that exam and they're going to see the word variable and lose control. Hey, it's variable costing, variable selling, and they want to jump for it. It's not a manufacturing item. It's not an inventoriable item. Put a no in that column. How about variable factory overhead? Of course. That's a variable manufacturing item. That's a yes, and the answer is D. No, yes. The answer will be D to that one. In direct costing, only the variable manufacturing costs are considered part of unit cost. Now, what they test the most on this, if you're with me on the difference in unit cost in both methods, we haven't really got to what they hit the most. What they test the most is whether or not you understand the impact on financial statements from using these methods. And what I want to do to get us into this is do some income statements. So let's assume that year one is the first year of operation. Okay, I'm going to assume year one is the first year of operation. If you look in your viewer's guide, you will see the outline, the format of an income statement under absorption costing for year one. It's in your viewer's guide, and I want you to go to that page. And as I started to say, we're going to assume that in this problem, year one is the first year of operation. And you'll notice the assumption is that in year one, they produce 2,000 units, but they sell 1,000. And we're going to assume that they sell units for $100 each. Together, let's do the income statement for year one under absorption costing. Now, before I start, let me just say that I think you will be comfortable with this right off the bat because this is the format we're all used to. This is generally accepted accounting principles. Remember, absorption is GAAP. So let's go through it. The sales, of course, are pretty easy. They sold 1,000 units for $100 each. So sales would be $100,000. Now let's work on cost of goods sold. What would be beginning inventory? Well, 0, right? I'm assuming year one is the first year of operation. So beginning inventory would be 0. How about cost of goods manufactured? Now be careful. Everything I'm doing is based on that comparison sheet that we just did. That comparison sheet where we came up with unit cost under absorption, $26, unit cost under direct costing, $22. Everything I'm about to do is based on that comparison. So you might want to look back on that sheet. How would I get cost of goods manufactured? Well, in year one, they produced 2,000 units. And going back to that comparison page, what's the unit cost under absorption? 26. So if you multiply 2,000 units times 26, cost of goods manufactured would be $52,000. Add that up, that gives you goods available for sale, $52,000. Now how about ending inventory? Well, if we produce 2,000 units and we sell 1,000, there must be 1,000 units in finished goods valued at $26 each under absorption. So ending inventory would be valued at $26,000. That gives you cost of goods sold, $26,000. And that'll give you gross profit, $74,000. You know, in a traditional income statement, under GAAP, you work down to gross profit, $74,000. Now how do we finish? Now we put in selling, general, administrative expenses. What are our selling expenses here? Well, again, everything I'm doing is based on that comparison page in your viewer's guide. Weren't we told that the variable selling is $1 for every unit they sold? So I'm going to take $1 times 1,000 units they sold. Variable selling is 1,000. What's fixed selling? Again, back on that page, we're told that fixed selling is $6,000 per year. So I put that in. And that gives me profit before tax of $67,000. Putting in the variable selling, $1 per unit sold, times the 1,000 units they sold, variable selling is 1,000. The fixed selling, we're told in that comparison page, is $6,000 per year. So when I take that gross profit of $74,000 and I back out the variable selling of 1,000 and the fixed selling of 6,000, that gives me the profit before tax of $67,000. Now, by comparison, let's do the income statement for year one under direct costing. Well, we know under direct costing, and you have a page in your viewer's guide all set up with the format of an income statement under direct costing. And it is a little different. That's why it's important to go through it. Sometimes in the exam, they ask you questions just about the format. So we'll start with sales. Of course, that would be no different. They sold 1,000 units at $100 each, so sales would be $100,000. Now let's work out variable cost of goods sold. Again, beginning inventory would be 0. Year one is the first year of operation, so beginning inventory is 0. How about cost of goods manufactured? Well, didn't they produce 2,000 units? And the unit cost under direct costing from that comparison page is 22. So cost of goods manufactured is 44,000. That gives you goods available for sale, 44,000. How about ending inventory? Well, if you produce 2,000 units and you sell 1,000, there must be 1,000 units in finished goods. They're valued at $22 each under direct costing. So ending inventory be valued at $22,000. That gives you what they call variable cost of goods sold, $22,000. Now be careful. When you subtract variable cost of goods sold from sales, you don't get gross profit. You get a subtotal called contribution margin from manufacturing. And that's something you should be aware of. You might want to even write it on this page. In direct costing, there's no gross profit. In an income statement under direct costing, there's no gross profit. They've asked that several times, so you should know that. When you subtract variable cost of goods sold from sales, it gives you, as I say, a little subtotal called contribution margin from manufacturing. There's no gross profit on an income statement under direct costing. Now follow through with me on the approach. Once I get down to that subtotal, contribution margin from manufacturing, now what I want to do is subtract any other variable cost that's in the problem. The only other variable cost we have in this problem is the variable selling. I'm going to take the variable selling, remember it's $1 for every unit sold, times the 1,000 units they sold. The variable selling is 1,000. That's what you would do at this point. You would subtract any other variable cost you have in the problem. You could have 7 of them. Here you just have 1, the variable selling. And when you subtract that, that gives you the most important number on the screen, contribution margin, 77,000. What your sales have contributed to the recovery of fixed costs. Contribution margin, what your sales have contributed to the recovery of fixed costs. Before we finish this little income statement, you might want to just write this down. Get down the definition of contribution margin. What is the definition of contribution margin? I just write it down. The definition of contribution margin is your sales minus all variable costs. That's the definition of contribution margin. It's your sales minus all variable costs. And I'll tell you why I had you write that down. A lot of students in the exam make a mistake. Just trust me that I know this happens. What a lot of students do in the exam is just look at the 22,000, just that variable manufacturing. No, you don't have a contribution to fixed costs until you cover all your variable costs, even that variable selling. So that's the definition of contribution margin. It's your sales minus all the variable costs, even that variable selling. So that gives you what you need, 77,000, contribution margin, what your sales have contributed to the recovery of fixed costs. Now, before we finish this income statement, let me emphasize that direct costing is not acceptable under generally accepted accounting principles. Why does it survive? It's not GAAP, but it survives because it reflects how every business person thinks. Every business person in the universe thinks like this method. If I take my sales minus all my variable costs, I know what's being contributed to the fixed costs which eat me alive. There isn't a business person in the universe that doesn't know their fixed costs. Fixed costs are frightening. They're frightening. Why do business people wake up in the middle of the night screaming about their fixed costs? Because they go on, whether you find a customer, whether you make a sale, fixed costs eat you alive. So every business person knows that, hey, if my sales are contributing 77,000 to the recovery of my fixed costs, if my fixed costs are less than 77,000, I have a profit. And I don't care what accountants say. You know, accountants can take that same information and show it's a technical loss. I don't care. If my fixed costs are less than 77,000, I'm going to survive. That's where I live. That's a profit in my book. And if my fixed costs are more than $77,000, I have a loss. I don't care what accountants say. Accountants could show me that technically it's a profit. I'm not going to listen. If my fixed costs are more than $77,000, I've got problems. And if my fixed costs are exactly $77,000, that's the break-even point. That is the point of sales where there's no profits and there's no losses. So that's how all business people think. So let's get back to the income statement. We take our sales minus all our variable costs, and that gives us contribution margin, what your sales have contributed to the recovery of fixed costs. And now, obviously, the way you finish the statement, you back out the fixed costs. Fixed factory overhead, I'm going to give you that. It's $8,000 a year. Fixed factory overhead, let's just say it's given, $8,000 a year. The way you could get it, by the way, they'd probably give it to you, but the way you could get it, if you go back to that comparison page, in absorption, aren't we putting $4 of fixed overhead on every unit? And I'm assuming 2,000 units of production is normal activity. So that's how you would do that. Look, if I know you're putting $4 of fixed overhead on every unit you produce, and then I say normal production is 2,000 units, that would let you back into what the fixed overhead budget must be, $8,000, at any level of activity within the relevant range. Because fixed is fixed, it's set in amount. But I think they'd probably just give it to you. The fixed selling is what? $6,000. It was given in the problem on that comparison page. And if you work it out, profit before tax comes out to $63,000. Now I want you to listen to me very carefully. We're at an important point. If you're in the exam and they want that profit under direct costing, that $63,000 we just calculated, you don't have to do out a whole income statement. There's a shortcut. And this shortcut will help you a lot in the exam. You want to get it down. I'll tell you what the key is. The key to the shortcut is to think in per unit terms. What does the sale of each unit contribute to the recovery of fixed costs? If you can get that, you can work fast. Let me show you what I mean. Let's get contribution margin per unit. I'll do it on the screen. What's the selling price per unit? Well, of course, it's 100. Now, to get contribution margin per unit, I'm going to back out the variable costs. What are the variable costs? 22? No, be careful. No, that 22, remember, is just variable manufacturing. Let's do it again. What's the definition of contribution margin? What is it? It's selling price minus what? Minus all variable cost. Don't forget the dollar of variable selling. So my point is, my variable costs per unit are not 22, they're 23. So the contribution margin per unit is 77. That is very powerful information. Once I know that every time I sell a unit, it contributes $77 to the recovery of fixed costs, I can do a lot. I want you to think in per unit terms. It'll help you a lot in the exam. But be careful of that definition. Definition of contribution margin is your sales minus all your variable costs. Don't forget that dollar of variable selling. All right, now once I have that information, once I know that every time we sell a unit, it contributes $77 to the recovery of fixed costs, do you see what I can do with it? In year one, how many units did they sell? 2,000. Didn't they sell 1,000? So if I take 1,000 units sold times 77, there's their total contribution margin, 77,000. Now I just back out their fixed costs. Fixed factory overhead, 8,000 a year. Fixed selling, 6,000 a year. And that gives you profit before tax of 63,000, about as fast as a human being can do it. It is very powerful in that exam to think in per unit terms. And let me emphasize that it goes beyond helping you with direct costing. When the exam wants you to do any sort of analysis on profit, that's the way you want to think. You know, what am I getting for a selling price? Can I cover my variable costs? The rest is contribution margin. And once I cover my fixed costs, the rest is gravy. That's the way you want to think in the exam when you do profit analysis as well, and we'll do some of that later in this class. Now, before I leave year one, I'm sure you noticed I did out the income statement under absorption costing, and I got profit before tax of $67,000. Then I took the same information, did the income statement under direct costing, and got profit before tax of $63,000. Listen very carefully. All else being equal, if you produce more units than you sell, and that was the case in year one, wasn't it? They produced 2,000 units, but they sold 1,000. If you produce more units than you sell, absorption will give you more profit than direct. You memorize that. That relationship will help you in the exam. All else being equal, if you produce more units than you sell, absorption will give you more profit than direct. I would just memorize it because that comes in handy in the exam. Now let's go to year 2. If you go in your viewer's guide, move on to year 2. Notice in year 2, once again, we produced 2,000 units, but we sold 2,500. Now we're still selling units for $100 each. Now to save time, it's all filled in for you. Notice that under absorption costing, profit before tax came out to $176,500. And if you go to the next page and look at direct costing, it's all filled in. Profit before tax came out to $178,500. Why don't we do our shortcut? How could I prove out that $178,500? Remember, thinking per unit terms. I'll put it on the screen. The quick way to get that, without doing an income statement, if you want to get that profit under direct costing, you say, well, I know they sell units for $100 each. What are the variable costs per unit? Well, $22 variable manufacturing, $1 variable selling. The total variable costs per unit are $23. I know every time they sell a unit, it contributes $77 to the recovery of fixed costs. Then you can work fast. I take that $77 contribution margin per unit times the 2,500 units they sold in year 2. That gives me a total contribution margin of $192,500. Then it's just a matter of backing out the fixed costs. Fixed factory overhead, $8,000. Fixed selling, $6,000. Profit before tax, notice it comes out, $178,500. And I'm sure you've noticed the second relationship that you just have to memorize. All else being equal, if you produce less units than you sell, absorption gives you less profit than direct. All else being equal, if you produce less units than you sell, and that was the case in year 2. We produced 2,000 units, but we sold 2,500. Absorption gives you less profit than direct. I would just memorize it. So remember, if you produce more than you sell, absorption gives you more profit. If you produce less than you sell, absorption gives you less profit than direct. Notice the mores and lesses go together. That's why I'm phrasing it the way I am. If you go to the next page in your viewer's guide, it's now year 3. In year 3, everything stays the same. We're still selling units for $100 each. And in year 3, we produce 2,000 units and we sell 2,000 units. And it's all filled in for you to save time. Notice that under absorption, we get profit before tax of $140,000. And if you go to the next page, under direct costing, we get profit before tax of $140,000. And that's the last relationship that you have to be aware of. All else being equal, if you produce the same number of units that you sell, absorption gives you the same profit as direct. If you produce more than you sell, absorption gives you more profit. If you produce less than you sell, absorption gives you less profit. And if you produce the same number of units that you sell, absorption gives you the same profit as direct. Just flat out memorize those relationships because they'll help. I'd like you to try some questions. I'd like you to turn the tape down and try 19, 20, and 21, and then come on back. Let's do this group together. 19 says that this company has done an income statement under both approaches. And notice that the variable costing statement shows a profit, but the absorption costing statement shows a loss. Well, you know what I'm going to ask. When is absorption less than direct? If you produce what? Less than you sold. And the answer is A. If absorption is less than direct, they must have produced less than they sold. I hope you tried 20 and 21. It's a really excellent set on direct versus absorption costing. I'll say this. If you can do this set, you understand direct versus absorption costing. And number 20, if you go to the bottom, they say, what is Sans operating income under direct or variable costing? And one of the big things I hope you remembered is that you wouldn't sit in the exam and do out a whole income statement. No, use the shortcut. And remember, the key to the shortcut is to think in per unit terms. What does the sale of each unit contribute to the recovery of fixed costs? Once you have that, You can do a lot. First of all, what's the selling price per unit? $20. It's given. Now, what we're going to back away from that would be variable costs. And they gave you a column of variable costs. We're going to back out the $4 of direct material. We're going to back out the $2.50 of direct labor. We're going to back out the $1.50 of purely variable overhead, right? We back out the $4 of material, the $2.50 of labor. We're going to back out the $1.50 of variable overhead. How about the variable selling? Yes. The variable cost per unit are 10, not 8. Remember, the definition of contribution margin is your selling price minus what? All variable costs. Don't forget the variable selling. So the variable cost per unit are not 8, it would be 10. That $2 is included in there. So our contribution margin per unit is $10. 20 minus 10. Now I can do a lot. Once I know every time they sell a unit, it contributes $10 to the recovery of fixed costs, I can now work fast. How many units did they sell? 80,000. If you take the 80,000 units they sold times 10, there's your total contribution margin, 800,000. Now it's a matter of backing out your fixed costs. Fixed factory overhead, 240,000. Fixed selling, 140,000. And that gives you profit before tax of 420,000. Answer B. So the answer to number 20, as I say, is B. Now in 21, they say, what would be sans finished goods inventory under absorption costing? That's why I like this set, because now they switch the method. Well, if I'm going to work out finished goods inventory under absorption costing, the first thing I have to do is calculate the inventoriable unit cost under absorption costing. Let's do it together. You know I'm going to pick up the $4 of direct material. You know I'm going to pick up the $2.50 of direct labor, the $1.50 of purely variable overhead. How about the variable selling? Yes or no? No, it's not an inventoriable item. It's not part of unit cost. If I'm doing an analysis of profit, I've got to consider it, but it doesn't belong as part of unit cost. Am I done? No. In absorption would take the 240,000 of fixed factory overhead, divide by 100,000 units produced, and put $2.40 of fixed factory overhead on every unit. Remember, that's what makes it absorption costing, that the units that are produced absorb all manufacturing costs, both the variable and the fixed. So that's what absorption is going to do. Absorption is going to take that 240,000 of fixed factory overhead, divide by 100,000 units of production, and put $2.40 of fixed factory overhead on every unit. So we get that in there. How about the fixed selling? No, it's not a manufacturing item. It's not an inventoriable item. If you add it up, the unit cost under absorption costing comes out to $10.40. Now, how many units are in finished goods? Well, if they produce 100,000 units and they sell 80,000, there must be 20,000 units in finished goods valued at $10.40 each. Finished goods is valued at $208,000. The answer is also B. Now, as we said in this class, the break-even point is defined as that point of sales where there's no profits and no losses. You know that. And going into the exam, you want to be able to calculate the break-even point fairly quickly. And the way I cover this, I always tell my students, you flat out have to memorize one formula. It's not a hard one, but if you know this one formula, you can do a lot with it. What I want you to memorize is the formula for determining the break-even point in units. That's what you want to do. Just flat out memorize the formula for determining the break-even point in units. Let me give it to you. If I want to get the break-even point in units, in the numerator, I put the company's total fixed costs. And in the denominator, I divide by our good friend, contribution margin per unit. As I say, it's powerful to think in per unit terms, and we use it here as well. Now, to illustrate this, if you go in your viewer's guide, you'll see a page on break-even point. And if you look at the page, you'll see it's the same problem we did before, where we calculated the unit cost under direct costing and the unit cost under absorption costing. It's really the same problem on that break-even page, but I changed a couple of things. Notice now the selling price is $29 a unit. And notice, remember, it used to be 100, now it's 29. And the fixed factory overhead is now $90,000 a year. And the fixed selling expenses are $30,000 a year. Together, for this company, let's calculate the break-even point in units. In the numerator, I want to put the company's fixed costs. That's the fixed factory overhead of $90,000, the fixed selling of $30,000. I put in their total fixed costs, which are $120,000. Now, I have to divide by contribution margin per unit. What's that? Well, the selling price per unit is 29. What do I back out from that 29? 22? No. Don't make that sloppy mistake. The definition of contribution margin is selling price minus all variable costs. Don't forget to pick up the dollar of variable selling. So the variable costs per unit are not 22, they're 23. So the contribution margin per unit is $6. Every time they sell a unit, it contributes $6 to the recovery of fixed costs. And if you divide the 120,000 by 6, the break-even point is 20,000 units. Please remember, though, that my formula gives you break-even point in units. It tells you how many units you have to sell to break even. What if the exam doesn't cooperate and it wants break-even point in dollars, break-even point in sales? Well, the way I look at it, you don't have to memorize another formula. As long as you can get break-even point in units, you should be able to get dollar sales. How? Just multiply by the selling price. So if they want break-even point in dollars, I would just take the 20,000 units times the selling price, 29. Break-even point in sales is 580,000. So that's why I say this one formula is very useful, because if you can get break-even point in units, you can get break-even point in dollars by just taking the break-even point in units, 20,000, times the selling price, 29. Break-even point in dollars in sales, 580,000. What if they asked this? Same problem. What if they asked, how many units would you have to sell to generate a $90,000 profit before tax? Well, you just use the same formula. All you do, I'll put it on the screen, is take the $90,000 profit you want to generate plus the fixed costs, 120, and divide by good old contribution margin per unit. You're really using the same formula. Take their total fixed costs, 120,000, add the $90,000 profit before tax that you're looking for. That adds up to 210,000. Divide by $6, contribution margin per unit. If they sell 35,000 units, they'll end up with a $90,000 profit before tax. What if they want dollar sales? Well, just take the 35,000 units times the selling price, 29. If they generate $1,015,000 of sales, they'll end up with a $90,000 profit before tax. That's why I say if you can get units, you can get dollars. Now, what I want to go over next is definitional, but you have to know it. They hit it a lot. Let's talk about the margin of safety. It's definitional. The difference between actual or budgeted sales. In this definition, you can use actual or budgeted sales, either one. I'm going to assume that $1,015,000 that we just calculated for sales, that's my actual or budgeted sales. But I'll start again. The difference between actual or budgeted sales, I'll use that $1,015,000, and the sales at the break-even point. We work that out to be $580,000. That $435,000 difference, that's what they mean by the margin of safety. It's the difference between actual or budgeted sales, the $1,015,000, and the sales at the break-even point, $580,000, giving us a margin of safety of $435,000, which is defined as how far your sales would have to drop before you incur losses. Margin of safety, how far your sales would have to drop before you incur losses. I'd like you to try a set. I'd like you to shut your tape off, try 22 and 23, and then we'll do it together. Let's do this set together. In number 22, they're just flat out asking you for the break-even point in units. And as you know, that's the one formula that I want you to memorize. So you're in the exam, you write it down right away. In the numerator, total fixed costs. Now that's pretty easy here. You've got fixed factory overhead 70,000, fixed selling 60,000. You know in the numerator you want 130,000, total fixed costs. Now we're going to divide by contribution margin per unit, and that's what you had to work on. What's the selling price per unit? Well, it's got to be 20. They sold 50,000 units for $1 million. Selling price per unit is 20. Now let's get the variable cost per unit. They've got 300,000 of direct material and direct labor. That's purely variable. They've got 40,000 of overhead. That's purely variable. And don't forget, you've got to consider the variable selling of 10,000, because the definition of contribution margin is your sales minus all variable costs, even that variable selling. So you add that up. The total variable costs are 350,000. That 350,000 spread over 50,000 units sold. The variable cost per unit are $7. So the contribution margin per unit is 13. Now you can solve it. If you take their total fixed costs, 130,000, divide by contribution margin per unit 13, you get answer B, break-even point in units, 10,000. Now, you know this. What if they want a break-even point in dollars? What would you do? Wouldn't you take the 10,000 units times the selling price, 20, break-even point in dollars would be 200,000, just in case they ask. That's break-even point in dollar sales. Now, in number 23, they want the contribution margin ratio. And you have to know what this is. They ask about it a lot. Well, look at it this way. In this problem, think of the selling price, $20, as 100%. If you think of the selling price, 20, as 100%, notice the variable cost per unit are 7. Variable costs are 35% of selling price. If you take 35% of 20, you get 7. So naturally, contribution margin is 65% of selling price. If you take 65% of 20, you get 13. And I want you to know that that 65%, that's what they mean by the contribution margin ratio. And the answer to number 23 is also B. And you've got to be aware that that's always a function of 100. The exam just assumes that you think like this. So, for example, sometimes in the exam, they just give you little threads of information, and you have to infer things. They could say in a problem, variable expenses are 15%. You're supposed to infer then contribution margin ratio must be 85%. They do that a lot in the exam. You know, they could go the other way. They could say contribution margin ratio is 32%. You got to sit in the exam and go, oh, I see, then variable cost for this company must be 68%. It's always a function of 100. And as I say, sometimes they give you threads of information and make you infer things. So you're in the exam and they say, variable costs are 30% of sales. You know right away for that company, contribution margin is 70%. That's what they mean by the contribution margin ratio. Another point, what did we just say that break-even point in dollar sales would be? Didn't we take the 10,000 units, break-even point in units, times the selling price 20, and say, hey, break-even point in dollars is 200,000? The other way to get that, I'll just show you, is if you take their fixed costs, the 130,000, divide by the contribution margin ratio of 65%, that'll give you break-even point in dollars. Just another way to do it. If you take the total fixed costs, 130,000, divide by 65%, the contribution margin ratio, that'll give you break-even point in dollar sales as well. Now, sometimes in the exam, they will take break-even concepts, sort of mix them up a little bit, and ask some convoluted questions. And I want to show you how to deal with a question like this. Together, let's go to number 24. 24 says, Seahawk is planning to sell 200,000 units of product B. The fixed costs are 400,000, and the variable costs are 60% of selling price. In order to realize a profit of 100,000, what would the selling price per unit have to be? So you see this is a little different. And of course, what this really is an algebra question. And I know that not everybody's strong on algebra. And you know, algebra is one of those things, if you don't work with it all the time, you lose it right away. I'll show you how to solve a question like this without using any algebra. One way you can solve a question like this is with a technique that I call test the answers. See, I say you're in the exam, go, hey, I've got 4 answers. You know, why can't I sit there and go, what if it is $5? Does it come out? You know, what if it is $3.75? Does it come out? It's just a good technique to know. If you have a question that would take algebra, and you say, well, gee, I'm not good at algebra, start testing the answers. Now, when you test answers like this, always start with the roundest answer because it's easy to work with. Let's go down to C. You know, what if it is C? What if they sell units for $5 each? Let's work it out together. If they sell units for 5, didn't they say that variable expenses are 60%? Well, if variable expenses are 60%, contribution margin is 40%. It's always a function of 100. So wouldn't the contribution margin per unit be $2 at that level? I'll take the $2 times the 200,000 units they told me they're going to sell. That gives me total contribution margin of 400,000. What are their fixed costs? They said 400,000. Notice in answer C, we break even. There's no profit or loss. So I ask you, is the answer C? No. They wanted to know what the selling price per unit would have to be to generate a profit of 100,000. Now, I know you're with me. Don't I already know it's D? I mean, once I know they break even at 5, am I going to sit there and test $3.75? I don't think so. You got to use your common sense to generate any profit. Never mind 100,000. It's got to be something more than 5. So I already know it's D. That's what's good about starting with the round answer. If it's not the answer, very often it tells you direction. But just to show you it comes out, let's just show D. If I sell for $6.25, I know that variable costs are 60%, so contribution margin would be 40%. So contribution margin would be $2.50 a unit. I know they're going to sell 200,000 units, so that gives you a total contribution margin of 500,000. Back out the fixed costs, would still be 400,000. Fixed is fixed, and that does give you exactly 100,000 of profit. So it does work. Let me show you another one. We'll do it together, and it's maybe a little harder. Let's go to number 25. In number 25, they say COBIT has sales of 200,000 with variable expenses of 150,000, fixed expenses of 60,000, and an operating loss of 10. By how much would COBIT have to increase their sales to achieve operating income equal to 10% of sales? By how much would COBIT have to increase their sales so operating income is 10% of sales? It's a nasty question. Well, I say try not to fight with it. You got answers, why not test the answers? And as I say, start with the roundest answer. It's easy to work with. Now I've got 2 round answers here, so I'll start with A. It's just the first one. What if it is A? What if it is 400,000? Now, I'll do it on the screen. What I'm going to do is a little income statement here and test out A. But before I do, I have a question for you. If it is A, would sales be 400,000? No. No. Sales would be 600,000. Remember, the question was, by how much would COBIT have to increase their sales? You have to read it carefully. I halfway think that that's most of the battle right there, is making sure students read the question carefully. If it is A, the sales wouldn't be 400,000. The sales would go from 200,000 currently up 400,000 to 600,000. The question was, by how much would they have to increase sales? So if it is A, sales become 600,000. Now you had to notice that when sales were 200,000, variable expenses were 150. You had to notice variable expenses were 75% of sales, and that relationship would hold. So variable expenses would be 75% or 450. Or you could just drop right down and say contribution margin is 25%, 150,000. Now the fixed cost, would it still be 60? Yes, fixed is fixed, set an amount. It's not going to rise and fall with activity. Take out the fixed cost 60, that gives you a profit of 90,000. Now look what I have on the screen. Is the answer A? It's not. How do you know? You sit in the exam and say, is 90 10% of 600? It's not. They wanted profit to be 10% of sales. It's not. Well, let's try D. If it is D, wouldn't sales go up by 200,000, up to 400,000? Variable expenses would be 75%, or 300,000, or as I say, you could just drop right down and say, well, contribution margin is 25%, 100,000. Fixed cost would still be 60. It's not going to change. It's set an amount, 60,000. And if you take the 60,000 from the 100, that gives you a profit of 40,000. So you sit in the exam and say, is 40,000 10% of 400? It is. The answer is D. It's a good technique to know. So try to remember that if you're in the exam and you get a question and say, oh, gee, I could solve it if I was really good in algebra, test the answers. It gives you a really good shot at it, especially if you are particularly weak at something like algebra. Now, what I want to get into next is profit analysis. And I know you've seen these kind of questions before. Let me just tell you the way the exam gets into this. They tend to get into profit analysis in one of two ways. One way they like to do it, they'll give you a special order. You know, they'll say you run a factory. A customer gives you a special order. They're willing to buy 100,000 units for $17. Should you take the order? Now, how much profit would you make on that order? Would you accept that order? Is it profitable? They love special orders. The other thing they like is make or buy decisions. I'm sure you've seen them before. They'll say it costs so much to make a motor, so much to buy a motor. What should the company do? What's the best thing for the bottom line? Should they make it or buy it? So this tends to be the two ways they get you into profit analysis. Now, before I have you try some, I'll just say one quick thing. The key to all of these problems is to only look at what changes if you accept a proposal. That's the key to all of them. When you're doing any kind of profit analysis, only look at what changes if you accept a certain proposal. In other words, only look at variable costs. Fixed costs are irrelevant to a decision like this. Why? Because fixed costs go on whatever you do. They have no bearing on the decision at all. So when you make any kind of profit analysis decision like this, the secret is only look at what changes if you accept a given proposal, which is to say, only look at variable costs. The fixed costs, they go on whether you make the part, buy the part, whether you accept the order, reject the order. Therefore, the fixed costs have no bearing on your decision. Now, the best thing to do is try these, and then we'll talk them through together. But try some first. Try 26, 27, 28, and 29, and then come back. In number 26, Jordan makes calculators, and Jordan sells calculators for $40 each. Now somebody comes along, and they're willing to buy 40,000 calculators for $23 each. And they want to know what the effect would be on profit if Jordan takes this order. Now, before we solve it, I just want to mention to you how somebody could look at this if they had no business background. I know you didn't look at it this way, but I want you to appreciate if somebody has no business background, they're going to say, wait a minute. They're willing to pay $23 per calculator. What does it cost me to make a calculator? It costs me $16 of variable manufacturing, $10 of fixed. It costs me $26 to make a calculator. You're willing to give me $23. No, thank you. I lose on every one. But what we understand is that the fixed costs have no bearing on this decision. The fixed costs are going to go on whether we take this order or not. So it has no bearing on the decision at all. You've got to sit in that exam and say, what does it really cost Jordan to make each additional calculator? We'll put it on the screen. You know I've got to consider the $16. That's purely variable manufacturing. Every time Jordan makes another calculator, Jordan incurs another $16. They've got to consider that. What about the overtime? Sure, because we only work the overtime if we take the order. Remember, you only look at what changes if you accept a proposal. And the fact is, we only work the overtime if we take the offer. So we've got to consider the $3 of overtime. If I accept this offer, we'll get $23 for each calculator. It really costs Jordan $19 to make each additional calculator. Isn't there $4 of contribution margin on every calculator? I'll take that $4 times 40,000 calculators. Jordan's overall profit will go up $160,000, and the answer is B. Remember, it's all gravy. You know, once you cover your variable costs, fixed costs are going to go on whatever you do. So if you're going to make $4 of contribution margin on every calculator times 40,000 calculators, it's all gravy. Jordan's overall profit will go up $160,000. Now let's try number 27. In number 27, it says Spencer has a regular selling price of $10 per unit, variable costs are $6, fixed costs are $1 per unit, and they get a special order. Someone's willing to buy 10,000 units. And at the bottom, they ask to increase operating income by $10,000, what price per unit should Spencer charge for this special order? Well, one way you could solve this, and maybe you tried it, you could test the answers. Let's go down and see. You get some answers here. What if Spencer charges $10 a unit? Well, if Spencer charges 10, they'll cover their variable costs 6. How about the fixed? Irrelevant. Fixed costs go on whatever you do, have no bearing on the decision. There'll be $4 of contribution margin on every unit times 10,000 units. No, the answer is not C. They make 40,000 profit if they charge 10. All right, let's go down. Let's try A. What if they charge $7 a unit? If they charge 7, that'll cover their variable cost 6. So there'll be $1 of contribution margin, $1 of gravy, if you will, on every unit, times the 10,000 units the person is willing to buy. Yes, overall profit will go up exactly by 10,000, which is what they want. So the answer is A, making $1 of profit. In other words, in these problems, think of contribution margin as the same as profit. They make $1 of gravy times 10,000 units. They do make exactly $10,000 of profit, and that gives you answer A. Don't forget that test the answer approach. In 28, we get into some make or buy decisions. And I'm sure you noticed in number 28, Cardinal, they're not asking you to do a full analysis in the sense they're not asking you, hey, bottom line, should Cardinal make it or buy it? They didn't ask you to do a full analysis. All they asked in number 28 was, what does it really cost to make it? If you go to the bottom, they say, in deciding whether to make or buy the part, what's the relevant cost to make it? So they're just asking you to work out one part of the analysis. So let's do it together. What does it really cost Cardinal to make this part? Well, you know you have to consider the $4 of direct material. You know you have to consider the $16 of direct labor. You know you have to consider the $8 of purely variable overhead. You have to consider that $28 because it's all variable. Every time they make another unit, they incur that other $28. What you learn by doing these is you have to read very carefully what they say about the fixed. In the problem, it does say, and you might want to underline it, 60% of the fixed will continue. Underline, will continue, regardless of what decision is made. So think about it. 60% of that 10, notice they're putting $10 of fixed on every unit. They're saying 60%, 6 of the 10, will continue regardless of what you do. Well, if 6 of the 10 will continue regardless, we're stuck with it. We don't worry about it. But isn't that another way of saying that 40%, 4 of the 10, won't continue if I buy the part, only will continue if I make the part. 4 of the 10 won't continue if I buy the part, only would continue if I make the part. That becomes another cost of making the part. So what does it really cost Cardinal to make it? If you add it up, 4 plus 16 plus 8 plus $4 of fixed that won't continue if I buy the part, will continue if I make the part. It's another cost of making the part. It really costs $32 to make a part times 20,000 parts. It cost me $640,000 to make it, and the answer is B. That's what it costs Cardinal to make it, $640,000. Answer B. Now in 29, what's good about 29 is that they're having you do a full analysis. They're saying, okay, you decide, should Motor make this part or buy it? Well, there's no one way to do these. There are several ways you can approach this, but the approach I like, I do a calculation of what it costs to make it, then I do a calculation on what it costs to buy it, and then I make a decision. Let's start with what it costs to make it. In terms of what it costs to make it, you know I've got to consider the $20,000 of direct material. I've got to consider the $55,000 of direct labor. I've got to consider the $45,000 of purely variable overhead. I've got to consider that $120,000 of cost because it's all variable. When I make 10,000 motors, I incur that $120,000 of variable cost. But again, you have to read carefully what they say about the fixed. Read it with me. It says, If Motor accepts the offer, some of the facilities presently used to manufacture Part M1 could be rented to a third party for a rental of $15,000. Additionally, $4 per unit of the fixed overhead applied to M1 would be totally eliminated. Notice, $4 of the fixed overhead applied to M1 would be eliminated if I buy the part. So follow me. I take $4 times 10,000 parts. They're saying 40,000 of that 70,000 could be eliminated if I buy the part. Well, then I only incur it if I make the part. It's another cost of making the part. If 40,000 of the fixed could be eliminated if I buy the part, then I only incur it if I make the part. It's another cost of making the part. In other words, 30,000 of the fixed cannot be eliminated no matter what I do, so I'm stuck with it. I don't worry about it. It's a fixed cost. But 40,000 I could eliminate if I buy the part. I only incur it if I make the part. It's another cost of making the part. If you add it up, what it really cost me to make it is $160,000. All right, now let's do a calculation. What does it cost to buy it? Well, they said I can buy 10,000 parts for $18 each. That's $180,000. Am I done? No, because if I buy the part, I can rent out the facilities for $15,000 cash. So the net cash my client has to come up with is $165,000. The answer is A. No, I turned this down because it's $5,000 cheaper to make it. It costs $160 to make it, $165 to buy it. I turned this offer down, A, because it's $5,000 cheaper to make it. What I want to do next with you is a schedule. And even though this schedule hits some basic points, the exam plays a lot of games with these concepts, so I thought we should talk about them. If you go to your viewer's guide, you will see a schedule all set up on fixed versus variable cost. Now you'll notice the basic premise. I'm assuming that fixed costs are $10,000, the selling price per unit is $8, and the variable cost per unit are $2. And we're going to look at some categories under two levels of activity. First, let's assume they produce and they sell 1 unit. You should fill this in with me as I go through it. If they produce and they sell 1 unit, what's their total fixed cost at that level? $10,000, right? We put that in. Fixed is fixed. It's set in amount. How about fixed cost per unit? Well, at this level, don't I have to spread 10,000 of fixed costs over 1 unit? Fixed cost per unit would also be 10,000. What about variable cost per unit at this level? Still be $2. How about total variable cost? Well, we made 1 unit times 2 would also be $2. How about total costs? The total cost would be, at this level, 10,000 of fixed, $2 of variable, be 10,002. How about sales at this level? Well, we sold 1 unit for $8 to be $8. And finally, what about the ratio of variable cost to sales? Well, if I take the total variable cost, $2, over sales, $8, it would be 25%. Now, by comparison, let's assume they produce and they sell 10,000 units. Let's go through the same categories. Well, if they produce and they sell 10,000 units, what's total fixed cost at this level? Still 10,000. Fixed is fixed. It's set in amount. What's fixed cost per unit? Well, now I've got to spread 10,000 of fixed costs over 10,000 units. Now fixed cost per unit would be $1. Notice fixed costs in total stay the same. Fixed cost per unit fluctuates. If you look at that schedule, what happens as production rises? Just look at the two-column schedule. As production goes from 1 unit up to 10,000, fixed cost per unit goes down. What happens as production falls? Fixed cost per unit rises. The exam plays a lot of word games with this. All right, let's move on. What's variable cost per unit at this level? Still $2. How about total variable costs? Well, we made 10,000 units times 2 would be 20,000. How about total costs? Well, you know that fluctuates. At this level, it would be 10,000 of fixed, 20,000 of variable, be $30,000. How about sales? Well, we sold 10,000 units at $80,000. And then finally, what's the ratio of variable cost to sales? Well, if I take the total variable cost, 20,000, over the sales, 80,000, it's still 25%. The big thing to notice in the schedule is that fixed costs in total stay the same. Fixed costs per unit fluctuate. Look at variable costs. Variable costs per unit stays the same. Variable costs in total fluctuate. Let me show you one reason why I went through a schedule like that with you. Together, let's do question number 30. Number 30 says, when production levels are expected to increase, I would circle two words, production and increase. All we know in this question is production is increasing within the relevant range, and a flexible budget is used. What effect would be anticipated in regard to each of the following costs? First column, what happens to fixed cost per unit? Goes down. You want decrease. You know what they want you to pick? I think they want you to pick B or C, no change. They want you to sit in the exam and go, well, fixed costs are fixed, no change. Not per unit. Not per unit. If production is rising, fixed cost per unit would be falling. How about the other column? Variable cost per unit, no change. Not per unit, no change. And the answer is D. Now, the real reason I had you go through the schedule with me is that they like to ask these concepts in a graph. I'd like you to try a graph. I'd like you to try 31 and 32 and then come back. I hope you tried number 31. I think it's important to try a graph question. I know students don't like graphs. And let me say that if you've done any graph work at all, you've probably seen this one before. This is a standard cost, volume, profit graph. It's the one the exam hits the most. Why don't we label a couple of things before we solve it? That straight horizontal line, that is your fixed cost line. At any level of activity, you have the same fixed cost. They're fixed in amount. Then the first diagonal line that starts on top of the fixed cost line, that's the total cost line. Because if you go to zero activity, you start with your fixed costs, then you add your variable costs. That first diagonal starting at the fixed cost line, that's the total cost line. And then the other diagonal starting at the 0 point, that's the revenue line. Now you can label a couple of other things. The little triangle between the revenue and the B point, that would be your profit area because revenue is higher than total costs. And then the little triangle below the A point to the revenue line, that's the loss area because revenue is below total costs. So that's how you read the graph. And if you look at the graph, there's one thing you know for sure, and that is that A sales are lower than B sales. Isn't that true? Now, they happen to plot A and B on the total cost line. How would I find A sales? If you look at that graph, I would go to the A point, drop a line down to the revenue line, and look over to the left, and that would be the revenue for A. If you go to the B point, draw a line up to the revenue line, and look over to the left, that's the B sales level. But as I say, the one thing you know for sure looking at that graph is that A sales are lower than B sales. And if that's true, can't I think of that last schedule we did by using the 1 unit level as A and the 10,000 unit level as B? That schedule we just did where we compared 1 unit to 10,000 units, those different categories. Well, if A sales are lower than B sales, can't I think of the 1 unit level as A and the 10,000 unit level as B? Why don't we do that? And now let's read the question. It says at point A compared to point B as a percentage of sales revenue. That's the killer. At point A compared to point B as a percentage of sales revenue, variable costs are the same, right? If you look at that schedule we just did, at the 1 unit level, what was variable costs as a percentage of sales? 25%. At the 10,000 unit level, the B level, it was still 25%. So I hope you see why it's got to be C or D. As a percent of sales revenue, variable costs are still going to be 25%, still going to be the same. How about fixed costs? Well, let me say, I think they want you to sit in the exam and go, oh, fixed costs are always the same. Not as a percent of sales revenue, they're not. Look at the B level. At the B level, on our analysis sheet, what were fixed costs? 10,000 at the B level. Total fixed cost, 10,000. What were sales? 80,000. So as a percent of sales, fixed costs were 10,000 over 80,000, 1/8. How about at the A level, the 1 unit level? Total fixed cost would be 10,000 over sales, 8. Much larger at the A level, and the answer is D. Now, before we leave this graph, I'll say one more thing that you should be aware of. When you do this graph work, when you do break-even analysis, you assume everything is linear. That's the assumption in these graphs, that everything is linear. What's that mean? It means we assume fixed costs approximate a straight line. We assume revenue approximates a straight line. We assume total costs approximate a straight line. Are they straight lines? No, not in reality. If you carry activity out far enough to infinity, all the lines curve. But the whole theory of break-even analysis is if I look at a little slice of activity called the relevant range, they look like straight lines. We assume everything is linear. And that gets us to question 32 because it bothers people. 32 says break-even analysis assumes that over the relevant range, the answer is A. We assume revenues are linear. You do assume everything is linear, and the answer is A. What I want to talk about next is strategic management. Strategic management concentrates on decisions that will map out the long-run operations of a company. Long-run operations. And the basic benefits of strategic management would be an improved vision of the future for the company, also an improved perception of what is important for the company, and also an improved perception of changes in the environment in a dynamic marketplace. So there are a lot of benefits from this sort of strategic management. Now, the strategic management model basically has 4 components. Let's go over the 4 components. Number 1, there's environmental analysis. Environmental analysis. Number 2, strategy development. Number 3, strategy implementation. And number 4, evaluation and control. Those are the 4 components to strategic management. Let's talk a little bit about each one. When we talk about environmental analysis, we are talking about analyzing both the external environment and the internal environment, both. You're trying to identify factors. You're trying to identify factors that will have an impact on future performance. And these factors are not necessarily within the short-term control of management. So when I say that we're going to evaluate the environment, what's the environment? Well, first of all, you look at general trends, like the aging of the population, the percent of baby boomers in the marketplace. So you look at general trends. You look at industry trends. It could be that people are really concerned about food additives in your industry. So there are industry trends you look at. Also, you look at societal trends. Are there more single-person households now? Do more people use email? Do more people use cell phones? What kind of societal changes are you dealing with? And also, you consider the internal environment as well. What is the corporate culture? What is the chain of command? What are the corporate resources? That's all part of the environment. That is environmental analysis, the first part of strategic management. The second part is strategy development. Strategy development is the formulation of a long-term plan to seize advantage of opportunities. That's what it's all about. You're trying to take advantage of opportunities. You're also trying to manage threats. You're trying to do that as well. And basically, in terms of strategy development, you start by defining your mission. What is the purpose of the company's existence? You define your mission. And sometimes, as a separate statement, a company will do a vision statement. What the company is seeking to become in the future. And what it all leads to is a master plan. That's really what you're really trying to develop with strategy development, a master plan. What is to be done and by what deadline? And also in the master plan, what plans do you have for expansion, corporate growth? How are you going to manage corporate growth? Is it going to be vertical growth? Vertical growth is assuming functions that were previously done by some of your suppliers, by some of your distributors. That's vertical growth. It could be that you're planning on horizontal growth. Horizontal growth is increasing your market share within your current industry. Maybe you're going to diversify. There are two types of diversification. Could be concentric. Concentric diversification is expanding into a related industry, an industry related to the current industry that you're in. A conglomerate strategy would be expanding into an unrelated industry. But that's all part of the master plan. How are you going to manage corporate growth as well? That's all part of strategy development. In terms of strategy implementation, that's really all about developing programs and budgets and procedures to implement the strategy. That's what I mean by strategy implementation. You're coming up with budgets, you're coming up with programs, you're coming up with procedures to implement our overall strategy. And then by the fourth and final step, evaluation and control, we simply mean over a period of time, you have to monitor the performance of the strategy and take corrective action where it's needed. So try to remember the four basic components of the strategic management model: the environmental analysis, strategy development, strategy implementation, and evaluation and control. Let's do a couple of questions on strategic management. In number one, question number one says, which of the following is the least beneficial result of strategic management? Least beneficial result. A says a focus on the future. No, that's what it's all about. Strategic management's all about long-term planning. B says our perception of the environment. No, that's part of it. Environmental analysis is a big part of strategic management. Vision, of course, that's a big part of it, trying to improve your vision. But D, having a written plan, that's the least benefit. That's the least beneficial result of doing strategic management, the fact that you've written down a plan. Of all the ones listed, that is the least beneficial. Answer D. Question number two. What is the typical link that two businesses being combined in a conglomerate diversification strategy have? What is their typical link? Well, if it's a conglomerate strategy, remember the company is expanding into an unrelated industry. Unrelated. So they don't have a common customer base. Answer A. They don't have B, a common distribution network. They don't have D, common management skills. They don't have E, common technology. No, their link is probably financial. Answer C. Because a conglomerate strategy means you're expanding into an unrelated industry. Your link is really financial. Question number three. What strategy involves increasing your market share in the same industry? Same industry. How about concentric? Answer A. No, concentric, you are expanding into a related industry, not the same industry. B, a conglomerate growth? No, conglomerate growth, remember, you're expanding into an unrelated industry. Can't be B. How about D? Vertical? No, vertical, remember, is you're assuming responsibilities, functions that were previously done by somebody else within your industry, like you are doing functions that were previously done by suppliers or distributors. But in terms of increasing your market share in the same industry, that's the definition of horizontal growth. That's what horizontal growth is. It's just increasing your market share in the same industry. And the answer is C, horizontal growth. Let's go to question number four. In question number four, we have a question about regression analysis. And regression analysis studies the relationship between a dependent variable and one or more independent variables. If you're talking about simple regression analysis, just simple regression analysis, you're comparing the change in one dependent variable and you're associating that change with one other independent variable. With multiple regression analysis, you are studying the relationship between the change in one dependent variable, associating it with the change in more than one independent variable. So if you look at this graph that they gave us, sales would be the dependent variable, and income levels increasing would be the independent variable. This is a simple regression analysis. Now, what you're looking for is a correlation. The measure of correlation, what they call the coefficient of correlation, is always measured between a +1 and a -1. In other words, a perfect positive correlation where both variables are moving in the same direction, a perfect correlation where both variables are moving in the same direction would be a +1. A perfect correlation where the variables are moving in an opposite direction would be a perfect -1. The +1 and -1 is trying to measure the degree of linearity, how linear the relationship is. So if you look at this graph, what you'll notice is there's a negative correlation. As income is rising, sales are going down, right? So it's not a positive correlation, it's negative. And if you just notice that as income levels are rising, sales are going down, if you notice it's a negative correlation, it can't be C or D, because C and D has a positive correlation. So when they ask you what is the coefficient of correlation, it can't be C or D, it's got to be a minus. Answer A makes no sense at all because it's a -9.00. Remember, the coefficient of correlation is always measured as either a +1 or a -1. It's always in regard to 1, 1 being perfect correlation, a +1 being perfect positive correlation, a -1 being a perfect negative correlation. Your best answer here is answer B. A little less, minus 0.93. It's a negative correlation, not quite perfect, but it's a very strong correlation where if income rises, in this case, sales are going down. Question number 5 is a probability question. We're involved in a lawsuit, and a vendor has offered Wyatt a $25,000 settlement. A lawyer comes along and says, no, let's bring them to court. If we bring them to court, I think I can win $75,000. What should you do? We've already got a $25,000 settlement in hand. Lawyer thinks if we go to court, we could win $75,000. Notice there's a 60% probability we'll win that case. So let's work it out. What is the expected value of going to court? What is the expected value of litigation here? Well, if we go to court, there's a 60% chance we'll win $75,000, but we've got to pay the lawyer's retainer no matter what happens. That's $12,000. Plus the lawyer gets a contingency fee. Lawyer gets 50% of everything over $35,000. So if we win $75,000, we're $40,000 over $35,000. Lawyer gets 50% of that, or another $20,000. So if we go to court and we win, we don't get $75,000. We get $75,000 minus 12, the retainer, minus $20,000. Lawyer gets 50% of everything over 35. What we net out of the win in court is $43,000. Because there's a 60% chance that that'll happen, I multiply by 60%. The expected value of that outcome is $25,800. Now there's also a 40% chance we'll go to court and we'll lose. So do I multiply 40% times nothing? No. If I lose, I still pay the lawyer the $12,000 retainer. So there's a 40% chance that I have to pay a $12,000 retainer and end up with nothing else. That's a $4,800 loss. The expected value of going to court is a 60% chance that I'll get $25,800, a 40% chance I'll have a $4,800 loss. The expected value of going to court is $21,000. So the answer is C, right? No, it's not C. I already have a $25,000 offer in hand. They've offered a $25,000 settlement. My expected value of going to court is just $21,000. But if I litigate, I'm expecting a $4,000 loss. Answer A. That concludes our discussion of decision making and planning and measurement. I want to wish you the best of luck on the exam. Study hard.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam to let you customize your own review programs to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you are going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as exam preparation tips, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of a computer-based exam, including multiple choice, simulation, and written communication questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you will have the confidence and knowledge to pass it. Guaranteed.
Hi, I'm Jennifer Lewis, and the hotspot that I'm going to be leading you through is corporate governance. But before we get started, let's talk about a few study hints. First of all, make sure that you treat studying like a job. This means that you're going to put your best effort forward and you're going to devote sufficient time to your studying efforts. Remember, there's a very important performance evaluation at the end of all this, which is passing the CPA exam. You also want to make sure that you're balancing your lifestyle, though, and that you're taking sufficient breaks when needed. We all need to take those mental and physical breaks. So as we go through these materials, make sure that you stop at appropriate times, get up, walk around, clear your head, and then come back. Now, whenever you're starting back up again from taking a break, it's important to go back and at least look through the viewer guide to scan through the material that's already been covered to make sure that you refreshed your memory on those things, and then you can start back up with the video and we can continue on. There's a few things that you want to make sure that you really are committing to memory, and that's going to be the key definitions that I'm going to provide to you as we go through the materials. And then there's other things that you're going to need to know. So for example, with corporate governance, one of the things that you're going to need to know is the authority of the boards of a board of directors and what types of qualities do those board members need to have and what are their duties and responsibilities. We're also going to talk about audit committees as being a subgroup of the board of directors, and we're going to talk about the purpose of that audit committee and why they are composed the way they are. And then as a governance structure, we also can't forget the officers and senior management and other employees that play an important role in governance, and so we'll cover the duties and responsibilities and authority of those people. We also are going to talk about internal controls, because an important aspect of governance is going to be to have sound internal control over reliable financial reporting. And so we'll talk about the important elements of internal control, and we'll also talk about the role of just managing risk in an organization. So as part of corporate governance, it's going to be to make sure that they're looking at enterprise risk management, and so we'll talk about some of the foundational principles of enterprise risk management. We'll delve in a little bit more detail about some of the more important elements of internal control over financial reporting as it relates to governance. One of the areas is going to be the control environment, which is the foundation of all the other elements of internal control. We'll talk about the importance of making sure that there is appropriate oversight over the financial reporting process. And we'll talk about the purpose and the benefits of actually monitoring the effectiveness of internal controls over financial reporting. We'll talk about some of the types of monitoring as well as some of the other practical application concepts as it relates to monitoring. We'll talk about the importance of having good, strong information that's used in the monitoring process. And so we'll cover some of the key important qualities that information should have that management's using in their monitoring efforts. And we'll talk about how monitoring the operating effectiveness of controls over financial reporting, how that actually strengthens and improves the overall risk assessment process of an organization to make sure that they're managing their risk appropriately. And if there are changes that need to be made to a system of internal controls because there are weaknesses or deficiencies in internal controls over financial reporting, what's the change control process that needs to be undertaken? So the first topic that we're going to cover is going to be an overview of what we mean when we say corporate governance. Corporate governance refers to the manner in which an entity is managed and governed. So this could include a lot of different individuals depending on the nature, size, and complexity of a business. This is going to naturally include management, senior management, and other personnel within the organization that provide oversight, supervision, and review of an organization. It also is going to include those charged with governance. Now, just in a moment, I'll give you a more precise definition of what those charged with governance is, but keep in mind now that those charged with governance typically for a larger, more complex type entity is going to include a board of directors and potentially an audit committee. But an entity does not have to have a board of directors. It may have other person or persons that are responsible for overseeing the strategic direction of the entity. The benefits of having a solid corporate governance function is that it helps in multiple ways. It's going to help an organization ensure that they have effective and efficient operations. It's going to make sure that they have compliance with laws and regulations and contracts and agreements that are important to the organization. And it's also going to make sure that they're generating reliable financial information that's used by the organization internally as well as outside third-party users as appropriate. So the role of governance is focused in a lot of different areas with operations, compliance, and financial reporting. Now, when we talk about internal controls over financial reporting, it is a process that's affected by the board of directors, management, and other personnel. It's designed to provide reasonable assurance regarding the reliability of financial statements. Now, notice there's a couple key concepts there. One of them is that internal controls as a process. So when we talk about governance and governance focusing on ensuring that there's a good solid system of internal controls over financial reporting, we're talking about them looking at all of the controls that are relevant to the organization, not just one specific aspect of controls, but looking at the process of all the controls that all work together and interrelate with each other to ultimately lead to reliable financial statements. And ultimately, they're looking to make sure that the financial statements are not materially misstated. So there's only this sense of that you're looking to provide reasonable assurance that the financial statements are reliable, not absolute assurance, because we can never give absolute assurance because of the fact that there's human error, there's subjectivity, there is just situations where people make mistakes, there's system breakdowns. So we want to make sure that we're focusing on getting the best information out there to the users of the financial statements, realizing that no system is ever going to be perfect. Those charged with governance is a relatively new term that's evolved to broaden out to think about governance from the aspect that not every organization has a board of directors. In some instances, entities are required to have a board of directors. In other cases, they're not. And so they may optionally decide to have a board of directors, or they may decide to have a group that they just call the governance structure. And so the governance structure could be one person, or it could be multiple people. And their role is to oversee the strategic direction of the entity and its obligations, including the financial reporting process. It may include a board of directors, it may include an audit committee, or it may just include an owner of a business. And that sole owner or that sole trustee of the business may be the person that is charged with governance. Some or all of the members of a governance structure may be part of management. So there may be an organization that has an executive management team that functions as the governance role. When you're looking at who is those charged with governance, sometimes it's very easy to identify who those charged with governance are or who the person charged with governance is, but it really can vary from entity to entity depending on the nature, size, and complexity of the organization. Management is going to be those that are responsible for achieving the objectives of the entity directly. So they are the ones that actually have the authority to establish policies and make decisions. Those people are going to be the ones that are directly responsible for the financial statements, and they're going to be directly responsible for designing, implementing, and maintaining effective internal control over financial reporting that generates these financial statements. So when we talk about management, we're thinking about those that are a part of the organization that could be someone like the controller, the CEO, the CFO. Those individuals are going to be considered management. When we talk about those charged with governance, it's going to be an executive management team. It could be the owner of the business. It could be a board. It could be an audit committee. It's going to be a group of individuals or a single individual that is overseeing management. Another term that you're going to hear me refer to a lot in this topic is going to be COSO. COSO is the Committee of Sponsoring Organizations. That's what COSO stands for. And it's comprised of representatives from various financial and accounting regulatory type bodies. And you'll hear something called the COSO Internal Control Integrated Framework. And this integrated framework is a gold standard, as you might say, of the components and elements of internal control that really should be in place to mitigate the risks of an organization and to make sure that an organization is able to achieve its operating financial and compliance objectives. It's the most widely accepted framework out there for designing a sound system of internal control, and it's the framework that most organizations use when they are thinking about internal control over financial reporting. You'll also hear me mention it periodically in this hotspot about materiality. And materiality is a fundamental concept that helps distinguish the importance of matters. So what would really be a trivial situation, maybe a trivial error, versus one that is more significant to the impact on the financial statements. And so it helps people go through the concept of thinking about how is it that I need to address issues that I come across? And so it helps determine what are those thresholds that I need to give attention to. So are there things that I could perhaps ignore? Or are there things that perhaps I could set aside and deal with on a later basis? Or are there things that I want to bring to the forefront and deal with immediately because it could be something that would actually alter the financial decision making of an organization or the intended users of the financial statements? Their economic choices could be altered or influenced because there is this misstatement in the financial statements. So as you go back and think about when we discussed internal controls over financial reporting and we said that it's to give reasonable assurance about the reliability of the financial statements, that's where materiality comes in, because we want to make sure that there's not material misstatements due to fraud or error in the financial statements or in the disclosures to the financial statements that would cause the user of the financial statements to make a different economic choice. So we need to have some context around what is considered to be material. So before we move forward with this topic, I'd like you to shut down the video and do the next series of multiple choice questions. When you're done with those multiple choice questions, I'd like you to turn it back up again, and then we will debrief those questions and we will move forward with the next topic after that. Welcome back to the program. Now, hopefully you've gone through and you've looked at the multiple choice questions on your own, and now let's go through and debrief those multiple choice questions. Let's start with this one. Which of the following is a true statement related to corporate governance? Is it A, that it refers to the manner in which an entity is managed and governed? B, that it excludes entity management? C, that it requires entities to have a board of directors? Or D, it is a uniquely distinct concept from those charged with governance? The correct answer is A. It refers to the manner in which an entity is managed and governed. It does not exclude entity management. Remember I said that when we talk about governance, it could include management, it could include a board of directors, and it could include other appropriate personnel within the organization. Remember, an entity does not have to have a board of directors. It may be required to through legal or regulatory type requirements that the entity has to deal with because of the nature of the organization, like it's a publicly traded organization, but smaller, privately held companies are not required to have boards of directors. And when we talk about governance, and I talk about those charged with governance, it really is a concept that is interrelated. Those charged with governance can be and should be a part of corporate governance. The next question reads, which is not an element of those charged with governance? Is it A, those charged with governance are responsible for overseeing the strategic direction of the entity? Is it B, those charged with governance encompasses the board of directors and audit committee when relevant? Is it C, those charged with governance does not vary by entity? Or is it D, those charged with governance may include responsibility for approving the entity's financial statements? The answer up there that is not a true statement and is not an element of those charged with governance is C. It will vary by entity, depending on the nature, the size, and the complexity of the organization. Those charged with governance will look vastly different in some situations. The next question for this section reads as follows. Which of the following is a true statement regarding materiality as it relates to corporate governance? Is it A, there is no concept of materiality relevant to corporate governance? B, it is a foundational concept that helps distinguish the important from the trivial? C, users of financial statements are not relevant to determining materiality? Or D, does not permit decision makers to omit issues from consideration? The answer up there that is a true statement regarding materiality is B. It is a fundamental concept that helps distinguish the important from the trivial in the governance role and responsibility. There is a sense of materiality. There is a sense of things that maybe are less consequential. And when thinking about what's material for a particular organization, it's important to go through thinking of what would be important to the users of my financial statements. So certainly materiality is something that those charged with governance need to keep in mind as they're fulfilling their role and their responsibility. Let's talk a little bit more around the authority of a board of directors. So a board of directors would be a formal board that is elected or appointed to oversee the activities of a company or an organization. You sometimes will hear it referred to as a board of trustees. A lot of times when we're talking about colleges or universities, they might have a board of trustees. You might hear them referred to as a board of governors, a board of managers, an executive board. Regardless of the specific term that is used to describe this board, the fundamental concepts around what their authority and responsibilities are is going to be similar. So their activities are going to be determined by the powers and the duties and the responsibilities delegated to it or conferred on it by an authority outside itself. And so often this is going to be the organization's bylaws. So the entity is going to put together some sort of bylaws. If it's a corporation, they would have corporate bylaws that would say how many board members do we need to have, how are they going to be selected, what are their primary roles and responsibilities, and so everything would be laid out in the bylaws of the organization. Now, above and beyond the bylaws of the organization, the other area that might influence a board of directors is going to be if there's any specific legal responsibilities that are conferred on it because of the fact that it's publicly traded. So the SEC, for example, has very specific rules around how they want the board of directors to be established and who can sit on that board and what are the things that they're expecting that board of directors to do. So the nature of the entity could confer upon this board of directors certain legal responsibilities. There also could be some responsibilities that are conferred on it because of the jurisdiction that the organization operates in. So for example, a not-for-profit organization might be required to have a board of directors based on the legal geographic jurisdiction that it operates in. So depending on the nature of the entity, there's going to be different ways that this board of directors might be structured, and there's going to be different people that might sit on this board of directors. Organizations with voting members, so if we talk about a publicly traded organization that has shareholders, these shareholders often elect this board of directors to act on their behalf. So the actions of this board of directors are really subordinate to the entity's full assembly of all of the voting members of the organization. Now the SEC, as I mentioned, does require issuers, which is another term for publicly traded entities, that they require these issuers to have boards. And the way that this is done is through what you hear when you hear the Sarbanes-Oxley Act. So the Sarbanes-Oxley Act is the rule that has the statutory and regulatory things that a board of directors must follow in order to comply with the SEC's rules. In large public companies, boards sometimes tend to have de facto power. Now, what's de facto power? De facto power doesn't mean that they have direct authority to be able to approve transactions and guide the direction of the organization, because remember I said that they are subordinate to the full assembly when they are representing all of the voting members of an organization, all of the shareholders that have a say in running the business. What does sometimes happen, though, is that in large public companies, they might have de facto power because they really comprise a large voting block. So a lot of times either they own shares of the organization or they are members of management within the organization, or they are conferred voting authority because somebody's giving them their proxy vote and say, here, however you vote is how I'm going to vote as well. So in essence, sometimes because they can put together these large voting blocks, they have de facto power over an organization. Small private companies don't have shareholders that need to be represented in the same way that large public companies have. So small private companies often have directors that are also a member of management, or directors that are also the owner of the business, or might be a small group of individuals that jointly share ownership of an organization that all might sit on what they call a board. So there's really no real division of power per se in a small private company like there is in a large publicly traded organization. Even if a small private company is not required to have a board of directors, it's important that if they do have a board of directors or another governance type structure like an executive management committee or even a sole trustee, because it's a solely owned business, they need to look at the concepts that apply to boards of directors and try to adopt those concepts and those underlying foundational principles and to still apply them to whatever their governance structure is. When we have an organization that has different types of directors on it, like a large publicly traded organization, they're going to have varying different types of directors. Some of them are going to be owners or managers of the business, and so they're called inside directors. Inside directors are the ones that have a vested interest in the organization. They're interested directors would be another term that you hear them called. So they're insiders to the organization. You also sometimes are going to refer to directors who are also managers. They sometimes are called executive directors. So if you hear the term inside directors or executive directors, these are all interested parties in the organization that also happen to be members of the board of directors. Now, a board of directors also should have members who are not owners or they're not managers of the business. And so these are often referred to as outside directors. So outside directors are more independent. They're not executives, they're not owners, they don't have a vested interest. They're more independent and objective in fulfilling their governance responsibilities. So those charged with governance should be ideally comprised of a mix of inside directors and outside directors in order to fulfill their roles and responsibilities appropriately. Really large companies also sometimes have something called an advisory group. And an advisory group would not be a group of individuals that's elected, but they are somebody that the board of directors turns to get advice around specific issues. An advisory group has no decision-making authority, they have no voting authority, they really have no direct responsibility to the entity other than it's just a group of individuals put together to provide advice. So an advisory group is not the same thing as a board of directors, and it doesn't have the same responsibilities as a board of directors. Now, as we mentioned in the introduction, the board of directors is governed by the bylaws of the organization. And the bylaws of the organization may say that the board of directors needs to have a subgroup called the audit committee. And the audit committee often is established by a charter through the bylaws. So the charter of the audit committee typically defines what the audit committee's responsibilities are. So they need to go through and say, okay, what are the activities that we should be undertaking? And this charter is going to guide them in that process. There also is going to be things like minutes. So if we have minutes to a meeting, the minutes to the meeting are just the documentation of what are the key topics of discussion, what are the important decisions that were made, and they're going to also talk about keep a record of any internal control deficiencies that might have been identified and discussed, if there were any known instances of fraud that were brought to the attention of the board or the audit committee, any important financial reporting issues that may have been discussed and resolved. So it's to provide a trail of documentation that somebody could go back and really understand what were the key topics of discussion, what were the important conclusions, and maybe what were some of the things that were voted on and decided by the board or by the audit committee. The other piece of documentation that you may find as it relates to boards and audit committees is this concept of having certifications of independence. Certifications of independence may be required at least annually by audit committee members to have them say outright that they have no related party interest in the organization, because the audit committee really, you want them to be even more independent. You want your audit committee to be comprised of outside directors as much as possible. And so you want to make sure that if they are involved in management of the business or have any sort of conflict of interest with the organization, if they have any immediate family members that are part of management of the business, if there's any way where their independence or objectivity might be influenced, that they need to disclose that in a certification of independence. So it's more to make sure that the organization and that senior management of the organization and other members of the board of directors know where there might be a conflict of interest that might be influencing the judgment and the advice that's being provided by these individuals. So what I'd like you to do now is to once again shut down the video and to open up your books and do the next series of questions. Welcome back to the program. Let's go ahead and debrief the questions that you should have answered regarding the board of directors. Which of the following is not a true statement related to the board of directors? A, that it may be elected or appointed. B, that it's typically governed by an entity's bylaws. C, legal responsibilities do not vary due to the nature of the entity or the jurisdiction that it operates in. Or D, it's sometimes referred to as a board of trustees, a board of governors, or an executive board. The correct answer that is not a true statement is C. If you recall, we talked about how legal responsibilities are going to vary depending on the nature of the entity. A publicly traded organization and its board of directors is going to have vastly different responsibilities than a small privately held organization that may not even be required to have a board of directors. So C would be the incorrect response up there as far as it not being a true statement. The next question says, which of the following is a true statement related to types of directors? A, owners who are directors are called outside directors. B, managers may not serve as directors. C, a board is not permitted to contain any inside directors. Or D, managers who are directors are often called executive directors. So this question is looking for which of those four options is a true statement. And then the true statement is answer D. Managers who are directors are often called executive directors. Owners who are directors are inside directors. So that's why answer A is not correct. Managers may serve as directors, and that's why they're called executive directors or outside directors. So that's why answer B is not correct. And answer C is not correct because we really want a board to have as many outside directors as possible, but there may be some inside directors that may be included as long as there's an appropriate number of outside directors balancing that out. The next section that we're going to cover is called Qualities and Duties of the Board of Directors. So let's talk a little bit about what are some of the qualities that we really want a board of directors to have in order to appropriately exercise their oversight role. So first of all, we want them to have some sort of financial reporting expertise. We want them to understand financial statements and how financial statements are used to run and manage a business and make economic decisions. We also want them to have an in-depth knowledge of business operations and the industry that the organization and the entity operates in. So they have some context around some of the operational business decisions that need to be made and any sort of compliance issues that need to be considered as they're making key choices about the organization and authorizing certain transactions and events. So beyond the technical knowledge that we need somebody to have, they also want somebody that has some of the non-technical qualities like having the commitment to carry out their responsibilities with due care. And what that means is that we need a board of directors that operates in a way such that they keep the company's interests in the forefront or the shareholders or the stakeholders' best interests in mind. So to make sure that they're always making choices around what's in the best interest of the company or the shareholders or the stakeholders, not just what's in their own best interest or what's in the best interest of management. So in doing that, you're really counting on this board of directors to operate in good faith and to act honestly and have a good sense of integrity and ethical values. And they want to make sure that we can count on that board of directors to exercise their authority for proper purpose. So that means that we want to make sure that they don't have any conflicts of interest. So when we look at conflicts of interest, we want to make sure that they don't use the entity's assets or they don't use the access to information that they have by being a part of the governance structure of an organization for their own profit or their own benefit. Now, sometimes there might be some transactions or some events that they get involved with that involve the organization, but they really should only be doing that with the informed consent of the entity and entity management and other members of the board. So there may be some things that they do where there's overlap in the interests of the individual and the interests of the entity that they're governing, but those where there's that overlap, it just needs to be brought to the attention of appropriate parties so that everybody is informed of it and can approve of the transaction or the event moving forward, despite the fact that there might be some sort of perceived conflict of interest. Now, one of the things that you really don't want a board member to do, though, is to compete directly with the company. So we want to make sure that they're not engaged in a business that competes with the company, and we want to make sure that they are also not acting as a director on the board of a competing company, because the board of directors is privy to a lot of important information, and a lot of key decisions are authorized or approved by the board of directors, and so we wouldn't want that inside information to become readily available to the competition. A board member should also not enter into transactions that are significant to the point where there starts being a conflict between what is in their best interest and what is in the best interest of the company. And so when we talk about individual transactions, like if they are engaging in a contract to buy a product or a service that the organization is involved with, if there's negotiations involved in this contract, if there is terms of the arrangement that could be modified and there's not a set fixed price list somewhere, then there could be a conflict there, because the individual board member would want to get the best benefit for themselves. So they're going to be constantly negotiating for the cheapest price and the current terms of the arrangement that would be to their individual benefit. But they also have a duty to the organization for them to maximize the profits and to get as much possible out of the arrangement and the transaction for the company. And so you can see where there would just be a natural conflict there. And so if there is going to be any transactions that are entered into between a board member and the entity that they're governing, it really needs to be ratified or approved by management and disclosed to the rest of the board. So one of the things that is really important about a board is to try and have as many of those independent directors as possible. Now, the Sarbanes-Oxley Act, actually, for a publicly traded company, says that they need to have a critical mass of independent directors that are sitting on the audit committee. And they define critical mass as having at least 2. So you need to have preferably at least 2 people that are independent, that are those outside directors of the organization. And the reason they discuss that for that type of organization, for a publicly traded organization, is because they're the ones that need to be appropriately monitoring senior management and providing objective counsel to really oversee all of the inside directors or the executive directors that also might be serving on a board. So it's making sure that there is an objective party that can sit and look with an unobstructed viewpoint and maintain the appropriate level of skepticism regarding some of the decisions and the judgments that are being made by management and by the full board of directors. So their job for these outside directors or these independent directors is to really ask probing, challenging questions of management and to make sure that they fully understand and have all the information available as they're making approvals for certain transactions and events to occur. If there are some requirements to have independent outside directors, whether it's required by law, like through the Sarbanes-Oxley Act for publicly traded organizations, or even if it's something that is voluntarily done by a private organization just through the charter of the audit committee or through the corporate bylaws for the board, there's going to be a need to periodically reevaluate the continued independence and objectivity of these outside directors. So there needs to be a means of capturing information where there might be some real or perceived conflicts of interest because of changing relationships or changing circumstances that occurred throughout the period. So periodically, probably at least annually, if the independent outside directors of an organization should fill out some paperwork that describes any related party interests that they might have with the organization and to describe any sort of affiliations or relationships that really might be perceived as being a conflict of interest. The challenges that a smaller entity has is that they do not have the same ability to attract independent directors. It's easy to get inside directors involved. So if there's somebody that's the management of a company or has a share interest in an organization, so stakeholders are automatically going to want to be involved in a board of directors because they have a vested interest in the success of the company. Outside directors, though, are supposed to be independent and they're not supposed to have that same level of vested interest. And so how do you attract them to want to be a part of the board? Sometimes there is some compensation that's provided to these directors, and so that might be the motivational factor for them to be involved. Smaller entities have a more limited ability to provide appropriate compensation for these board members. And there are also sometimes with smaller entities where things might not be as formal and as structured as a large entity might have their board or their governance structure set up. Sometimes there's some concerns for smaller entities for board members to be concerned about the potential for personal liability. So as they're approving transactions and events for these smaller entities, would they potentially be personally liable for an unfavorable outcome of those transactions or events? And then the other thing that they encounter sometimes is that there's a real resistance from management or from those inside directors to share governance responsibility with the outside directors. A lot of times the inside directors for smaller entities think that they have a larger voice. So what I'd like you to do now is to shut down the video, go through and answer the next series of questions related to this topic, and then come back and we'll debrief those questions. So welcome back. Let's debrief the questions that you should have responded to on your own first. And the first one deals with the important qualities for a member of a board or directors, and the question is, which of the following is true except? So what are important qualities for a member of a board or directors, including all of the following except? A, that there's financial literacy. B, that they have a lack of industry expertise. C, that there's a commitment to carry out responsibilities with due care. Or B, or D, that there's an ability to maintain the entity's interest in the forefront. So important qualities for a member of a board of directors include all of the following except B, lack of industry expertise. We obviously want the board of directors to have adequate industry expertise and to have adequate knowledge about business and their operations, including having a good sense of financial literacy and having some of those concepts like a commitment to carry out their responsibilities with due care, and they're making sure that they have an ability to maintain the interest of the company and the stakeholders of that company and to keep that in the forefront above and beyond their individual vested interests. Another question was, which of the following is an appropriate duty for a board of directors? A, do not enter into transactions with the entity unless disclosed and ratified by management. B, use the entity's assets for personal profit. C, compete directly with the entity. Or D, act as a director for a competing entity. So which of those following would be an appropriate duty for a board of directors? It's obviously A, that they should not enter into transactions with the entity unless it's disclosed and ratified by management. Whoever is the member of a board of directors should make sure that they are maintaining some sort of barrier between their own personal interests and the best interests of the organization. And so they should not look at it as an opportunity to enhance their personal profit, and they should not compete directly with the entity or act as a director for a competing entity. Let's talk a little bit more about the responsibilities of a board of directors or those charged with governance for entities that don't have a formal board of directors. One of the key general responsibilities that they're going to have is to make sure that they're objectively reviewing the significant judgments that management makes as it relates to financial reporting and financial statements. Their job is to look at the financial information that's provided by management to help identify and diagnose any unusual activity that potentially may impact the financial statements. Their job is to make sure that things are properly presented and disclosed and classified within the financial statements to ensure that there's no misrepresentations that could impact the financial statement users' need of those financial statements and their ability to be able to make good economic decisions based on those financial reports. So beyond making sure that there's reliability of the financial statements, they also are focused around the controls that are involved in the processes and the procedures that are generating those financial statements. So one of the things that they're going to do is they're going to be there to listen to any recommendations that internal audit or external audit makes to the organization about how to improve the overall quality of the entity's controls over financial reporting. They also are there to be a part of the system of internal controls because their job is to offset any potential improper management override that might be occurring that might relate to fraudulent financial reporting or misappropriation of assets. So their job is to oversee management. Management's job is to oversee other personnel within the organization, to take primary responsibility for generating the financial statements, and then those charged with governance are there to make sure that management isn't doing anything that's improper. So their job is to monitor management's performance in relation to all of the internal control components. Boards tend to have agendas, and so they will go through and they will establish a standard agenda item, and often those standard agenda items are put forth by the bylaws of the company or with an audit committee, maybe in the charter of the audit committee, to go through and have the key things that they really need to make sure that are being addressed. And one of those key things is to make sure that they are involved in approving any significant decisions that the entity makes, which would include if they are going to adopt a new accounting policy. And there may be alternatives to how you could adopt that particular accounting policy. And so the selection among those alternatives and deciding how it's going to be implemented in the company is something that's very important for those charged of governance to be involved with to make sure that the company is making the best decisions possible for the entity and for its stakeholders. So generally with the standard agenda items, there's going to be some sort of calendar of how many times a year they're going to meet and what are the key topics and discussions that are routinely going to be held at each board meeting. Part of the things that they might have on there is to make sure that they are reviewing key performance reports. So for example, there might be budget to actual reports that are generated every quarter. And so those charged with governance might have a standard agenda item every quarter to meet to talk about these budget to actual reports and to discuss any significant variances with management. They also will participate in major decisions of the company, such as if they wanted to do an acquisition of another company or if they wanted to spend money making a major capital expenditure of some means. It's important for them to look at the best use of the resources of the company, which may also include any sort of compensation arrangements, particularly incentive compensation arrangements that would include raises or bonuses or things of that nature. They're not necessarily going to get involved in the individual compensation arrangements of everybody in the company, but they will sometimes establish a range that management could use in spending money as it relates to compensation. They may say you can give the company a 3 to 5% wage increase, and then the individual management members would go through and determine how to use those resources. However, they often will get involved in the compensation arrangements for management. So reviewing and approving any sort of incentive compensation arrangements that they have as it relates to wage increases and bonuses and similar type arrangements. Beyond how to spend the money of the company and looking at the financial results of the company, they also are going to be the critical link between the company and its auditors. which would include internal audit and external audit. They'll look at the audit plans that internal and external auditors have and make sure that they're comfortable with the scope of the services that are being provided and making sure that all of the various areas of the business are being addressed as they think is necessary. For the external auditors, they're going to be the ones that would actually engage the external auditor in most cases. So management would make a recommendation around which CPA firm they wanted to hire, and then the governance structure would, whoever those charged with governance is or are, they would be the ones to make the ultimate decision of which CPA firm to hire and determine the fees that they would be paying, the timing of the engagement, the full scope of services that they're comfortable with the auditor providing. And a large part of that is that they are the ones that are looking for any possible issues where there might be independence issues for the auditor. And so them being the objective party looking at who's being selected and what they're doing and how much they're being paid are critical elements in them to make sure that auditor independence is being maintained and safeguarded to the fullest extent possible. Other things that those charged with governance might do on a routine basis is to look at what the results are of any internal control assessments. So whether the deficiencies are identified by internal audit or external audit, or whether deficiencies are identified through management and some self-assessment work that they might be doing. Their job is to look at any identified deficiencies and to make sure that they're being remediated or fixed on a timely basis. They also should get periodic updates from management on what's the entity's approach to adopting any new significant accounting standards or any changes that they're making to significant estimates that are reflected in the financial statements, or if they are modifying or enhancing any other types of standards or principles that they have been using to create the financial statements for the company as a whole. The last thing that they should do is they should periodically assess themselves. And so there needs to be a means of showing that they really are committed to this spirit of continuous improvement and engaging in an open and honest dialogue about internal controls over financial reporting and generating reliable financial statements. And then they, at least once a year, should look at their charter and look at their composition and to make sure that they have included everything and done everything they can on their end to ensure that they are a good, sound governance structure fulfilling the roles and responsibilities that they're expected to fulfill in order to really strengthen the reliability of financial reporting for the organization as a whole. One of the things that board members are going to need to have in order to do their job well is to make sure that they are getting timely and relevant information. They need to feel as if they have the time to explore and understand and resolve any potential issues that come to their attention. And they also need to feel comfortable that they have adequate resources to be able to hire a consultant perhaps to come in and explore a particular issue that might be of importance to the financial statements as a whole. They might have a valuation expert come in to go and come behind management to look at how they valued a particular piece of property that they own, or they may bring somebody in to actually do an assessment of internal controls over financial reporting, and they might compare those results to what management is doing on a regular basis. And so they need to feel as if they could go out and engage specialists, which may include legal counsel, to explore relevant issues and to make sure that they're governing the organization appropriately. Most boards rely on management to provide information to them, and they rely on management to make certain representations to them about the financial statements. But you have to keep in mind that management often will put their own spin on information, and this is particularly going to be true if they're trying to conceal or misrepresent the true facts or the financial state of the organization. And so there needs to be a sense of professional skepticism that board members have in order for them to make sure that they're fulfilling their obligations. What I'd like you to do now is to shut down the video and to answer the next series of appropriate questions before we continue with the program. Welcome back to the program. Let's look at the questions that you should have answered on your own. Which of the following would be an appropriate responsibility for a board of directors? A, performing performance evaluations of lower level staff. B, participating in daily routine decisions. C, rubber stamp management's judgments. Or D, engaging the external auditor. The most appropriate responsibility for the board of directors is going to be D, to engage the external auditor. Those charged with governance, including a board of directors, really should not be too heavily involved in the day-to-day decision-making and routine things, including doing performance evaluations of lower-level staff, although they may be involved in doing performance evaluations of management. They also need to make sure that they're not just rubber stamping management's judgments, but that they are objective in looking at the judgments that are brought to them for review and approval, and to make sure that they're making decisions in the best interest of the entity and the stakeholders of the entity. The next topic that we're going to cover is audit committees. The purpose of the audit committee is to take an active role in overseeing the entity's accounting and financial reporting policies and practices. So they're going to assist the larger board in fulfilling their fiduciary responsibilities. So they're often a subset of the board of directors. There needs to be a process to make sure that the audit committee is informed of significant issues on a timely basis so that they can adequately fulfill this fiduciary responsibility to oversee accounting and financial reporting, policies, practices, results, and key decisions. So the audit committee needs to make sure that they understand how management is identifying and monitoring and controlling the financial reporting risks that could affect the organization and the reliability of the financial statements. They also need to make sure that there's a direct line of communication with the internal and external auditors to discuss any relevant matters that come up that are significant to the financial statements. So if there is an audit committee, the audit committee is the one that will meet with the internal auditors, they'll meet with the external auditors, they'll talk to management most directly around things that influence financial reporting and internal controls over financial reporting, and then they, in essence, will share that information with the larger board in a more executive type forum. It's important that they meet with the external auditors because they need to make sure that they understand the auditor's objective and independent perspective around the reasonableness of the financial reporting process and the system of internal controls that's generating the financial statements. They also want to know if the auditors have any significant findings or recommendations that the organization should take into account to strengthen and improve the reliability of their financial statements. They're going to be talking with the external auditors about what's going on within the organization, but they also are there to be the second set of eyes to make sure that the external auditor is maintaining their independence and objectivity in performing the services. So their job is to make sure that if they feel as if there is a real or perceived independence issue, that they bring it to the attention of management and the auditors, and that they ensure that that independence issue gets resolved to their satisfaction, which may include changing the staff that are assigned to engagement, or it may include changing CPA firms to do attest services for them. Sometimes they may be asked to interact with regulators. So if the SEC sends somebody in to deal with a particular issue that they think may not be handled appropriately, or if the government accounting office sends somebody in to look at the financial statements related to somebody that gets federal funding, there may be questions that arise around compliance with laws and regulations, or whether or not something's been properly presented or disclosed or classified in the financial statements. And the audit committee would be the one that would be the link between that would be there to link between management and the regulators, and also to be the speaking voice of the board in trying to resolve those types of issues. So they have a lot of authority and to make decisions, but all of those decisions are going to be sometimes they're going to be necessary to get the larger board to review and approve them. So they're the first stop on the train, but they're not necessarily the final stop on the train. So oftentimes they'll bring issues to the forefront, discuss them, investigate them, and then have some preliminary decisions and recommendations that they make to the full board, which could include engaging or replacing or determining external auditor compensation. If the organization is a publicly traded organization, the Sarbanes-Oxley Act is the law that's in place that deals with audit committees and what their purposes are and how they need to be assigned responsibility and who could sit on these audit committees. So there's formalized rules that need to be followed if the entity is a publicly traded entity or an issuer. So this sense of accountability really tries to build into the system of internal controls what are the direct responsibilities of these directors that are sitting on these boards of publicly traded organizations, and more specifically, what's the responsibilities of the audit committees. One of the requirements that a publicly traded company has to follow is that they have to have more than half of its members be outside directors or independent directors. So the audit committee has to be comprised of outside or independent directors, and they have to make sure that at least one of those outside directors is financially literate, meaning that they need to be able to understand financial statements, understand generally accepted accounting principles, understand alternatives and treatment of accounting principles that an organization might face as far as some of the decisions they have to make. So there has to be one person that qualifies as being financially literate, and more than half of the members needs to be independent or outside directors. In addition, if it's a publicly traded company, by law, it's required that the internal audit function of an organization report directly to the audit committee in order for there to be that extra line of oversight and to ensure that management can't interfere in the communications between the internal auditors and those charged with governance. When we talk about being financially literate or being a financial expert, there are no hard and fast rules that the Sarbanes-Oxley Act puts in there. There's no real checklist to go through and complete, but they do give some general criteria of what they're looking for in an individual that satisfies that criteria. And some of it is likely going to come from their training or the experience. Now, they could have had training or experience as an outside public accountant. They could have been somebody that was a controller or a CFO for a private company or a publicly traded company. It doesn't have to be that they had training or experience in the exact type of company, the exact nature of company, but they do need to make sure that they understand the general accounting principles that are relevant to the organization and that they understand the general business purpose of the organization, and that they are somebody that's willing to take on the responsibility of getting brought up to speed on any particular industry-specific issues that the organization might be dealing with. So in essence, they want to make sure that they're comfortable, that they would understand the key elements that are going into the financial statements that they're supposed to be reviewing and approving and overseeing the preparation of. This would include any type of estimates or accruals or reserves where there's subjectivity involved in coming up with the amounts that are being presented in the financial statements. They need to have experience around understanding internal controls and key controls that are important to creating the financial statements. And they also need to make sure that they understand what their role and responsibility is. And so they need to understand how an audit committee functions. In looking for people to sit on an audit committee, it's important for an organization to do appropriate due diligence, which is going to include performing background checks, of getting independent references, of looking to see what else are they involved with as far as their business affiliations, professional affiliations, whether they're also a director of any sort of other company, particularly if it's an entity that might be competing with the organization that's looking to bring somebody on as a member of the audit committee. They want to make sure that they are comfortable enough with this information so that they can be comfortable about their technical skills, their means of what any sorts of conflicts of interest they might have with the existing organization, and then also just whether or not they think that they'll be able to fulfill their responsibilities with due care and professional skepticism. Sometimes you might use an independent search firm to go out and look for these individuals. Larger publicly traded entities are often going to expend those resources to make sure that they're finding the best candidates possible. There also often might be a nominating committee within the board of directors that also might oversee the due diligence process of deciding which members of the full board of directors would be appropriate to establish as the audit committee within the board of directors. If there are issues with independence and ethics that need to be dealt with, you want to make sure that anything that's identified as being potential issues is updated on an annual basis at a minimum, and that you also look for things that changed over the course of the year that might actually influence a director's independence and objectivity. So there needs to be a constant revisiting of who is the most appropriate to sit on this board as circumstances change. The chairperson particularly plays a critical part of the audit committee because they're the ones that really need to make sure that they have an appropriate level of financial reporting expertise. They're the ones that are going to potentially be the one that's going to be the direct line of communication between the auditors and the audit committee itself. So if there is going to be conversations where the auditor calls up somebody from the audit committee to talk to them about significant issues and potential issues with fraud or something there they think that accounting treatment might not be handled appropriately, they're often going to start with the audit committee chairperson as being their main contact. So there needs to make sure that there's an open channel of candid and ongoing dialogue with all appropriate parties between the audit committee, which would include the internal audit director, the external auditor partner, as well as direct lines of communication with executive management and members of the board. It's appropriate for the external auditors to periodically meet with the audit committee in private and to discuss things like audit findings and the quality of the internal controls over financial reporting and the scope of the audit and how management's doing, any disagreements they may have had with management, any difficulties in performing the audit. So if there is an audit committee, it's expected that they would have a separate meeting without management present in order for them to discuss these things in an open and honest, meaningful way. Let's take the time to go ahead and answer the next series of questions. So turn off the video, answer the questions on your own, and then turn the video back on and we'll debrief them. So welcome back. Let's go through and look at the questions that you answered on your own and discuss why the answer that we suggested as being the most appropriate is the best choice. Which of the following is not an appropriate purpose of an audit committee? Is it A, they give adequate consideration to understanding how management identifies, monitors, and controls financial reporting risks? B, that they assist the board in maintaining a direct line of communication with both internal and external auditors. C, they only meet with auditors with management present. Or D, review the full scope of external auditor activities. The answer up here that would not be an appropriate purpose of an audit committee would be C, only meet with auditors with management presence. As we discussed, it's important for the auditors to meet with the audit committee in an executive session without management present so there can be a full and robust and open dialogue about potential issues and concerns. Which of the following is an indicator of financial expertise? Is it A, no formal accounting education, B, an understanding of generally accepted accounting principles, C, lack of experience with internal accounting controls, or D, no understanding of how an audit committee should function? The item that would be an indicator of financial expertise would be B, an understanding of generally accepted accounting principles. We need them to have, as a financial expert, somebody that does have adequate training and experience and understands financial statements and understands internal controls over financial reporting and understands how an audit committee should function in fulfilling their roles and responsibilities. The next thing we're going to talk about is the duties, responsibilities, and authority of officers and other employees of the organization. So senior management is an important part of governance. Often when we think about governance, we think about the board, we think about an audit committee, we may even think about an executive management team or an owner, but senior management also plays an important role in governing an organization. A large part of it is that senior management is so influential in establishing the tone and the control consciousness of an organization. So their attitude would trickle down to the lower levels within the organization. It's important for them to have a high understanding of generally accepted accounting principles, to understand the financial reporting standards and their specific application to their industry and the nature of their business and best practices that might be important for the organization. So they need to have a high-level understanding of everything that's relevant and important to generating reliable financial statements. And they also need to make sure that there's a good solid system of internal controls over financial reporting. They're the ones that are primarily responsible for the design, implementation, and monitoring of the financial reporting system, and they play an important role in preventing and detecting fraud as well as error in these financial statements. Their responsibility would include making sure that all company staff accepts responsibility for their part and their role in internal controls over financial reporting. So that's where that monitoring element becomes critical, is they can describe to company staff what they want them to do and how they want them to do it and when they want them to accomplish it by. But it's their job as senior management to do some monitoring to make sure that things are happening as intended. It's also their responsibility to make sure that there are adequate financial reporting competencies throughout the organization. They need to be able to identify what do we need our employees to have as far as their skills and experiences and education in order to support accurate and reliable financial reporting. If they don't have someone on staff that's able to fulfill those roles and satisfy those obligations, then they may need to retain somebody or use an outside service provider to ensure that all those competencies are ultimately met. The organization should regularly evaluate and maintain the needed competencies. So as things change, as the business gets more complex, as new accounting principles come out, as the organization grows and evolves, they may need to add people to the system of generating financial statements in order to ensure that the reliability of the financial statements is preserved. Smaller entities sometimes really struggle with that because they don't have the ability to go out and hire the best and the brightest and to necessarily have, to add 2-3 people to the accounting staff in order to ensure proper segregation of duties and reliable financial statements. So what they need to do is they need to make sure that they are trying to design their system of internal controls to avoid any unnecessary complexity in the structure of transactions or the structure of the organization, to make sure that they are looking at, not that they can't stretch themselves and try to get engaged in some complex transactions, but they want to make sure that they're making a choice, that if they decide to go down that path, that they're going to need to make sure that they supplement their financial reporting competencies to ensure that somebody has the skill set needed in order to process those activities, review those activities, approve those activities, and make sure that everything ends up in the financial statements appropriately at the end. This may involve making sure that senior management gets additional training and development to keep their skill sets up to date and current with the types of transactions and events that the organization is engaging in at that point in time. It's time to do some more questions, so go ahead and shut off the video and answer the next series of questions before we begin again. Welcome back. Let's debrief the correct answers to the questions that you answered. Which of the following is not an important consideration for senior management of an entity in fulfilling governance responsibilities? Is it A, adequate understanding of financial reporting standards and their application? B, ensure that all entity employees accept responsibility for their role in internal controls over financial reporting? C, that they devote resources to hiring and retaining qualified individuals? Or is the correct answer D, abdicate responsibility of monitoring financial reporting to the external auditors? The answer that is not an important consideration for senior management of an entity in fulfilling their governance responsibilities is D. You can't abdicate your responsibility for monitoring financial reporting. Senior management is primarily responsible for the financial statements, and they're primarily responsible for designing and implementing and monitoring internal controls over financial statements. They cannot abdicate that responsibility to external auditors. However, they do need to make sure that they're doing A, B, and C to make sure that they understand financial statement standards themselves, that they make sure that everybody understands their role and responsibility in internal controls over financial reporting, and they want to make sure that adequate resources are devoted to hiring and retaining qualified individuals to ensure that you have adequate financial reporting competencies. Another question was, which of the following is a management control method that most likely could improve management's ability to supervise company activities effectively? Is it A, monitoring compliance with internal control requirements imposed by regulatory bodies? B, limiting direct access to assets by physical segregation and protective devices? C, establishing budgets and forecasts to identify variances from expectations? Or D, supporting employees with the resources necessary to discharge their responsibilities? So what's going to enable management to improve their ability to supervise company activities effectively? The best answer is C, to establish budgets and forecasts to identify variances from expectations. We're now going to discuss internal control over financial reporting. And if you remember from an earlier section when we were talking about different definitions, I said that the definition of internal control over financial reporting was a process affected by the company's board of directors, management, and personnel that's designed to provide reasonable assurance regarding the reliability of financial statements. So if you recall correctly, we talked about it being a process where it was an integrated system of controls that all work together to reduce risk to ensure reliable financial reporting. The effectiveness of internal control over financial reporting involves a lot of judgments because the design of the system is a matter of professional judgment to determine what's necessary to put in the system versus not, and to try and make some judgment calls also around what things need to be functioning effectively for there not to be a material weakness in the financial statements. So there's really 5 components of internal controls that are important elements of a good system of internal control over financial reporting. Now, this doesn't mean that all 5 components have to function at the same level, and it also doesn't mean that there's a set design of controls that needs to be in existence for every single entity in order for it to say that it has an effective system of internal controls over financial reporting. But what it does mean is that you have to understand the 5 different components of internal controls so that you can properly design the system using elements of each of those in order to create a process as a whole. So controls in one component may serve the purpose of controls that might normally be in another component, or there might be several controls that all work together in order to meet that to satisfactorily meet the objective of generating the reliable financial statements. So let's talk about the different components of internal controls. And the components that we're going to discuss are the ones that are in the COSO Internal Control Integrated Framework. So you remember from our earlier section, COSO stands for the Committee of Sponsoring Organizations, and it designed this integrated framework that is the most widely used framework in the world as it relates to designing internal controls over financial reporting. The very first component out of this COSO integrated framework is the control environment. So the control environment sets the control consciousness of the organization and sets the standards that everybody follows around ensuring reliable financial statements. It's the foundation for all other components, and in fact, in a later section, we're going to talk more about the control environment in more detail. The second component of the COSO integrated framework is risk assessment. And what's involved with risk assessment is identifying, evaluating, and analyzing things that might keep an organization from having reliable financial statements. So those are risks. So you identify risks that will either happen to an organization because there's things that could occur internal to the organization, like turnover of key staff, or it could be a risk that happens outside of the control of the organization, or an external risk like changes in the economy or interest rates. So the job of management and governance is to properly identify all the things that could impact an entity's financial statements and to evaluate the magnitude and likelihood of those things happening, and to analyze and decide which of those risks they need to design controls around to manage those controls and mitigate those controls so that you're not creating misstatement in the financial statements. So risk assessment is going to look at the ability of the organization to record and process and summarize and report financial data that's consistent with management's financial statement assertions. It may be a very formalized process, or it might be something that's less formalized and less structured for smaller entities, because smaller entities are naturally going to face fewer risks. So out of the 5 components, we talked about the control environment and we've talked about risk assessment. The third component of the COSO framework is information and communication. Information and communication has 2 aspects to it. One of them is the information systems used or that are used to produce reports containing operational, financial, and compliance related information that's critical for running and controlling the business. This information is going to include all internal and external information that's pertinent to the financial statements and the things that must be identified and captured and communicated in a form and a time frame that enables people to carry out their responsibilities effectively. So in essence, it's the nerve center of an internal control system. So beyond the information systems themselves, there also is this aspect of communication. And communication means that there is a robust and open dialogue about the data and the information necessary to create reliable financial statements. So that's information that must flow up through the organization, from the lower levels of the organization upwards to management. The things that must be communicated from management down. Things that must be communicated across departments, or must be communicated with legal counsel or the external auditors or regulatory bodies. So it's looking at all forms of communication that enable and support the understanding and the execution of internal control objectives, processes, and responsibilities. It's important for this communication to emphasize that people need to have a clear message from the top about the seriousness of their internal control responsibilities, and they must understand their role in the system of internal controls and how their activities that they perform relate to the work of others. So the interrelationship of all the controls and how what the activities that one individual performs, how it impacts the ability of other individuals to fulfill their responsibilities as well. And as we mentioned, this communication is not just internal, but also who does the organization need to communicate with external to the entity, which may include customers, suppliers, shareholders, external auditors, regulators, and similar type bodies. So with the 5 components of the COSO integrated framework, we've discussed control environment, we've discussed risk assessment, we've discussed information and communication, and the 4th thing we're going to discuss is control activities. So once an organization has set the right tone in the organization around the importance of internal controls, and once they have decided what risks they need to manage, they need to go through the process of managing those controls. And so the control activities are the actual policies and procedures that help ensure that management's directives are carried out. It's the actions that are necessary to address the risks that were identified as possibly influencing the achievement of the entity's financial reporting objectives. Control activities can occur throughout the organization at all levels of the organization and any function of the organization. It's the things that happen all the way from when things are processed, initiated and authorized and processed through the system, to the reconciliation and review of activities that come out of the system, all the way through creating the financial statements. So the range of activities can be very, very diverse, and it can be something that's done through various levels, various people, various functions. It's everything from processing and recording things, approving things, reconciling things, and reporting things in the financial statements. Control activities is different than control objectives, and so I want to make sure that you don't get confused about that. The 2 different terms are very distinct in their meaning. A control objective is the target that management establishes that sets the goal that they're trying to meet. So it's typically stated in terms that describe the nature of the risk that this control is designed to help manage or mitigate. So for example, a control objective might be that all transactions should be properly authorized. So the objective is to ensure that all transactions are properly authorized. The control activity is going to be the actual authorization of transactions. Who does it? When do they do it? How do they do it? How is it documented? So it's not the why we're doing something, which is the control objective. It's the control activity is the what you're doing, when you're doing it, how you're doing it. So the 4 components of the COSO integrated framework that we've talked about so far: control environment, risk assessment, information and communication, and control activities. The 5th one that we're going to discuss, and it's the final component of the COSO framework, is monitoring. Monitoring helps make sure that all these controls that were designed to function a particular way, that's what's actually happening over the course of time. So it's an ongoing assessment around the quality of the internal control process, and it also involves considering whether or not there needs to be corrections made into the system in order to strengthen and improve the system of internal controls over financial reporting. Monitoring could include separate evaluations, things that are done periodically by internal audit or through a control self-assessment, or things that are performed every year as you close out the financial statements. Or it could be things that are performed or activities that are performed on an ongoing basis just through the normal course of business and how people generally carry out their responsibilities. So monitoring ensures that controls are appropriately operating as effectively as possible, and they're also looking to see whether or not there needs to be modifications or changes to controls because of changing circumstances in the entity, its environment. This may involve communications from outside of the organization, like customer complaints. Customer complaints may alert somebody within the organization to let them know that perhaps goods are being shipped out without the right number of items being in the package. So the monitoring can also include external parties and the information that you might gather from them about the operating effectiveness of controls. So we've talked about the 5 components of the COSO integrated framework: communication, the control environment, risk assessment, information and communication, the control activities themselves, and monitoring. What I'd like you to do is to go ahead and answer the next series of questions, and then we'll pick back up with our materials. Welcome back. Let's debrief the answers to the questions that you should have answered on your own already. Which of the following is not a component of an entity's internal control? Is it A, control risk, B, control activities, C, the information and communication systems, or D, the control environment? The correct answer is A, control risk. The one that is not a component of an entity's internal controls is control risk. The components of the internal control are, as you recall, the control environment, risk assessment, information and communication, control activities, and monitoring. Which of the following factors would most likely be considered an inherent limitation to an entity's internal control? Is it A, the complexity of the information processing system, B, human judgment in the decision-making process, C, the ineffectiveness of the board of directors, or D, the lack of management incentives to improve the control environment? The answer that would most likely be considered an inherent limitation in an entity's internal control is A, the complexity of the information processing system itself. We're now going to talk about enterprise risk management. And enterprise risk management, or ERM as you're commonly going to hear it referred to, is a principle that takes the COSO integrated framework related to internal controls and enhances it to have it really start thinking about how do we use our systems to provide value to all of our stakeholders. So that's the underlying premise of ERM, is that every entity exists to provide value for its stakeholders, and management's challenge is to determine how much uncertainty to accept as it is striving to grow that stakeholder value. Management needs to be able to effectively deal with uncertainty and associated risk and opportunity while still enhancing value for its stakeholders. That means they have to make choices. They have to go through the process of saying, well, how much risk am I willing to accept in order for me to expand my revenues, or for us to reduce our costs, or for us to make an acquisition to grow our business geographically. All of those things are opportunities that are available to a company that may enhance shareholder value or stakeholder value, but there is going to be some relative risk that those decisions will not end up in the way that we would hope they would. So in order to ensure that they are meeting those objectives of creating value, the organization also has to look to see how it is that they're looking at compliance with laws and regulations, and operational effectiveness and efficiency, and generating reliable financial statements. There's lots of objectives that all are important to the organization, and all of them are going to have consequences for the organization if those objectives aren't achieved. So enterprise risk management is a process that's affected by an entity's board of directors, management, and other personnel, which is applied in strategy setting across the enterprise. It's designed to identify the potential events that may affect the entity and helps management to decide what their appetite is for risk, and helps them to decide how it is that they could design controls and activities to provide reasonable assurance that they're achieving the entity's objectives within that risk appetite that they've established. Elements of enterprise risk management start with making sure that they know what risk appetites are for the organization and what are the different strategies that they could employ in trying to align their alternatives with their objectives that they're trying to achieve, and trying to figure out what are the mechanisms that we're going to develop to manage these related risks. Sounds a little complicated, but let's talk a little bit more about it, and I think it'll start making a little bit more sense to you. They have to decide when they identify a risk, and that's going to be very similar to back when we were talking about the COSO internal control integrated framework. We said that you're going to identify the internal and external things that could occur in an organization and decide what's the likelihood and magnitude of that happening, and then deciding what it is that you're going to do about it. It may be in some situations that the risk is there, but the magnitude of the risk wouldn't be all that great. It would be relatively inconsequential or trivial. So while it's possible for this threat to occur, it really wouldn't have a big impact on our financial statements. In that case, the entity may decide to just accept that risk. It's a risk we're willing to live with. In other cases, the impact of the risk might be so material and so significant to the financial statements that the entity might decide to avoid the risk, and they might decide not to engage in that particular strategy. They also might decide that they could reduce the risk. So it's a big risk, that's something that could go wrong, but we can put some mitigating or compensating controls in place to try and reduce the risk down to an acceptable level. And then the fourth strategy that they could take in looking at how to respond to risk would be to share the risk. And so a lot of times where you see organizations that joint venture with another organization to get into a particular product or service line, or to engage in acquiring a company, they might decide to do that with another organization in order to share the risk. And so then their portion of the risk is at an acceptable level. So what they're trying to do is to rigorously identify what could go wrong and to try and decide what do we want to do about it. What is the possible responses that we could have to these risks that we identified? I can either avoid them, I can accept them, I can reduce my risk, or I can share my risk. The goal at the end of the day is to try and reduce any surprises that might come along that would severely impact the financial statement. So you're trying to minimize your losses. You're trying to make sure that you are doing this process in such a way that you're reducing any surprises and any associated costs or losses that would come along with those surprises, things that we didn't anticipate. Because hopefully you've gone through a very rigorous process of identifying all the things that could go wrong, so that if they do go wrong, you've already dealt with the situation by already have made that decision about, well, we knew this was going to happen and we decided to accept the risk, and it's okay. Enterprise risk management, or ERM, by calling it enterprise risk management, is emphasizing that governance needs to think about the enterprise as a whole. So you're trying to look across multiple business units. You might be looking at a multinational operation, something that happens on a worldwide operation, and trying to go through and identify the most important things that could go wrong for the entity as a whole. ERM isn't necessarily appropriate for looking at things on a business unit by business unit level. It's really looking at managing risk at an enterprise level and looking at the interrelationships of all the different risks that are out there that might exist at the individual business unit level. So that's a key part of ERM, is that it's enterprise-wide, that it's focused on identifying risks or what could go wrong, and it's emphasizing rigorously trying to go through the process of deciding in what way do I want to respond to those risks? Do I want to avoid them, reduce them, share them, or accept them? When you're looking at all of the potential things that could occur, all the internal and external events that could occur, and you're identifying them and you're trying to figure out what the outcome could be, you're also making decisions about how to use your resources and how to deploy your capital within the organization. Management needs to think about where they have the biggest opportunity to meet their objectives, be it a financial reporting objective, an operational improvement objective, a compliance with laws and regulations objective, or a strategic objective. Where's our biggest opportunity? And let's make sure that we're looking at our capital needs and our allocation of capital to all those needs, and that we're appropriately allocating our capital in the ways that are going to ultimately, hopefully, result in the biggest opportunities for the organization. So it's important for management to use information that's going to help them in their oversight role to ensure that they're moving towards the achievement of what they've determined to be their most critical objectives.
Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. BISC Education.
Hello and welcome. My name is Kevin Kemmer, and I'll be your instructor for today's discussion on the area of economics. Economics is the study of the allocation of scarce resources among alternatives. Again, the economics is the study of the allocation of scarce resources among alternatives. So you can tell by the definition of what economics is that we're assuming that resources are limited and human desires, the desires of people, are unlimited. And so we have this problem of how to allocate those limited resources among alternatives. There are two major areas in economics that we typically think of, microeconomics and macroeconomics. And I'd like to begin today's discussion with microeconomics. And you can just take the word from microeconomics, micro out of there, think of microscope, and that's what we're going to do in microeconomics, is take a really close look. So microeconomics deals with the economic decisions of individuals, that is buyers or consumers, and the firms that are providing the goods or services, those are the sellers, in pursuit of maximizing satisfaction. Again, microeconomics deals with the economic decisions of individuals and firms in pursuit of maximizing satisfaction. Now, the law of demand says that the quantity purchased of a good or service is inversely related to the price, all other things being equal. So what does that mean? If the quantity purchased of a good or service is inversely related to the price, that means that when the price goes up, demand is going to go down. And when the price goes down, demand is going to go up. Now, several factors could affect demand for a product, a good, or a service. First factor that we'd like to talk about is closely related goods. What I'm talking about here is something called the cross-elasticity of demand, how related goods can influence the demand on other goods. And the more closely that two goods are related, then the greater the influence on the change in demand of the other product. For example, let's talk about substitute goods. Substitute goods are closely related goods. For example, margarine and butter. Now, I go to the store and I could buy margarine or I could buy butter. Now, I can use them interchangeably. And so if the price of one of them is going up, then I might choose to buy the alternative. They're just like they sound, that one is a substitute for the other. Other examples of substitute goods would include things like mayonnaise and Cool Whip, movies at the theater versus renting a movie and watching it at home, buying chicken or buying turkey. Chicken and turkey are substitutes. Again, when the price of one good goes up with substitutes, the demand for that product tends to decrease as some consumers purchase the substitute. So what's going to happen is if the price of butter goes up, then I'm going to stop buying butter and I'm going to start buying margarine. So we can see that substitutes, with substitutes, that when the price affects one, the price goes up, demand's going to go down, we'll just go and buy the substitute instead. Other closely related goods would include complements. And these are items that go together. For example, hot dogs and hot dog buns, peanut butter and jelly, cameras and rolls of film, razors and razor blades, and my favorite, surf and turf, little prime rib and lobster. And with complements, when the price of one of the goods goes up, the demand for that product, as well as its complement, tends to decrease. Again, with complements, when the price of one good goes up, the demand for that product and its complement tends to go down. And of course, the opposite is true. If the price of one good goes down, the demand for that product and its complement will tend to increase. There are other factors that can also affect the demand for goods. The next factor I'd like to talk about is income. Now, as personal income increases, as my income increases, the demand for normal goods tends to also increase. And conversely, if my income goes down, then the demand for normal goods will go down. For example, steaks. When my salary goes up, I may buy steaks once a week instead of once a month. And if my salary goes down, then I may choose to not buy any steaks at all and just eat hamburgers. Another example of a normal good would be something like airline tickets. As personal income increases, demand for airline tickets goes up. But if personal income decreases, the demand for airline tickets goes down. On the other hand, there are some products when our income increases that the demand for those goods will actually go down. For example, when my income goes up, I may choose to buy less potatoes. In that case, this is called an inferior good. An inferior good. When you have inferior goods, the increase in personal income will result in a decrease in the purchase of those inferior goods. And the opposite is true as well. As personal income decreases, then the demand for inferior goods is going to increase. So if all of a sudden I have a big cut in my income, then I will probably stop buying normal clothing and start buying used clothing, which is usually perceived as an inferior good. Another factor that affects demand for goods is future price expectations. Future price expectations. If consumers expect that prices are going to go up in the future, then the current demand will increase as people look to buy those goods and services and enjoy them now before the price increases take effect. Again, if consumers expect future prices to be higher, the current demand is going to increase because people want to enjoy those goods and services now at the lower prices and not buy them later when the prices are higher. And of course, the opposite is true in this situation. If consumers expect future prices to decrease or to lower, then the current demand is going to decrease as people will defer the purchases until prices go down. Other factors that affect the demand for goods include things like consumer preferences and market size, group actions like boycotts. As far as preferences go, consumer preferences can change over time, so during a certain period of time, certain styles of clothing might be in fad or in fashion, and therefore the demand for those goods would be larger or higher or greater. And in other times, maybe those fashions would no longer be fashionable, and the demand for those goods would decrease. With respect to market size, when the population tends to increase, there also tends to be changes in demand, and they could be increases or decreases. And certainly things like boycotts are going to result in no demand. When people boycott something, then they stop buying it altogether. What I'd like to do at this time is to take a look at a graph. I know a lot of students get a little hesitant about these graphs and get a little bit concerned about them. So I want to make sure that you're able to read the typical graph that we use in economics. And if you look in your viewer's guide, the first figure that I have is titled the demand curve for video conferencing time. I'd like for you to take a look at that. And I want you to notice we have two axes. You'll recall that the vertical axis, usually known as the y-axis, you'll notice that I have it labeled there. It's the price per hour of video conferencing time. The x-axis is the horizontal axis, and that typically has the quantity of units. Excuse me. The quantity of units in this case would be the thousands of hours of conferencing time. So again, you've got P's and Q's. Teachers and people used to tell you, or your parents used to tell you, to mind your P's and Q's, so you can remember that graphs are a bunch of P's and Q's. The P's are on the vertical axis, the y-axis, and the Q's, the quantity, go on the x-axis. Now what I have there, when you look at that graph, you see a curve, and this is a demand curve for video conferencing time. Make sure that everyone's comfortable with reading this. If you go to the y-axis and go down the prices per hour, $1.90, $1.80, until you get down to $1.50. You'll notice that I have a line drawn from $1.50 over to the demand curve, and then a line downward or vertical from there down to the x-axis, so that you can see at that point when the price per hour of video conferencing time is $1.50, the demand is 4,000 hours. Now this demand curve represents a whole series of demands at various prices. So we can move down this curve. In fact, if you move down the y-axis from $1.50 to $1.30, you'll notice that we slide down the curve, and if you follow the horizontal line from the $1.30 over to the demand line, and then follow the vertical line from the demand curve down to the x-axis, you'll find that the demand at the price of $1.30 per hour is 6,000 hours. So does this follow what we said about demand? It does, doesn't it? We said that the demand is inversely related to price. So as price goes down, demand will increase, and that's what happens here. As price went from $1.50 down to $1.30, the demand would increase from 4,000 hours to 6,000 hours. You find another figure in another graph in your viewer's guide, and this is titled Demand Curves, and I have not just one curve on here, but I actually have three curves for representing demand for video conferencing time. And excuse me, what I'd like you to note is that there are three demand curves. The middle one is labeled just D. Let's start with just D there. You'll notice that using the demand curve labeled D, the price, I have a line drawn from the price of $1.45 over to the demand curve and then down to the x-axis, and you'll find that at $1.45, consumers are demanding 5,000 hours of video conferencing time. Well, what the other curves represent are shifts in demand. This is different than sliding down the demand curve like we did in the previous graph. If you look at the demand curve labeled D sub 1, you'll notice that what happens here is as you follow that $1.45 line from the price per hour, the y-axis, you follow that over to D sub 1, you'll find that the intersection of that demand curve is 7,000 hours. So what's happened between the curve D and the demand curve D sub 1 is we've experienced a shift in demand. At the same price, $1.45, consumers under the D1 curve are demanding 7,000 hours instead of 5,000 hours. Now, why would there be a shift in demand like that? Well, one example could be that there was an increase in the price of a substitute. Maybe there was an increase, since we're talking about video conferencing time, it might be a little bit of a stretch here, but let's say that the prices of airline tickets go up, and therefore we're not, companies don't want to send as many employees out to visit other companies, so they would rather do teleconferencing, video teleconferencing. So because the airline prices are going up, there'll be less demand for airline prices, which will result in an increase in this particular kind of substitute. Instead of demanding 5,000 hours, now demand is 7,000 hours. There are other reasons why there would be a shift to the right or an increase in the demand curve from D to D sub 1. We could also have a decrease in the price of complements. For example, let's assume that these demand curves related to prime rib and lobster, or let's just say prime rib, okay? And the price of lobster goes down. Well, if the price of lobster goes down, then more people like me will want to buy more surf and turf, which means that the demand for prime rib will go up since the demand for lobster is going to go up because of the decrease in price of lobster. So that would cause a shift from D to D sub 1. Another reason why the demand curve would shift to the right is an increase in consumer income. If I get a 20% raise from one year to the next, then I might be more inclined to go out and buy more surf and turf. And that's going to shift the curve to the right, an increase in demand. Well, what about D sub 2? The demand curve D sub 2 represents a decrease in demand. A shift to the left is a decrease in demand here. And why would that happen? One possible explanation would be a decrease in the price of a substitute. So if maybe we had a decrease in airline tickets, then we'd be more inclined to send people face-to-face to meet our clients, and not as much demand would exist for video conferencing since we're sending the people out to the companies, meet them face-to-face. That would result in a shift to the left. Another reason for a shift to the left would be an increase in the price of a complement. Notice this is just the opposite of the shift to the right. When we shifted to the right, we had a decrease in the price of a complement. If we have an increase in the price of a complement, it's a shift to the left. And of course, decrease in income. If we have a decrease in income, then I'm going to buy less prime rib, or I'm going to buy less video conferencing time. So we'll have a shift to the left. The other thing that I wanted to mention about these demand curves is you'll notice the direction that they go. They tend to be downward sloping. And again, that represents the fact that the quantity demanded is inversely related to the price. So as the price goes down, the demand will increase. That means we're going further over to the right. So it's going to be a downward sloping curve. And the way you can sort of remember that is down for demand, or demand slopes down. The D and demand and downward. What I'd like to talk about now is talk about supply. Supply is the quantity of a good or service that sellers are prepared to sell at a given price at a given point in time. Again, supply simply represents the quantity of good or a service that sellers are prepared to sell at a given price at a given point in time. And the law of supply says that the quantity of a good or service sold is directly related to the price, all other things being equal. Again, the quantity of a good or service sold is directly related to the price, all other things being equal. And what that means is that when the price goes up, supply is going to increase. And when the price goes down, supply is going to decrease. You stop and think about it. We said all other things being equal. If the price of a good goes up and all other things are being equal, including the cost to produce that good, aren't the companies that produce the good going to want to sell more since it's at a higher price and it has higher profit margin? Absolutely. And that's why when the price goes up, the supply increases. When the price goes down, the supply is going to decrease. Now, there are several factors that can affect the amount of supply. The first we'll talk about is production costs. If production costs were going to increase, For example, let's say that there are taxes that are now enacted, they're slapped on video conferencing time. What is the effect of taxes on our video conferencing time going to have on our supply? Well, what's going to end up happening is, all other things being equal, with the production cost being higher, there's going to be a decrease in supply. Why? Because if the price hasn't changed, remember, all other things being equal, if the price has not changed, and there's an increase in the cost to produce that product, then the profit margin is going to be less. And so there's going to be less reason or less incentive for the company to supply that. So they'll decrease the supply of the goods. Conversely, any decreases in production costs due to things like lower wages to our employees, lower supply costs, maybe subsidies, all of these things would result in a reduction in our production costs. And if you keep everything equal, including the price, then that's going to result in higher profit margins for the company. And they're going to be willing to supply more at a higher profit margin. So any decreases in costs are going to result in an increase in supply. Technology also affects supply. If we experience technological improvements in the production, then that will result in an increase in supply. Because typically the technology improvements is going to decrease the cost, or we're going to be able to produce more for the same cost overall, so the average cost of production is going to go down. And that's going to increase profit margins. So the company is going to be willing to supply more. A third factor affecting supply is the prices of other goods. Let's say that both goods X and Y are made with the same inputs, the same materials, but the price of Y has gone up. Now, if the price of Y goes up, then producers are going to want to produce more of Y, because as long as the costs haven't changed, but the price of Y goes up, higher profit margins. And the less of good X that they're going to produce, because if the price of the materials have not changed, then the supplier will make a higher profit margin on Y. So the prices of other goods, as those prices change, could impact what the supplier is going to produce. A fourth factor affecting supply would be price expectations. An anticipated increase in the price of a good will cause a firm to supply less now and more later when that anticipated price increase arrives. Again, because they can sell it later at a higher profit margin if they're anticipating a price increase. So price expectations affect supply. If you'll go back to your viewer's guide, I'd like for you to look at another graph. I have a graph in there that's titled Supply Curves for Video Conferencing Time, and it has 3 supply curves. And you'll notice right away that in that graph that the supply curves are all upward sloping. Okay? They're all upward sloping, which pretty much reflects the fact that for supply, when the price goes up, suppliers are willing to supply more. So I sort of remember the supply is an upward sloping because of the UP in supply and the UP in upward. So demand is downward sloping, the supply curve is upward sloping. Now, let's look at the middle curve here, the one that's just labeled S. At a price of $1.45 per hour, suppliers are willing to supply 7,000 hours of video conferencing time. Again, all I have to do is follow the line going from $1.45 on the y-axis until it intersects the S demand curve, and then follow the intersection going down to the x-axis. And we follow that line down, we come to 7,000 hours. Okay. Well, what happens if we go from S to, say, S2? Why would there be a change here? And again, I want to point out, we're not moving up and down the same curve. What's happening here is you go from S to S2, you're experiencing an increase in supply. Why? We'll follow that $1.45 line over until it reaches S2. And then you go down to the x-axis and you'll see that at $1.45 on the S2 supply curve, suppliers are willing to supply 9,000 hours. as opposed to the 7,000 hours they were willing to supply for the demand curve just labeled S. So what would cause that increase in supply from 7,000 to 9,000 hours? Well, one reason might be a decrease in production costs. If the company is able to produce those video conferencing hours for a cheaper price, whether it's due to an improvement in technology or some other production costs, then they're willing to supply more because they now have a higher profit margin. Again, we're holding everything else equal. The price being equal, we have a lower production cost. That's going to be a higher profit margin. Suppliers will be willing to supply more. Another reason why there might be a shift from the S demand curve to S sub 2, an example would be a decrease in the price of other goods. If other goods decrease in price, then the profit margin is not as good, and so it'll shift. What about shifting from S to S1? What's happening there? We have a decrease in the supply, and that could be caused because of an increase in production costs. If our costs are going up, whether it's because wage increases or just supply costs are going up, or subsidies have been discontinued, all of those would result in higher production costs. And if we have higher production costs, but the price that we sell it at doesn't change, what happens to your profit margin? It goes down. And so suppliers don't want to sell it at a lower profit margin, so they'd be willing to supply less. So there would be a shift from 7,000 hours to 5,000 hours. There's one more graph that I'd like for you to take a look at, and I've titled it Demand, Supply, and Market Price for Video Conferencing Time. And what I've done here is I put both a demand curve and a supply curve on this graph. And this is important to us because when we put the demand curve and the supply curve on a graph, we'll be able to determine what the equilibrium point is. In a free market, what is the quantity of goods that would be supplied and at what price? And so what we would do is find the intersection of the demand curve and the S curve there, the demand curve and the supply curve. And I've labeled that point E. And I've drawn a line, a horizontal line, over to the y-axis so you can see what the price is, $1.30. And I've drawn a vertical line down to the x-axis to 6. And you see that at a price of $1.30 per hour, suppliers and buyers, they'll have an equilibrium exchange of 6,000 video conferencing hours. What I'd like to talk about now is the concept of elasticity. Now, elasticity is the measure of the sensitivity or the responsiveness of quantity demanded or supplied to a change in a determinant of that demand or supply. The reason why I say demand or supply is because there are different measures of elasticity. And the first one that I'd like to talk about is the price elasticity of demand. So if we're talking about the price elasticity of demand, we're talking about measuring the sensitivity or responsiveness of quantity demanded to a change in the price of the good. Again, the price elasticity of demand is a measure of the responsiveness of the quantity demanded to a change in price. So if prices change, how does the demand change? Well, there's a couple of approaches that we can determine how elastic the demand is. And the first way that we could go about it is by using a formula approach. Now, the measure of sensitivity or responsiveness of quantity demanded, and using a formula, what we have to do is we have to look at the responsiveness of the change in demand, and that's going to be one measure, and then we're going to divide that by the percentage change in price, which is in the denominator, and then put those two together. So it's a sort of a large formula, and we actually have two different formulas, or two different methods of approaching the formula for the price elasticity of demand. So let's begin with the simple method. And just like it sounds, it's simple, it's easier. What you're looking at is the responsiveness of quantity demanded, the percentage change in demand. We're going to take the demand after the price change, subtract out the demand before the price change, and divide it by your starting point, the demand before the price change. And so that gives you the percentage change in demand. That will be your numerator for the price elasticity of demand. Then in your denominator, you're going to look at the percentage change in price. So prices are going to change from P1 to P2. You're going to look at the change in price. That will be P2 minus P sub 1, or P1. And then you'll divide that difference by the original price, the starting price. So it's very simple in that in your little calculations, the little denominators, if you will, are just the starting points. So when you look at the percentage change in demand, you're using the original demand. When you look at the change in price, the percentage change in price, you're looking at the original price. And one thing that I need to comment on here in computing the price elasticity of demand is that we use absolute values. So if price goes down, say from $1 to 75 cents, you actually have a decrease in price. And when you take that change in price, it'll be minus 0.25. Well, for price elasticity of demand, we'll take the absolute value and instead just use 0.25 instead of using the minus 0.25. Well, let's look at an example using this simple formula. Let's assume that we have a hot dog vendor. And every day at the rush lunch hour, the hot dog vendor sells his hot dogs for $1 per hot dog, $1 per hot dog. And in the normal lunch hour, when he has that price of $1, the vendor is able to sell 100 hot dogs. Let's say that the supplier, the vendor, wants to change the price and see what happens to demand. And the vendor decides to reduce the price to 75 cents per hot dog. And when the vendor changes the price of the hot dogs to 75 cents, it results in 150 hot dogs being sold. Well, let's compute the price elasticity of demand for the hot dogs using the simple formula. Now again, the simple formula is the percentage change in demand divided by the percentage change in price. So let's do our percentage change in demand first. The demand originally was 100, it went up to 150. So to get the change, we take the 150 after the price change, subtract out the starting point of 100. So 150 minus 100 will give you 50. And then we have to divide that by what? Our starting point. Simple formula using just that one starting point. And the starting demand was 100. So we've got a 50 unit change divided by 100, that's 50%. Now let's do the denominator. That's looking at the percentage change in price. Price went from $1 to 75 cents. So we're going to take P2, the price after the change, that was 75 cents, subtract the starting price of $1, P1, and you're going to get minus 0.25. Again, we're going to use the absolute value. So make sure you just use 25 cents here. And then in the denominator, we're going to divide that by the starting point, the original price, which was $1. So we've got 25 cents divided by $1, and that's going to give you 25%. So we've got 50% in the numerator, 25% in the denominator. The price elasticity of demand for hot dogs here is 2. Now, what that number tells us is how elastic demand is. And as a rule, when the coefficient is greater than 1, then we say that that demand is elastic. In other words, it's responsive to price changes. Well, now let's look at the computing the price elasticity of demand using the ARC method. Now, the ARC method, instead of using one starting point, in other words, the original demand or the original price, depending which part of the formula you're in, you actually want to use an average. So the formula for price elasticity of demand would be the change in demand, D2 minus D1, divided by the average demand. Well, the average demand is D1 plus D2 divided by 2. So now in the denominator for that part of our formula, we've got a lot more than just that original D1. We'll do the same thing in the percentage change in price part of the formula. We'll take P2 minus P1, and we'll divide that by the average price. In other words, P1 plus P2 divided by 2. So if we go back to our same example with the hot dog vendor. The hot dog vendor was selling 100 hot dogs in the lunch hour at $1 each, and when the vendor reduced the price to 75 cents, the demand went to 150 hot dogs. Let's fill in our numbers here for our formula using the ARC method. We're going to have 150 hot dogs minus 100, so we have a 50 hot dog increase, and we're going to divide that by the average demand. Well, the average demand, 100 plus 150 divided by 2 is 125, and that's going to give us 40% as the percentage change in demand for hot dogs, 40%. Now let's look at the denominator part of the formula. Let's look at the percentage change in price. That's going to be the new price, P2, which is 75 cents, minus the starting price, P1, which is $1. We're going to have minus 25 cents, and again, we'll take the absolute value. So we're going to have 25 cents in the numerator here for the percentage change in price. We're going to divide that by the average price. Well, we had $1 plus 75 cents, divide that by 2, and you're going to get about 87.5 cents. So the percentage change in price comes out to be about 0.2857. Well, now we have our numerator, 40%, divided by our denominator of almost 0.29, and the price elasticity of demand using the ARC method would be 1.4. So even though we're using a different method, we still come up with a coefficient that is elastic because it's greater than 1. So again, this indicates that this demand of hot dogs is very responsive to changes in prices. Now what I'd like for you to do is to look in your viewer's guide, and I have a graph there that I've entitled Demand Curve Showing Different Elasticities. And you'll find 3 curves actually on this graph. One's labeled D, one's D sub 1, one's D sub 2. Let's look at the middle line here that's labeled D, and it says that it's unit elastic. Well, what is that, and how do we know? Well, demand is unitary elastic or unit elastic if the price, the coefficient is equal to exactly 1. Well, how are we going to compute that? Well, let's look at that D demand curve. You'll notice that I have a line drawn from the y-axis, which is where we have the price, and we have a price there equal to 10, and draw the line over from 10 over to the demand curve, and then down to the x-axis, and we see that it intersects at a quantity of 1,600. So at that point on the demand curve, at a price of 10, there's a demand of 1,600. Now, if we want to get the price elasticity of demand for this demand curve, we have to pick out another point that we're interested in. Well, let's say that we drop the price to $8. Again, go to the y-axis where the price is 8, and draw a line over to the D demand curve, and then down to the x-axis, and you see that the quantity demanded on the curve there at the price of $8 is 2,000 units. So by dropping the price from $10 to $8, demand goes from 1,600 to 2,000. So it is responsive to the price change, and the question is how responsive is it? Now, in coming up with this graph, I've assumed that we're going to use the ARC method in computing the price elasticity. So let's compute the price elasticity using the ARC method as we change from the price of $10 to the price of $8. Well, what's our formula? We want the percentage change in demand. Well, we've got an increase of demand of 400 units, and we're going to divide that by the average demand. The average would be 1,800 because we have the 1,600 plus the 2,000 divided by 2. So we've got 400 divided by 1,800 as the percentage change in price. Let's look at the percentage change in demand, Now let's look at the percentage change in price. We went from 10 to 8. That's a decrease of 2. Of course, since we're dealing with the price elasticity of demand, we're going to use the absolute value. We're just going to worry about the difference, which is 2, not worry about that the price went down. So it's a price of 2, price change of 2. We're going to divide that by the average price. Well, 10 plus 8 divided by 2 is going to give you 9. So we have in the percentage change in price, $2 divided by $9. And 400 divided by 1,800, then divide that by 2 divided by 9, and you have 1.0. So that demand curve is indeed unit elastic using the ARC method. What about D sub 1? D sub 1 is labeled elastic demand. And elastic demand, as I mentioned previously, means that the coefficient must be greater than 0. And we can compute that. If we use the ARC method, you're going to find, and I encourage you to do that on your own, that the coefficient will be greater than 1. If you were to look at D sub 2 as the price changes from 10 to 8 and compute the coefficient of the price elasticity of demand, you're going to get a number that is less than 1. And when the coefficient is less than 1, that indicates that demand is inelastic. Now, in looking at this graph with these 3 different curves, we've come up with 3 different types of elasticity: elastic, unit elastic, and inelastic. But one of the things that I want to make you aware of is just because you look at the change from one price to another price on a demand curve, that doesn't mean that prices all along that curve are the same elasticity. In other words, D sub 1, when we looked at here, is elastic, but only from the price of 10 to 8. If you go to your viewer's guide, I have another graph, also called demand curve, showing different elasticities, and it's simply one curve. And again, if you were to compute the price elasticity of demand, as you go from the price of 10 down to the price of 5, you'll find that demand is elastic as we go through that price change. As we go through the price change of 5 down to 0, you'll find that demand is inelastic. So we can have one demand curve, and different parts of that demand curve will represent different levels of elasticity. Now, what goods tend to be elastic and what goods tend to be inelastic? I wanted to give you some example of goods that have a tendency to have a price elasticity of demand that we would consider elastic. In other words, greater than 1. Luxury items tend to be elastic. Large expenditures, durable goods, refrigerators, cars. Substitute goods tend to be elastic, and goods that have multiple uses. Again, elastic goods include luxuries, large expenditure items, durable goods, substitute goods, and multiple use items. Goods that tend to be inelastic include necessities, small expenditures, perishable goods, complementary goods, and those that have limited uses. Again, goods that tend to be inelastic include necessities, small expenditures, perishable goods, complementary goods, and those with limited uses. I have another set of graphs in your viewer's guide I'd like for you to take a look at, just to sort of give you almost all the different possibilities. If you go to the graph in your viewer's guide that's entitled 3 demand curves showing different elasticities, you'll see that it has three graphs in there. We actually have a graph A, graph B, and a graph C. Graph A simply represents a demand curve that is completely horizontal. In other words, at the same price, we would have various demands, various quantities demanded. That demand curve is perfectly elastic. In other words, there's no change in price, yet we have a great responsiveness in the quantity demanded. Graph B, you have a vertical line for a demand curve. And this demand curve is perfectly inelastic. In other words, we can change the price a lot, but it's not going to change the quantity. Demand is not responsive to changes in price. In the last example in section C there, you have a curve that represents perfectly unit elasticity. Now, another approach to determining elasticity would be using the total revenue approach. Remember, total revenue is simply price times quantity. So since in looking at elasticity, we're wondering how does demand change with changes in price, what we can do is look at the change in total revenues. And we have a number of possible situations here. If prices were to increase and total revenues were going down, demand would be said to be elastic. Remember, the coefficient is the responsiveness to the changes in demand to the changes in price. Okay? So if prices increase and total revenues go down, we're having a bigger impact on quantity than the change in price. If prices increase and total revenues remain the same, this is an example of unitary elastic. In other words, we have exactly the same percentage change in demand as we have change in price. If prices increase and total revenues go up, then demand is inelastic. Well, we've looked at three situations where price increase. How about if prices decrease? If prices decrease and total revenues go down, then demand is said to be inelastic because consumers are not responding to the change in price. The demand is not as responsive as the change in price. If prices decrease and total revenues remain the same, again, we have unitary elasticity. It's unit elastic. If prices decrease and total revenues go up, then the coefficient is going to be greater than 1. It's going to be elastic. Let's talk about some other measures of elasticity. Let's talk about the price elasticity of supply. This is the measure of the sensitivity or responsiveness of the quantity supplied to a change in the price. Again, this is the measure of the sensitivity or responsiveness of the quantity supplied to a change in the price of the good. So in our numerator, we're going to be having the percentage change in quantity supplied. That's going to be the quantity supplied after the price change minus the quantity supplied before the price change, divided by either your starting supply, if you're using the simple method, or by the average supply, if you're using the ARC method. Then we would divide that by the percentage change in price. P2 minus P1 divided by either your P1 or your average price, depending again if you're using the simple method or the ARC method. Example, we might be interested in looking at how a 5% increase in the price of regular unleaded gasoline would affect the quantity supplied. So we could measure that with the price elasticity of supply and determine how elastic the quantity supplied is to changes in price. The next measure of elasticity is the cross-elasticity of demand. And what this measures is the responsiveness of the quantity demanded for a particular good relative to a change in price of a different good. In other words, our formula is the percentage change in the quantity demanded for good, let's say X, divided by the percentage change in price of good Y. We have a different good in the numerator and a different good in the denominator. For example, this would be like looking at how the price of filet mignon changes, how that price change would affect the quantity demanded for hamburger. So if filet mignon prices went up by 20%, how responsive would the quantity demanded for hamburger be? Now, one of the things I want to warn you about, here with the cross-elasticity of demand, we don't want to use absolute values. Here, we're going to come up with numbers that are either positive or negative, and we're going to use those coefficients to identify whether the goods are substitutes, complements, or unrelated. So by not using absolute values, we could come up with negative numbers. Well, if we compute this cross-elasticity of demand and the coefficient is greater than 0, we consider these goods substitutes. If the coefficient ends up being negative, then we consider these goods to be complements. And if it's exactly equal to 0, that means these goods are unrelated. The final measure of elasticity that I'd like to talk about is the income elasticity of demand. And the income elasticity of demand measures the sensitivity or the responsiveness of the quantity demanded to changes in income. So we're going to have the percentage change in quantity demanded divided by the percentage change in income. For example, let's say we have a 10% increase in income and an 8% increase in stake. Well, we have more income, we have more stake, which is what we would normally think of. Well, when we compute this coefficient, again, we're not going to use absolute values. If the coefficient ends up being greater than 0, then we know the good is a normal good. And we know before that stake is a normal good. So if we have a 10% increase in income and an 8% increase in stake, we know the coefficient is going to be positive. It's going to be greater than 0. And stake is indeed a normal good. Let's look at another example. Let's say that we had a 12% increase in income, and it resulted in a 5% decrease in potatoes. In other words, consumers are making more money, but they're buying less potatoes. Well, when we compute the coefficient for the income elasticity of demand, we're going to end up with a negative number, because remember, we're not using absolute values. And any coefficient that's less than 0 for the income elasticity of demand indicates that the good is an inferior good. Let's talk a little bit about the market. The market is the interaction between buyers and sellers of a good. So you can have a market for airline tickets. You can have a market for potatoes. And as we've discussed previously, the point at which the demand and supply curves meet is called the equilibrium point. Okay? The price at which that equilibrium point occurs is called the equilibrium price, or the market price. So you can sort of think of the market as sort of an automatic system of allocating resources. Essentially what happens is we end up allocating resources and the goods to those that are willing to pay for them. In the market, if there's a shortage of goods, we know that the market price is going to increase. And once the market increases, we know that the quantity demanded will decrease. So there's going to be a shifting here. There's going to be a moving around. And eventually that shortage will be eliminated. We'll find a new equilibrium point. Conversely, if there's a surplus, the price is going to decrease, resulting in an increase in demand, eliminating the surplus. Well, the market, as we just talked about it, is a free market. However, sometimes the market's not always so free. Governments sometimes intervene and they set mandatory or artificial prices. They can utilize price floors or price ceilings. Now, a price floor is a government-mandated minimum price that can be charged for a good or service. Again, a price floor is a government-mandated minimum price. The floor is as low as you can go is the floor, right? It's the minimum price that can be charged for a good or service. And we have a little bit of a problem if the government sets that floor above the market, or in other words, above the equilibrium point, above the market price. And if the floor is set above the market or the equilibrium price, a surplus will develop. Let's look at the figure in your viewer's guide titled Surplus of Video Conferencing Time. You look at the figure, we have demand curve and a supply curve, and I've marked the original equilibrium point. You'll notice where E is, that's the intersection of a price of $1.30 and 6,000 hours. So that was the original equilibrium price. Now, if the government comes in and mandates a floor of $1.50, now $1.50 is above that equilibrium point of $1.30, If they mandate a floor of $1.50, what's going to be the impact? Well, what I've done is I've drawn a line over from $1.50 over to both the supply and the demand curves. And if you follow that line across until it reaches the demand curve, then we can see that at a price of $1.50, the demand is only going to be 5,000 units. But how much are the suppliers willing to supply? If you follow the line from $1.50 over to the supply curve, you'll notice it intersects the supply curve where the quantity is equal to 8,000 units or 8,000 hours. So at a price of $1.50, suppliers will be willing to supply 8,000, but consumers are only demanding 5,000 hours. That's going to result in a surplus of video conferencing time of 3. Let's talk a little bit about how shifts in the supply and the demand curves interact with each other and their impact on price and output. We have a lot of different possible combinations here. I'm going to start with looking at changes in demand and holding the supply constant. If demand increases and supply is held constant, what's going to happen to the price? Well, you've got more people demanding the goods, but there's not additional supply. It's the same amount of supply. The price is going to increase. If demand decreases, however, and supply remains constant, then it's going to result in a decrease in price because suppliers aren't getting rid of all the goods that they would like to. So they're going to have to lower the price in order to reach a new equilibrium. Let's look at changes in supply and let's hold demand constant. If we were to increase supply but hold demand constant, what would be the impact on price? Well, if you increase supply and and hold the demand constant, there's going to be a resulting decrease in price. Why? Because there's more goods out there in the market, but demand hasn't changed. In order for the people, the suppliers, to get rid of those goods, they're going to have to lower their price. If we have a decrease in supply and demand remains constant, then we're going to have to increase our price. Or they're not going to have to increase it, the price is going to increase because there's less supply. What if both increase? If supply and demand increase, we know that more goods would be demanded, more goods are available, and therefore we know output is going to increase, but we don't really know what the effect is on the market price. It really depends upon what the slope of the demand and the supply curves are. Same is true with decreasing supply and demand in that we really don't know what the effect on the market price is going to be. If you have a decrease in supply and a decrease in demand, the only thing that we know is that the output is going to decrease. But we don't know the change in the price. Again, that's dependent upon what are the slopes of the demand and supply curves. A couple more possibilities. What if we have a decrease in income, a increase in demand, a decrease in demand, and a decrease in supply? If there's an increase in demand and a decrease in supply, it will result in an increase in the market price. Just think about it. If demand increases, if you didn't do anything to supply, that's going to increase the price. If supply decreased and you didn't do anything with demand, the price is going to increase. So the combination of the two is also going to result in an increase in market price. However, we wouldn't be able to figure out whether output is going to increase or decrease. That would be dependent upon the slopes of the curves. What if there is a decrease in demand and an increase in supply? Well, if there's a decrease in demand and you didn't change anything else, what would happen? A decrease in demand would result in a decrease in market prices. What if there's an increase in supply? If supply increases and everything was held constant, there would be a decrease in market prices. So when you combine the two, there has to be a decrease in market prices. But the effect on the quantity of output is going to be indeterminable. Well, we've covered quite a bit of material. I think it's time to see what you've learned, what you've picked up in this class. What I'd like for you to do is to stop your tape, go to your viewer's guides, do questions 1 through 13, and when you get your answers, come back We'll go over them together. Welcome back. I hope you tried these. Let's go over them together. The first question says, if a law establishes a maximum price for product Y in a competitive market and the ceiling price is above the market or equilibrium price for product X, what? Well, let's stop and think about it before we read any of the answers. Remember, a ceiling price is a maximum price, so the price cannot go above it, and a floor would be a minimum price. Here, the ceiling price is set above the market. So what we're saying is that you can't go any higher than that ceiling. Well, the market is not higher than that ceiling, so there's not a problem, is there? So look at answer A. It says the law has no effect on the market of good Y. It's not going to have any effect because it does not cause a problem. It would cause a problem if the ceiling was below the equilibrium price. Only when the ceiling is below will there be an effect, and that would result in a shortage. Look at the second question. If the demand for cigars in Miami is relatively elastic, and Miami imposes high taxes on cigars that result in higher cigar prices, then in Miami, A, the quantity of cigars demanded would increase. No, if cigar prices go up, the demand is going to decrease. So A is not correct. B, the demand for cigars would increase. No, the demand for cigars is not going to increase. It would decrease. C, the demand curve for cigars would become vertical. In other words, that's perfectly inelastic. Why would a change in price cause the demand curve to become vertical? How about D, expenditures on cigars would fall? And that's the correct answer. If you remember when we talked about the total revenue approach to measuring elasticity, we said that when prices go up, if total revenues, or in this case expenditures, go down, then the elasticity of demand is elastic. It is elastic demand. Number 3, if the coefficient of elasticity is 2, then the consumer demand for the product is said to be what? Well, we said that when we have a coefficient that is greater than 1, then demand is elastic, and so the answer is letter B. Now, you might want to make a little bit of notes here. Letter A says unit elastic. Well, remember, that is where the coefficient is exactly equal to 1. Letter C says inelastic. Well, remember, inelasticity, or being inelastic, the coefficient would be less than 1. D says perfectly inelastic. Well, in that situation, the coefficient would be 0 because demand is constant at all prices. So again, the answer to number 3 is B. The next question says, if the average household income decreases and there is no change in the price of a normal good, and normal is important here because that's going to have the opposite effect than an inferior good, then the what? Letter A says supply curve will shift to the right. Well, when income decreases, that has no effect necessarily on supply curve. That would impact the quantity demanded. It would cause the demand curve to shift. So A is not right. B, the quantity demanded will move farther up the demand curve. Well, when there's an increase in income or a decrease in income, as in this case, there's a shift of the curve. It's not moving up or down the curve, but an actual shift of the curve to the left or the right. So B is not correct. C, demand will shift to the right. Well, demand will shift to the right if income increases, not decreases. Because if we had more income, we could buy more. But income here decreases. So the answer is letter D, demand curve will shift to the left. Number 5 says an increase in the price of a complementary good will do what? Well, remember, complementary goods, they tend to move in the same direction. And if you have an increase in the price of a complementary good, then what's going to happen to the demand for that good? Well, the demand for that good is going to decrease, right? So it's also going to have an effect on the joint commodity or the complement commodity. Let's read through the answers to see what we have. Letter A says shift the demand curve of the joint commodity to the right. No, that means that we would be demanding more. Well, if the price of a complementary good has increased, we'd be demanding less. So A is not correct. B will decrease the price paid for a substitute good. No, we're talking about complementary goods, not substitutes. C, shift the supply curve of the joint commodity to the right. Okay, the supply curve to the right. Well, an increase in the price of a complementary good is not necessarily going to have a determinable impact on the supply curve. D, shift the demand curve of the joint commodity to the left. Yes, there's going to be a decrease in the demand for the complementary good, or for the complementary goods, because there's an increase in the price of one good. It'll be a decrease for that decreased demand for that good as well as its complement. Number 6, if shoes are part of the consumer's basket of goods and the consumer price index increased by 6% for the year while the price of shoes increased by 2%, then what? You know, if you don't read the whole question, you might get misled here. If you just looked at the price of shoes increasing by 2%, you might be thinking, oh, well, the prices are going up, so the demand is going to go down. Well, what you have to understand is that we are given the consumer price index, which is for a basket of all goods. And all goods went up in price by 6% in overall. But the price of shoes individually, just as a type of good, increased by only 2%. So relative to all the other goods, the price did not go up as much as the other. So in effect, that's sort of like a decrease in price. And what that really means is that now shoes are more attractive, that relatively speaking, the price is less, so the demand curve will actually shift to the right. The answer is letter C. Next question says Y and Z are substitute goods. What would cause a shift in the supply curve to the right for Y, which happens to be a normal good, not an inferior good? So what's going to cause a shift in the supply curve to the right, which means that suppliers are going to be willing to supply more at the same price? Well, they're usually going to do that, if you recall our discussion earlier. They will be willing to supply more at the same price if their costs decrease. If technology causes improvement, wages go down. And if you look at answer D, it says cost-saving technological improvements in the production process for Y. And that will cause a shift in the supply curve to the right. So the answer to number 7 is letter D. The next question says the market for product A is elastic and purely competitive. If the market price of product A increases, what is the effect on total revenue? Well, we said that if a product is elastic, if the demand for that product is elastic, using the total revenue approach, total revenues would actually decrease if the price of that product increased. So the answer is A, decreases. The next question, we have a demand schedule for Kendall Tomatoes. And apparently Kendall Tomatoes has 3 customers, Michael, Kevin, and Gabriel. And we have the demand for Kendall Tomatoes at different price levels. And it says, assuming that these 3 are the only customers of Kendall Tomatoes, which of the following sets of prices and levels of output would be on the market demand curve? Well, let's look at letter A. One set data point is $4.03 units. Well, if you go up to the table, at a price of $4, Michael's demand is 1, Kevin's is 2, and Gabriel's is 0. So the total demand is 3, so that first data point would be on the demand curve. Let's look at the second data point in letter A, $3.12. Well, if we go to the price of tomatoes when it's $3, Michael will demand 3, Kevin will demand 6, and Gabriel will demand 2. Well, 3 and 6 and 2, that's 11, not 12. So A is not the correct answer because one of those data points, the second one, does not fit on the curve. Look at letter B. Letter B says $4.10 units. Well, we already determined in letter A that $4 at $4, the demand would be 3 units, Michael 1 and Kevin 2. So we know that in B, the first data point is wrong. So that can't be the correct answer. Let's go to letter C. Letter C, the first data point is $3.11. Well, when we analyzed letter A, that's what we came up with, the demand for $3. Again, if you go to the price of $3, Michael demands 3, Kevin demands 6, and Gabriel 2. 3 plus 6 and 2 is 11. So that data point fits. How about the second data point in letter C? $4.03. Yeah, that's the same correct one that we did in letter A. At price of $4, Michael will demand 1, and Kevin will demand 2, and Gabriel 0. So that's $4.03. Letter C is the correct answer there. So D should be wrong. Shouldn't have to go through it, but sometimes a good idea to make sure that the other answers are wrong. Let's real quick take a look at it. $2.50 and 17. Well, at $2.50, Michael demands 4, Kevin 8, and Gabriel 5. That is 17. How about the second data point? $4.10. No, we said $4.10 wasn't right. At $4, the demand is 3. So D is wrong. The answer to this question is letter C. The next question asks, an improvement in technology that in turn leads to improved worker productivity would most likely result in A, wage decreases, B, wage increases, C, a shift to the right in the supply curve and a lowering of the price of the output, or D, a shift to the left in the supply curve and a lowering of the price of the output. Well, if we have an improvement in technology that leads to improved worker productivity, we say that that results usually in lower costs and a shift to the right in the supply curve. And the only one that has that in the answer is C, a shift to the right in the supply curve and a lowering of the price of the output. Now, why would the price of the output lower? Well, because usually when you have technology increases, increased worker productivity, you're able to manufacture the units at a lower price. And so C does fit with the question here. With A and B, just because we have improved technology and improved worker productivity, that can't tell us in what direction wages might go. Okay. And D is wrong because it's a shift to the left as opposed to a shift in the right in the supply curve. The next question says, an increase in the market supply of coffee would result in A, an increase in the price of coffee. Well, if supply went up, prices normally would go down, right? So A is not right. B, decrease in the demand for coffee. Well, just because there's an increase in the supply, don't really know whether or not there would be a decrease in the demand. Why would that impact it other than an increase in the market supply of coffee would usually result in a decrease in the price of the coffee. But how does that impact the demand for coffee? How is it going to decrease it? Well, if the increase in market supply of coffee, that would result in a lower price, that would result in increased demand, right? Because as price goes down, demand is inversely related to it. And so answer D is the correct answer because quantity of coffee demanded will indeed increase because of the decrease in price. C is wrong. It says increase in the price of tea. Coffee and tea, I guess the assumption here is that they might be substitutes. If there's an increase in the market supply of coffee, there would be a lower price for coffee, which means more people would buy coffee and less people would buy tea. And if less people are buying tea, then there would be a decrease in the price. So C can't be right. It is indeed letter D. In the next question, it says, in any competitive market, an equal decrease in both demand and supply can be expected to always what? Well, if there's an increase in demand and in supply, we said that we wouldn't know what the effect would be on prices. So A, B, and C all tell you a change in prices, but we can't determine that. The only thing that we do know is that with a decrease in demand and supply, there will be a decrease in the number of units that are exchanged, and that would be C, a decrease in the market clearing quantity. Number 13, it says if a legal price floor of $5 is declared in the diagram below, what will be the result? Well, if we look at that diagram, we can see that where the demand and supply curves intersect, the equilibrium price was $3.50, and the quantity was 70,000. But if there's a law that establishes a price minimum, a price floor of $5, we need to draw a line going from $5 over, and when it connects the demand curve, you can see that demand is only going to be 60,000 units. And if you extend the line from $5 on over to the supply curve, you'll see that suppliers would be willing to supply 80,000 units. So supply is 80,000, demand is only 60,000, and therefore there's going to be a surplus of 20,000 gallons. So the answer to number 13 is A. Let's review some terms. Utility is the satisfaction derived from a good or service. This is totally a subjective kind of concept. So from a consumer's perspective, their utility might be different from another user's utility. But it's simply the amount of satisfaction that they get from buying a good or a service. Now, marginal utility is the additional utility obtained from one more unit. Now, you want to make sure that you understand this concept of marginal, because we're going to use marginal, the term marginal, many times. Marginal, if you remember from like cost accounting, is similar to incremental. It's the increase, it's the difference, it's the amount from that next unit. So again, marginal utility is the additional utility, not total, but the additional utility obtained from one more unit. So if I already have 10 units of something, the marginal utility of the 11th unit is just the utility that I derive from that 11th unit. I mean, don't include any of the utility from the previous 10 units. The concept of diminishing marginal utility says that each additional unit provides less satisfaction. Again, diminishing marginal utility says that each additional unit provides less satisfaction. You know, when I go out and I get my New Zealand lobster tail, that first New Zealand lobster tail is just absolutely magnificent, and I really enjoy it. And that second one is really good too, but it's not quite as good as the first. And by the time I get to that fifth lobster tail, I'm not getting that much satisfaction from it. I'm just getting way too stuffed. I think you understand the concept of diminishing marginal utility, a little bit less satisfaction from each additional unit. Now, an individual's objective under this utility theory is to maximize their utility given that individual's income. Okay? An individual's objective under utility theory is to maximize their utility. They want to make themselves as happy as they can given their available income. Now, the objective is achieved, and this is important. The objective is achieved when the utility obtained from the last dollar spent on each commodity purchased is the same. So we're going to derive equal satisfaction from each of the last dollars that we spend on each commodity. Okay, I say that again. The objective is achieved. We've maximized our utility when the utility obtained from the last dollar that we've spent on each commodity purchased is the same. Now, one of the ways that we can represent this utility is through the use of something called indifference curves. Now, an indifference curve is a curve on a graph of various combinations of x and y, or whatever the two goods or services are. We'll just use x and y. It's a combination. It's the various combinations of those two goods that give equal utility. Okay, so it's a curve, and some of the characteristics of that curve, it's nonlinear. It's not a straight line. It is curved. And we have a lot of indifference curves. And all the indifference curves that an individual have are parallel to each other. So they're not going to intersect at all. Each indifference curve is negatively sloped with the convex to the origin. And then each curve represents a different level of utility. So the further to the right and up that we go represents a higher level of utility. Now, what are we going to use these indifference curves or utility curves for? Well, what we're going to try to do is eventually we're going to figure out where the utility is maximized by looking at the indifference curves, and when the highest possible indifference curve becomes tangent to the budget constraint line. Let's talk about that budget constraint line. The budget constraint line consists of all the possible combinations of two commodities, remember X and Y, that an individual can purchase given a set level of income and at given prices. Again, the budget constraint line, it consists of all the possible combinations. 0 of X, so many of Y, 1 of X, so many of Y, etc. All these possible different combinations that an individual can purchase given their level of income and at given prices for X and Y. As I mentioned a minute ago, an individual's utility is maximized where that budget constraint line is tangent to the highest possible indifference curve. Then you're going to know exactly how many X and Y you should buy based upon your income to maximize your utility. I'd like to turn now to different factors of production. You should be aware that there are 4 factors of production in economics. Land is a factor, labor is a factor, capital is a factor, and management or entrepreneurial activity is a factor. So we've got 4 factors: land, labor, capital, and management activity or entrepreneurial activity. Now, each of these factors can sort of be measured by their return or their cost. Land, the return or the cost there is rent. For labor, it's wages. For our capital, it's interest. And for management or entrepreneurial activity, it's profits. So what we're going to talk about now is various cost classifications. And it seems like there's just so many terms here, but it's really important that you have an understanding of each of these terms. And that's why I have them in the presentation. I want to make sure that you understand these and that you're prepared in case when you get to the exam, you come across questions that include these in the questions. Let's start with fixed costs. Now, remember what fixed costs are. When we talk about a cost being fixed, or variable for that matter, what we're talking about is the total amount of costs. Okay? Fixed costs are fixed because the total fixed costs remain exactly the same regardless of how much output there is, regardless of the activity. Okay? Again, total fixed costs are fixed because the amount of fixed costs don't change. The amount of fixed cost does not change as output or the quantity changes. Now, what about fixed cost per unit or average fixed costs? Well, to get average fixed cost, you would take the total fixed cost and divide it by your quantity, by your output. Now, that is going to change. It's the total fixed cost doesn't change, but the average fixed cost or the fixed cost per unit does change with output, because what you're doing is spreading the same amount of total fixed cost over a different number of units. So as we go up the x-axis, as x increases, or as q, the quantity increases, the average fixed cost is going to decrease. We're spreading the same amount of fixed cost over an increasing quantity of units, resulting in decreasing fixed cost. As activity decreases, the fixed cost per unit is going to increase. As activity increases, that denominator gets larger and larger, the average fixed cost, is going to decrease. How about variable costs? Well, variable costs, again, are variable when we talk about the total cost of these. And the total variable cost will vary as activity changes or as output changes, as Q changes. But the average variable cost is usually constant. The average variable cost, in other words, take total variable cost and divide it by the quantity of output. And that is a constant figure. I used to really love to confuse my students and say fixed costs are fixed and variable is variable, but sometimes fixed are variable and variable are fixed. And that's because it depends if you're looking at the total or if you're looking at the per unit. Again, total fixed costs are constant, they're fixed, but the fixed cost per unit varies. Total variable costs vary, but the variable cost per unit or average variable cost vary. How about total costs? Well, total cost, of course, would be the sum of the variable cost and the fixed cost. That's all we have to do. To get total cost, we'd sum up the variable cost and the fixed. Another term you need to know is the average total cost. What you do here is take the sum of the variable and the fixed and divide it by the output. Remember, the average variable cost is constant, but the average fixed cost decreases with activity. So your average total cost is going to decrease with activity. As long as activity is increasing, your average total cost will also decrease because you're spreading those fixed costs over more and more units. Now, one way that economists look at cost is by talking about cost in the short run versus the long run. Cost in the short run, what we're assuming here is that at least one input is fixed. In other words, short run is such a short period of time that there's a cost that can't be changed. It's fixed. On the other hand, when we talk about cost in the long run, we're talking about such an extended period of time that we have enough time to vary all the inputs in such a way that all the costs are variable. So in the short run, we have variable and fixed cost. We have variable and at least one in the short run. In the long run, all costs are considered to be variable. Other ways of classifying costs. We have explicit costs. Explicit, meaning straight out, obvious. These are actual expenditures. Okay? Explicit costs are actual expenditures, as opposed to implicit costs. Now, implicit costs are not actual expenditures, but they're amounts that would have been received or paid if resources had been used for other purposes. It's sort of like an opportunity cost. It's amounts that would have been received if resources had been used for other purposes. In other words, implicit cost is because you've given up something. You used a resource for one thing, so you gave up the use of that asset, or excuse me, resource for something else. Some more cost terms. Let's talk about opportunity costs. To give a good formal definition of opportunity costs. Opportunity costs are costs that are foregone by not engaging in an alternative activity. Again, it sounds very similar to those implicit costs. Okay, opportunity costs are costs foregone by not engaging in an alternative activity. Economic costs is the income an entity must provide to attract resource suppliers. The definition of economic costs is the income an entity must provide to attract resource suppliers. Well, what about economic profit? How do we determine economic profit? Not accounting profit, not accrual basis profit, but economic profit. Economic profit is equal to total revenue minus all economic costs. Remember, we gave factors of production a while ago. We said land, labor, capital. Okay? These are factors of production. Okay? So these are all economic costs. Economic profit is total revenue minus all economic costs. That's the cost of land. Remember, that's rents. Labor, that's wages. Capital, that's interest. And I want to point out here the difference between economic profits and accounting profits. And the difference is that in accounting, accountants do not subtract out the cost of investors' capital. Oh yeah, we'll subtract out the cost of the land and labor, but not the cost of investors' capital. Now let's talk about more marginal concepts. I have a number of marginal concepts I want to make sure you're aware of. Again, remember, marginal is incremental. It's an increase. Let's start with marginal revenue. Marginal revenue is the revenue that's provided by selling an additional unit of product. Okay? What is the revenue from selling one more unit of product? That's marginal revenue. Marginal cost is the cost of producing one more unit. Again, it's incremental concept. It's marginal. The cost of producing an additional unit of output, one more unit. So your marginal profit is the difference between your marginal revenue and your marginal cost. We're just going to take marginal revenue minus marginal cost. Well, how about marginal product? What's marginal product? Marginal product is additional output obtained by adding one more unit of an input. So if we added one more cook to the kitchen, how many more meals could we put out in an hour? That's the additional output obtained by adding one more unit of input. Marginal revenue product, not marginal product, but marginal revenue product. I know there's just a ton of terms here, and should be able to know what these are. You should be able to identify these. Marginal revenue product is the additional revenue provided by using one more unit of input. Similar to the marginal product. Marginal product was additional output. It was in terms of units, like meals. But marginal revenue product is actually revenue, additional revenue provided by using one more unit of input. Okay. Marginal resource cost. What's marginal resource cost? The marginal resource cost is the change in total cost of a resource from using one more unit of resource. So these last three terms, marginal product, marginal revenue product, marginal resource cost, we're talking about adding one more unit of input, one more unit of resources. Now, you need to be aware of the term diminishing returns. Diminishing returns are experienced when additional units of variable inputs contribute less and less to total production. So even though we're adding one more unit, we're not getting the same amount of output out of that additional unit. It's diminishing returns. We're getting less for each additional input. In other words, marginal production is declining. Diminishing returns is where marginal production, marginal product is declining as we add more and more units. Let me give you an example. If we have 100 units of input results in an increase in output of 150. Okay. Excuse me, let's try this again here. We have 100 units of input, and with those 100 units, we get out 150 units of output. But then we add one more unit, and that one more unit results in an increase that is less than the previous unit resulted in. Say 145, we're experiencing less output for each unit. Again, if we have 100 units, if the 100th unit, make sure I said this properly here, if 100th unit, just the one unit, the 100th, results in an increase of output of 150, okay? One unit of input gives us 150 output. Then the next unit, if I put in a 101st unit, and that results in an increase of only 145 more units, I have diminishing returns. Okay, so you're getting less for each unit of input. A couple of sort of just overall things that you need to know, just statements that you really ought to memorize. First thing that I really want you to make sure that you have in your notes and you spend time on, in case it comes up in questions. When do we maximize profits? Well, maximization of profits occurs when marginal revenue is equal to marginal cost. Again, we will maximize profits when marginal revenue is equal to marginal cost. In other words, an increase in one more unit sold, that revenue is equal to the cost of that one more unit sold. At that point, we'll be maximizing profits. It doesn't matter what the market structure is. It doesn't matter, we haven't talked about market structure, but if it's a monopoly or a monopolistic competition, doesn't matter. We're going to maximize profits when marginal revenue is equal to marginal cost. Also, another sort of statement here that I'd like for you to make sure you know, in case you see this. A firm should demand additional resources until the marginal revenue product is equal to the marginal resource cost. Okay? You should demand additional resources until you reach the point that marginal revenue product is equal to marginal resource cost. Let's talk about long-run costs. In the long run, the cost curve, the long-run cost curve, it's U-shaped. And what that shape represents is that initially, companies experience economies of scale. In other words, the average costs are decreasing over time. Again, they're spreading out those fixed costs over more and more units. But eventually, they experience diseconomies of scale, which results in the average cost increasing. And that's what makes it a U-shape. You start out going down, and then the average costs start to increase because of diseconomies of scale. Why would economies of scale exist? 3 reasons I want you to make sure you're aware of. Increased specialization and division of labor, better use and specialization of management, and more efficient machinery. Now, diseconomies of scale tend to result from the difficulty associated with managing a large-scale entity. One last blanket statement I want to make sure that you know. It's one of these things I want you to memorize. When we talk about marginal and average cost curves, whenever the average total cost is at a minimum or a maximum, that average total cost will be equal to the marginal cost. So hopefully you can take all these blanket statements. I know it's a lot, but you ought to spend a little bit of time of memorizing these. They'll come in handy when you're answering questions and preparing for the exam. Let's talk about market structures. There are 4 major market structures that I want to spend some time talking about. The first being pure competition. And really is going to help if you understand a lot of the assumptions about pure competition. When we talk about pure competition, we have a large number of buyers and sellers. Okay? Large number of buyers and sellers. And all these competitors are selling a homogeneous, or in other words, a standardized product. So all these, lots of buyers and sellers, and they're all buying and selling a standard product. And in a purely competitive environment like that, there's free entry and exit into the market. Also, we assume in pure competition that there's perfect information, that there's no price controls, no ceilings, no floors. There's no non-price competition. In other words, no advertising or brands. Now, in a pure competition, in the short run, the producer is a price taker. They take whatever price that they can get for their product. And in the long run, they're not going to make any economic profits at all. Okay? In pure competition, there's no economic profits. And the allocation of the resources in pure competition is completely optimal. It's the best that they can be. And that's because the price is equal to the marginal cost. Again, here in the long run, the company's not going to make any economic profits. And the allocation of resources is considered to be optimal because price is equal to marginal cost. Now, in a pure competitive environment like this, companies are going to produce a quantity such that the average cost is at its lowest point. Okay? Production is going to occur at a quantity where the average cost is at its lowest point. And the market price is going to be equal to the marginal revenue, which is equal to the average revenue. Okay? Again, in a purely competitive market, the market price will be equal to the marginal revenue, which will be equal to the average revenue. Okay? This is the best possible situation. Resources are optimally allocated. No one's making any economic profits. And this is going to result in the largest quantity of goods of all the market structures. It's the largest quantity of goods that are going to be produced. Let's talk about pure monopoly. For example, at one point in time, telephone service in the United States used to be a monopoly. There was one seller of telephone service. And that's the first assumption of a pure monopoly, is that there's only one single seller. And that monopolist has a unique product. Also in a pure monopoly, there's blocked entry. Okay? It's hard to get in, or almost impossible to get in. There's perfect information, like we assumed in pure competition. And with a monopoly, there are significant price controls, as opposed to pure competition. Remember, in pure competition, there was no price controls. Well, with a pure monopoly, there are significant price controls. And we also assume that there's goodwill advertising. Remember, we said in pure competition, there is no real advertising or brand competition. Okay, so again, the assumptions for a pure monopoly: single seller, unique product, blocked entry into the marketplace, perfect information, significant price controls, and goodwill advertising. Now, to maximize profits in a pure monopoly, the producer will produce at a point where the marginal revenue is equal to the marginal cost. Remember, I said that previously. I've said that to maximize profits, this is one of the things that you ought to just memorize. To maximize profits, marginal revenue should be equal to marginal cost. At that point, profits will be maximized. Doesn't matter what structure, profits will be maximized there. Of course, in a pure competition, there are no profits, so it's hard to maximize no profits. But in a pure monopoly, there are profits, and they're maximized where marginal revenue is equal to marginal cost. Except one condition. The marginal revenue can be equal to the marginal cost, but if the price of the product is less than the average cost, then we're going to stop production. Okay? Again, if price is less than the average cost, then we're going to stop production, because we're not making any profits at all, okay, if the price is less than the average cost. In terms of the short run, in a pure monopoly, the demand is negatively sloped, and the marginal revenue curve is less than the demand, and it's negatively sloped. In the long run, in a pure monopoly, blocked entry allows an entity to earn an economic profit. Okay, so there is economic profits in a pure monopoly. Also in a pure monopoly, the price is going to be greater than the marginal cost. Again, the price is going to be greater than the marginal cost. And this is going to result in an under-allocation of resources. Remember, in a pure competition, it was optimal allocation of resources. But in a pure monopoly, there's only one seller. Resources are going to be under-allocated. Okay. Also, in a pure monopoly, production is less than ideal. The output is less than ideal. Remember, in a pure competition kind of market, the production or the output was the maximum. It was best. It was ideal. It was optimal. Okay. Pure monopoly, it's less than ideal. Also, in a pure monopoly, the price is higher, and output, like I said, is lower than in a competitive market. Okay. The price will be higher than in pure competition, and the output is going to be lower. And the next concept that I want to talk about, excuse me, the next market structure here is monopolistic competition. Now, in monopolistic competition, we assume that there are a large number of firms, and the products are differentiated. Again, there's a large number of firms, and the products are different. It's relatively easy to enter into the market. There are some price controls, and there is considerable non-price competition. In other words, brands and advertising. Again, the assumptions for monopolistic competition are a large number of firms, they're differentiated products, it's relatively easy to enter into the market, there's some price controls, and considerable non-price competition. What about profit maximization? Well, as I told you earlier, profits are maximized when marginal revenue is equal to marginal cost, unless the price is less than the average cost. We have the same exception here. If the price is less than the average cost, we're going to cease production. In terms of the short run, the demand is negatively sloped, but it's not as negatively sloped as it is in a pure monopoly. In other words, demand here in a monopolistic competition, it's more elastic than it is in a monopoly. Also here in the short run, marginal revenue is less than demand and it's negatively sloped. Okay, so in the short run, demand is negatively sloped, less than it is in pure monopoly, and therefore demand is more elastic, and marginal revenue is less than demand is negatively sloped. What about the long run? Well, with monopolistic competition in the long run, their limited entry allows an entity to earn a normal profit, not an economic profit, but a normal profit. And in this situation, in the long run, the price will be greater than the marginal cost. So again, we have an underallocation of resources. The only time that you really have the proper optimal allocation of resources is under pure competition. Okay? With pure monopoly, monopolistic competition, you have underallocation of resources. The production is less than ideal. Okay? The price is higher than pure competition. And the output is lower than pure competition, but they're still better than in a monopoly. In other words, the price in monopolistic competition is lower than a monopoly. The output is higher than in a monopoly. The fourth structure that I want to emphasize is oligopoly. Okay? A good example of oligopoly is airline services. In an oligopoly, you have few sellers, just a few sellers. And there are barriers to entering the market. And these could be natural barriers or they could be created barriers. And when I say natural barriers, I just mean there's a cost advantage to them. They're just better able to control those costs. By created barriers, I'm talking about things like advertising and patents. Okay? So in an oligopoly, we have few sellers and we have some barriers to entering the market. Some of them are natural, some are created. In an oligopoly, rivals' actions are observed. Okay? They watch each other. But their products can be differentiated or standardized. Okay? They can be differentiated or standardized. Remember, with a pure monopoly, they were unique. With monopolistic competition, they were differentiated. Okay? In purely competitive environment, they were standardized. Okay? Now they can be differentiated or standardized. The one other characteristic of oligopoly that you ought to know is they have sticky prices. What does that mean? Well, there's price leadership occurring here. In other words, if one airline lowers their prices, then the other airlines also tend to lower their airline prices, their ticket prices. These firms are so closely related in the competition, and that's why they're called sticky prices. Okay? They follow the leaders for the most part. Now, there's another market structure that's not as major, and it's really more specific in detail. It's a monopsony, and I just wanted to let you know what a monopsony was. Okay, and that's where one buyer exists for all sellers. Okay, usually it's because of like geographic location. There's only one buyer for all of them. You could talk about monopsonistic demand for employment, where there could be just one employer in an area and everyone gets their job at the local Walmart or whatever that one employer is. What I'd like for you to do now is to stop your video, and I'd like for you to try some questions. If you go to your viewer's guide, I want you to do questions numbers 14 through 29. Let's look at this group of questions together. The first question says, in the economic theory of production and cost, the short run is defined to be a production process, A, which spans a time period of less than 3 months in length. Oh, we didn't say anything about less than 3 months in length. What we did say was that in the short run, there was at least one fixed cost. Let's look at B, in which all inputs employed are variable. No, that's definition of the long run. C, that is subject to economies of scale. Well, that may be the case, that may not. It may be in the long run or not. D, in which both fixed and variable inputs are employed. Yes, with at least one fixed input, that's the definition of the short run. The next question says, all the following are true about perfect competition except that. You've got to always watch out for words like except and always and never and but. A, firms are price takers. Well, is that true about perfect competition? Yes. B, there are a large number of buyers and sellers. That's true about perfect competition. C, there's a standardized product. Yeah, we said in perfect competition all the products are the same, they're standardized. D, in the long run, an increase in profits will have no effect on the number of firms in the market. Well, that's not true. Remember, we said in perfect competition in the long run there would be no real economic profits. If there's any profit at all in the short term, then there will be an increase in the number of firms in the market because they're going to want in to try to get into that profit. And eventually, in the long run, there will be no profit. So D is the exception and the answer. Next one says all of the following are characteristics of monopolistic competition except that. Okay, so 3 of these are characteristics of monopolistic competition and 1 is not. Let's start with letter D. It says price is higher than in pure competition. That's true. That's true. In pure competition, the price is the lowest. Monopolistic competition, it's higher. That's a true answer. That's not an exception. C, firms tend to earn normal profits. Yeah, we said that's true. In monopolistic competition, firms do earn normal profits. B, the firms tend not to recognize the reaction of competitors when determining prices. That's true. We really don't look at that. Remember, that was an oligopoly when they do look. That was sticky prices, oligopoly. But B is true of monopolistic competition. A, the firms sell a homogeneous product. No, that's pure competition where they sell a homogeneous product. Monopolistic competition, they sell a differentiated product. So the answer is A. That is the exception. The next question. An industry that is oligopolistic would be best characterized by what? A, many firms selling unique products. No, we said in oligopoly that there would be few sellers. B, a single firm selling a unique product. No, that's not correct either. It could be a differentiated or a unique product. C, significant barriers to entry. Yes, there are significant barriers to entry in an oligopoly. Okay. They could be natural or created. D, horizontal or flat demand curves for the output of individual firms. No, that's not the characteristics of an oligopoly. And the answer is C. In the next question, they're asking us about the law of diminishing returns and which of those 4 possible answers is a best description of the law of diminishing returns. Well, let's remember what diminishing returns are. We said that diminishing returns are experienced when additional units of variable inputs, additional units of input, contribute less and less to total production. Well, let's see. A small furnace is less efficient than a large furnace. Well, going from small to large, that is an economy of scale kind of thing. That is an increasing return. The small furnace is less efficient. The large furnace is more efficient. That's good. That's not the right answer. B, a manufacturing company purchases its supplier of materials. No, that would result in economies of scale, not diminishing returns. C, at the No Place Like Home restaurant, 4 cooks can prepare 160 meals in the evening, while 3 cooks can prepare 150 meals. Well, we don't see the difference between 2 cooks and 3 cooks. But 3 cooks can prepare 150 meals. On average, that's about 50 meals a cook. But 4 cooks can only prepare 160 meals. On average, that's 40 meals per cook. So overall, we seem to be getting less out of that 4th cook. C is an example of the law of diminishing returns. Let's look real quick at D, just make sure it's not a correct answer. John's Landscaping can mow an acre in 10 minutes and 2 acres in 15 minutes. So by adding just 5 more minutes John's Landscaping is able to do twice as many acres. Okay? For the first 10 minutes, they mowed 1 acre. And for 5 more minutes, going up to 15, they mowed an additional acre. So it took them less time to do 1 more acre than it took to do the first acre. That's economies of scale, not diminishing returns. So the answer is C. The next question reads, a corporation's net income as presented on its income statement is usually A, less than its economic profits because opportunity costs are considered in calculating net income. No, we don't consider opportunity costs in calculating net income. So A can't be the right answer. B, the net income is more than its economic profits because economists consider interest payments to be costs. Well, both accountants and economists consider interest payments to be costs. That's not going to cause a difference between economic profits and net income. So B's not right. C, equal to its economic profits. Well, usually that's not going to be the case. It shouldn't be the case. Remember, the difference between accounting income and economic profits is that economic profits, they also subtract out the cost of the capital. Look at letter D. It says net income is higher than its economic profits because opportunity costs are not considered in calculating net income. And that is the correct answer. In accounting, we do not consider opportunity costs, the cost of the capital. Next question. The competitive model of supply and demand predicts a long-run shortage only when, well, the one situation that we came across where there was a shortage was where the maximum price was set below the equilibrium price. And that's letter B. Okay. Again, whenever the maximum price, the max, is below the market, there's going to be a shortage. Next question. It says Clegg Company's average cost is decreasing over a range of increased output. What is Clegg experiencing? Well, this is just the definition of economies of scale. We said that economies of scale is when average cost is decreasing. The answer is B. Next question deals with the monopolist. It says a monopolist tends to, in comparison with firms in a perfectly competitive market, produce same, more or less, sell at a higher price or a lower price. Well, remember, in a monopoly, there's an underallocation of resources, and the amount of output, the production is less. So we can immediately eliminate A and B because monopolists will produce less. Now, what about prices? Well, they sell at a higher or lower price. Well, they're going to sell at a higher price. Remember, they're the only ones in the market. They can sell at a higher price. They don't have any competition. So the answer is D. The next question asked, how does a company maintain a natural monopoly? Well, this is really asking the difference between a natural and a created one. When you create one, you can create it by things like advertising and patents. But a natural monopoly just exists typically because you are the best at doing it, or it's only cost efficient for one to do it. And if you look at letter C, it says technological or economic conditions permit only one efficient supplier. So C is the answer. The next question says companies in monopolist and monopolistic competitive markets maximize profits when? Well, I told you this. I said this is one of those blanket statements you just got to memorize. You maximize profits when marginal revenue is equal to marginal cost. I said it didn't matter what market structure you were in. That's the answer. Letter B. Marginal cost is equal to marginal revenue. Next, we have a fact pattern that goes with the following 3 questions. We have information regarding the number of units produced and the average selling price for different levels of workers. If we have 20 workers, 21 workers, or 22 workers. The first question for this fact pattern asks about the marginal physical product. It says, what is the marginal physical product when 1 worker is added to a team of 20 workers? So if we add 1 worker to a team of 20, that would give us 21. So we're obviously looking at the first 2 lines of this. What happens when we go from 20 workers to 21? Now this is where it's important that you memorized all those terms we talked about previously, and that is the marginal revenue, marginal product, etc. What is marginal product? Which is what they're asking about. The marginal physical product is the additional output. It's the additional output obtained by adding one more unit of an input. So by going from 20 workers to 21 workers, how many more units did we produce? Well, with 21 workers, we produced 45, where with 20, we had only produced 40 units. So we were producing 5 additional units based upon that one more input, that one more worker. The answer is C, 5 units. The next question deals with the marginal revenue per unit. It says, determine the marginal revenue per unit when one worker is added to a team of 21 workers. Not from going from 20 to 21, but adding to 21 workers. So we're going to go from 21 to 22. And again, recall, what is the marginal revenue product here? It's the additional revenue provided by using one more unit of input. So by using one more worker, how much more revenue are we going to get? So we need to use the average marginal revenue product over 3 units, because if you look from 21 to 22, we're going up 3 units, not 1 unit. So we can't really get the exact marginal revenue per unit from going from 47 to 48, but we can get the information from going from 45 to 48, determine what the marginal revenue product is over those 3 units, and just average it out. So what we need to do is figure out what is the selling price at 21 units, or excuse me, I'm sorry, 21 workers. We produce 45 units. Well, at 45 units, we are able to sell them at an average selling price of $69. So if you sell 45 units at $69, that's $3,105. Well, how much sales revenue do you have when you produce 48 units, when you have the 22nd worker there? Well, you're selling those 48 units at an average price of $67.50. So the revenue for those 48 units would be $3,240. All we have to do is take the difference between the revenues for 48 units of product, subtract out the revenues for 45 units of product. In other words, the 3,240 minus the 3,105. We know that the increase in revenue is $135. But remember, that's over 3 units, not 1 unit. It's over 1 unit of workers, but not 1 unit of product. Okay. So if we take the 48 and minus the 45, that gives us 3. 135 divided by 3 is $45. Okay. Next, I asked about the marginal revenue product. Okay, the marginal revenue product. And remember, the marginal revenue product is the additional revenue by using one more unit of input. And one more unit of input is the 22nd worker. So here all we're looking for is the difference between the 3,240 and the 3,105 that we computed in the last question. In other words, $135. So the answer is letter C. Again, it's just the additional revenue by using one more unit of input, which is the 22nd worker. Now we have another fact pattern that goes with the next 2 questions. We have the total units of product there, 6, 7, 8, and 9, and average fixed cost and average variable cost, and then the average total. And the first question for this pattern, it says the total cost of producing 7 units is what? Well, remember, total cost is what? It's average plus variable. Well, we could really do this 2 ways here. We have the average fixed cost and we have the average variable cost, but we also have the average total cost. The average total cost. All we really have to do is take the 7 units of product, multiply it by the average total cost of $39.29, and we're going to get the cost of producing those 7 units is $275.03. That's letter C. Of course, we could have taken a longer way and added the average fixed cost, the 1429, excuse me, not added it, but multiplied that 1429 times 7, and then add it to the average variable cost of 25 times the 7 units. But why take the long way? Just take the average total cost of $39.29, multiply it by 7. The next question asks us for the marginal cost of producing the 9th unit. Again, marginal means the increase. The increase in cost, marginal cost of producing the 9th unit. In other words, as you go from unit 8 to unit 9, what's the extra amount of cost? In order for us to figure that out, we would have to know what the cost of producing 8 is, and then compare that to the cost of producing that 9 units, subtract the cost of producing all 9 we can subtract from the cost of producing all 9, we can subtract the cost of producing 8 to figure out what the cost of producing that 9th unit is. So what's the cost of producing 8 units? Well, 8 units times $37 of average total cost is $296. For 9 units, we had an average cost of $35.36. That would result in total cost of $318.24 for the 9 units. Subtracting the cost of producing 8 from the cost of producing 9 units, and we're going to get the difference of $22.24. The answer is C. Let's talk about macroeconomics. Remember, when we say macroeconomics, we're talking about the big picture as opposed to microeconomics, which looks at the small picture, the individuals and the firms. With macroeconomics, we're talking about dealing with aggregates. We're looking at the big picture, allocating resources to maximize social welfare. Again, macroeconomics deals with the aggregates and allocating resources to maximize social welfare. And we'll look at things like total production and total employment, these aggregate kinds of numbers. We need to discuss a number of measures that are used in macroeconomics. And you're going to notice that there's a progression here. We're going to start at the very top with a very big number, and we're going to go through various other measures that start with that bigger number and continue to subtract things away, and sometimes some things are added. But the numbers tend to get smaller as we go through this progression of measures. The first measure, the start of it all, is GDP, or the gross domestic product. Now, the gross domestic product is equal to the total market value of all final goods and services produced within a country. Again, GDP is equal to the total market value of all the final goods and services produced within a country. Say the U.S., for example. Now, I emphasize the final goods and services because something like an automobile engine is not a final good, and therefore it's not counted, at least not until it becomes part of the automobile, a finished car. And that way we avoid double counting. So it's just the total market value of all final goods and services. The other thing I wanted to emphasize is that it's all produced within a country. So if we're talking about U.S. GDP, then this would include goods are produced by foreign companies as well as United States companies, as long as those goods are produced within the U.S. borders. It doesn't matter who the manufacturer is, as long as it's being produced within the U.S., it's part of the U.S. GDP. The next measure is GNP, the gross national product. Now, the gross national product is equal to the total market value of all final goods or services, goods and services, that are produced with resources from a specified country. It's a little bit different than the GDP. Okay? It's all the goods and services produced with resources from a specified country. So this is going to include goods and services produced outside the United States, but using U.S. resources. And this is not as common of a measure as in years past. GDP is a little bit more common of a measure, a macro measure. The next macro measure we need to talk about is net domestic product. As I said, we typically are going down through a progression here. The net domestic product, NDP, is equal to the gross domestic product minus depreciation. Okay, so NDP is equal to GDP minus depreciation. Sounds like we're mixing up a bunch of alphabet soup here, but it is important that you have an understanding of all these measures, so you're going to have to spend some time, some effort, in making sure that you can identify and compute all of these measures. Again, we start with GDP. Next basically is NDP. We're going to take GDP and subtract out depreciation. The next measure in the progression is national income. So we're going to start with the previous measure, net domestic product, and we have to make some adjustments to get to national income. National income is equal to NDP, the net domestic product, plus U.S. net income earned abroad minus indirect business taxes. Okay. Again, national income is equal to NDP, net domestic product, plus the U.S. net income earned abroad minus indirect business taxes. What are indirect business taxes? Things like sales taxes are indirect business taxes. The next measure in the progression is personal income. And of course, to obtain personal income, we're going to start with the previous measure, and that was national income. Personal income is equal to national income minus corporate income tax and undistributed profits minus Social Security contributions plus transfer payments. Now, what do I mean by transfer payments? Transfer payments, I'm talking about things like Social Security benefits, not contributions, but Social Security benefits that are received, and dividends. So again, personal income is equal to national income minus corporate income tax and undistributed profits minus Social Security contributions plus these transfer payments. Then we get to disposable income, which again starts with the previous measure. That's personal income. The disposable income is personal income minus personal income taxes. Okay. Disposable income is equal to personal income minus personal income taxes. And basically what disposable income measures is it's what people have left over that they can use to consume on goods and services, make interest payments, and save money. So basically we're spending or saving, consuming or saving. You can sort of think of the making interest payments as spending. But that's what disposable income is used for, consumption and savings. One final macro measure is the real per capita output. And real per capita output is equal to GDP divided by the population and then adjusted for inflation. So there's quite a few measures there, and you're going to need to take some time and learn how to compute all of those. Next, I'd like to talk about business cycles. And when we talk about a business cycle, it really would help for us to look at a graph. And so if you go to your viewer's guide, I have a graph in there that's labeled the phases of the business cycle. And you'll notice that it has sort of a squiggly line that looks sort of a little bit like a cursive N. And what we want to do is look at this business cycle, this curvy line here, and talk about the different parts of that business cycle. The first part that I'd like to highlight, if you go down to the bottom where the line first starts towards the origin, and you go up, as you reach that top, as you reach the top of the mountain there, so to speak, that's the peak. That's the highest level of economic activity in a particular cycle. Okay? Again, that peak there is literally called the peak of the business cycle. And this involves the highest level of economic activity, and this is where pretty much the full use of resources is taking place. Now, as you go over that peak and start heading down, okay, sort of think about over the peak but not down to the very bottom. In between there, on that way down, is the part of cycle there is called a contraction or a recession. And basically during this period of time, we notice a drop in the level of business activity, employment is decreasing, and inventories typically grow. Okay? So we have a recessionary or a contractional kind of period of time. Again, we have a drop in business activity, employment is decreasing, and inventories are typically growing. As you reach that very bottom, that's called a trough. And that trough is the lowest level of business activity in a particular business cycle. And obviously way down here, not as much is going on, therefore we're not really utilizing our resources. We have underuse of our resources. And then we start to go back up again, and as we head back up the last part of that curve, the N, so to speak, that's called the expansion or recovery. And this is a period of time where we have rising level of economic activity. Okay. Let's go back and describe some of these areas in a little bit more detail. Let's start with the trough. I'd like to give you a number of characteristics about that trough part of the cycle, the very bottom. Okay. Remember I said that this was a low level of business activity. So there's a lot of things that are occurring at low points here. In the trough you have low level of outputs, employment is low, income is low, prices tend to be low, costs are low, profits are low, and investment is low. So we have low output, low employment, income, prices, costs, profits, and investment. But the one thing that's high at this point in time is pessimism, because everything's looking sort of bad. Business activity is at a real low, and people aren't feeling very good, and so pessimism is high at that point. Let's talk about the recovery or the expansion period of the cycle. What's happening here? Well, during the recovery, we usually have low interest rates. A lot of times the interest rates are low, trying to spur on or activate some of that recovery, get some business activity going. Also during the expansion, recovery period of time, we're replacing depleted inventories. Investment starts to increase. Demand also starts to increase, as well as employment and income. A lot of the things that were at lows at the trough are starting to now increase. So in the expansion period, we have low interest rates, with the replacement of depleted inventories, investment, demand, employment, and income are all increasing. What about the peak, which is just the opposite of the trough? The trough was the lowest point. Peak is the highest point. So if you can remember a lot of the characteristics for the trough or the peak, then you can just do the reverse for the other. Okay? At the peak, a number of things are at highs. Output is at a high. Employment is at a high. Income, prices, profits, and investment, they're all at highs. And of course, if all these things are at highs, what's at a low? Pessimism is at a low. But on the other hand, you could look at it this way, be optimistic. Optimism is at a high. We're at the peak. Things are going really well, so people are optimistic at the peak. In the final section of this business cycle that I want to give a little bit more detail on is the contraction or the recessionary period. What's happening during the recession? Well, during the recession, output, employment, and income are all at their peak or have reached their peak already. And at this point, consumer demand begins to taper off. And because demand begins to taper off, prices begin to level out. They're no longer at that high. And inventories are beginning to increase because the demand has tapered off, not as much as being purchased. Also during the recession, costs tend to increase and the profit margins diminish. Because the costs are increasing but demand is tapering off, businesses aren't willing to pass on increased costs to the customer because they'll just lose more sales. So the profit margins diminish during this period of time. Also during a recession, demand slackens, as I mentioned, the consumer demand tapering off, and firms reduce their excess inventories. Output begins to become cut, and therefore, so is income and employment. Also during the recession, investments are discouraged, and the outlook becomes pessimistic in nature. The next area of macroeconomics that I'd like to discuss with you is indicators. And there are two kinds of indicators we typically talk about. You may hear in the news if you're ever listening to one of the business channels or the nightly news or reading the Wall Street Journal. Leading indicators are used to forecast future trends. Again, leading indicators are used to forecast future trends. They're trying to give us an indication about what's to happen, what's coming up. You may be familiar with a private research group called the Conference Board. And the Conference Board computes a number of composite indices that use these leading indicators. I don't want to try to give you an exhaustive list because there's a lot of them that are used, but I'd like to give you an idea of some of the leading indicators that are used by the Conference Board and others. Some leading indicators would include the average hours worked per week by workers. Another leading indicator is the weekly initial unemployment claims, stock prices of 500 common stocks, new housing permits, new orders for durable goods, changes in the money supply. Again, these leading indicators include average hours worked per week by manufacturer workers, weekly initial unemployment claims, stock prices of 500 common stocks, new housing permits, new orders for durable goods, and changes in the money supply. There are also a number of trailing indicators. Now, obviously, they're not doing any predictions. They're not forecasting. Trailing indicators are indicators that change after the change in the phase of the cycle as we're moving from the peak down or from the trough up and starting to expand. Okay? These are going to give you the indication after the change in the phase. Some examples of trailing indicators include average prime rate charged by banks, the average length of unemployment in terms of weeks, and the change in CPI for services. Again, 3 examples of trailing indicators: the average prime rate charged by banks, the average length of unemployment in weeks, and the change in CPI for services. What I'd like to discuss with you now are a couple of the major models of economic analysis. Let's begin by talking about the classical model. Under the classical model, equilibrium occurs only at full employment. And if it's not at full employment, it's assumed that the market will correct itself. Again, equilibrium is assumed to occur only at full employment. And if full employment doesn't exist, then the market is assumed to correct itself. Well, how does the market go about correcting itself? Well, the driving force behind the market is seen to be as competition. Competition will move the economy towards equilibrium point. For example, if there's any unsold inventory, then prices will be decreased so that the inventory can be sold. We also assume that the competition eliminates any unemployment because of the competition between workers. In contrast, the Keynesian model of economics assumes that the market can reach an equilibrium point, the economy can reach an equilibrium point with significant levels of unemployment. Not full employment, but unemployment, with some unemployment. And it's also assumed that the economy cannot take care of itself. It's not self-regulating as it is in the classical model. And therefore the government needs to come in and act in order to pull the economy out of recessions. Now, 2 very important variables that exist in these economic models are consumption and savings. You'll recall in previous parts of the class that disposable income is income to the consumer that the consumer can either spend or save. As disposable income increases, you have more money, so what can you do with it? Well, you can spend it or save it. Well, do you always spend everything that you get in income increases? No, we're going to assume that some of it is going to be saved. So what we have, the economists use, are 2 measures of the changes in disposable income and their impact on consumption and savings. The first measure, let's talk about the marginal propensity to consume, MPC, marginal propensity to consume. And what that measure is simply a ratio of the change in consumption spending to the change in disposable or after-tax income. Again, the marginal propensity to consume is the ratio of the change in consumption spending to the change in disposable or after-tax income. So the ratio is going to fall between 0 and 1. For example, let's assume that we have an MPC of 0.4. What that says is that for every dollar of increases in disposable income, we're going to take 40 cents of that and consume it. We're going to spend it on something. So what are we going to do with the other 60 cents? Right, we're going to save it. And that leads us to the next measure, which is the marginal propensity to save. The marginal propensity to save is the ratio of the change in planned saving to the change in disposable income. And as you probably have already realized, when you have a dollar increase of disposable income and 40 cents of it is going to be spent and 60 cents of it is going to be saved, that's all that there is. So the sum of the marginal propensity to consume and the marginal propensity to save must be equal to 1. So if you ever know one of those ratios, one of those measures, and you don't know the other, you can always subtract that other measure from 1 to get the measure you don't know. So for example, if you don't know what marginal propensity to consume is, you can simply subtract the marginal propensity to save from 1. Let's talk a little bit about savings and their viewpoints in the different economic models. Now, in the classical model, it's assumed that savings depends entirely on the interest rate. But Keynes believed that savings habits were based primarily on consumers' income. Again, under the classical model, the assumption was that savings depended upon interest rates. Under the Keynesian model, consumer savings depends on income. What about investments? Well, classical economists believe that the most important determinant of planned investment spending is the interest rate. Keynes, on the other hand, argued that profit expectations are the most important determinant of investment spending by businesses. The next item we need to talk about is the multiplier effect. You see, as expenditures are made, it results in a larger impact on the national output or national income. Again, this multiplier effect, what it does is it measures the relationship between a change in the aggregate expenditure and the resulting larger change in national output. The way that we compute the multiplier effect is simply to take 1 and divide it by the marginal propensity to save. Of course, if you don't know the marginal propensity to save, you could compute this multiplier effect by taking 1 divided by 1 minus the marginal propensity to consume. Now, the larger this multiplier, the larger the marginal propensity to consume, then the larger the multiplier. Or another way to look at it is the smaller the marginal propensity to save, the larger the multiplier. So the marginal propensity to consume and the marginal propensity to save have opposite effects on that multiplier. Remember, they're equal to 1 minus the other measure. So they're going to have opposite effects when they get in that denominator of the multiplier effect. Let's talk about money supply. Money supply can be measured in different ways. The first measure is M1. M1 is the most liquid definition of money. And in M1, we'll include currency, traveler's checks, and checkable deposits. When I talk about currency, of course, I'm referring to paper money and coins. When I talk about checkable deposits, I'm talking about checking accounts at banks, I'm talking about NOW accounts, automated transfer service accounts, and share draft accounts. M2 is equal to M1, but it includes more variables. So to get M2, what we'll do is we'll take M1 and we'll also add savings accounts. We'll add small time deposits. These are deposits less than $100,000. And we'll also add in money market funds. So M2 is equal to M1 plus the savings deposits, the small time deposits less than $100,000, and money market accounts. Now, when I refer to savings deposits or savings accounts, I'm talking about interest-bearing accounts that do not allow for automatic transfer services. If you have a savings account that allows for automatic transfer services, that's part of the M1 supply. Time deposits, or the small time deposits I was talking about, I'm talking about CDs here, certificates of deposits. These are funds that earn a fixed rate of interest and must be held for a specific period of time. Money market funds are deposits held in accounts invested in a broad range of financial assets. Okay, so M2 includes saving deposits, time deposits like CDs, and money market funds. M3 is the largest measure of money supply. It's going to include M2, plus we're going to add in large negotiable CDs. These are the CDs that are over $100,000. And we'll also include Eurodollars in the M3 measure. Now, Eurodollars are simply US dollars that are deposited in foreign banks, and therefore they're really outside the jurisdiction of the United States. Again, Eurodollars are US dollars, they're deposited in foreign banks, and therefore they're out of the jurisdiction of the United States. Well, how does money get created? Well, first, somebody takes some new money and they deposit it in a bank. Now, when a customer deposits money in the bank must retain a certain percentage in reserve. This is known as the reserve ratio. So for example, if I deposit $1,000 and the reserve ratio is 20%, then the bank is going to have to maintain or keep on hand $200 of that $1,000 deposit. The rest, the difference, the $800, are considered excess reserves, and that money can be loaned out. Now, when a bank loans out money from its excess reserves, it's creating money. It's increasing the money supply. Now, the effect of this increase on the money supply is measured through what we call the money multiplier. Now, the money multiplier is very easy to compute. It's simply the reciprocal of the reserve ratio. So the money multiplier is equal to 1 divided by the reserve ratio. So let's look at a little example. Let's say that we have an increase in deposits at a bank of $1,000. The reserve ratio is, let's say, 10%. Then we can measure the effect that this deposit has on the overall money supply in the banking system. What we can do is get the money multiplier, compute the money multiplier. Remember, that's 1 divided by the reserve ratio. If the reserve ratio is 10%, 1 divided by 10% would be 10. So if we have an increase in deposits of $1,000, we can multiply that by the money multiplier of 10, and that would result in an overall money supply increase in the banking system of $10,000. Well, who controls the money supply? I hope you know it's the Federal Reserve, Federal Reserve Board. They control the money supply. Now, the Federal Reserve has general controls that affect the overall supply of money. And they also use some selective controls that we'll talk about. Now, the most important of all the controls that the Federal Reserve uses are open market operations. And what I'm talking about here is when the Federal Reserve buys and sells government securities. And by buying and selling government securities, they're impacting the money supply. When they purchase securities, it encourages the expansion of the money supply. They're putting more money into the banking system, and of course that gets impacted by that money multiplier. When they sell securities, that leads to a contraction of the money supply. They're taking money out of the money supply. So for example, if the Federal Open Market Committee buys $50,000 of securities, they're putting $50,000 into the banking supply, but the money multiplier, if we assume that the reserve ratio is 10%, say, then the money multiplier, remember, is 10 times. So by putting $50,000 in there, or buying $50,000 of securities, then they're going to increase the money supply by $500,000. The $50,000 times the money multiplier of 10. So you can see there's an importance to these excess reserves. The effectiveness of the Federal Reserve Board's efforts to either limit or expand the money supply depend on the status of these excess reserves. Again, if they purchase securities in the open market, they're trying to expand the money supply. And if they sell, they're reducing the money supply. Well, what is the discount rate? You may have heard of the discount rate before. Well, the discount rate is the interest rate at which depository institutions can borrow funds from the Federal Reserve banks. Okay. Discount rate is an interest rate that reserve banks can borrow from the Federal Reserve, from each other. Okay. This is usually very short-term kind of borrowing, like overnight. Now, the Federal Reserve can affect these discount rates, and if they lower the discount rate, then the Fed is signaling that they want to encourage the expansion of the money supply. If the Federal Reserve raises the discount rate, it gives the opposite signal. In other words, they're trying to contract the money supply. Some other rates that you might ought to be familiar with include commercial loans and federal funds rates. Okay. You've probably, I'm sure you've heard of the prime rate. Make sure you know what the prime rate is. The prime rate is the rate at which individuals and firms with the best credit can borrow. Okay. Prime rate is the rate at which the individuals and firms with the best credit ratings can borrow. The federal funds market rate, is a fairly well-organized market where the banks borrow. And again, we talked about the federal funds rate a little bit earlier. That's the rate at which each of these federal funds banks can borrow from each other. Let's talk about price indexes. Now, a price index is simply a number, a method that we can compute that allows us to compare the average price of anything in one period of time with its price at another point in time. In other words, we can compare, let's say, for example, how much a loaf of bread costs today to how much a loaf of bread cost 1 year ago. So a price index just measures the price for a good in one period relative to a base period. And you can develop price indices or price indexes for a variety of items. We could group goods together. We could group goods and services together and compare prices in one period to prices in another period. Now, the way that you determine the price index is you simply take the price of whatever good or goods that you're interested in a given year, divide that by the price of goods in the base period, and then if you want to, you can multiply it by 100. Some people do, some don't. Let me give you a numerical example, just to make sure that you're following me here. If the price of goods or a good in 1 year, this year, is $1,200, and if we bought the same good, let's say 1 year ago, our base period, and that good would have cost us $1,000 then, what would be the price index for the current year? Well, we would be comparing the price of that good, $1,200, to the base period price of $1,000. So we have $1,200 divided by 1,000, and we would get 1.2. If we multiplied it by 100, we would get 120. But either way, it gives us the same information. If we don't multiply it by the 100, and we just have 1.2 or 1.20, what you can do is subtract out 1, that's what you start with, and the difference, 0.2 or 20%, indicates how prices have changed. In other words, from our base year to the current year, there's been a 20% increase. If you had multiplied it by 100, you would be comparing, or you would have a price index of 120. To figure out how prices have changed since the base period, you would subtract out 100. So 120 minus 100 would be 20, and that indicates that prices went up by 20%. So you really can compute that using the 100 in there or not. It's up to you. Now, the price index, a commonly used price index in our economy, is the CPI, the Consumer Price Index. Now, the Consumer Price Index compares the price of a group of basic goods and services as purchased by urban residents. Again, the CPI is an index that basically compares the price of a group of basic goods and services as purchased by urban residents. Today, compare that to some base period. Now, you might be interested as to what goes into the CPI. I don't think the exam is going to ask you any percentages, but some of the things that go into the computation of the CPI include food and beverages, housing, apparel, transportation, medical care, recreation, education and communication, as well as some other items. Now, the CPI does have some limitations that you ought to be aware of. Basically, what the CPI does is it measures the relative change in the cost of living. How have prices changed from relative to some base period? And so, by doing that, what it does not measure is the actual cost of living. It does tell us how the cost of living has changed, but not what the actual cost of living is. And it's really not a completely pure index. In fact, it's recognized that there's usually a little bit of upward bias in there each year. Now, the other common index that you probably ought to be aware of at the exam is the Producer Price Index. The Producer Price Index, or PPI, is a measure of the average prices received by producers and wholesalers. So the Consumer Price Index is looking at how prices change for consumers. The Producer Price Index is looking for how prices change for the producers, what they're able to receive for their products. What I'd like for you to do is to stop your video and do questions 30 through 41. When you get your answers, come back, we'll go over them together. Let's do this group of questions together. The first 4 questions relate to this fact pattern for NIVIC. And in these questions, we are asked to compute a number of these macroeconomic measures that we've previously discussed. The first question asks us to compute the net domestic product. You'll recall that the net domestic product is equal to GDP minus depreciation. So all that we have to do here is take the 4,500,000 talents of GDP, subtract the depreciation of 500,000 talents, and we'll get 4 million talents. The answer is D. The next question, we are requested to compute national income. You'll recall that national income is defined as net domestic product plus any income earned abroad minus any indirect business taxes. So what we're going to do is we'll start off with the net domestic product we got in the previous question, the 4 million talents. We're going to subtract out $100,000 of income earned abroad. We're going to add the 100,000 talents of income earned abroad. We're going to subtract out the 175,000 talents of indirect business taxes, and we get our answer of 3,925,000 talents. The third question in this pattern asks for us to compute personal income. You'll recall that personal income is defined as the national income minus the corporate income taxes, minus any undistributed corporate profits, minus any retirement contributions, and plus any transfer payments. Well, here we're going to take the national income that we computed in the previous question, the 3,925,000 talents. We're going to subtract out 100,000 talents for the corporate income taxes. We're going to subtract out 50,000 in undistributed corporate profits. We're going to subtract out 300,000 in the retirement contributions, and we'll add the 600,000 talents of transfer payments, and we'll get the answer of 4,075,000 talents. The last question in the pattern asks us to compute disposable income. Recall that disposable income is defined as the personal income that we just computed minus any personal income taxes, So we're going to take the 4,075,000 talents of personal income, and we'll subtract out the personal income taxes of 150,000 talents. So our answer is B, 3,925,000 talents. The next question says the recessionary phase of a business cycle is characterized by what? How about A, high levels of economic activity? No, in a recessionary phase, remember that economic activity is decreasing. B, shortages of resources? No, here we're actually going to beginning to have increases in supplies of resources because we're not operating at full capacity. C, potential national income will exceed actual national income. Or D, the reverse situation? Well, it's going to be C, the potential national income is going to exceed the actual national income, again, because not all our resources are being used. So we're not operating at full capacity, therefore we're not realizing the full potential. The full potential is greater than actually what's occurring. Answer is C. The next question asks us about the multiplier effect. What does it explain? Well, remember, we said the multiplier effect is basically explaining how a change in an investment can impact the larger number, the national output. Well, that's letter A. A small change in investment can have a much larger impact on gross domestic product. For the next two questions, we have another fact pattern, and this deals with gross domestic product. What you have to remember about gross domestic product is that it's a measure of all the final, remember it's a market value of all the final goods and services produced in a country. Well, consumption and investment represents what's being done in that country, but it also includes net exports because you're exporting from our country or whatever the national country is into another country. So GDP, the equilibrium GDP, occurs when consumption, investment, and net exports all add up to be the real GDP. So the first question asks us, what is the equilibrium point for gross domestic product? And if we look at the data, we have to go through and see where consumption and investment added to net exports is equal to the real GDP at that level. And when we go through that list, go down to 420 real GDP, you'll notice that the consumption and investment is 412 and the net exports are 8. When you add that together, you get the real GDP of 420. So the answer is letter B. In the next question, it says, what is the equilibrium real GDP if net exports are increased by $6 at each level? Well, we have to go back to this data, and we're going to have to add $6 to the net exports, which is going to break all those net exports equal to 14. Then we'll add for each level the consumption and investment and see where that equals the real gross domestic product. And we're going to come up with 460. Because at 460, we have consumption and investment of 446 plus the net exports now of 14. So again, the answer is C. In the next question, it asks, if the marginal propensity to consume is 0.35, a $30 increase in net exports will cause an increase in equilibrium real GDP of what? Remember, net exports is a part of real GDP, and when you increase expenditures, then that's going to increase or have a bigger impact. So what is the impact of this? Remember, marginal propensity to consume being 0.35, that makes the marginal propensity to save 0.65. And so we're going to get the multiplier. We'll take 1, divide it by the 0.65, the marginal propensity to save, multiply that by the $30, and that's $46 rounded. So the answer is letter B. The next question asked about what action would the Federal Reserve Board take to implement an expansionary monetary policy? Well, if they want to have an expansionary monetary policy, they want to increase the money supply. Let's look at the choices. Letter A says increase the reserve requirement and decrease the discount rate. Well, if you increase the reserve requirement, remember what that does to that money multiplier. You're going to have 1 divided by a larger reserve ratio. Well, that's going to make that multiplier smaller. So that's not expansionary. A is not correct. If we look at B, B says purchase U.S. government securities and decrease the discount rate. Well, when the Federal Reserve purchases U.S. government securities, they're putting in money into the money supply. That's going to be expansionary. What about the discount rate? It says, and decrease the discount rate. Well, Federal Reserve, when they decrease the discount rate, they're trying to expand monetary policy. They're trying to expand the money supply. So that's correct. Letter B is the answer. If you look at C and D, it's usually a good idea. Make sure they're wrong. I feel pretty good about B. Let's look at C real quick. It says increase the reserve requirement and the discount rate. Well, we said in letter A, increasing the reserve requirement is going to not have an expansionary monetary effect. It's going to decrease the monetary supply. So C is wrong. In D, it says increase the discount rate. Well, if you increase the discount rate, that's not expansionary. That's contractionary. It's going to contract the money supply. So the answer is B. The next question also deals with money in the banking system. This is a banking system with a reserve ratio excuse me, of 25%, and a change in reserves of $750,000 can increase its total demand deposits by how much? Well, again, we use the multiplier. We're going to take 1 divided by the reserve ratio of 25%. Your multiplier is 4. So you take 4 times the change of reserves of $750,000, and you get $3 million. The answer is C. The next question deals with Carlton Bank. It says Carlton Bank has deposit liabilities of $100,000. It has reserves of $45,000 and a required reserve ratio of 25%. Let's stop and think about that. If they have $100,000 of deposits on hand and a required reserve ratio of 25%, the only amount that they are required to keep on hand is the 25% of the $100,000, which is $25,000. So they have $20,000 of excess reserves. Let's read what the question says. It says, therefore, Carlton Bank and the banking system can increase loans respectively by how much? Well, since Carlton has $20,000 of excess reserves, they can loan that money out. So that immediately cancels out B and D. They can't be right because they say $45,000 and $50,000 as the increase in loans by Carlton. They can only loan out $20,000, so it's got to be A or C. Well, what's the effect on the banking system? Well, again, the multiplier, 1 divided by 25% is 4. When they loan $20,000 out, that has an impact on the banking system of 4 times that amount, which is $80,000. So the answer is A. Let's talk about international economics. One of the issues that we're interested in this area is what should we be producing for exchange with other countries? And there are a couple of concepts for us to look at. One is called the absolute advantage. The absolute advantage is the ability to produce a good or a service using fewer resources than other producers use. Again, the absolute advantage is the ability to produce a good or service using fewer resources than other producers use. Another concept that we talk about is comparative advantage. This is the ability to produce a good or service at a lower opportunity cost than other producers. Again, comparative advantage is the ability to produce a good or service at a lower opportunity cost than other producers. Ideally, parties should produce the good in which it has the lower opportunity cost. If you go to your viewer's guide, I have an example of 2 nations and their ability to produce cotton and wheat. We have countries Southland and Northland. Now, if you look at the data, for Southland is able to use 3 units of resources to produce 30 bales of cotton. and they can use 2 units of resource and produce 60 bushels of wheat. Northland, using 3 units of resource, can only produce 15 bales of cotton, and using 2 units of resource is able to produce 40 bushels of wheat. So in all, with both countries using 6 units of resources to produce cotton, they get 45 bales of cotton. And in producing wheat, using 4 units of resource, they're able to produce 100 bushels of wheat. Well, let's look at these concepts of absolute advantage and comparative advantage with relation to this data. Let's start with absolute advantage. Let's figure out who has the absolute advantage in producing cotton. Remember, the absolute advantage is the ability to produce a good or service using fewer resources than other producers. Well, let's look at Southland. Southland can produce 30 bales of cotton using 3 units of resource, but we need to know how much they can produce using 1 unit of resource. So take the 30 bales of cotton, divide it by the 3 units of resource, they're able to produce 10 bales of cotton for each unit of resource. What about Northland in producing cotton? They produce 15 bales of cotton using 3 units of resource. So per unit, they're only able to produce 5 bales of cotton. So Southland has the absolute advantage. They're able to produce 10 bales of cotton per unit of resource, whereas Northland can only produce 5 units of resource. Again, Southland has the absolute advantage over Northland in producing cotton. How about the absolute advantage in producing wheat? Again, let's start with Southland. Southland's able to produce 60 bushels of wheat when they utilize 2 units of resource. So per unit, that would be 30 bushels of wheat. Northland is capable of producing 40 bushels of wheat when they use 2 units of resource. So per unit of resource, that's 20 per unit of resource. So Southland has the absolute advantage over Northland in producing wheat. They're able to produce 30 bushels of wheat compared to Northland's 20 bushels of wheat. So Southland has the absolute advantage in producing both cotton and wheat. And that's a little bit of a problem because we want to have countries producing what they're best at, but some countries are better at producing a lot of goods. They're more efficient. So what we can do is look at the comparative advantage. Ideally, what we'll do is have the countries produce those goods that they have a comparative advantage in. And when we look at comparative advantage, only one country will have a comparative advantage in a resource when we're looking at a 2-resource situation like this, and then the other country will have the comparative advantage in the other resource. So under comparative advantage, the parties will produce the good in which it has the lowest or lower opportunity cost. So what we're going to have to do is compute the opportunity cost of these countries in producing cotton and wheat. Well, let's look at producing cotton. And what we really need to do, it's a lot easier if you look at the output based upon just 1 unit of resource. So for Southland, when we talk about cotton, they were able to produce 30 bales of cotton using 3 units of resource, so that translated into 10 bales of cotton per unit. Well, they could also use that unit of resource to produce bushels of wheat. How much wheat could Southland use? Because if we're going to talk about the opportunity cost of cotton, remember that's the cost of not producing wheat. Well, with wheat, they're able to produce 60 bushels using 2 units of resource, or 30 bushels per unit of resource. So for Southland, using 1 unit of resource, they could either produce 10 bales of cotton, or they could produce 30 bushels of wheat. If we wanted to express this in terms of the opportunity cost of producing cotton, again, the opportunity cost of producing cotton, the cost of producing cotton is 30 bushels of wheat to 10 bales of cotton, because that's what happens. If they use 1 unit of resource, they could make 30 bushels of wheat or 10 bales of cotton. So the opportunity cost of producing cotton is 3. It's 30 divided by 10. What about the opportunity cost of Northland to produce cotton? Well, again, let's put this cotton and wheat production in terms of 1 unit. How many bales of cotton can Northland produce using 1 unit of resource? They had 15 bales of cotton when they used 3 units of resource, so that translated to 5 bales of cotton using 1 unit of resource. When they produced wheat, that was 20 bushels of wheat for 1 unit of resource. It was the 40 divided by 2 units. So how do we compute the opportunity cost of producing cotton for Northland? Again, we're going to take the 20 bushels of wheat that they could produce using a unit of resource, divide it by the 5 bales of cotton that they could produce using the 1 unit of resource, and the opportunity cost of producing cotton, more or less, is 4. So who has the lower opportunity cost of cotton? It's Southland. Southland has an opportunity cost of cotton of 3 compared to Northland's 4, so Southland should produce cotton. We said that the parties should produce the good in which they have the lowest opportunity cost. So Southland will produce cotton. Therefore, Northland must have a comparative advantage in producing wheat. But let's make sure. Let's figure out the opportunity cost of producing wheat for both the countries. Let's start with Southland. What's the opportunity cost of producing wheat? Well, in that case, they would have to give up the 10 bales of cotton they could produce in order to produce the 30 bushels of wheat using 1 unit of resource. So the opportunity cost is 1 over 3. With respect to Northland, the opportunity cost of wheat would be the 5 bales of cotton divided by the 20 bushels of wheat they could produce using 1 unit of resource. That's 1/4. Which one of those opportunity costs is smaller, 1 over 3 or 1 over 4? It's 1 over 4 is the smaller number. So Northland has the lowest opportunity cost of producing wheat. So Northland should produce the wheat. So you can see that comparative advantage is good in identifying who should produce what unit, because there's only one country that will have a comparative advantage in a particular product. Well, if we use that comparative advantage and Southland produces cotton and Northland produces wheat, and they use all their resources for producing those items, how much cotton and how much wheat will be the result? Well, if Southland produces nothing but cotton, remember they were able to produce 10 bales of cotton for every unit of resource. If they were to, say, have 5 units of resource, because remember they had 3 units that they were using for cotton and 2 for wheat, they had 5 units of resource before. Now they can take those 5 units of resource. Instead of doing some cotton and wheat, they can produce all cotton. They would get 10 bales of cotton for each unit of resource. They would make 50 bales of cotton. Northland, on the other hand, had a comparative advantage in producing wheat. So they're going to take all their resources and make wheat. And in the original data, Northland was using 3 units of resources for cotton and 2 for wheat. Now they're going to take all 5 of those resources and make wheat. Well, they were able to produce 20 bushels of wheat for every resource. So using all 5 units of resource, they'll make 100 bushels. So how many bales of cotton and bushels of wheat are there after the countries begin to specialize? Well, now they're making 50 bales of cotton and 100 bushels of wheat. So overall, there's more production when the countries produce the item that they have a comparative advantage in. So using comparative advantage, it's better for everyone because there's more units being produced. Well, if countries are making products and working with each other and they're exchanging, there has to be a way of making that exchange easier. In other words, there needs to be some foreign common medium of exchange. And if countries are using different currencies, then we need to come up with an exchange rate. And the exchange rate is the rate at which one currency can be exchanged for another currency. Now, when a currency can buy more of another currency, for example, if the US dollar can buy more Swiss francs or any other, Mexican pesos, if they could buy more with $1 US, then the US dollar is said to have appreciated. If on the other hand the US dollar can buy less pesos, that dollar is said to have depreciated. Well, where do the exchange rates come from? Well, we have different kinds of exchange rates. Floating exchange rates is where the market determines what that exchange rate should be. Okay, a floating exchange rate is where the market itself determines what that rate should be. On the other hand, a fixed exchange rate is an exchange rate that's fixed by a particular government. Again, a fixed exchange rate is fixed by a particular government. Now, we could have some sort of cross between these two systems and have what we call a managed float. A managed float. And in managed float, the market is the primary determinant of the exchange rate, but sometimes governments intervene to maintain stability. When talking about foreign exchange, we have more rates to talk about. We have spot rates and forward exchange rates. What is a spot rate? A spot rate is the exchange rate paid for a currency right now on the spot. Again, a spot rate is the rate of exchange for a currency right now. So if I went out right this moment and exchanged US dollars for pesos, that would be done using the spot rate. The forward exchange rate is a rate agreed upon to be paid at a specified point in the future. If I knew I was going to have a transaction and I would have to pay a certain amount of pesos in the future, I could enter into a forward contract using a forward exchange rate. And we could agree, I would agree with the bank or wherever I was getting the pesos from, at a certain rate, at a certain period of time. That's the forward exchange rate, the amount that will be exchanged at a specified period of time. And these two usually are not the same. Usually the forward rate and the spot rate are different. What happens if the forward rate is greater than the spot rate? Again, the forward rate is greater than the spot rate. Well, in this case, the currency is said to be at a premium. The forward rate is at a premium. That's more than the spot rate. And what that says is that they're expecting the value of that currency to increase. Again, if we have a forward rate greater than a spot rate, then it's at a premium and the value is expected to increase. And the opposite would be where the forward rate is less than the spot rate. And that currency, the forward exchange rate, would be at a discount to the spot rate. In other words, investors are expecting the currency to decline in value. Now, these exchange rates are affected by interest rates. Whether these forward rates are less than or more than the spot rate is often determined by the relationship between interest rates in one country to that of the other country. So what kind of relationships exist there? If the domestic rate is greater than the foreign interest rate, again, the domestic interest rate is greater than the foreign country's interest rate, then this forward exchange rate is going to be at a premium. And the opposite is true. If the domestic rate is less than the foreign interest rate, then it's going to be at a discount. Some other items of importance here in the area of international economics is the balance of payments. When we're talking about exchanging between these countries, sometimes some countries import more than they export. And so we have a difference in the accounts. There's a difference in how much the countries owe each other. There's a couple of accounts that we need to talk about. One is called the current account. Now, the current account includes the balance of goods and services, net of any interest and dividends, and any unilateral transfers. Again, the current account includes the balance of goods or services, the net interest and dividends, and net unilateral transfers. So what is the balance of goods and services? Well, the way you need to look at balance of goods and services is this. It's the imports, which you can say that they're debits, less exports, which are credits. In other words, The imports, that's what's coming in. Exports, that's what's going out. Now there is a difference between this balance of goods and services and something else called balance of trade. Remember, the current account is the balance of goods and services and the net of interest and dividends and net of unilateral transfers. But the balance of trade is a little bit different, and you may come across that term. It's the same thing as the balance of goods and services, except it excludes the services. So if you come across a question and it says the balance of trade, then you're going to just look at the imports minus the exports, not including the services, just goods. But in the current account, we typically are using the balance of goods and services. So you want to include the services in the imports and exports. Well, what about the interest and dividend? Okay, how do we handle that? Well, if interest is being paid out because, for example, you're paying interest on a foreign loan, well, that's like an export. That's going out. And what we're really looking at in this current account is where's the money going? Is it coming in or is it going out? So if you're making payments for interest and dividends going out overseas, then that is basically a credit. If it's coming in, then that's a debit. Same with the unilateral transfers. These are things like foreign aid. When the United States sends aid to foreign countries, we're exporting our money. If we're sending pension payments overseas for some reason, that's an export, that's a credit. Now the capital account is another account that deals with the balance between countries. And what the capital account looks at is the result of the exchange in fixed or financial assets. In other words, things like equipment and securities. Next topic that we need to talk about with international economics is trade barriers and control strategies. And I just wanted to mention a few here. Some of the relationships that exist between countries and this balance of trade. Some countries will have import quotas. In other words, this is a limit on the imports. And this is a strategy to try to keep the difference or the balance in trade more balanced. Countries will use these import quotas. And for example, if the U.S. imports more goods from like Japan than they're exporting, the United States might decide to use import quotas and limit the number of imports coming in from Japan. Tariffs is another control strategy. And what a tariff is, it's simply a tax on imports. Okay? So it's a tax on imports, which means that the imports are going to cost more to the consumer in this country. So if there's a tariff, say, on Japanese automobiles, then that's going to increase the price that U.S. citizens pay on those Japanese automobiles. Another control strategy is export incentives. Things like subsidies. Sometimes a country like the United States may make payments to producers in the United States to send goods overseas. They'll pay them a little bit of money to add on to the price because the price overseas isn't large enough, and that's considered a subsidy. What I'd like for you to do is to stop your video and do questions 42 through 51. Let's do this group of questions together. We have a fact pattern here for the first three questions that deals with North Korea and South Korea and their ability to produce corn and potato chips. Using 1 unit of resource, we're told that North Korea could produce 5 bushels of corn, or they could produce 1,000 units of potato chips. South Korea, on the other hand, can produce 10 bushels of corn using 1 unit of resource, or 1,500 units of potato chips. Well, let's just do a little bit of analysis on our own before we get into the questions. Let's look at who has the absolute advantage in producing corn and who has the absolute advantage in producing potato chips. Remember, absolute advantage is how much you can produce using 1 unit of resource. Whoever can produce more using 1 unit of resource has the absolute advantage. North Korea is able to produce 5 bushels of corn using 1 unit of resource, but South Korea can produce 10. So South Korea has the absolute advantage in producing corn. They also have the absolute advantage in producing potato chips because they're able to produce 1,500 potato chips compared to North Korea's 1,000 units. We're a little bit luckier in this particular problem because the data is already given to us on a per unit basis. I've seen other problems, like the example we've done previously, where it wasn't based upon the 1 unit of resource and you had to figure out what the amount of production would be for 1 unit of resource. What about the comparative advantage? Who has the comparative advantage in producing potato chips? Well, remember, the country that has the comparative advantage in producing potato chips has the lowest opportunity cost of producing the chips. And to compute the opportunity cost of producing chips, you have to compare the bushels of corn you would have to give up to the number of units of chips that you would be able to produce. So looking at North Korea, they would give up 5 bushels of corn in order to produce the 1,000 units of potato chips. In other words, that's an opportunity cost of 1/200. For South Korea would have to give up 10 bushels of corn in order to produce 1,500 units of potato chips. So 10 divided by 1,500 would be 1/150. And of course, 1/200, the opportunity cost for North Korea is lower than the opportunity cost for South Korea of 1/150. So North Korea has the comparative advantage in producing potato chips. What about producing corn? Well, again, the country that has the comparative advantage in producing corn is going to have the lowest opportunity cost, which means if you're going to produce corn, you're going to give up producing potato chips. So what is the opportunity cost for North Korea? Well, North Korea would give up 1,000 units of potato chips in order to produce 5 bushels of corn. That's an opportunity cost of 200. For South Korea, they would have to give up 1,500 units of potato chips in order to produce 10 bushels of corn. 1,500 divided by 10 would be 150. So South Korea has the lowest opportunity cost and therefore has the comparative advantage in producing corn. Well, knowing this, we should be able to answer these questions. In the first question, it says, in trade between North Korea and South Korea, what? Well, we already saw that South Korea has a comparative advantage in producing corn, and that is the answer in B. Let's look at the other answers to make sure that they were wrong. A says North Korea has an absolute advantage in producing corn. And we said that South Korea had the absolute advantage in producing both corn and chips, so A is not right. C, North Korea has a comparative advantage in producing corn. Well, no, that's the opposite of the correct answer, which is letter B, which we've already computed. D, South Korea has a comparative advantage in producing chips. No, we said that North Korea had the comparative advantage in producing chips. So B is the only correct answer in that question. In the next question, it says, if there were free trade between the two countries, which one of the following statements would be true? A, only North Korea will gain from free trade. No, theoretically, everyone is going to gain from free trade because then we're going to have the maximum amount of output. You saw in our previous example that after specialization, there was more bushels of cotton, bales of cotton and wheat being produced. Okay, so specialization is going to benefit everybody. There would be more output. B, South Korea would specialize in the production of both chips and corn. No, South Korea is going to just produce the corn because they have the comparative advantage in corn. North Korea had this comparative advantage in chips, so B is not correct. C, South Korea will export chips to North Korea. No, South Korea has a comparative advantage in corn. They're not going to be exporting any chips to North Korea. North Korea can produce chips better. North Korea is going to specialize in the chips. So the answer must be D. North Korea will specialize in the production of chips. Now the third question is a little bit more difficult. It says, assuming free trade between the South Korea and North Korea, the relative prices of the corn and the chips would be what? Well, the answer here is going to be B. It's going to be between 150 and 200 chips for 1 bushel of corn. Now, why is that correct? Well, recall that North Korea's opportunity cost to produce 1 bushel of corn is 200 units of chips. South Korea's opportunity cost for producing 1 bushel of corn is 150 units of chips. Thus, the lowest price that South Korea would charge would be 150. And North Korea wouldn't pay more than, North Korea would only be willing to pay around 200. So the answer is B. Next question says, what is the consequence of tariffs on imports of a product? Remember, we said that tariffs is a tax sort of on these imports, and that makes the cost of the final consumer higher. And the answer is C, a higher cost for the consumer of the imported product. A is not correct because it's not going to result in higher consumption. The cost is going to be higher. And because the cost is higher, we know that there would be less demand. So A is not correct. B, there would be lower profits on rival domestic products. Well, the tax on imports is not really going to affect the domestic products. And in fact, by taxing or providing a tariff on these imports, that makes the domestic products a little bit more competitive in that they don't have to reduce the price in order to compete with the imports. So the profits are not going to be affected on rival domestic products. D said lower cost for the consumer on rival domestic products. No, it's not going to result in any lower cost. It's still going to be charging the same price. So the answer is C. The next question says, given a spot exchange rate for the US dollar against the euro dollar of 1.209 and a 90-day forward rate of 1.1956, what? Well, we said that when the forward rate is lower than the spot rate, that forward rate was at a discount, and that's the answer to C. The forward euro dollar is at a discount against the dollar. The next question says, if the US dollar British pound exchange rate is $1 for 0.58 British pounds, a product priced at 45 pounds will cost a US consumer how much? What we have to do is convert the pounds into US dollars, and the exchange rate is $1 for 0.58 British pounds. All we're going to have to do is multiply the 45 pounds times $1 divided by 0.58 British pounds. The pounds will cancel out, leaving us $77.58. The answer is B. The next question. What would be the likely result of a decline in the value of the US dollar relative to the currencies of the trading partners of the US? Well, if the value of the US dollar is declining, that means that the foreign currencies are getting stronger. And what that means is that US exports to other countries will become cheaper for those foreign countries because their dollar is stronger. They're able to buy more items of US exports. So the US exports will increase. The answer is C. The last question says, generally, how are balance of payment deficits and surpluses eliminated? Well, we have typically in the currency markets flexible exchange rates or floating exchange rates. And just by the market mechanism of the floating exchange rates, this is how balance of payment deficits and surpluses are eliminated. The answer is C. A says by adopting a common monetary unit. Well, that's not going to help reduce any deficits or surpluses because some countries will still import more or export more to certain countries. B said by adopting tight monetary policies. Well, that's not going to necessarily affect the exchanges between countries. It might impact a little bit in this country of the change, but not necessarily in the other country. D says by taxing imports as necessary for import and export quantities to match. Not a really great thing to do. Usually tariffs and other control strategies sometimes backfire and don't work the way that they are intended to. It's not really the best way to do it. C is the best answer. Just let the market reach its own equilibrium. Well, Well, that's the end of our discussion on economics. On behalf of all of us here at BISC, I'd like to encourage you to study, do lots and lots of questions. There's a very high correlation between doing lots of questions and doing well on the exam. We'd like to wish you the best of luck.
Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. BISC Education.
Hello and welcome to our coverage of financial management. My name is Kevin Kemmer and I'll be your instructor today. Before we get started, I wanted to give a little bit of advice to those of you that are sitting for the exam for the first time. Most of the candidates that I have instructed that have been successful have demonstrated a few characteristics. One, all of them have made a choice to pass the exam. Two, they all have set a plan. They all have a plan about how they're going to go about succeeding. And that plan usually incorporates a number of different avenues, including studying from textbooks, using software, watching videos. But I think the biggest key you have to remember is that when you take the CPA exam, the exam is questions. And I think one of the better ways to prepare, although not the only way, is to answer a lot of questions. And I really encourage you to answer as many questions as you can in preparing for the exam, because that gets you very involved with the topic. that helps that information to sink in better than if you were just reading it or you were just watching it. And whenever we go through this videotape today, and I have you do questions, I will tell you to stop the tape. That's because I want you to get involved with it. I don't want you to sit back and just watch me answer the questions, because you won't learn as much from that approach. So you need to get involved. And the third aspect or positive characteristic of these people that are passing the CPA exam is they stick to their plan. They don't get sidetracked. They don't let in-laws distract them. They don't let the game on Friday night get in the way. But when they plan to study, they actually follow through. With that in mind, let's go ahead and get into our topic. The first area under the topic of financial management that we'd like to talk about is working capital management. I think you recall from your classes that working capital is equal to current assets minus current liabilities. Sometimes this is also referred to as net working capital. Again, net working capital is current assets minus current liabilities. And this concept, working capital, is a measure of liquidity. Liquidity refers to the ability of the firm to meet its short-term debts and obligations as they come due. So working capital is sort of going to give us some indicator as to the ability of the firm to pay its short-term debts as they come due. So if you compute working capital and you take current assets minus the current liabilities, you have three possible situations. One, you could get zero. If current assets were exactly equal to current liabilities, then working capital would be zero, and that's pretty unlikely. More likely situation would be if current assets were greater than current liabilities. And if current assets are greater than current liabilities, then working capital is positive. And that implies that the company is able to meet its short-term debts as they come due. On the other hand, if current assets are less than current liabilities, then working capital is negative. And this would suggest that the firm might experience some difficulties in satisfying their short-term debt. Now, a related measure of liquidity is known as the current ratio, and it uses the same information that the working capital concept does, and that is current assets and current liabilities. And all it does is it expresses a ratio and with the current assets in the numerator and the current liabilities in the denominator. So if current ratio is greater than 1, that means that the current assets are greater than the current liabilities. So a current ratio that is greater than 1 corresponds to a positive working capital. Also, a current ratio that would be less than 1 would correspond to a working capital that would be negative. So again, they give you the same kind of information, just expresses it in a different way. Now, to compute working capital or the current ratio, we need to make sure that we remember what current assets consist of. And you'll recall that current assets consist of items like cash, marketable securities, accounts receivables, prepaid items, and inventory. Again, current assets would include items like cash, marketable securities, accounts receivables, prepaid items, and inventory. Examples of current liabilities would include accounts payable, wages payable, taxes payable, utilities payable, and unearned fees. Now, I really think that the CPA exam is most likely to ask you how certain transactions would affect working capital. I really think that they're probably going to test your understanding of how transactions would affect working capital. So I want you to do a number of questions. At this point, I want you to stop your tape and you go to your viewer's guide and answer questions 1 through 4. And when you get your answers, then you can come back and we'll go over them together. And again, I want to encourage you here. You really need to stop your tape. If I tell you to stop your tape and do these questions, you do that because you need to get active. You need to be a participant in this process. That's the best way to learn. So go ahead, stop your tape, do questions 1 through 4, and come back. We'll do them together. Welcome back. Let's go through these questions together. Number 1 says, which of the following would increase the net working capital of a firm? Now, what you really have to do in a question like this is check all the possible answers. You really have to stop and do the analysis, and you have to know what working capital is. Remember, working capital, current assets minus current liabilities. Letter A, it says the payment of wages payable. Well, if you're going to pay wages payable, you're going to pay cash. So you know that you're going to have a decrease in cash, which is a decrease in a current asset. You also are going to pay off wages payable, and that will decrease your liabilities, your current liabilities. So you have both a decrease in current assets and a corresponding decrease in current liabilities. So when you take the decrease in current assets minus the decrease in current liabilities, they really offset each other, and there's no effect on working capital. If you have any problem seeing that conceptually, if you're sort of like me, what you might want to do is make up some numbers, make up an example. And you know, if you're sitting in the exam, you've got some scratch paper or something, you could write down some numbers here. For example, let's say that prior to the payment of wages payable here, you had current assets equal to 10, and you had current liabilities equal to 8. So your working capital is 2. The 10 minus the 8 is 2. Let's say that you then go on and you pay wages payable of 2. So you're going to decrease your current assets because cash is being used up. You're going to decrease it by 2. That'll bring current assets down to 8. Your current liabilities will have gone from 8 down to 6 because you paid $2 of liabilities. So your working capital after the payment is the 8 minus the 6 equals 2. You still have working capital equal to 2. And so A doesn't change working capital. Look at B, collection of accounts receivables. In this case, we'd be collecting cash. That's an inflow. That's an increase in current assets. But you're going to be decreasing accounts receivables because you're not going to have that right anymore. So you have an increase in current assets and a decrease in current assets that offset each other. And B is not the right answer because working capital isn't going to change. You look at letter C, it says refinancing a short-term note payable with a 3-year note payable. Okay, so we're going to be taking a short-term note off the books, and that's going to decrease current liabilities. But the incurrence or the issuance of the 3-year note payable is a long-term liability. It's not going to affect working capital at all. So only the payment of the short-term note payable, the refinancing of it, is going to affect working capital by decreasing current liabilities. So you have the same amount of current assets minus a smaller number for current liabilities. So your working capital is going to be higher. So, and that answers the question. C results in an increase in the net working capital of a firm. Now what you want to do usually is check all the answers. You find an answer that you think is right, and C certainly appears to be the right answer. I also suggest it's a good idea to read all the answers. Sometimes you might find an answer that's better. I don't think we'll find one that's better than C, but let's check D anyway. D says a purchase of a new building financed with a 25-year mortgage. Well, building is a long-term asset, so acquiring a building isn't going to change working capital. And issuing a 25-year mortgage is a long-term debt, and that's not going to affect working capital. So D is definitely not a right answer. The answer to number 1 is C. In the second question, they ask you to determine the effect of the issuance of common stock for cash on the company's working capital and the current ratio. What I suggest here, in this kind of problem, take it one at a time, look at working capital first, okay, and really would help maybe to think about what the journal entry is. The issuance of common stock for cash, we would be debiting cash, we'd be receiving cash, and that's a current asset. So current assets would be increasing. When we issue the common stock, we'll credit common stock. Well, that's an owner's equity account. You know that's not a current asset or current liability. So the only part of this transaction that affects working capital is the increase in cash. So that'll have an increase on the working capital because current assets went up, current liabilities didn't change, so we have an increase in working capital. So we know for number 2, we want an answer for working capital that says increase. So it's either going to be A or C, and we can eliminate B and D. Now let's go to the current ratio. What effect will having the issuance of common stock for cash have on the current ratio? Again, cash is a current asset, and that will be increasing, so our numerator is increasing. And the common stock is not a current asset or current liability, so it doesn't affect the ratio. So we have an increase in the numerator, no change in the denominator, and that's also going to increase the current ratio. So the answer here would be letter C, increase, increase. And one of the things that I want to warn you about in analyzing working capital and current ratio is just because one increases, like in this case, working capital increased, doesn't necessarily mean that the current ratio will always increase. And you might be wondering, well, that doesn't sound right. Sometimes you sort of have to play with the numbers, and I want you to be careful when you're doing questions that just because you have an increase in working capital doesn't mean you have an increase in current ratio or some other change, like working capital doesn't change, what will happen to the current ratio? You have to analyze every circumstance individually, because you can't always say that an increase in working capital will always be an increase in current ratio. For example, remember back in number 1, letter A, when we were analyzing the payment of wages payable, I gave you that numerical example where we had current working capital of 2. Remember, that was 10 minus the 8 is equal to 2. And then we paid off the 2, and that gave us 8 of current assets and 6 of current liabilities, and we still had a working capital of 2. Well, that was no change in working capital. So you think, well, maybe there's no change in the current ratio. But if you analyze that situation, you find that there is. The current ratio prior to the payment of wages payable would have been the 10 of current assets divided by the 8 of current liabilities, and that would give you 1.25. After the payment of the wages payable, you had current assets of 8 and current liabilities of 6. That would be 8 divided by 6, and that would give you a current ratio of 1.33. So although the working capital did not change, the current ratio went from 1.25 to 1.33. It increased. So be very careful, in analyzing working capital and current ratios. One might go in one direction, but that doesn't mean that the other will always go in the same direction. Let's look at number 3, Adam Company. Adam's company board of directors was identifying 4 courses of action, and of course we want to choose the course of action that's going to maximize the net working capital. So you, again, have to look at all 4 options and find out what happens to working capital. So let's start with option 1. Option 1 said that it would result in an increase in current assets by 100, and it would decrease current liabilities by 30. So what effect does that have on working capital? If current assets go up by 100, current liabilities go down by 30, that would actually have an increase of $130. So for option 1, we have an increase of 130. Option 2 says that current assets would increase by 160, and current liabilities would also increase by 40. So you have an increase of 160 minus an increase of current liabilities of 40. That's an increase of $120. Okay, that's less than in option A, so we know B is not a right answer. Option 3 said there would be a decrease in current assets by 150 and an increase in current liabilities of 50. Wow, if we have a decrease in current assets and an increase in current liabilities, we're going to have a decrease in working capital. In fact, that's a decrease in working capital equal to $200, right? We have $150 decrease in current assets. That's a negative, minus an increase in current liabilities of 50. That's minus 200. Option 4 resulted in a decrease in current assets of $120. Well, that's going to reduce working capital. We also have a decrease in current liabilities of 85, so that'll offset some of that decrease in current assets. You have the minus 120 minus a decrease in current liabilities, that's minus minus, remember that's really plus, plus 85, so 120 negative plus 85 would give you a decrease of working capital of 35. So the answer here is A, option 1 gives us the biggest increase of $130. The next question deals with Gene Company. And Gene Company is evaluating a plan to expand its capacity. And if you go to the question, it says, what is the estimated effect of the expansion on Gene's working capital? So what we have to do is we have to analyze what the current working capital is and compare that to what the planned results would be. Now you've got a list of a number of financial statement items there, cash, marketable securities. And the first thing you have to think about is, are all of these related to working capital? In other words, I would go down this list and you have to identify the current assets and the current liabilities. And if you look down this list, fixed assets are not a current asset, not a current liability. I would cross fixed assets out. Now we have two mortgages. We have a mortgage payable, a current portion. So obviously that's a current liability. We also have mortgage payable long term. That's not a current liability. You'd want to cross through that line. And also the retained earnings. Retained earnings, that's not a current asset or a current liability. So what we want to do here is, let's start with the current. We'll take the cash of $4,000, the marketable securities of $20,000, accounts receivables of $45,000, the inventory of $43,000. Those are all current assets. And then we would want to deduct the current liabilities, the accounts payable of $37,000, the mortgage payable of $18,000, and you would end up with working capital for the current situation of $57,000. Now let's go to the planned results. Again, we've crossed out the fixed assets, the long-term mortgage payable, and the retained earnings. So if we add up the cash of $10,000, the marketable securities of $11,000, accounts receivables of $60,000, inventory of $53,000, and then subtract out the accounts payable of $46,000 and the current mortgage payable of $34,000, we'll get working capital equal to $54,000. So the company would have gone from $57,000 of working capital to $54,000. That would actually result in a decrease of working capital equal to $3,000. So the answer here is letter D, decrease of $3,000. Well, I hope you did well on that set of questions. Certainly would encourage you to do more questions. And if you're with me to that point, I think the next topic I'd like to talk to you about is cash management. Now, one of the first things I'd like for you to learn about cash management is reasons why firms hold cash in the first place. Now, if you were to ask me, Kevin, why do firms hold cash? I'd have to turn around to you and say, look, firms hold cash because cash is the special toilet paper of the future. Okay? And I know I'm not off my rockers, but this is a little memory tool that I've come up with to help me remember the 5 reasons why firms hold cash. And the first letter in cash and special and toilet and paper and future all stand for one of the reasons. So cash is the special toilet paper of the future. The C in cash represents compensating balance. Now, a compensating balance is an amount that a company needs to maintain in their bank account to compensate the bank for services that they receive from the bank. Again, a compensating balance is simply an amount that the amount that the firm has to maintain in their bank account to compensate the bank for services that the bank provides them. The S in special stands for speculation. And when we talk about speculation, what we're referring to here is sometimes firms come across some bargain purchases that they didn't plan for. So speculative reasons or speculation here is unplanned bargain purchases. Firms like to keep some money on hand just in case they come across a bargain. The T in toilet stands for transactions. These are the everyday routine transactions of the company, like meeting payroll, buying inventory on a periodic basis. Okay, so transactions, the T in toilet stands for transactions. The P in paper stands for precautionary measure. This is more or less a contingency for uncertainty. When companies prepare cash budgets, they prepare them under certain expectations, and the company needs to maintain some little bit extra cash as a contingency in case their forecast is not accurate. So it's just a contingency measure. Okay, that P for precautionary. The F in future stands for future cash requirements. Companies will keep cash on hand for special outlays that they're planning for, like dividend payments, making debt payments, and tax payments. So again, cash is the special toilet paper of the future. You know, one of the things that you might want to keep in mind, think about doing in your preparation for the CPA exam, some of my more successful students use flashcards. And this is a situation where you could write down CSTPF, or cash is the special toilet paper of the future. And on the other side, put compensating balance, speculation, transactions, precautionary measures, and future cash requirements. And then you can develop all these flashcards and use them. I know some people feel silly. They feel like it's something that they did in elementary school. And I certainly remember using them to learn like the multiplication tables, and they work. And so I really strongly encourage you to use a variety of techniques to help you learn things. Also using mnemonic tools like coming up with funny phrases, cash is special toilet paper of the future, can help you in grasping all this material that you have to learn for the exam. Now, a good financial manager is going to understand a number of items, a number of things, so that they can increase the firm's cash balance. A good financial manager is going to increase the firm's cash balance. There's basically two ways that they could go about doing this. They could either speed up the cash collections of the firm, or they could also, or they could slow down any disbursements or payments. And a good financial manager is going to have an understanding of something called float and take advantage of float. Now, float is the time between when a customer mails a payment and when it becomes available in the firm's bank account. Again, float is the time between when a customer mails a payment and when it becomes available in the firm's bank account. And this float is composed of three items: mail float, processing float, and check clearing float. Mail float is the time between when the customer mails that payment and when the company actually receives it. Again, mail float is the time between when the customer mails it and when the company receives it. Processing float is the time between when the company receives the payment and when the check is actually deposited at the bank. They're actually processing it inside the company. Then check clearing float is the time between when the payment or the check is deposited at the bank and when the funds actually become available to the company. Okay. Now, there are several ways that we could go about speeding up cash flows. If you stop and think about it, you have a bunch of customers that also probably sort of understand float, and they're going to be taking advantage of that float. And as a good financial manager, that manager would be interested in speeding up those cash flows and trying to eliminate some of that float here and there. So we need to come up with some ways of speeding up those cash inflows. Now I want you to stop and think for a moment. If you're collecting cash slowly, in other words, cash collections are being delayed, or a delay, that's not a good thing for your firm, because that's keeping you from cash that you could be using and investing and making a return on. So a delay is not a very good thing. In fact, you might even say that delay is a crime. Now, if you had a crime, who would you call? The law. Well, in this case, when you have a delay, you're not going to call it the law, but D-law. Again, I have a little memory aid here to help you remember 5 ways in speeding up cash inflows. Okay, D-E-L-A-W, the law, will help prevent the delay. What does the law stand for? Well, the law stands for D, decentralized collection centers, E, electronic data interchange. The L stands for lockbox system. A stands for automated clearinghouses. And the W stands for wire transfers and depository transfer checks. So let's talk about each of these items, make sure you know what these are. Let's begin with decentralized collection centers. Let's say we have a company that has a centralized collection center, for example, located in Tampa, Florida. And this company has customers all over the United States. And they're mailing payments in from places like Hawaii and Oregon and Wyoming and New York and Texas and Alabama, okay, all coming into Tampa, Florida. Now the company would like to get access to their money a little bit faster, right? And they would be able to do so if they were to decentralize their collection process. In other words, instead of having everybody send their checks into Tampa, we can cut down some of that mail float by having decentralized centers. For example, the company may open up a collection center in California to handle their Hawaiian and West Coast customers, and another in Texas for their customers in the Southwest, and maybe another collection center in New York for all their customers in New England, and maybe one in Tampa for their Southeastern customers. So decentralized collection centers will help us cut down on that mail float, and we'll get our money a little bit faster. But there is a trade-off. Remember, if you're going to open up these other collection centers, then you're also going to incur cost in having these collection centers open. So you really have to figure out whether or not you have more benefits coming in from having these decentralized collection centers than the cost of those collection centers. Basically, we have to look at how quickly we can get that money and how much faster we're getting money, and figuring out how much interest or return we're getting on that excess funds. The fact that we have our money faster, we can invest it in overnight securities, money market funds, what have you, and so that's where we're going to get our benefits. Now the E in DeLaw stood for electronic data interchange. Electronic data interchange is simply the exchange of electronic documents from one computer to another computer. For example, some businesses accept payments for items that they sell on the internet through companies like PayPal, and that's simply a form of electronic data interchange which enables individuals to transfer money to another individual or company at very little, if any, cost. And wow, if you have people transferring money electronically, there goes all that mail float, right? So we're going to get our money much quicker. The L in DeLaw stands for lockbox system. Now, a lockbox system is an arrangement between a company and a bank. And in this arrangement, the bank is going to go to a special post office box that is there just for payments for that company. And sometimes they'll send employees over once, two, maybe even 3 times a day, take the money, the payments out of that post office box, and they'll deposit it, the funds, the checks, into the bank account of the company. Then they'll send the remittance advices to the company. And what happens in this arrangement is the check clearing process is actually beginning before the check processing process. Remember before, when we talked about float, you sort of thought of it more sequentially, that you had the mail float, then you had the check processing float, and then the check clearing float. Well, here we're taking that sequence and we're letting 2 of the items happen side by side. Okay, the check processing process actually is beginning before the check, the check clearing process is actually beginning before the check processing process. The A in DeLaw stands for automated clearinghouses. Now, automated clearinghouses are simply networks of banks. They're electronic networks that are operated by the Federal Reserve. Okay, and these networks, because they're electronically connected, it makes it easier to exchange information and move the funds from one bank to another. In fact, usually we're able to move funds from one bank to another bank in less than 1 day. Now the W in the law stands for wire transfers and depository transfer checks. And again, this is a very fast way to move funds. However, it's very costly. Now, I want to go back to one of these items in the law. I want to go back to the lockbox system and go through an example with you. Because as I was saying, when we have these different approaches to speeding up cash inflows, we can't just blindly say, well, let's do it, because some of these items cost money. And what you really have to do is make sure that the benefits that you receive from taking on one of these special approaches is going to exceed the cost of that approach. And so I want to look at a lockbox system as an example. If you go to your viewer's guide, I have example number 1 on a lockbox system. In the example, it says that a firm has daily cash receipts of $200,000. So every day, the company receives $200,000 on average. And a commercial bank is offered to reduce the collection time by 3 days. How? By setting up this lockbox system, where the bank, again, goes to the special post office, pulls the money out, automatically deposits it in the company's bank account, and starts that check clearing process before the check clearing process before the check processing process has even started. Now, in the problem, it says the money market rates will average 12% during the year should the firm adopt the lockbox system, and why? Well, I've broken it down into really 4 steps here. If you come across a lockbox system, the first step is compute the increase in funds available. Because we're speeding up cash inflows, we're going to get money faster. Now remember, the problem said that this company is receiving cash on average of $200 per day. And because of this lockbox system, we're going to be able to reduce the collection time by 3 days. So we're going to take the $200,000 collections per day times the 3 days that we're speeding it up. Multiply that out, we get $600,000 increase in cash. So on average during the year, we'll have $600,000 more cash on hand. And what do you do with that cash? You invest it. So in step 2, what we'll do is we're going to compute the amount of interest that we can generate from those extra funds. You all remember the interest formula. Interest is principal times rate times time. We're going to take that $600,000 of excess cash or increase in cash that we got in step 1, and we're going to invest that at the money market rate, which they gave in the problem was 12%. So that's our interest rate. We'll multiply it by the time. We're assuming 1 year, 600,000 times the 12%. We're going to have $72,000 more money due to the interest that is generated on these extra funds. That's step 2. Step 3, we need to compute the cost of the lockbox. Remember, this isn't free. And in the problem, it mentioned that the bank offered to do this for a fee of $4,000 per month. So if this operates for 12 months, we'll take the $4,000 per month, multiply it by the 12 months, we get the $48,000. That's the cost of operating the lockbox. And finally, you can go to step 4, and you can compute the net benefit by taking the extra funds that we have from step 3, the increase in interest of $72,000, subtract the cost of the lockbox that we computed in step 3, the $72,000 minus the $48,000 will give us a net benefit of $24,000. So in this case, the company would enter into the lockbox system with the bank because they would be better off by $24,000. Now that we've talked about speeding up cash inflows, I'd like to talk about slowing down cash outflows. In other words, how are we going to keep the money from flowing out so quickly? And we can do that in a number of ways. First is pay by draft. In other words, make full use of the float that we now have a good understanding of. Pay by the check, put it in the mail, make it go through the mail, and take all that time through the mail float and the check processing float and the check clearing float. The second means of slowing down cash outflows would be using something we call payable through drafts. Now, payable through drafts are drafts. Remember, a check is a draft, but this is not a check. A payable through draft is not payable on demand. And in this case, the drawee is the payee. What happens, a payable through draft must be presented to the issuer and then accepted. Now, this is slower, but it's more expensive than using regular checks, because it has higher processing costs, and most businesses do prefer checks. But it is one way that we could slow down our cash disbursements. A third means of slowing down our cash disbursements is to utilize what is known as a zero balancing checking account. This is an account that always maintains a zero balance. Of course, when you write a check on an account that has zero balance in it, then you have an overdraft. And what the bank does is that then, because of that resulting overdraft, it will cover that overdraft by funds from a parent account. So they have to wait until the funds are transferred from the parent account to the zero balancing checking account to cover the overdraft. Again, the cost may be higher because the bank probably is going to charge a fee for this service. Now, another means of slowing down cash disbursements is to simply pay beyond the normal credit terms. Now, this is not really advisable, but it is possible that you could do this. Of course, you're going to risk ill will with your supplier, and you could incur interest charges. What I'd like for you to do is try some questions, see how you're doing here, make sure that you understand about float and speeding up cash inflows and slowing down cash outflows. So at this point, I'd like you to stop your tape and do questions 5 through 9. Get your answers, then come back and we'll do them together. Welcome back. Hopefully you tried these questions and did well. Let's go over them and see how you did. The question number 5 says 4 major motives for holding cash are. Well, remember what we talked about a number of moments ago, and that is there are 5 major reasons for holding cash. And we learned that special memory aid. Cash is the special toilet paper of the future. Remember, the S stands for, the C in cash stands for compensating balance, and the S stands for speculative reasons, and the T stands for transactions, and the P stands for precautionary measures, and the F stands for future requirements. So if you're in the exam, you got some scratch paper, you sit down, you write cash is the special toilet paper of the future, the C, the S, the T, the P, and the F, and you write those down, and then you can go through these answers. Let's go through them and see what we have. A says speculative. Yeah, that was one of the reasons. Social. No, that wasn't on our list. The S stood for speculative. So A is not the right answer. Go to B. B says speculative. Yes, that was one of them. F, fiduciary. No, we said the F was for future needs. Okay, so B is not the right answer. C, we have transactional. Yes, that was the T. P, psychological. No, the P that we had was precautionary measures. Let's look at D, make sure that it's the right answer. A, B, and C seem to be wrong. D, transactional. Yes, that was the T. The P, precautionary. The C, compensating balance, and the S, speculative purposes. And the answer to number 5 is letter D. Number 6 asks us which of the following would not result in accelerating cash inflows. Remember, here we were talking about the fact that the law would help prevent delay. Okay, so if you keep that in mind, you know that decentralizing its collections would result in it. Remember, D for the law stood for decentralized collections. The E stood for electronic data interchange. The L stood for lockbox systems. The A stood for automated clearinghouses. And the W stood for wire transfers. So let's look at these answers and see what we have. Let's start with letter D. Letter D says initiating controls to accelerate the collection and deposit of checks over $225. Well, if you initiate controls to accelerate the collection, it will result in accelerating cash inflows, right? So that's not the answer. Again, the question says which of the following would not result. You have to find the one that would not result in accelerating cash inflows. D does result in accelerating cash inflows. C, lockbox arrangement, well, that was the L in the law. That results in accelerating cash inflows, so that's a good method of accelerating, and that's not our answer here. B, decentralize its collections, that was the D in the law. How about A, compensating balances? Well, compensating balances doesn't accelerate cash inflows, okay? that was a reason why we hold cash. So the answer to number 6 is letter A. Number 7 says, which of the following is a method of slowing down cash outflows? Well, again, we talked about 4 methods of slowing down cash outflows. Paying by draft, payable through draft, zero balancing checking account, and just paying beyond the normal credit terms. And you can see letter B, it's probably standing right out there, a zero balancing checking account. That was one of the 4. Okay, so the answer to number 7 is B. Number 8 is about compensating balances. It says the compensating balance A is a level of inventory held to compensate for changes in the average quantity used over a 4-month period of time. We haven't talked about inventory yet. We'll talk about it later. That's not what compensating balances are. We remember compensating balance is an amount that the company must maintain in its bank account to compensate the bank. And that's B. B says compensates a bank for the services it renders to the company. And the answer is letter B. But again, as I mentioned before, it's always good to read all the answers, make sure there isn't a better one. So let's look at C. Is the amount of money withheld by a bank on a discounted note? No, that would simply, that's not a compensating balance. They might hold money on a note discounted at the bank, and that's going to represent their interest, but that's not called a compensating balance. D is used to compensate for possible losses in the company's long-term portfolio of securities available for sale. No, we never talked about any such thing. D is not the right answer. It is B. Number 9 deals with Kemmerer Corp. This is a pretty unusual question because I've yet to ever see a question on the exam that is about Kemmerer Corp. You don't see my name on there. Kemmerer Corp uses a central collection system that requires all checks to be sent to its Miami, Florida headquarters. And an average of 5 days is required for mailed checks to be received, so that's the mail float. 4 days to process them, check processing float, and 2 days for the checks to clear the bank, the check clearing float. So there's a total of 11 days there. A lockbox system would reduce the mail and process time to 5 days and the check clearing time to 1 day. So this lockbox system is going to take the total float time down to 6 days. We had 11 prior to the lockbox, 6 after. We're going to save 5 days. We're going to collect money 5 days faster. Now it says Kemmerer Corporation has average daily collections of $150,000. If Kemmerer Corp adopts the lockbox system, how much would its average cash balance increase by? Well, that was step 1 that we showed you earlier in the 4 steps of determining the benefit, the net benefit of a lockbox system. We don't have to go through the whole process. We're just asked what the increase in average cash balance is. And that's going to take the 11 days of float time minus 6 days. We've decreased 5 days of float. So we're going to get our $150,000 a day times our 5 days is $750,000. And our answer is letter B, 750. Now that we've discussed how good financial managers increase the firm's cash balance, the question then becomes, what are those financial managers going to do with that extra cash? And you need to keep in mind that they ought to take that excess cash and they should invest it in liquid assets that provide a high return and yet impose little risk, such as money market instruments that I've included in a table in your viewer's guide. If you go to your viewer's guide and look at table 1, I put this table together to sort of give you a feel for the different kinds of money market instruments that exist and what kind of maturities they have, how marketable they are. And one of the things that I want to state right off the bat about this table is that as we go down the table from top to bottom, as we go from the U.S. Treasury bills on down, the yields on these instruments tend to increase. And that's generally because as we go down this list, the risk is also increasing. Remember that interest returns are usually commensurate with risk. So U.S. Treasury bills being up at the top are your less or your least risky money market instruments. And as you can see there, they have a variety of maturities basically 3 months, 6 months, and a year. And these are very highly marketable securities, very safe investments, and probably the most popular investment when companies want to invest in something and have quick access to the cash later. U.S. Treasury bills are going to be a safe investment and very marketable, so they'll be able to get their cash back relatively easily. Below the U.S. Treasury bills, you'll see federal agency issues. Now, there's 5 major federal agencies, and I'm not sure that you would really need to learn all 5 major agencies that will issue money market instruments. But they're pretty easy to recognize because 4 of them have the word federal in their name. So if you're on the exam and you come across an agency that's issued a money market instrument, it's probably one of those big 5 if it's got the word federal in there. For example, Fannie Mae, the Federal National Mortgage Association, issues money market instruments. And these instruments vary in maturity from just a few days to even a year. And there's a really good market for this. They're very highly marketable. We also have short-term municipal securities. These are securities that could be issued by states and local governments. Again, there's a variety of maturities. They could be 1 month up to a year. They're not as marketable as the U.S. Treasury bills, however, or the federal agency issues, but they're still fairly marketable. Continuing on, you also see that we have negotiable certificates of deposits. These are usually rather large amounts issued by banks. And again, a variety of maturities, and there's a fairly good market there. Now, commercial paper is basically promissory notes issued by your bigger firms. There's not a really big secondary market here. A lot of this commercial paper gets issued directly to an investor. For example, IBM might issue some commercial paper and get directly to an investor. And they tend not to trade that commercial paper, even though it's a negotiable instrument. They tend not to have much of a secondary market. There are a number of other firms, not as big like IBM or any of those Dow 30 or whatever. Some of your smaller firms, when they issue commercial paper, they sometimes have to go through a broker, so there is somewhat of a market there. But it's not strong like the market for U.S. Treasury bills and federal agency issues. We also have repurchase agreements, also known as repos. We have bankers' acceptances, which are backed by the bank. We have euro-dollar deposits, money market funds, and money market accounts. So you might want to spend some time in your studies looking at this table. And again, keep in mind that as we go from the top of the list down to the bottom, the yields are going to increase because usually the risk is increasing. What I'd like for you to do is take a few moments and look at some questions after you've had a chance to look at this table. What I'd like for you to do is stop at your tape at this point, study that table a little bit, and then answer questions 10 through 14. And when you have your answers, then you can come back and we'll go through them together. Okay, welcome back. I'd like to start with number 10. It says, which of the following is the least appropriate substitute for cash? Again, on an exam, you have to be very, very close attention to the wording. You want to look for words like most, least. You want to look for words like not. Okay, so least appropriate substitute for cash. A banker's acceptance. Well, that's an appropriate substitute for cash. That's on our list of money market instruments. B, commercial paper. That's also on our list. C, convertible bonds. They're not on our list. Convertible bonds are more long-term in nature. D, U.S. Treasury bills. Well, that was on our list. In fact, that's the most popular substitute for cash. So our answer to number 10 is letter C, convertible bonds. Number 11 deals with commercial paper. Number 11 says commercial paper A generally has interest rates that are lower than Treasury bills. Well, again, if you go back to that table, I said that generally the rates increase as you go down, okay? And as you go down that table, and commercial paper is below the Treasury bills, so it's going to have a higher interest rate typically than Treasury bills. So A is not a correct answer there. B, is commercial paper a secured promissory note? Well, it is basically a promissory note, but it's not necessarily secured by anything. So B is not the right answer. Letter C says typically does not have an active secondary market. Yes, we said that was one of the characteristics of commercial paper, is a lot of times this paper is issued directly to the investors, and there isn't that much of a secondary market. There is one, but it's not very active. C looks like the best answer. Let's check D. D says has maturities of greater than 1 year. No, the commercial paper we want to talk about here, we're talking about short-term investments, and D is not right. The answer to number 11 is C. Number 12 says short-term notes issued by the Federal National Mortgage Association, Fannie Mae, are called what? Well, again, I mentioned if you see any federal agencies, these are agency securities. The answer is A. Short-term notes issued by Fannie Mae are called agency securities. Number 13. 13 says, which of the following is most often used as a cash substitute? Most often. And that would be E, as we mentioned, Treasury bills, because they're the safest short-term investment. Okay. Again, as we go through that list, up at the top, Treasury bills are the safest. They have the lowest yields. Number 14. Of the following, the marketable security with the least default risk is, again, we know that's E, Treasury bills. Okay. But as you can see, what if Treasury bills wasn't on that list and you had to choose between agency securities and bankers' acceptances? That's why it's a good idea that you sort of take a look at that table and keep in mind as you go down the list, the default risk or the risk involved tends to increase as you go down the list, which is why the returns normally increase as you go down that list. So I think you ought to spend some time studying that table to make sure that you can make comparisons about the safety and the interest rates involved with these various money market instruments. The area that I'd like to get into next is receivables management. Now, when a company is establishing credit policies, they often don't have a lot of room to work with because credit policies and setting credit standards across industries is usually fairly competitive. But firms do occasionally need to tweak their credit policy. And when they're considering making credit policy changes, they ought to analyze the impact of those changes on company profits. Now, to really understand credit policy, you need to make sure that you know the different variables that compose the company's credit policy. That includes credit standards. The credit standards are the financial attributes of the customers you give credit to. And you have to realize that these standards are going to affect your bad debt expenses. It's going to affect your investment in receivables and your collection costs. And so as we change these standards, they will have an impact on these items. We also have credit quality. Basically, when you establish certain credit standards, we can pretty much predict what the probability of default is for a particular class of customers. So even though we don't know specifically who won't end up paying, we do know that for a particular class of customers that a certain percentage of those receivables will go bad. Credit period is also a credit policy variable, and this is simply the duration of the credit. We also have cash discounts. Cash discounts are the discounts that we offer to entice our customers to pay more quickly. And of course, if we offer attractive cash discounts, then more of our customers may pay more quickly, and that will reduce some of our expenses and collection efforts. Another credit policy variable is collection policies. And these are our procedures that relate to how we handle our overdue accounts. Again, collection policies relate to the procedures that we use to handle our overdue accounts. Now, two ratios are really important in analyzing accounts receivables. And I think you need to know this for the financial management section of this exam. The first ratio is receivables turnover ratio. And I always tell my students, whenever you hear a ratio and it says turnover, you simply turn over back on top of the word that comes before the turnover. In other words, receivables is going to end up being in the denominator. So for receivables turnover ratio, we will compute it by taking sales and dividing by average accounts receivables. Again, we have receivables turnover, you turn over or put receivable. Let's look at another question. Look in your viewer's guide at question number 15, dealing with big company. Big company's budgeted sales for the coming year are expected to be $540 million, of which 80% are expected to be credit sales at terms net 30. Now, Big is estimating that by using the credit standards, they'll be able to increase the credit sales by 30%, and that's going to result in an increase in the average collection period from 25 days up to 40 days. The question asks us about the proposed relaxation of the credit standards. Will it result in an increase in the average accounts receivables balance? How much? How much of an increase in the average accounts receivables balance? Well, first, we need to determine the average balance of accounts receivables if there is no change. If we don't change that policy, sales are still expected to be $540 million. But remember that only 80% of those are on account. So in terms of our receivables, the $540 million of sales on account, $540 million of sales times 80% on account is $432 million of actual credit sales. So now that we have the $432 million of sales on account for a year, what's the average daily sales on account? Okay, so we're going to take that yearly amount, the $432,000. Try to get it right here. $432 million. We'll spread that over the 360 days, and our average daily sales on account would be $1,200,000. But again, that's daily sales on account. We need to know what our average investment is, and on average, we have an average collection period of 25 days, so those sales will sit in our accounts receivables on average for 25 days. That will give us a $30 million average balance of receivables under the old credit policy. Now, what about if we change the policy? If we change the policy, it says that sales would increase by 30%. So what we have to do is, remember that only 80% of those sales were on account. What we can do is start with the $432 million of credit sales that we had before the change. Remember, we took 80% of the $540 million. We'd taken 80% of that to get to $432 million. Now we can increase that by 30%, multiply the $432 million by 1.3, and we'll get $561,600,000 in credit sales for the entire year. Well, if we divide that by average daily sales, by 360 days, we will get the average daily sales on account. That would be $1,560,000. Again, we take the annual amount of credit sales, divide by 360 days, we get the $1,560,000 of sales on account on a given day. But how long are we going to hold these under the new credit policy? It said 40 days. So we multiply it by the 40-day average collection period. We'll get $62,400,000 of average receivables. So what's the increase? We've gone from $30 million up to $62,400,000. That's an increase of $32,400,000, and the answer is B. Now what I'd like for you to do is stop your tape and do a question on your own. See how you handle it. I want you to stop your tape and do question number 16, and when you get your answer, come back and we'll do it together. Now number 16 deals with Smith Wholesale Company, and they have average daily sales on account of $50,000. This is assuming a 360-day year, and all of their sales are on credit terms where they offer a 2% discount if customers pay within 10 days, Otherwise, the full amount is due within 45 days. It says customers representing 30% of sales pay on day 45. So 30% don't take the discount at all. They just wait 45 days and then they pay. But the remaining amount, which of course would be 70%, take the discount and pay on day 10. And the question asks, what are the Smith's average daily collections from customers? Well, on any given day, Smith will be collecting from two different sources. Smith will be collecting 100% of sales that for those customers that aren't taking advantage of the discount. It's not 100% of the sales, but remember we said that the customers that aren't taking the discount is 30%. So 30% of your average daily sales are going to be coming in on a given day 45 days later. Also on any given day, we'll be collecting 70% of the average daily sales where our customers have taken advantage of the discount. So all we have to do is take the 30% of the customers that don't pay within the discount period. They pay the full amount. Multiply that by the average daily sales of $50,000, and we get $15,000. That's every day we're going to receive $15,000 from customers that don't take the discount. We're also going to receive on any given day 70% of $50,000. In other words, 70% of our customers take the discount. So we're going to collect on the other $35,000 of average daily sales, but we don't collect the full $35,000. Remember, they're taking advantage of a discount. If they get a 2% discount, they're only going to pay 98%. So we'd have to take the $35,000 of receivables that we should be collecting on in a given day and multiply it by 98%, we get $34,300. And so the total amount that we collect is $49,300, and our answer is letter C. Now, if you're with me to here, what I'd like to talk about next is inventory management. Now, in inventory management, companies are trying to minimize a number of costs. Ordering costs, carrying costs, stock out costs. And when we talk about ordering costs, we're talking about those costs consisting of placing an order and receiving an order for goods. Again, ordering costs consist of cost of placing and receiving an order of goods. What's included in ordering costs? This would include things like quantity discounts lost, shipping costs, purchasing costs, and setup costs in a manufacturing environment. Again, examples of ordering costs would be quantity discounts lost, shipping costs, purchasing costs, and setup costs. Carrying costs consist of holding inventory for a given period of time, just like it sounds, carrying. It's cost of holding inventory for a given period of time. And the cost that we would include in here would be handling costs, interest on the invested capital, storage cost, and obsolescence. Again, carrying costs would include handling costs, interest on invested capital, storage costs, and obsolescence. Now, stock out costs are incurred when a firm is unable to fill an order. In other words, you risk ill will with customers because you aren't able to make the sale, they're not able to get the product that they want. Sometimes this causes you to have a backlog and you have to incur some extra cost to catch up, and so you might have overtime costs, and so you want to avoid stock out costs. The stock out costs are never good. Now, most firms use an economic order quantity model, and hopefully you remember from your courses at school, the economic order quantity, the basic economic order quantity, is computed by taking the square root of 2 times the ordering cost per order times the annual demand and dividing it by the carrying cost per order. Or I've put there in your viewer's guide, that formula, I put the square root of 2OD over C. And in fact, I have a nice little memory tool that I use to remember this, and that is 2OD over C makes you a square root. Okay? So you can imagine if you were to die overseas, to overdose overseas, that would be bad news, right? Square root of 2 times O times D over C. So to overdose over C makes you a square root. Now what I'd like to do is look at illustration in the viewer's guide about how we can approach a number of issues related to inventory management. So if you look at the Florida Electronic Tools example, it says that Florida Electronic Tools uses integrated circuits and manufacturing calculators. And we have information regarding various costs and demand. Demand is for 110,000 units a year. The integrated circuits cost $2 each. It costs us an average of 30 cents per year to carry one integrated circuit in inventory. And it costs us $41.25 to place an order. It takes about 15 days from the time an order is placed until it is received. And Florida Electronics assumes that there are 250 working days per year in their calculations. Okay. So the first thing that we would like to do is to determine the economic order quantity. What is the amount that they should purchase every time so that they minimize the ordering and the carrying costs? So all I have to do is fill in our formula. Again, remember EOQ is to overdose overseas makes you a square root. So in the numerator we have the 2. The cost of placing an order was $41.25. D, the annual demand, is 110,000 integrated circuits. And our denominator will have C, the carrying cost per unit, which is 30 cents. And when we compute that, we get the economic order quantity of 5,500 units. That's pretty basic. But what if they asked you how many orders you would have to place each year? Well, the way that you would compute the number of orders that you place each year is you would take the annual demand and divide that by the economic order quantity. We know that we need 110,000 units every year. If we're ordering them in batches of 5,500 units, then we're going to have to place 20 orders during the year. What's the reorder point? At what point is Florida Electronics going to put in their order? Well, the reorder point is the level of inventory in which we must place an order so that we don't run out of inventory. So in other words, we have to have some idea as to how much we're going to use over a period of time after we've placed the order until we receive that order. And that time between when we place the order and when we receive it is known as lead time. So your reorder point is equal to your lead time in days times your daily demand. Well, in the problem, it told us that the lead time is 15 days. And we would multiply that by our average daily demand. To get the daily demand, you would have to take your annual demand divided by the number of years, and the number of days in the year. So we're going to take 110,000 units, divide that by 250 days to get 440 units per day, multiply by the 15 days of lead time, and we would need to reorder when Florida Electronics was down to 6,600 units. Now what about the safety stock? The safety stock is sort of like an extra amount. It's a buffer. It's sort of a contingency plan in case your expectations regarding lead time are incorrect, because there can be some variability associated with our estimates. So some firms like to carry what they call safety stock, an amount in case they're wrong. So let's assume that Florida Electronics decided to maintain a 2-day safety stock. What they would do is they would keep enough inventory on hand for an extra 2 days. Remember, they're using 440 units a day. For 2 days, that's 880 units. So instead of reordering at 6,600 units, they would reorder at 7,480. Okay, the 6,600, the reorder point before we computed, plus the 880. Okay. What I'd like for you to do now is to try a number of questions dealing with inventory management. I'd like for you to stop your tape, do questions numbers 17 through 21. When you get your answers, come back, we'll do them together. Welcome back. Number 17 says the economic order quantity for a product is 1,000 units. However, new orders require 5 working days lead time, during which 100 units will be used. Given this information, what's the correct economic order quantity? Well, they told us the economic order quantity is 1,000 units. What's this about the lead time? We need 5 days lead time. Well, 5 days lead time, that has no effect on economic order quantity. Remember your formula. Your formula for economic order quantity. 2 over dose over C's makes you a square root. There's no lead time in there. Okay. The answer to number 17 is letter B, 1,000 units. In number 18, it says in inventory management, the safety stock will tend to decrease if what? Okay, what's going to make our safety stock decrease? Well, let's start with letter D. Letter D says the carrying costs decrease. Okay. If the carrying costs decrease, then we can carry more units for the same amount of money that we were before, in which case we could increase our safety stock. So D is not the right answer. Letter C says variability of the usage rate increases. Our variability, that means our uncertainty, our estimates of the usage rate are going to increase. Well, if our usage rates increase, then we're going to want to increase our safety stock to make sure that we don't run out. So C is not the right answer. It's not going to cause us to decrease our safety stock. How about letter B? Letter B says variability of the lead time decreases. Oh, so we have a decrease in variability, a decrease in uncertainty. So we're more sure about it. Well, if we're more sure, then we can keep less on hand because we don't have that variability. We don't have that broad uncertainty in there. So B is the correct answer. We'll be able to decrease the amount of safety stock. Well, let's check letter A, make sure it's not correct. Letter A says cost of running out of stock increases. Well, if our cost of running out of stock increases, you're going to want to increase your safety stock because remember, it cost us to run out. We don't want to have stock out costs. So that would cause an increase in safety stock, not a decrease. Again, the answer to number 18 is letter B. Number 19 says an increase in which one of the following variables would decrease our economic order quantity. Okay, which one of these is going to cause a decrease in EOQ? Remember what your equation is for EOQ. To overdose over C's makes you a square root. Okay, let's start with letter D. Cost per order. Okay, where did our cost per order go in our formula? Did we even have a cost per order in our formula? We had a carrying cost, we have an ordering cost, but we didn't say anything about the cost of ordering. If you go back to that Florida Electronics example, you remember that each integrated circuit cost $2. We never even used that. We weren't concerned with the cost for the order. We're concerned about the carrying cost and the ordering cost and the carrying cost. Not part of EOQ is not the cost of the items. Let's go to letter C, annual sales. Well, annual sales is part of our formula. It's in the numerator, right? So what it says in the question, an increase in which one of the following? Well, what impact would an increase in sales have? If you had an increase in sales, your numerator would increase, which means that number under that square root sign is getting larger. And if the number under that square root sign is getting larger, then the overall EOQ is going to be getting larger. That's not causing a decrease. So C is not the right answer. B, safety stock level. Well, safety stock level isn't in the EOQ formula. It's not going to have an impact on our EOQ. So B is not the right answer. It must be A, but let's check it and make sure that A is indeed the right answer. What about carrying cost? Does an increase in carrying cost cause a decrease in EOQ? Well, carrying costs is the C. To overdose over C's makes you a square root. So our denominator is getting larger. And if your denominator gets larger in a fraction, then your overall number is going to get smaller. And if you take the square root of a smaller number, it's going to be even smaller. So yes, the answer to number 19 is A. Carrying costs, when they increase, do decrease EOQ. Number 20. What costs are included in carrying costs in the economic order quantity model? Okay, we talked about this earlier, about some of the examples of carrying costs. Is A, shipping cost part of carrying costs? No, that's more ordering, right? B, quantity discounts loss. That's an ordering cost. How about C, handling cost? Yes, that's a cost of carrying the inventory. So C is the correct answer for number 20. And again, let's check number 20, letter D, to make sure that it's not right. Purchasing costs. Is purchasing costs including carrying costs? No, it's not. So the answer to 20 is letter C. Number 21 says, which of the following is least likely to affect the inventory stock, safety stock level? Okay, least likely. Well, let's read through them. See, letter A says degree of customer intolerance for back orders. Well, if your customers are, so which of the following is least likely to affect the inventory safety stock level? Will the degree of customer intolerance affect safety stock level? Yes, it does, absolutely. If your customers are intolerant, then they're going to go elsewhere for their products in the future. And you don't want that. So that's going to increase the stock out costs, and that's going to have a big effect on your safety stock level. So A is not least likely. It is very likely to have an impact. How about letter B? Degree of sales forecast uncertainty. Well, we mentioned before that if you have uncertainty, that will increase stock out costs. Okay? The increased uncertainty causes our safety stock level to increase. C, degree of shipment lead time uncertainty. Well, uncertainty as to when we're going to receive orders will increase the level of safety stock. So that has a likely effect on our safety stock level. How about D, order placement cost? Well, order placement cost is going to affect our EOQ, but how is it going to affect our safety stock level? I don't see it. How about letter E, stock out costs? Well, yes, stock out costs are going to affect our safety stock level. So the answer is D for number 21. Order placement cost is your answer. We started talking about working capital management, and we said working capital is current assets minus current liabilities. And we've talked about a number of topics related to working capital management. We've talked about cash management, receivables management, and inventory management. So it's time to move on to talking about some of the current liabilities, talking about short-term credit. One of the most interesting things about short-term credit is the annual financing costs. And what I'd like to look at first is a situation where we try to decide when we should take the cash discount when a supplier offers a cash discount so that we would pay our payable more quickly to them. And so you might wonder, when should we pay? When should we take advantage of that discount? And the answer is, the firm should pay within the discount period if the firm's cost of capital, what they can borrow at, is less than the cost of not taking the discount. Okay? In other words, there is a certain cost associated with not taking that discount, and that's called annual financing costs. Now, in your viewer's guide, I've sort of given you a general form of computing annual financing costs, and you really need to look at it in two parts. The first part is the cost associated with borrowing divided by the funds that are basically available from that borrowing. Okay. But what we have to recall is that we may not always borrow for a whole year. And if we want to put this in terms of an annual financing cost, we have to annualize it. So there's a second component, a second part to computing annual financing costs, and that is annualizing it. What you do in the second part is take the days in the year divided by the term of the loan. So how do we relate this general formula to a cash discount? Again, we're going to take advantage of the cash discount if we can borrow at a rate that is lower than the the annual financing cost that's implied by not taking this cash discount. So how do we compute the annual financing costs associated with a cash discount or not taking that cash discount? Again, there's a formula I put there in the viewer's guide for you. The annual financing cost is equal to, again, the first part. Remember what the first part of the formula was. Costs associated with the loan. Well, the annual financing cost, when we're talking about cash discounts, is related to not taking the cash discount. So the cost associated with the loan is the discount that we're not taking advantage of. So in our numerator in the first part of our formula, we have discount percentage. Well, we want to divide that first part by the funds that are made available. Well, if we were to borrow, the amount of money that we would have had to pay on this would be 100% minus that discount. So the denominator is 100% minus the discount percentage. Then we have to annualize it. Over in the second part of the formula, we've got 360 days in a year in the numerator. Again, the problem could specify that it's 365 days. You just have to pay attention to what's in the problem. In the denominator, we want the term of the loan. Well, the term of the loan, or this annual financing cost, the cost of not taking this discount, is related to that period that goes from the discount period to the end of the credit period. In other words, what we have to do is take the full credit period. If the terms were 210 net 30, we would be taking the full credit period of 30 minus the 10 days, that's the discount period. Okay. Again, we're going to do an example here. If you look in your viewer's guide, I have an example of the cost of not taking the discount when the credit terms are 115 net 30. And what we'll simply do is plug in our numbers into our formula. We'll plug in the 1% discount. Remember, 1/15 stands for 1% discount if paid within 15 days. So we're going to have a 1% in the numerator for the first part of the formula. The denominator, 100% minus the discount percent. Discount percent's 1%. We're going to end up with 99% in that denominator. Then we have to annualize it. We're going to multiply it by 360 days, and we'll divide that by that period associated with not taking the discount. Well, the full amount is due within 30 days. We'll take 30 days minus the 15 days. That's the day that we have to pay if we were going to take advantage of the discount. And our denominator would be 15 days. And when you multiply that out, you get 24.24% annualized interest. Well, let's look at a problem together. Let's look at question number 22. It says the annual interest cost associated with a company offering credit terms of 210 net 30 based on a 360-day year is what? Again, use your formula. The discount percentage is 2%, so we're going to have 2% divided by 98%. We need to annualize that. 360 days divided by 20 days. Why? We had 30 days to pay the full amount. We had 10 days to pay within the discount period, so the denominator is the 30 days minus the 10, or 20 days, and we'll get 36.73% annualized interest. And the answer to number 22 is D. What I'd like for you to do is to stop your tape and try a couple more questions. I'd like for you to try questions 23 and 24, and then we'll come back and go over the answers. Okay, welcome back. Let's do number 23 together. Number 23 says a firm requires payment within 45 days but allows customers to take a discount of 2% if paid within 15 days. Assuming a 360-day year, what's the annual cost of the trade credit terms? Again, we just fill in our formula. Our discount is 2%. Our denominator for the first part of our formula is going to be 98% because we're going to take 100% minus 2%. In terms of annualizing it, we have 360-day year, and in the denominator part of the annualization, we're going to take the full discount, the full credit period of 45 days minus the 15 days of the discount period, and in that case we'd have 30 in the denominator, and we'll get 24.49% annualized interest. The answer is letter B. Number 24 says an organization would usually offer credit terms of 210 net 30 when what? A says the cost of capital is approximately the prime rate. Well, we haven't said anything about the prime rate. The fact that our cost of capital is approximately that, that's great, but why would that cause us to offer credit terms of 210 net 30? B, the organization can borrow funds at a rate that exceeds the annual financing costs. Well, that's not necessarily a good thing. You know, it would be better if we could borrow funds at a lower rate, but again, why would we offer the terms 210 net 30? C, all of its major competitors are offering the same terms, and the organization has a shortage of cash. Well, remember I said much earlier on in the video that our credit terms are often driven by our competitors because the industry there for credit is very competitive. And so that's a good answer. We have a shortage of cash, and that's a good reason to offer a discount of 2% because if we have a shortage of cash, we need to get the cash in sooner. So C sounds like a very good answer. Let's look at D. D says the organization can borrow funds at a rate less than the annual financing costs. Well, again, that's a good thing. It's great that we can borrow money at less than that, but what does that have to do with extending credit terms? So the best answer here for number 24 is letter C. Now I wanted to show you one more thing about this annual financing cost. What we've done so far, the formula that I've given to you, does give us an annualized interest rate. But what it fails to do is take into consideration compounding, okay, compounded interest. And so if you look in your viewer's guide at example number 5, I have in there a situation where we're to determine the cost of not taking the discount when the credit terms are 115 net 30, and what we're to do is to assume compounded interest. And I've given you the formula there. The annual financing cost, if we want to assume compounded interest, is equal to 1 plus the discount rate divided by the amount that you borrow, but then we take that whole quantity and we raise it to the power of 360 days divided by the discount period. And then we subtract 1. And you can see there in the viewer's guide that when we plug in all the numbers, we get 27.3% annualized interest. And you might be interested in comparing that to one of the earlier examples where we looked at having a 1% discount if paid within 15 days. And in that situation, we had annualized interest of 24.24%. That was example number 4. So you can see that indeed by compounding the interest using this formula, we do get an annual financing cost that is greater because it does take into consideration the effects of compounded interest. I'd like to talk about another possible situation. Let's look at an example or a situation where we have annual financing costs when the interest is not specified. If you look in your viewer's guide, question number 25 on AC Incorporated, you'll notice that it says that AC Incorporated issues 3-month commercial paper with a face value of $500,000, but they issue it for $490,000. They issue it for a discount. And they also incur a transaction cost of $1,000. It says the effective annualized percentage cost of the financing based on a 360-day year will be what? Remember what your general formula is. Your general formula for annual financing cost is equal to the cost of borrowing divided by the cash proceeds. Okay? What is it going to cost AC to borrow in this situation? Okay. Well, they're issuing paper with a face value of $500,000. They're only getting $490,000. We think of that $10,000 usually as sort of an interest charge that's taken out up front. We're sort of discounting that paper. But they also incur a transaction cost of $1,000. So the true cost of borrowing for AC here is $11,000. Remember, we want to divide that by what? Basically the proceeds that are available from the borrowing. So what does AC really have that's available after they're done borrowing and incurring this discount and the transaction cost? Well, we take that $500,000, we subtract out the $10,000 discount to get us down to $490,000, and we also incur the transaction cost of $1,000. They're not going to have access to that $1,000. They're giving that up. So truly the denominator, the cash proceeds that are available from the borrowing is $489,000. So we take the $11,000, the cost of borrowing, divided by the $489,000. And remember, you have to annualize it. The commercial paper is for how long? It's for 3 months, so basically we assume 90 days here. Part 2 of the formula for annual financing cost, to annualize it, 360 days divided by that borrowing period. That's 90 days. We're going to take the 11,000 divided by 489, multiply it by basically 4, and we get 9%. And the answer then is letter D. Another situation I'd like to cover with you is the matter of compensating balances. We discussed this a little bit earlier when we were talking about the reasons to hold cash. Let's look at question number 26 together. Number 26 says, what is the effective interest rate on a loan if a firm borrows $400,000 at 8% and is required to maintain a $50,000 balance as a minimum compensating balance at the bank? And we're to assume a 360-day year. Again, go back to your general formula. In the first part, we have the cost of borrowing divided by the cash proceeds. What is the cost of borrowing here? We're going to borrow $400,000 and we have to pay 8%. That's our interest rate. So for a year, our cost of borrowing is going to be equal to $32,000. We want to divide that by the cash proceeds. What's available from this amount? Remember, we borrowed $400,000, but we're required to maintain $50,000 as a minimum compensating balance. So we really don't have access to that $50,000. The only amount that we really have access to is the $400 minus the $50, or $350,000. So we'll put $32,000, the cost of borrowing, divided by $350,000, the cash proceeds from borrowing. We'll annualize it. Well, this is for a year, so it's going to be 360 days over 360 days, just one. And we're going to get 9.1%. So the answer to this question is letter B, 9.1%. What I'd like for you to do is to stop your tape, try some questions, and see how you're doing using our general formulas for annual financing costs. I'd like you to do questions number 27 through 31. I'd like you to stop your tape, get your answers. Remember, no pain, no gain. You're going to have to be active participant in the learning process. It's all part of gaining that knowledge. So try questions 27 through 31. When you get your answers, come back and we'll go over them. Question number 27 deals with Hardy Company. And it says that Hardy needs to maintain a compensating balance of $60,000 in its checking account as one of the conditions of its short-term 8% bank loan of $600,000. So they're borrowing money, and in the process they have to compensate the bank for $60,000. Now Hardy's checking account earns 3% interest. Ordinarily, Hardy would maintain a $50,000 balance in the account, and they ask us to figure out what's the effective interest rate of this loan. Again, we know the formula for annual financing costs. The cost of borrowing divided by the cash available through borrowing, and then we need to annualize it. What is the cost of borrowing here? We know that Hardy takes out a $600,000 loan, which they have to pay 8%. So we'd be taking 8% times $600,000, and we would get $48,000. But there's a little bit more here. Remember, ordinarily Hardy would maintain a $50,000 balance in the account. As part of this loan, we have to maintain a $60,000 balance. So we have to maintain $10,000 more in the account than we ordinarily would. And because we're keeping $10,000 more in the account than we ordinarily would, we're getting more interest. Hardy's getting more interest than they ordinarily would. They're getting 3% interest on that $10,000. So what we have to do is take the $10,000 excess or extra balance, multiply it by the 3%. We get the $300. We're going to net that out with the cost of the $48,000 of the loan. So we're going to end up with $47,700 in the numerator. In the denominator, remember we have the cash funds that are available. Well, we borrow $600,000, and it says that we have to maintain a balance of $60,000. So maybe you were thinking, $600,000 minus $60,000? No, we don't need to do that. Remember, ordinarily Hardy keeps $50,000 in there. So the only amount that we need to keep in there out of the $600,000 that we're borrowing, since we already have $50,000 in there, is we need to take $10,000 out of that loan to keep in the account. So really the amount of proceeds that are available from the loan is $590,000. So we take the $47,700, divide by $590,000, we're going to get 8.08%. And the answer to the question then is letter B, 8.08%. So we also had a fact pattern here for Fox Company, and said that we were to use this fact pattern for questions 28 through 30. It says Fox Company needs to pay a supplier's invoice of $50,000, and they want to take a cash discount of $210 net 30. Okay, stop right there. If they want to take a cash discount, they have to pay within the 10 days. How much are they going to pay? Well, they're going to get a 2% discount, and 2% of $50,000 is going to be $1,000. So they're not going to have to pay $50,000. If they take the discount, they're only going to have to pay $49,000. Now it says the firm can borrow the money for 20 days at 10% per year with 8% compensating balance. So we borrow money, we're going to have to pay 10% annual interest on it for the period of time that we have it, and we're going to have to maintain an 8% balance. So we're to assume a 360-day year. Question number 28 says the amount Fox must borrow to pay the supplier within the discount period and cover the compensating balance is how much? Remember, if we pay the supplier within the discount period, we're going to pay $49,000. So the question becomes, how much do we have to borrow? Keeping in mind that we need to maintain an 8% compensating balance on whatever the loan is. Okay. What we need to do here is come up with an algebraic formula, something that a lot of people don't really love, but our formula here, the amount of the loan should be equal to the $49,000 that we want to pay to the supplier to take advantage of the discount, plus whatever it takes to cover the compensating balance. What does it take to cover the compensating balance? 8% of whatever the loan is. So we've got loan is equal to 49% plus 8% of the loan. If you solve for loan, okay, we get 92% of the loan is equal to 49,000. We take the 49,000, divide by 0.92, 92%, and we get $53,261. That's the amount that Fox is going to have to borrow. And the answer to number 28 is letter C. Number 29 says, if Fox Company borrows the money on the last day of the discount period and repays it 20 days later, what's the effective interest rate on the loan? Well, again, the annual financing cost, or the effective interest rate here, is equal to the cost of the funds that we borrow divided by the funds available, and we annualize that. Now, in number 28, we computed what the amount of the loan was. And that loan was $53,261. We're going to have to pay interest on that loan, and that's going to be 10% per year. But we pay the money back in 20 days, so the interest incurred on the loan is equal to, remember the interest is equal to principal times rate times time. We get the $53,261 times the 10% interest rate times the time. Well, that's 20 days out of 360. The amount of the interest is going to be $295.89. But what's the effective interest rate? Well, to get an effective interest rate, remember what we have to do, take the cost, divide it by the funds available. What funds are available? 49,000. Okay, remember, they have to maintain some of that $53,261 loan as compensating balance. So remember what we needed to do there was borrow enough so that we could pay the discount price of $49,000. That's truly the amount of funds that were available, is what we were paying the supplier. Okay, so we're going to take the $295.89, divide it by the $49,000 that we effectively are paying to the supplier there. That's the funds available. We need to annualize it. Well, the period that we're holding this loan, that we have this loan, is 20 days. So we're going to have 360 divided by 20. When we multiply that out, we're going to get 10.87%, and the answer is letter B, How about number 30? Number 30, it says if Fox fails to take the discount and pays on the 30th day, what's the effective rate of annual interest it's paying the vendor? Well, we're failing to take the discount. Remember what we said. Annual financing cost is the cost of not taking the discount. So we just go back to that basic formula, discount percentage divided by 100% minus that discount percentage. We're going to take 2% minus, divided by 98%, multiply it by the 360 days, and then divide it by 20 days. Why? To annualize it, we take the full payment period, 30 days, minus the discount period, well, that we have to pay within 10 days. So 30 minus the 10 is the 20. When we fill all those numbers into our formula, we get 36.73% annualized interest. And the answer to number 30 is letter D, or excuse me, B. Number 31. Number 31 says a firm is considering factoring its accounts receivables. The finance company requires a 5% reserve and charges a 1.5% commission on the amount of the receivables. So right off the bat, we're going to have 6.5% taken out. In addition, the amount advanced to the firm is also reduced by the annual interest charge of 12%. So when we take out the amount that they're going to hold back, the reserve and the commission, then we have the net amount of our loan. And then we're going to have to pay interest on that net amount of 12%. What is the amount of the proceeds the firm will receive from the finance company at the time a $200,000 account is due in 90 days? What are we going to get if it's factored? Well, first of all, we'll start with that $200,000. And we're going to have to compute the amount that the factor is going to hold back for reserve, which was 5%. So 5% times the $200,000 is $10,000. Secondly, the factor is going to deduct 1.5% for a commission. 1.5% of that $200,000 is $3,000. That's going to get us down to $187,000. And that is the amount that we have to pay interest on. It says the factor is also going to reduce the proceeds given to the firm for the interest on the $187,000. That discount rate was 12%. And this is going to be out 90 days. So we're going to take $187,000. We're going to multiply it by the 12%, multiply it by 90, divide by 360. We get $5,610. When we subtract that from the $187,000, we're going to get $181,390. And the answer to number 31 is letter B. Now, I hope you did well on those questions. And as always, I encourage you to do as many questions as possible. The more that you see, then the more you see the possible tricks that the exam can throw at you. Okay? And so I want you to be ready for all of those. Now, if you're with me to that point, what I'd like to talk about next is capital structure. Now, capital structure relates to how a company finances its assets. In other words, using debt or using owner's equity, issuing common stock or preferred stock. Okay? So capital structure is how we finance our assets. When we talk about optimal capital structure, we're talking about a mixture of debt and preferred and common stock. We're talking about that mix at which the company's stock price is maximized. Again, optimal capital structure is the mix of financing at which the company's stock price is maximized. And there's really no set way of determining what that optimal capital structure is. But there is a theoretical optimal capital structure. Now, optimal capital structure involves the trade-offs of higher expected return on equity and earnings per share against higher risk. Again, optimal capital structure involves trade-offs of higher expected return on equity and earnings per share against higher risk. Now, the company's target capital structure is that mix of debt, preferred stock, and common equity with which the company intends to raise capital. So they might have an idea thinking about what their optimal capital structure might be, but then they might have a certain target at which they're going to use. Remember, they can't compute the optimal. They don't know exactly what it is. So they'll come up with a targeted capital structure, and that's based upon the company's intentions, how they intend to raise the capital. Now, the concept of leverage refers to the relative amount of fixed costs in a firm's capital structure. And typically, the more fixed costs, then you're able to spread those fixed costs out, but then there's a certain point which is too much fixed costs. What we need to talk about here deals with this concept of leverage, and we have two concepts of leverage. The first, the degree of financial leverage. Okay, the degree of financial leverage. Now, the degree of financial leverage is simply an expression of the relationship between the change in earnings available to common shareholders and the change in net operating income. Again, degree of financial leverage is an expression of the relationship between the change in earnings available to common shareholders and the change in net operating income, which we often refer to as earnings before interest and taxes, the EBIT. Now, financial leverage causes a firm's earnings per share to fluctuate at a rate which is greater than that of the change in earnings before interest and taxes, or the operating income. Again, financial leverage causes a firm's earnings per share to fluctuate at a rate which is greater than that change in earnings before interest and taxes, or operating income. Again, and there's a couple ways that we can measure this financial leverage. And I'll give you a couple of formulas in just a moment. Now, firms that have a higher degree of financial leverage are considered in general to be riskier than firms with lower degrees of financial leverage. Okay, just in general, this is a general statement, not 100% all the time, but mostly firms that have higher degrees of financial leverage are usually considered to be riskier. Now, how do we compute the degree of financial leverage? Well, the first formula, and I think I put it there in the viewer's guide for you, the degree of financial leverage is, again, that expression of a relationship between earnings per share and operating income. And so the first formula is the percentage change in earnings per share divided by the percentage change in operating income, or earnings before interest and taxes. However, there's other ways that we could also measure this. And the second way that we could measure the degree of financial leverage is to take the earnings before interest and taxes and divide it by the earnings before interest and taxes after we've deducted out interest and we've deducted out the preferred dividends that have been divided by 1 minus the tax rate. It's quite a formula there. Okay. Let's talk about the degree of operating leverage. Now, the degree of operating leverage is an expression of the relationship between operating income and sales. Again, it's another expression. It's a ratio of sorts. It's an expression of the relationship between operating income and sales. And again, I have a couple of formulas that we can use here. The first is you take the percentage change in earnings before interest and taxes and divide that by the percentage change in sales. Okay, so percentage change in earnings before interest and taxes and divide it by the percentage change in sales. Alternatively, we could take contribution margin divided by earnings before interest and taxes. Remember, contribution margin is sales minus variable costs. Okay, contribution margin is sales minus variable costs. Now, the degree of operating leverage involves the use of assets with a fixed cost. Now, the more a firm makes use of assets with a fixed cost, the more this operating leverage, then the greater the variability of earnings before interest and taxes. And again, therefore, there's going to be more business risk. What I'd like for you to do is I'd like for you to stop your tape and, using the formulas that I've given you for financial leverage and operating leverage, and see if you can answer questions numbers 32 and 33. So stop your tape, get your answers, come back, we'll go over them together. It says, a Wen company sells 200,000 jars of pickles annually, and they sell them for $200 per jar. The variable costs are $60 cents per jar, and fixed costs are $70,000 annually. A Wen has annual interest expense of $60,000 and a 30% income tax rate. In question number 32, they ask us what the company's degree of operating leverage is. Well, the first formula I gave you for the degree of operating leverage uses the changes in earnings before interest and taxes and the changes in sales, and we don't know those. So we have to look at that second equation that I gave you, and that is the degree of operating leverage is equal to the contribution margin divided by earnings before interest and taxes. Well, let's figure out what the contribution margin is. Remember, that's sales minus the variable costs. What are your sales here? We're selling 200,000 jars at $2 per jar. That's $400,000. And our cost, our variable cost for each jar is 60 cents. 200,000 jars at 60 cents per jar would be $120,000. So we got 400,000 minus the 120,000. That gives us $280,000 of contribution margin. Now, to get the earnings before interest and taxes in this, what we're going to have to do is take our contribution margin and subtract out our fixed cost of $70,000. We'll take the 280 minus the 70,000. That gives us $210,000 in our denominator, and our degree of operating leverage is 1.33. So the answer to our question is letter C. Now about the degree of financial leverage. Number 33, we're asked to compute the degree of financial leverage. And again, we need to use the second of the formulas that I gave you. So hopefully you picked up the earnings before interest and taxes. We just computed that in number 32. That was $210,000. So our numerator is $210,000. In our denominator, we're going to have to subtract out the interest. We'll have to subtract out any preferred dividends that have been divided by 1 minus the tax rate. Well, what's the amount of interest in the problem? And according to the information, our annual interest expense is $60,000. So we're going to have to take $210,000 minus the $60,000. There were no preferred dividends. We've got $150,000 in our denominator. Divided into $210,000 of earnings before interest and taxes, we get a degree of financial leverage equal to 1.4, and the answer to number 33 is C. In our discussion of capital structure, we said that the company can finance its assets in many ways: debt, common stock, preferred stock. So what we want to talk about now is the cost of capital, because by borrowing money or by using other people's money, whether it be borrowing through debt or whether we're using the owner's money, there is a cost associated with it. We all know it can't be free, although we'd like for it to be free. So I'd like to talk about the cost of capital. And the cost of capital, really, the company doesn't have any say over that. The cost of capital is determined in the capital markets. And what that cost of capital is depends upon the risk that's associated with the firm's activities. So the cost of capital is simply what the firm must pay. It's the return that's required by investors. They are going to demand for the use of their money that you pay them a certain amount, and that's the cost of capital. Remember, we have several sources of capital. The first is debt. And obviously there's that cost associated with debt. And we usually think of that as the interest rate. Now in your viewer's guide, I've given you the formula for the cost of debt. But you'll notice that the cost of debt is not simply just the interest rate on the debt being issued. What you have to remember is that we're able to get a tax break because interest is deductible. So the cost of debt is actually equal to that interest rate times 1 minus the tax rate, and that reflects that tax shield that we all know. Now, preferred stock, when we issue preferred stock, what kind of cost is associated with it? Well, remember that preferred stockholders have to get paid dividends before any common stockholders get paid. So the cost associated with preferred stock are the dividends that the preferred stockholders would expect to receive. And again, in your viewer's guide, you have the formula there. The cost of preferred stock is equal to the dividend on the preferred stock divided by the net issuance price. Now, when we talk about common stock or the cost of equity, there are a number of formulas that we could use, and it depends upon the circumstances. The first, the cost of using retained earnings. In other words, internal equity. And I've got a formula there in the viewer's guide that indicates that the cost of common stock from internal equity is the dividends that you expect to receive 1 year from now divided by the price of common stock right now. And then we would add to that the percentage rate of growth. Now, I've also given you the formula for the capital asset pricing model that you can use to determine the cost of common stock. Theoretically, we should get the same cost of common stock that we would use in the first formula. And the cost of capital on common stock using the capital asset pricing model is basically equal to the risk-free interest rate plus the beta coefficient for the firm times the difference between the market rate and the risk-free rate. Finally, a third formula that we could use for computing the cost of capital, the cost of common equity, would be when we were issuing new common stock, as opposed to using the common stock that's already been issued, the internal equity. Now we're talking about issuing new common stock that's external equity. The formula is very similar to internal equity. It's the dividends that are going to be received by the common stockholders 1 year from now divided by the net receipt of the issuance of the stock as opposed to the current stock price. So that's the difference, is the denominator. And then, of course, we would add the percentage growth rate. So it's a very similar formula. It's just in the denominator we're using the net issue price. What I'd like for you to do is to try some problems on your own. Using these formulas, I'd like for you to stop your tape, try multiple choice questions numbers 34 through 39, see how you do, get your answers, come back, and we'll go over them together. Welcome back. Let's go over these questions together. Now we're given information about Jimmy Incorporated. He's interested in, the company is interested in measuring its cost of capital, and it's gathered a bit of data here for you. Data about issuing the bonds, issuing preferred stock, issuing common stock. The fact that Jimmy expects to have $100,000 of retained earnings in the coming year, and they plan on using those retained earnings first. And once those are exhausted, then the company will issue new common stock. And they also gave you a targeted capital structure. It says that Jimmy prefers to issue 20% long-term debt, 30% preferred stock, and then the other 50% of the financing is to come from common stock. So let's answer the questions together. Question number 34 says the cost of funds from the sale of common stock for Jimmy Incorporated is what? Okay, so we're selling common stock. Remember, the formula for computing the cost of equity when you're using new common stock, new equity or external equity, is the dividends being received 1 year from now divided by the net issue price plus the growth rate. Well, we know that the dividends that are going to be received next year by common stockholders is $6. But what's the net issue price? If you go back to the data, it said that when we issue, or when Jimmy issues the common stock, that the stock will have to be underpriced by $5 per share, and that the flotation costs are expected to amount to $4 per share. So really, in order to put this stock out on the market, they're going to have to take away $9 from the current price. We know that the current price is equal to 100, so when we deduct the $9 from the 100, we get 91. They're assuming here a growth rate of 0, so we get $6 divided by $91, and our cost of equity is 6.59%. So the answer to question number 34 is letter D. Let's look at 35. 35 asks about computing the cost of funds from retained earnings. Now the cost of funds from retained earnings is the cost of common equity, internal equity. A very similar formula to what we just used. Remember, the denominator is different. We have dividends received 1 year from now divided by the current stock price. So we can take the $6 divided by the current stock price of 100. We would add the growth rate. There is a 0 growth rate assumed in the question. So we have 6% is the cost of funds from retained earnings. The answer to number 35 is letter A. Number 36 asks us to compute the cost of funds from the sale of the bonds. It's a little bit of a tricky question. They already gave you the answer, actually. If you go back to the heart of the problem, it tells you in the last sentence in that bullet that the estimated after-tax cost of the funds is 4.8%. So the answer here is letter A. We didn't have to use the formula. The answer was already given to us. I guess they wanted to try to trick you into computing it. Number 37 asks us to compute the cost of funds from the sale of the preferred stock. Now, when we sell preferred stock, we want to take the dividends on preferred, divide it by the net issuance price. So hopefully you took the dividends on the preferred, which is $8.10 per share, divided by the net issue price of the preferred stock, which was $90, and you get 9%. So the answer to number 37 is C. Number 38 says, if Jimmy Incorporated needs a total of $500,000, what's the firm's weighted average cost of capital? Now, I didn't give you the formulas for weighted average cost of capital. I wanted to see how you would do here. Weighted average cost of capital is simply just like it sounds. It's a weighted average. We're going to take each of the cost of capitals, whatever that cost is, and multiply it by the weighting. Remember in the problem that Jimmy wants a targeted capital structure of 20%, 30%, and 50%. So if Jimmy needs a total of $500,000, you can recall that half of it, 50%, is targeted to come from common stock. So that would be $250,000 of the $500,000 that Jimmy needs would be coming from common stock. But the first $100,000 is supposed to come from retained earnings. So if we need $250,000 from common stock or from equity, and $100,000 is coming from retained earnings, then we're going to have to issue $150,000 of common stock. So all we have to do here to get the weighted average cost of capital is to multiply the cost of the three sources of financing by their weighting factors. Now the long-term debt, remember the cost of capital is 4.8%. Well, that's going to account for 20% of the financing. What we do is take 20% times the 4.8%, get 0.96. Then the preferred stock. Remember that Jimmy's targeted preference here is 30% of financing coming from preferred. So we're going to take 30% times the cost of capital associated with issuing preferred, which is 9%. We get 2.7%. Now when we get to common stock, remember we have to break it down into the retained earnings portion and the new external stock. Now 50% of the financing comes from common stock. How much of it was coming from retained earnings? Well, $100,000 of retained earnings divided by the total financing of $500,000. That's 20%. 20% of what Jimmy wants here, 20% of the $500,000 is going to come from retained earnings. Well, the cost of capital associated with the retained earnings was 6%. We're going to take 20% times the 6% to get 1.2%. And the remainder weighting must go to the new external. That must be 30%. We've done 20 for long-term, we've done 30 for preferred, we've done 20% for retained earnings. That leaves 30%. Of course, we could also figure, because we know that the new issuance of common stock must be $150,000. What's our total financing needs? $500,000. 150 divided by the 500 is 30%. So the weighting of this new external issue of stock is 30%. Multiply that by the cost of capital of that new issue, 6.59%. We get 1.98. When we sum up all our weightings there, we get 6.84%. So the answer to number 38 is letter B. Now number 39 says that Jimmy needs a total of $1 million. What would be the weighted average cost of capital? So it's very similar to the number 38, except that we need to compute it on the basis of $1 million. So we still know that the long-term debt of 20% times the 4.8%, 30% of it's going to come from preferred stock at 9% cost of capital. That's 2.7%. Now the common stock, the retained earnings, remember it's $100,000 out of a total financing needs of $1 million. That's 10%. So 10% times the 6% would give you 0.60, less than 1%, 0.6. And the new external would then account for 40%. And 40% times the 6.59, and then we would add all of this up, and we would get 6.8%. The answer to number 39 is letter C. What I'd like to do now is make a few comments about interest rates. And if you look in your viewer's guide, and I'll try to put it up here on the screen, I have a graph there about interest rates, and they're charted over time. And if you look at that graph, you'll notice that there are basically three components to interest rates. We can think of the real risk-free rate, and that is a flat rate typically over time there. We also have a component due to inflation, expectations about inflation, called the inflation premium. And then there's also a component dealing with maturity risk. The longer something is outstanding, there's usually a greater risk associated with that maturity. Now, this graph represents interest rates and their relationship from short-term, intermediate, and long-term financing based upon certain assumptions. Interest rates are not always like this, although they tend to be. And what you'll note here is, one, interest rates are not linear. There's a curve associated with this. The other thing that I wanted to point out about this graph is that you'll notice that that curve, it's an upward sloping curve. As the term of maturity is increasing, the yield is increasing. Now, the upward slope is also due to an increase in expected inflation. If people expected inflation to not exist, there actually to be deflation, there could actually be a downward sloping to this. But most of the time we are expecting inflation in the future, and because of that and the increasing risk associated with the increase in time, usually the slope is upward. The next topic we need to cover is security valuation. Now, when I refer to security valuation, I'm simply talking about the process of figuring out what a security ought to sell for. And the first security that I want to look at is bonds. How would we value bonds? Well, let's remember what a bond is. A bond is a debt security where an issuer is promising to pay the face value amount of that bond at some specified future date, also known as the maturity date. Now, usually this issuer is going to promise to pay a specified rate of return, a specified interest rate. We usually call that the stated rate or the contract rate or the coupon rate. But not all bonds have a specified rate on there. And typically things like junk bonds don't necessarily have a specified rate of interest. Now, bonds, how are we going to value them? What are they going to sell for? Well, bonds will typically sell for the present value of the future cash flows associated with that bond. And you'll recall that there are two types of cash flows associated with a bond. There, of course, is the principal repayment at the end of the specified period at the maturity date. And then if the bond issuer also promises to pay interest, then there is interest cash flows. The company is going to actually make cash interest payments in the future. Now, I mentioned that the bond is going to sell for the present value of these cash flows. So now is a good time for us to do a little bit of a review of the time value of money. Remember that something received 1 year from now is not worth the same amount today. It's worth less today because of the time value of money, because of interest. Now, when you're doing a bond problem, when you're trying to figure out what a bond is going to sell for, we said that there were two components, the two types of cash flows. The principal happens to be a single sum that's being received or paid one time at some point in the future. So, for example, if a bond was a 5-year term bond, then the company would be paying a certain amount 5 years from the time that it was issued. That's one time, 5 years into the future. We also have the interest payments. Now, you recall that the interest payments really represent what? They represent an annuity. In fact, they represent an ordinary annuity, also known as an annuity in arrears. Recall what an annuity is. It's a series of n equal payments. Okay? And that's the beauty of bonds for the issuing company, is that when they write the checks out for bonds, they know what the amount is every time, because they're promising on the face of the bonds to pay a specified rate of interest based upon that face value. So they're always writing the checks out for the same amount as long as the same number of bonds are outstanding, which is usually the case in a term bond issue as opposed to a serial bond issue, in which case the face value changes every year because they're constantly retiring some. Now, in terms of reviewing the time value of money, it would be wise to point out here that there is another kind of annuity. I want you to recall that there's annuities in advance. This is where the payment, in this case, maybe interest, would occur at the beginning of the period. But for our bonds, the payments usually occur at the end of the period for which the interest is being paid. So for bonds, we're going to be talking about ordinary annuities. But just keep in mind, annuity dues is where the payment occurs at the beginning of the period. Now, when we talk about these bonds and we talk about valuing bonds, we have to be very careful about keeping straight that coupon rate, that contract rate, the amount that's stated on the face of the bonds, and understand what its purpose is and keep it separate from another rate known as the effective rate, sometimes known as the market rate or the realistic rate. And so I want to make sure that you're very clear upon what these different rates are used for. Now, the coupon rate, the amount that's stated on the face of the bonds, is used to determine the cash interest payment. This is the actual amount of cash. This is what the company is going to write the check out for. Whoever's holding the bonds at a certain point in time, they send in that coupon, and the company writes a check out to that bondholder. Okay? And that's based upon the face of the bonds. So whenever you're ever trying to figure out the cash flows, the cash interest payment, you must use what's stated on the face of the bonds, the face value, and the coupon rate. And we'll do an example in a few moments, make sure that you can do that. Now, the effective rate is the rate that the market is really going to get on their investment. And that's really the effective amount of interest that the company has to pay. They might say that they're going to pay a certain amount according to the face of the bonds, the coupon rate, but that's not necessarily the effective amount of interest. And you can go back to our discussion about annual financing costs. When you take into consideration the cost of borrowing and divide it by the proceeds available, okay? See, the market is going to determine what the cost of the capital is. We talked about that earlier. The cost of debt, it's determined by the market. The market is going to get the rate at which they want, and that's the effective rate, the market rate, or the realistic rate. And you'll recall that rate is the rate that we used in getting the present value factors when we do the present value calculations. Now let's talk for a moment about the relationship between these two. Now, let's assume for a moment that the effective rate on a bond, the market is demanding 12%, but the company is only offering a 10% stated rate or coupon rate. What's going to happen? If the market wants 12% and the company is only paying 10%, is anybody in the market going to want to buy those bonds at that company? Not at face value, because their effective rate would end up being the 10%, which is the stated rate, and that's not what they want. The only way that the market can get what they want, the effective rate, is if these bonds sell for a discount. Face it, there's no demand for 10% bonds when the market wants 12%. So in order for them to get their rate, in order for them to get the return that the market wants, the price will have to come down. And in that case, the bonds sell for a discount. On the other hand, if the effective rate, the market, let's say, is wanting 10%, and the company is paying a stated rate according to the face of the bonds of 11%, then in this case, everybody in the market wants 10%, but the company is paying 11%, and everyone's going to flock over and try to buy those bonds that are paying 11%. And what's going to happen? Simple law of supply and demand, right? As everybody demands those bonds that are paying 11%, there's going to be such an increase in the demand, there's going to be so many people going over there, that the price of those bonds is going to go up. So in this case, the bonds are going to sell for a premium. Well, let's look at an example of bond valuation. Make sure that we can use the tables for present value calculations. If you go to your viewer's guide and look at example number 1 for Hound Incorporated, it says on January 1st, 2005, Hound Incorporated issues $100,000 of 10% 5-year bonds. So that's the face. The face value is $100,000. They're promising to pay 10%. That's the stated rate or the coupon rate, and the term of the bonds is 5 years. It says the bonds pay interest semi-annually on June 30th and December 31st, and the effective rate is 12%. Well, stop. Let's think about it. If the company is paying 10%, the market wants 12, what did we say? These bonds are going to sell for a discount, right? Because the market wants 12%. The only way they're going to get their 12% is if the price goes down. It's all a matter of that annual financing cost kind of formula, the effective interest rate formula, the cost of bonds, or the cost divided by the proceeds. Okay, well, let's make sure that this does indeed sell for a discount. Let's see if we can compute the present value of these bonds and what they would sell for. Now, I've got a little hint here. I suggest that any time that you take the present value of the cash flows associated with bonds, start with the interest first. Start with the annuity first. So let's start with that. And the first thing we have to do is know what the cash flows associated with the bond interest, associated with the bonds is. What is the interest payments? How much cash is the company going to pay? Remember that cash interest payments is based upon the face of the bonds and the stated rate. We know that the formula for interest is principal times rate times time. The principal here is the face amount, $100,000, and we're going to multiply that by the stated rate, the 10%, and we have to multiply it by time. Well, it's not 1. Remember, the interest here is paid semi-annually. So we're going to multiply this by 1/2 of a year. Remember, your interest rate and your time, these have to be on the same basis. If your interest rate is an annual rate, that time has to be expressed relative to a year. And since interest is being paid semi-annually, that's 1/2 of a year. So the cash interest payment that the company is going to make every 6 months is $5,000. Again, $100,000 times 10% times 1/2 of a year. So now Hound is going to make how many of these interest payments? Well, there's 5 years, and they're making these interest payments twice a year. So 5 years times 2 semi-annual interest payments is going to give you 10 payments, each of $5,000. So let's set up our calculation here for the present value of the interest, which we know is really present value of an annuity. And you'll recall the way I like to write present value of an annuity formula is it's equal to the rents times the present value of an annuity factor for I and N. Well, the rents are $5,000. Remember, all you have to do is take one interest payment date, $5,000. You don't have to add up 5,000 10 times. The present value of an annuity factor is going to take care of that for you. So we're going to take the $5,000 rents, multiply it by present value of an annuity factor. Well, now comes the real issue. What's the interest rate that we want to use, the I, and what's the N? Well, since interest is paid semi-annually, we need to have 10 payments. There are 10 interest periods. N needs to be 10 here. And if your N is semi-annual, your I, your interest rate, also has to be semi-annual. So the question is, what are we going to use? Are we going to take the 10% and divide by 2 and get 5%? Or are we going to take the 12% and divide by 2? Remember, we said for present value calculations, you want to use the effective rate, the market rate, and that was 12% in this case. So we're going to take 12% and divide by 2, we get 6%. We're going to look for a present value of an annuity factor for 6% in 10 periods. So we'd go to that present value of an annuity factor table, and we'd go over to the column where it says 6%, and we would go down to where N is equal to 10. And when we do that, we're going to get a factor of about 7.36, rounded to 2 decimal places. We're going to multiply that by $5,000 of the rents, and the present value of our interest is $36,800. But we're not done there. Remember, we need to take the present value of all the cash flows, and there's another cash flow we haven't taken the present value of. That's the principal. What is the principal? Well, it's the amount that the company is promising to pay. the face value of $100,000, which they're promising to pay 5 years from now. And that's a single sum. It's only being paid one time. So the present value of a single sum is equal to the future value times the present value factor for I and N. And the reason why I had you do interest first is because whatever you use for I and N for the calculation of the present value of the interest, you also want to use for the present value of your principal. So we're going to be looking for a present value factor here, 6% and N equal to 10. So when we go to the table, we're going to go to present value of a single sum, present value of $1. We'll go over to the 6% column. We'll go down to where N is equal to 10. We're going to get a present value factor of 0.558. And we multiply that by $100,000. That's the future value. We're going to get $55,800 for the present value of the principal, which will add to the present value of the interest, $36,800. These bonds, the present value of these bonds is equal to $92,600. And indeed, that's what we said. We said that these would sell for a discount. These are selling for less than their face value. So indeed, we have a discount here. Well, let's look at one more example. I just want to ensure that you do understand how to use the tables, okay, how to value the bond. So let's look at example number 2 in your viewer's guide on bond valuation. It says on January 1st, 2005, Hound Incorporated issues $100,000 of 12% 5-year bonds. The bonds pay interest semi-annually on June 30th and December 31st, and the effective rate is 10%. So all we have here is same situation as example 1, except what? The interest rates were swapped. Now the stated rate, the coupon rate is 12%, and the effective rate is 10%. And remember our relationship. Here, Hound is paying 12%. Everybody in the market is wanting 10% for the risk associated with these bonds. So everybody in the market is going to flock to the Hound bonds. And by everyone flocking to them, the demand is going to be so great that the price is going to increase. And it's going to increase so that we get to a point where Hound is going to sell these bonds for a premium. So let's figure out what they're going to sell for. And what do I say? Always compute the present value of what first? The interest. So let's compute the present value of the interest. Before we do that, we have to know what the interest payments are. How do we compute our interest payments? Remember, they are based on the face of the bonds. Our interest payments are equal to the face value, $100,000, times the stated rate, the coupon rate of 12%, times the time is a half a year. They're making semi-annual interest payments. So that's going to give us $6,000 of interest payments. Every 6 months, Hound is going to write out a check for $6,000. So now let's compute the present value of the interest. Again, this is an annuity. Each one of the rents is how much? $6,000. The present value of an annuity is equal to the rents times the present value of an annuity factor for I and N. Well, what are I and N are we going to use? Right. The effective rate was 10%. That's the market rate. That's what we want to use. And since it's semi-annual periods, we're going to take the 10% and divide it by 2. Have it. We're going to get 5%. And we're going to take the number of years, which was 5, multiply it by 2 semi-annual payments every year. We're going to get 10 payments. So we're going to look for a present value of an annuity factor, 5%, 10 periods. We'll go to the table, present value of an annuity table, find a factor by looking at the column where it has 5% at the top, go down to where the N is 10, find the intersection, and we get a present value of an annuity factor of 7.722. Multiply it by our $6,000 cash interest payments, our rents. We get $46,332, but we're not done there. We haven't taken the present value of the principal yet, right? Remember, always do the present value of the interest first, then do the present value of the principal, and you have to use the same I and N. We know the present value of a principal is the present value of a single sum kind of situation, and that formula is equal to future value times the present value factor for I and N. And we're going to use the same I and N. So future value is $100,000. Multiply that by the present value factor for 5% in 10 periods. If you go to your table, you go to the 5% column, N is equal to 10, find the intersection. You find the factor 0.614. It gives us $61,400 for the present value of the principal. What are these bonds going to sell for? Present value of the interest, $46,332, plus the $61,400 present value of the principal, it's going to give us $107,732, and this bond sells for a premium. Again, because the company was paying more, 12%, than the market wanted, which was 10%. So that's bond valuation. If you're with me there, we can go on to stock valuation. Stock valuation is pretty much the same thing as with bonds, except stocks are different from bonds. But what's the same is that stocks can be basically modeled or valued upon the present value of the future cash flows associated with the stock. Now, some people buy stocks because they expect to receive dividends. If you have that kind of situation, your stock price that someone's willing to pay today is really the present value of all the future dividends for that company. Now, some people purchase stocks for stock price appreciation. They just think the price is going to go up. In other words, what you could sell it for in the future. Now, the stock price is still going to be equal to the present value of the future cash flows. Okay. The present value of future dividends, you would discount the dividends you expect to receive, and then the purchaser would be valuing the stock at the present value of the future cash flows at that point in time. So it's still the present value of the future cash flows. Now we have what we call the constant growth model, and we can model or value the stock. Remember, it's the present value. We can simplify it to some degree, and that's equal to the dividends received 1 year from now divided by the required rate of return minus the growth rate. So let's look at an example I have there in the viewer's guide using the growth model for Dixon Company. It says Dixon is deciding what price to pay for 1 share of IMB common stock. IMB paid a dividend of $2 per share this year. Dixon anticipates IMB dividends to grow at a constant rate of 6% and desires to earn a rate of return of 8%. At what price should Dixon buy the shares of IMB stock? What we want to do there, remember, we want the dividends 1 year from now, D sub 1. We've got the dividends this year is $2. If dividends are expected to grow at a rate of 6% per year, then the dividend 1 year from now will be $2 times 1.06, $2.12. We want to divide that by the difference between the required rate of return, in this case 8%, and the growth rate, 6%. The difference, 8 minus 6, gives you 2%. We're going to take the $2.12, divide it by 2%. This stock would sell for $106. So Dixon would be willing to buy this stock if it was selling for either $106 or less, because the way Dixon's valuing it, their expectations of future dividends causes them to believe that the price is worth, or stock is worth, $106. Now, what if Dixon expected 0 growth in dividends? How much would this sell for? Well, if there's no growth in dividends, then the dividend next year will still be $2. And we take the required rate of return of 8%, we'll be subtracting 0, so it's 8% in the denominator. We'll have $2 divided by 8%, and in that case, the stock is only going to sell for $25. Dixon would only pay $25 for it, which is a very big difference. So the fact that companies expect dividends to grow is going to cause a really big factor there in computing the price of stock. If there's no growth in the dividends, then the stock price is going to be much lower than if you expected growth in dividends. What I'd like to talk about now is decision models, the various models and techniques that we use for evaluating projects. The first is the payback period. The payback period simply represents the amount of time that it takes for a project to pay itself off. In other words, it's the number of years for the cumulative net after-tax cash flows from the project to equal its initial cash outlay. And this payback period has several advantages over the others. One is it's very simple. It's also based on cash flows. It provides a measure of project liquidity, and it provides a measure of risk. So it's simple, it's based on cash flows, provides a measure of liquidity, and it provides a measure of risk. The longer the time for the payback period, then the greater the risk. In terms of disadvantages, the payback period is not really a true measure of profitability, and it ignores the cash flows after the payback period. So once they determine that the project is paid back, then all those future cash flows associated with the project are totally ignored. It also ignores the time value of money. Now, if you look in your viewer's guide, I have an example there relating to the major corporation. And major corporation is considering purchasing a new machine. It'll cost them $5,000 and have an estimated life of 5 years and no salvage value. And the estimated after-tax cash flow is $2,000 a year for 5 years. Major uses the straight line method of depreciation, has an incremental borrowing rate of 10%, and then they provide us with present value factors, which of course we're not going to need because the payback method doesn't utilize time value of money. Okay, so they were just throwing that stuff in and throw you off. It says using the payback method, how many years will it take to pay back Major's initial investment in the machine? So what we have to do, use the payback method, is divide that initial investment, which was $5,000, by the annual after-tax cash flows, which is $2,000, and that's going to give us a payback of 2.5 years. The next decision-making model I want to talk about is the accounting rate of return. Now, the accounting rate of return is equal to the average annual net income divided by average investment in the project. The great thing about this accounting rate of return is that accountants understand it. It's very easily understood. However, since it uses accrual numbers, which accountants understand, and not cash flows, it's not as good as the cash flow-based methods of making decisions. It also ignores the time value of money. Again, in the viewer's guide, if you look at example number 7, dealing with TAM Company, it says that TAM Company is negotiating the purchase of equipment that would cost $100,000, and they have expectations that $20,000 a year would be saved in after-tax cash cost if they were to acquire the equipment. Now, the estimated useful life is 10 years with no salvage value, and it would be depreciated by the straight line method. Now, TAM's predetermined minimum desired rate of return is 12%, and we're asked to compute the accrual accounting rate of return based on the initial investment. Now, to compute this accounting rate of return based on the initial investment, what we need to do is divide the average net income related to that investment by the initial investment. Well, the average net income is $20,000 per year in after-tax cash cost savings. But remember, they also have depreciation. Since we're using accrual numbers, we have to subtract out the depreciation. The cash cost savings didn't calculate the depreciation. So we're going to subtract the depreciation of $10,000. We'll get $10,000 of average net income divided by the initial investment of $100,000, and that's going to give us a 10% rate of return. The next method is the internal rate of return. Now, the internal rate of return is the rate of discount that will equate the present value of net cash flows of a project with the present value of the net investment. Now, in this situation, our assumptions are that the internal rate of return is going to assume that the cash flows are reinvested at that internal rate of return. In terms of advantages, the internal rate of return will take into consideration the time value of money. Obviously, it uses cash flows. And in the process, we're basically estimating the project's rate of return. Now, in terms of disadvantages, the internal rate of return is more difficult to use. And the cash flows are assumed to be reinvested at a rate earned by the project, as opposed to the normal rate of return on our investments. Well, let's look at question number 40 together. Question number 40 again deals with TAM. TAM Company is negotiating for the purchase of that equipment that would cost $100,000, expecting after-tax cash flows of $20,000. We know its life of 10 years and no salvage value, and we used straight line depreciation. It says that TAM's predetermined minimum desired rate of return is 12%. And then they give us discount factors for the present value of an annuity of $1 at 12% for 10 periods, 5.65. They give the present value of a single sum for 10 periods at 12% is 0.322. And we're to estimate the internal rate of return that the factors, in estimating the internal rate of return, The factors in the table of present values of an annuity should be taken from the columns closest to what number? Okay, so we're sort of working sort of backwards here. We're trying to figure out where in the tables we should be looking. Now remember that the internal rate of return is the rate of discount that equates the present value of the net cash flows of the project with the present value of the net investment. So what is the present value of the net investment? Well, that's $100,000. That occurs right now at time zero. Remember, the present value of anything today is itself. Now, the net cash flows, there would be savings of $20,000 per year after tax, and that would represent an annuity. So what we have there is $20,000, the annuity, times the present value annuity factor for I, and 10 periods is equal to $100,000. Remember, we're equating the two. And so we solve for the unknown. The present value factor that we're going to be looking for is 5. It's the 100,000 divided by the $20,000, and the answer to number 40 is C. The next method that we need to talk about is the net present value method. And what we do in the net present value method is we take the present value of the future cash flows from a project and we subtract out the project's net investment. Okay. Now the rule here is that if net present value is greater than 0, the method is acceptable. What that means is you're earning your desired rate of return. The advantage of this method is that it considers the time value of time value of money, but on the other hand, it's not very easily understood. A lot of people have difficulty with understanding the time value of money concept. Now, the assumption under the net present value method is that the cash flows over the project's life are reinvested at K, the required rate of return. Now, there is some relationship between the net present value of the internal rate of return. Many times, they'll give you the same responses. In other words, what we need to do is decide when would we use one method over the other if they disagree. And if they disagree, we're going to use the net present value method. That method is preferred. Now, in general, if the net present value is greater than 0, then the internal rate of return, if you were to use that method, would give you a rate that is greater than the required rate of return. And if the net present value is less than 0, then the internal rate of return is less than the required rate of return. Let's look at example number 8 in your viewer's guide. Helm Foundation is a tax-exempt organization. They invest $400,000 in a 5-year project. Helm estimates that the annual cash savings will amount to $130,000. Now, the $400,000 of assets will be depreciated over their 5-year life on a straight-line basis, $80,000 a year. For investments of this type, Helm's desired rate of return is 12%. And the information regarding present value factors is given, and they give you factors at 12%, 14%, and 16%. Remember, what percentage do we want to use in present value calculations? It's usually the market rate, the desired rate. Okay, in this case, we're talking about Helm's desired rate, 12%. So we're interested in the present value factors that use the 12%. What's the net present value of this project? Take the present value of the future cash inflows. Remember, every year they're expecting after-tax cash savings, $130,000. We're going to multiply that by the present value of an annuity factor for 5 periods at 12%, the 3.6. That will give us $468,000. We'll subtract out the net initial investment. Remember, that occurs right now, so the present value of that is $400,000. So the net present value would be $68,000. The next method that we need to discuss is the profitability index, which is very similar to the net present value method. The profitability index is the ratio of the present value of the future cash flows over the life of the project to its net investment. So basically, it's the same thing as net present value, but in a different form. And the rule here is, if we have a profitability index that is greater than 0, the project is acceptable. That means we're earning our desired rate of return. Advantage of this method, like the net present value method, is that it considers the time value of money, and it assumes, like the net present value method did, that the cash flows are reinvested at K, the required rate of return. So if we have a net present value situation which is greater than 0 and we accept the project, what's the situation with the profitability index? The profitability index would be greater than 1. Under the net present value method, if NPV, the net present value, was 0, we would be indifferent. We would be earning exactly the desired rate of return. So how does that equate with the profitability index? Well, profitability index in that same condition would be equal to 1. If the profitability index is less than 1, that's similar to when the net present value is less than 0, we would reject the project because we're not earning the desired rate of return. Return on investment is another method that companies can use to evaluate a project. I've given you a couple of formulas there in your viewer's guide. Return on investment is generally considered to be equal to net income divided by average total assets. But some people break that formula down into two parts, into margin and turnover. Margin is net income divided by sales, and the turnover is sales divided by average assets. And you'll notice that if you multiply those out, the sales in the denominator for the margin would cancel out with the sales in the turnover, giving you the net income divided by average total assets. Let's look at example number 9 and see if we can use this or one of these formulas to compute the return on investment. So the following data is pertaining to Beasley Company for 2010. Sales are $500,000. The operating income is $50,000. The capital turnover is 4, and the imputed interest rate is 10%. And we're asked, what is the return on investment? Remember, return on investment is equal to net income divided by average total assets. We know net income is $50,000 here, the operating income, but we don't know what average total assets are, so we can't quite yet answer the question. Well, we do know turnover is equal to 4. Remember, the formula for turnover is sales divided by average total assets. Well, we can use that formula and compute with the average total assets. So filling in what we know, 4 is equal to the sales divided by average total assets, where the sales are $500,000. The average total assets would be equal to $125,000. Now we can go back to our ROI computation and fill in the average total assets of $125,000, dividing it into the net income of $50,000, and our return on investment would be 40%. Now we also could have computed the ROI using the equation that breaks it down into margin and turnover. Remember, ROI is equal to margin times turnover. Margin being net income divided by sales. Net income was $50,000 and sales was $500,000. There's your 10%. And we multiply that by the turnover, which is sales divided by total assets. Well, we don't know sales and total assets, but we know the turnover was 4. And so we get 10% times 4 gives us 40%. Next, I want to talk about residual income. Now, residual income is another method for evaluating projects. And what we do under residual income is we take our operating income, what we're earning, and we would subtract out a desired return on our investments and on our average assets. That's I times the average assets. Let's look at example number 10 and illustrate this. Again, we have Beasley Company and the sales, the operating income, and the turnover. Now, residual income is equal to operating income. We know that's $50,000. And we would subtract out the desired rate of return on our investment. Well, that's 10% is our interest rate times our average total assets. And remember, we computed average total assets previously. That was $125,000. So 10% times $125,000 would be $12,500. Subtract that from the $50,000 of operating income, and you'll get $37,500 of residual income. What I'd like for you to do is to stop your tape and try some questions on your own. I'd like for you to look at questions numbers 41 through 45, get your answers, and come back, and we'll go over them together. Welcome back. Let's go through these questions together. Number 41 says, which of the following capital budgeting techniques implicitly assumes that the cash flows are reinvested at the company's minimum required rate of return? Remember what we said about net present value. We said that net present value method, we do assume that the cash flows are reinvested at the minimum required rate of return. So the answer under that column would be yes. Now, internal rate of return, we said that the cash flows would be reinvested at the project's internal rate of return. That's not the required rate of return necessarily, so the answer there would be no. The answer to number 41 is letter B. Number 42 says a proposed project has an expected economic life of 8 years. In the calculation of the net present value of the proposed project, salvage value would be A, excluded from the calculation of net present value. No, we would include it. Remember, salvage value is a cash flow, and under net present value, you want to take the present value of all the cash flows associated with that project. B, is it included as a cash inflow at the future amount of the estimated salvage value? No, not at the future amount. We want to take present value. That's why it's called net present value. Letter C, included as a cash inflow at the estimated salvage value. No, that would be as if it was received today, the present value of itself, and that's not the case. Salvage value is in the future. So the answer must be D. Let's check it. D says included as a cash inflow at the present value of the estimated salvage value. That is correct. The answer to number 42 is letter D. Now, number 43 deals with new company. New is considering a purchase of an investment that has a positive net present value based on new's 12% hurdle rate. Now, what does that mean? Net present value means that that company, that project is going to generate a return greater than the minimum, which is 12%. So it's going to be greater than 12%. And we said when the net present value is positive, that the internal rate of return would be also earning more than the 12%. So the answer is C, greater than 12%. In number 44, it says which of the following characteristics represent an advantage of the internal rate of return technique over the accounting rate of return technique? Number 1, recognition of the project salvage value. I don't remember any advantage there. I don't think 1 is correct. 2, it says emphasis on cash flows. Well, that's true because the internal rate of return does emphasize cash flows, and the accounting rate of return is based upon accrual numbers, so 2 is appropriate. 3 says recognition of the time value of money. Yes, the internal rate of return does use the time value of money. Accounting rate of return does not, so that is an advantage. So 2 and 3 are both correct. That would be letter C. So the answer to number 44 is letter C, numbers 2 and 3. Number 45 deals with PAIR Company. PAIR is reviewing the following data relating to an energy-saving investment proposal. Cost $50,000, expects a residual value of $10,000 at the end of 5 years. And we have some present value factors. This is what would be the annual savings needed to make the investment realize a 12% yield. Well, what we're doing there is equating the present value of the net investment and the present value of the future net cash inflows. This is an internal rate of return kind of question. Well, the present value of the initial cost, $50,000, is itself $50,000. Now we have that salvage value of $10,000 being received 5 years in the future. We would need to discount that back. 10,000 times 0.57, the present value factor of a single sum, that's $5,700, 5,700. So the present value of that net investment is $44,300. Remember, we want to, in the internal rate of return, equate the present value of the net cash flows of the project with the annual cost savings, the present value of those. The annual cost savings, we don't know. However, we do know that the cost savings would be over a 5-year period at the 12% discount rate. So we know that we use the factor of 3.6. We need to equate the $44,300 present value of the net investment with the annual cost savings, the present value of that, which we don't know the annual savings. That's X times 3.6. All we have to do is solve for the X. We get $12,306, and the answer to number 45 is letter C. Well, that wraps up our discussion here of financial management. And I'd like to encourage you, as always, to do as many questions as you can. Have a complete study program and get that plan, stick to it, have a very positive attitude that you're going to pass this exam. And from all of us here at BISC, I'd like to wish you the best of luck.